pauses. How is discretionary spending and the environment today versus, say, 3 months, 6 months ago?
Rima, same question we answered last year also. The way tech budgets are finalized for the year has gone through a dramatic shift. Most of our customers are taking a quarterly call based on the opportunities that are in front of them, and it's more the ROI based approach. And gone are the days where the year budget for the whole year is fixed. So, our second point is this macroeconomic uncertainty. I think people are also getting used to it. They are now coming to realize that this is going to continue, and they need to play within this, and they cannot be pausing the budget permanently. So the approach is, as I said, more ROI based approach. Look at a program or a project. When is it going to yield the result? Is the ROI quick, or is it going to take 5 years?
So there's no change in the last 3-6 months.
No.
Will FY26 international revenue be better than FY25 as you had guided earlier?
We are trying. We are trying all our. We definitely have a high ask rate on Q4 to achieve that.
What's the ask rate, if I may ask?
It will be upwards of about 3 to 3.5%, I think. Okay, so it's a high ask rate. We are doing our best to see how. See, as I said, there is a improvement in Q2. That same improvement in demand environment continued in Q3, but Q3 happened to be a furlough quarter. So we are doing everything possible to ensure that we stay above FY25, but we'll make all the attempts.
Okay. Are the AI-led revenues, I mean, the street was very excited when in the analyst meet you quantified the AI revenues for the first time. At that time, it was $1.5 billion in annualized revenues. Now it stands at $1.8 billion. Can this run rate sustain this 15-20% quarter-on-quarter growth? And where can it lead to? Today, AI-led revenues is still single digits, a little more than mid-single digits to your overall. I mean, give us some sort of an immediate goal, say 1 year down the line. What could that number look like? And what does it tell you about the rest of the business? Because that seems to be degrowing then, if this is the primary driver.
See, when you look at the spend on AI across industries, right? Every industry, customers are really looking at how they can deliver value with AI. And so if I, look at the last 3 quarters, every quarter, right, our incremental revenues on AI is just getting better, right? And when we met on the analyst day, December 17, the number we reported was 1.5 billion annualized, and now we are at 1.8. So I think the traction on AI is at a smaller base, but it's growing extremely well. And I see that continuing, because I think the more you see the value from the AI initiatives, customers are now expanding and scaling those initiatives across the portfolio. So I wouldn't want to put a number on it right now, but you'll see quarter on quarter. Now that we are reporting the numbers, you'll see the annualized revenues definitely gaining momentum.
What about pricing on some of these deals, Kriti? I mean, we've talked about this earlier as well.
Overall, new age services, the pricing is much better, and we are not seeing any pricing deflation in this quarter.
Nothing. So they're not. I mean, even compared to say 3 or 5 years ago. I mean, is there when you enter talks for deals, pricing, etc. There's no
pricing, particularly for services like AI. Pricing is not a consideration. The customers are looking at how soon they can realize the value.
And this new age services, which is not just AI, but it includes cloud native programs, cybersecurity, that number was $11 billion in December in the analyst meet. What does it stand at now?
I think it has grown. We are not going to be publishing that number because we never published the service line numbers before. We made an exception because we made a commitment that we'll be world's largest AI-led service company. So we thought we'll start publishing the AI service, AI revenue. But it's growing. It's growing, but as you are asking, the challenge is to ensure that if there is a slowdown in traditional services, how do we ensure? In fact, even traditional services need AI nowadays. So how do you use AI to spur the growth in traditional services is what we are looking at, and how do you ensure that one doesn't cannibalize the other.
The BSNL phase 2 order was expected in Q4. I mean, what is the timeline?
See, we have got the, as we told before, we got the advanced PO.
You've got the PO, yeah.
We don't have the actual PO to proceed with the work. We are also waiting for the government to issue the PO.
And what would be the contribution of the acquisitions in Q4? List Engage, and that's a smaller one, but Coastal Cloud and together?
See, together, I'm just give me a minute. Like together, both. See, List Engage will be less than 10 bips.
Correct.
Okay, this would be in the range of between 40 and 50 bips on a quarterly basis.
So 50 to 60 bips in terms of inorganic contribution.
Yeah, but this is already like List Engage is already taken on a quarterly basis. So what we should expect is about 40 to 50 bips. And
will we see something large, transformational in 2026 in terms of M&A, Kriti? Or is it going to be more tuck-in, smaller acquisitions to fill those white spaces that you referred to?
We are not ruling anything out. Okay, we are looking at a broad spectrum of but it's essentially it has to fit into a larger play. Okay, we are not going to be acquiring for the sake of just the revenue or top line. Okay, we'll be acquiring where we see there's a greater synergy, and where we are able to deliver greater value to our customers. There could be something larger if it's applicable.
By the end of 2026, you would have made in 2026 how many acquisitions? I mean,
no, I don't know. I don't want to
more
take
than
it.
three, less than six.
I don't want to take a target on acquisitions. Acquisitions is, as you see, like it will be more opportunistic. We see what is the value and do it as long as they fit into our larger playbook.
Would you be open to taking small minority positions in some of these areas in companies?
The adjacencies, which is
we have looked at it, taking minority positions. Again, it has to make it. Again, we are not against it. We do look at certain options, but we also see, does it produce value for us? By taking the minority stake, what is the value we get, and what is the value we are able to give it to our other shareholders? If it's strengthen the partnership that we can, or if we can take them to a larger set of our customers and able to scale that partnership. So if that kind of synergy is there, we'll definitely look at that.
We also caught up with TCS CFO Samir Sikseria and Vice President CHRO Sudeep Kunumal to decode the quarter gone by, understand the impact of the new labour code and how it will affect the cost structure going forward, and the data centre investments too. Listen in.
We'll be setting up a 1 gigawatt data center over a period of 5 to 7 years. And we will be setting up in the capacity of about 150 to 200 megawatts and linked to specific anchor customers. The investments which we have announced is TPG is come in as a partner. We have set up a separate subsidiary for that, and 1 billion investment is from them, and 1 billion would be from us, and the rest would be debt levered. The capex would then be, made basis how the requirements of the anchor customer would be in terms of capacity, but typically that's the overall.
In terms of return profile, etc., on the business, do you have now a little more clarity? What should we expect?
As we said, we would expect an IRR of in the mid-teens to high teens.
Okay.
Sudeep, can you explain the new labour codes and what was the reason behind this 2,000 crore plus one-time expense? Is it one time? Is it for past? And going forward, does it change the overall cost structure of the company?
So, as you know, the labour code came into effect November 21st, and the draft rules have been just published, so there's still clarity emerging and so forth. But as part of our advice that we have been receiving from our advisors, what we have done is for the retrospective predominantly, which is gratuity and leave that we carry in our books, we have made understanding of the law, and we have made a certain provision to it. And there will be significantly a small impact going forward as well, but that is not material enough. But obviously all these things are conditional to what is the final rules that gets formalized and how it is going to be getting implemented.
So going forward, there will be a slight increase in the overall.
Very significant.
How much?
Yes.
Have you?
Very insignificant.
Very insignificant.
Yes.
So that would approximately?
We're not going to quantify it because, as I said, all these things are based on the current understanding, and then what the rules actually come in, and then how we are going to be being fully compliant to the
One more
rules.
question on that legal claim. It was at CESC case, $194 million, the IP infringement. Now, you've taken a hit of 1,000 crore approximately. Is there going to be more, or is there a possibility that even this 1,000 crore gets reversed?
So this is on account of an adverse judgment which we received, and we had called it out through a press release. We have taken an impact on the P&L of 150 million, and there is a contingent liability of 60 million. We plan to challenge that, but basis the judgment from the circuit court, we have taken this provision.
Okay, so going forward, there's a possibility there'll be an additional hit of $60 million?
It could go either ways because we are going to challenge it.
Let me just come to M&A a little bit. Very large acquisitions in the quarter, and we discussed that with Kriti and Aarti earlier. And I was asking her whether 2026 will see more acquisitions, and they didn't give us specifics, but they said, well, they're always looking. So just wanted your thoughts, Sameer. I mean, is there an active discussion within how much, I mean, how do you think about, so one perspective has been that, well, the Coastal Cloud acquisition is a little on the pricier side compared to what you've paid for acquisitions in the past. Just wanted your thoughts.
So overall, we called out our 5-pillar strategy in terms of our AI readiness and what vision, bold vision we have set for ourselves. And one of the pillars is in terms of new horizons, which you talked about.
Sure.
And we have clearly called out, we are stepping up our pedal on the M&A side of it. We have seen a couple of them. It's not that we did not used to look for right opportunities and right targets. We have stepped up the pace at it. And there are active considerations. There's a pipeline. There's a specific team which is...
This margins, 25.2%. Can you break it up? The benefit on account of currency, the negative impact because of wages?
So 25.2 stable margins over the previous quarter. If you look at it, we got 80 basis points benefit from productivity, pyramid optimization, and operational efficiencies, and a further 20 basis points benefit from currency. This was offset by full quarter wage impact for the wage increases which were given from 1st of September. That was 50 basis points, and further 50 basis points was impact on account of investments in partnerships and brand initiatives.
Sudeep, the overall headcount went down by 20,000 in Q2 and now an incremental 10,000 plus. In 2 quarters, that's 5% of your overall headcount. How much of that is voluntary attrition? How much of it is on account of restructuring? And going forward, what should we expect on headcount?
So on the headcount perspective, if you really look at it, we have been hiring and we still need great talent, and both from the market as well from the university. So this time we've hired close to 16,000 people in the current quarter. And so that's the hiring that we have done. And extensive investment in talent building. I'm not sure if you've seen this. Actually, Everest Peak Matrix ranked TCS as the industry leader in future skills, specifically in AI, ML, and data services. Our training, deep skill AI and ML actually increased 3 times. So we have close to 217,000 employees today who are deep skilled and all that. So all those investments and building talent continues to do. As part of the exercise that we had announced earlier by our CEO, this quarter we had approximately 1,800 people who were impacted by part of the exercise. But again, like always we said, we did it with a lot of care, respect.
All right. Well, that's the TCS top management team talking to us about the earnings and, of course, the outlook going forward. Well, we'll take a quick commercial break here. We connect with Sudarshan Sukhani on technical trades. Mitesh Thakkar will also be with us with trading ideas. Stay tuned. Coming up.
Welcome back. Yesterday, markets recovered nearly 300 points from the day's low to close up 100 points. The question is, will we see follow-on buying today? Yesterday, Sergey Gore provided the trigger, but we need to see that momentum continue on the upside. The GIFT Nifty for now is suggesting a quietly positive start. Sudarshan Sukhani is joining in, and Mitesh Thakkar as always to set us up for today's trade technically. Gentlemen, good morning. Thank you very much for joining in. Lots of news flow tugging us in different directions. But Sudarshan, go first. Do we see, is there a buying opportunity? Do you see the momentum continue?
Yeah, good morning. Well, it just took 2 hours for the markets to turn around. And that's too short a period to say that the trend has changed. We were breaking down. We almost reached that 25,400 level yesterday. And it's good that we have seen a rally, but does not justify a buying, idea today. We are still below the 50-day moving average. That's roughly around 25,970 approximately. And that's the area, the bulls live above that level. So let the Nifty cross that level, let it settle down there, and then we'll have many opportunities. So today I would say we'll just wait and find out what the market wants to do. I would not take any trade.
Wait and watch. Too soon to say if the trend is reversed. Mitesh?
Good morning, Nima. I have a very similar kind of outlook. While there are no signs of trend reversal, I think what we can possibly look at is a bounce back from support levels close to about 25,400, and the upside level also matches with Sudarshan. I think 25,950, 26,000 zone, which has the 50-day average, also the 21-day exponential average. So I think around those levels is where, if this bounce back can get past those levels, close above that, then I think we'll look at a proper reversal on the upside. Otherwise, it will remain a bounce back.
Stocks, Mitesh?
For the day, I have 3 buys and 1 sell. JSW Steel is a buy with a stop at 11.59 for targets of 12.25. Alchem Labs is a buy with a stop below 5,800. Here, I would look for a target of around 6,000. A buy on Apollo Hospital with a stop at 72.29 for a target of 73.50. And Paytm is on the negative side, but not at the current price, about 10-15 rupees higher from here. So try to sell around 12.80. Keep a stop at 13.05. Look for targets of 12.30.
All right. Let's get into Sudarshan's picks as well.
Well, it's a mix. Vedant is a buy with a VDL. It's a buy with a stop under 615. Ashok Leyland is a buy with a stop under 185. M&M is an intraday short, stop above 37.50, and Fortis is another short with a stop above 910. Generally, in this market, I have a view which is not with these not directly connected with the stocks we talk, but metals as a theme seems to be upbeat, and traders or investors may consider buying metal ETFs. I own some of them.
Okay, all right. No, absolutely. Done phenomenally well. Thanks very much, Sudarshan and Mitesh, for joining us with those. We take a quick commercial break here. We're going to come back in just a bit. But just a quick reminder, later today evening, we're going to be discussing hardcore markets. There's, of course, also the budget, which is 15 days away. So the road ahead for markets in the economy is the CNBC-TV18 Market Forum. And you've got some of the best minds joining us. So Manish Chokhani, Ramdev Agarwal will be talking about markets top-down. Then Ramdev Agarwal and AU Small Finance Bank management sit down and talk about, of course, the financial services journey and how to sort of identify winners there. We've got a market panel with Sandeep Tandon, Tahir Badshah, Nilesh Surana joining in terms of how to create alpha this year. A budget, what should it and what will it hold? Neelkant Mishra, Sajid Shenoy, Gautam Chachoria join in. That's the lineup that you will see later today evening, starting 4:30 p.m. Welcome back. There's 14 minutes to go for the pre-open session, which means we are 1 minute into the 40 minutes to the market open, and we're 1 minute into the pre-open session. The Nifty up on your screen, it'll settle down. We've, I mean, it'd be great if we get a 150-point uptick, but I reckon not. We'll see. 90.25 is the rupee open, 90.15 was the close yesterday. Well, the newly appointed U.S. ambassador to India, Sergio Gore, said yesterday that the next call on the trade deal will take place today, but there is no confirmation from the Indian side. Let's go across to Parikshit, who gets us this story. Parikshit.
U.S. Ambassador designate to India Sergio Gore has said that United States is determined to get a trade deal done with India, and the next round of talks is going to take place on Tuesday this week. We've been told by sources that no formal talks are scheduled between Indian and U.S. officials on trade for that matter. Whether the United States reaches out to the Indian government now or Sergio Gore seeks to meet officials in the Commerce Ministry or the Ministry of External Affairs, that remains to be seen. And if that request were to come, the Indian officials would be more than happy to meet him or speak to officials in the US government. But for the moment, there is no formal talks scheduled between India and the United States. From our side, in December, Indian officials had said that we've already proposed a trade deal to the US. The negotiations are over from our side, and Donald Trump has to sign on the dotted line. We continue to wait for that. Indian and US officials continue to remain in touch at multiple levels. There's an air of optimism with Sergio Gore now arriving in New Delhi, somebody who's a part of Trump's inner circle. And there is a hope that with him being in New Delhi, the Indian government will have more access to someone from the US administration, someone close to Donald Trump, and perhaps we would have a trade deal sometime this year.
Parikshit, thank you very much for that. And of course, I mean, that's top of mind, front and center as far as market mind space is concerned. Well, valuations in IPOs are becoming more sensible. We've spent some time consolidating the past returns, but we are not out of the woods yet. That is the word coming in from one of the top fund managers of the country, Chirag Setalvad, who's head of equities at HDFC AMC. I spoke with him. I had the chance to speak with him at the 16th India Investment Conference organized by the CFA Society India. He added that consolidation will continue for some more time. Listen in to some of those comments.
We're so focused on the fact that we've had a terrible 2025, and sentiment follows the market. Rising market, great sentiment; falling market, terrible sentiment. But last 5-year returns are still in their 20s. Last 10-year returns, for the mid-cap index as an example, is 16-17%. Small caps is 14-15%. So we've had a fantastic run for many years. And we've had a 1 year or a 1.5 year consolidation. And in that period of time, we are all scampering and already quite nervous. So I think we have to realize that markets have delivered a fantastic long-term performance, and that's what we're here for. Nifty is at a 10% premium, mid-cap is at a 15-20% premium, small cap is at a 20-25% premium. So you need 15-20% corrections to get you to average. Forget about below average. And the overall environment is, I would say, fairly turbulent, right? Not only geopolitics, which is extremely murky, but even the global growth environment, right? US is growing at 2.5% this year, likely to slow down next year. So I think there is still a lot of question marks. I think it's going to be a toughish year, right? Now, whether we give plus 5, 7, 8, 10% or a little bit minus, but I think as cliche of consolidation will continue for some time until valuations normalize a little bit more. I think the good news is what? The last 3 panels I've been on, everybody is nervous, right? Retail sentiment has changed dramatically. IPOs have also now slowing down, and the valuations of those are also becoming more sensible. So let us put it this way. A year and a half back, we were extremely nervous. And we were saying this is a market you should stay far away from. We've gone from being extremely nervous to a little bit nervous. Are we excited? No. But the good news is, a year and a half ago, if there was a correction, there's nothing to do about it. Now, when you correct, at least you'll correct to reasonable valuations. And if you continue to correct, you'll correct to cheap valuations. So I think we're in a better environment, but we're not out of the woods yet. I mean, clearly things that happen outside of India will have a dramatic impact on us, right? I think we think that we are an India-only economy and it's the India growth story and so on and so forth. But risk appetite is global, money is global. The US is, if I'm not mistaken, 60% of global market cap. As Prashant mentioned, China is 40% of emerging market allocation. So what happens outside of India is incredibly important. And if those markets sneeze and if that economy sneezes, we will certainly get the flu as well. So we are not going to be isolated. So correlation in the long term can be low or lower, but in the short term, correlation is high. And what happens outside of India will be incredibly important. And it is certainly things to be nervous about, right? When you go into Venezuela one day and maybe Greenland the other day, and you've got another 3 years, and there's going to be a lot of news flow in those 3 years. And in the last 3 years, or towards the end of any president's term, things tend to get a lot more volatile. So imagine Trump in a corner, right? When he's not in a corner, he's swinging as hard as he can. Imagine when he's in that corner, how hard he's going to swing. So it's going to be a lot of news flow, it's going to be a lot of volatility, and most people see that as a bad thing. We see that as a fantastic thing. We want markets to be volatile. We want markets to correct every once in a while. You know, we want to create wealth, and the only way to create wealth in a significant fashion is to have volatile markets. You want another crisis. We'd love to have another crisis, right? Because those who invested in COVID, those who invested in the financial crisis, everything, you know, all that money did extremely well. But I think the other thing to keep in mind is this too will pass. When we were going through COVID, we thought the world was coming to an end. Genuine. It was actually unprecedented. When we had the financial crisis, we could not look beyond it. When we had the European crisis, we could not look beyond it. We've forgotten all of those. COVID was only 2 years ago. We will forget this. And there'll be a new set of issues. And hopefully, these set of issues will create an opportunity, and we'll take advantage of it. So I think the key is you got to be long-term, and you got to have that character and that patience to invest. And if you do, you'll do fine.
That point about, I mean, you said you'd love a correction or a crisis, etc. You think we will get one in the next 2 years? Some serious people think we will in a large correction.
Will it happen in the next 2-3 years? I mean,
and I'm not talking about India. I'm talking about, I mean, globally, like an event.
I mean, I wouldn't be sitting here if I knew that answer, right? I wouldn't be working for HDFC. It'd be a multi-billionaire and trillionaire if I knew an answer to that question. But let's put it this way. Crises today are no longer once in several decades, right? We live in more interconnected times. We live in more volatile times. So in my career of 25 years, we've at least had 3 or 4 massive crises. I think that is really unusual, and that will persist going forward. In the earlier generation, you saw one every 20 years. Now you see it once every 10 years. But is that bad news? No, that's fantastic news, right? You want crisis to have, events to take place so that we can hopefully take advantage of it.
Okay, that is Chirag Setalvad, the voice you rarely hear from. He runs money at HDFC AMC. Well, on India-US trade deal, right? I mean, sentiment is really low. And Prashant Khemka, White Oak Capital, weighed in saying that he'd be happy if he get a deal this calendar year. Listen in.
I was hopeful till a couple of months ago, based on all the comments and these things. You know, you like everyone else, you read the tweets from leaders of both countries. It seemed like by March and it should come. But then the most recent comments you hear, you know, if it comes during Trump's tenure, that will be good.
Oh dear.
Yeah.
Oh dear. That is. You're serious? Not.
Well, I think it just most recently, but you never know. Maybe these are both negotiating tactics when you are coming closer to the signing of the deal. At this point in time, from whatever little I know, I'd be happy if it is in this calendar year. It seems less and less likely.
Less and less likely, let's hope. And I think Prashad himself would be hoping that it's sooner rather than later, and we don't have to wait till the next year in that sense. Well, consumer discretionary and IT are Vikas Khemani's pick. So he weighed in terms of where he's focused on in what Chirag described as a toughish year. He's bullish on NBFCs and PSU banks as well. Take a listen.
You have to look at areas where there could be good earnings growth. So I do believe that BFS as a segment, still we have, you know, good legs.
BFSI.
Yeah, as a segment, and especially within that, I guess NBFCs and PSU banks have a good legs to go from this year perspective. I think second, we can see consumer-related play, especially consumer discretionary, can play out really well in this year. Third, which could be surprising, in my opinion, or dark horse would be IT. where I guess you had good order book accretion and execution was getting delayed. That can play out, and with the currency support, I think this year you could see a better earning growth than in the past.
Okay, all right. Well, let's get the 9-10 calls then. Sudarshan joins us to help us out with that. Sudarshan, what's your 9-10 call?
It's Vedant. Buy Vedant with a stop under 615.
Got it. All right. Vedanta is the one that Sudarshan is banking on. Mitesh, what about you?
I would like to go with Alkem for targets of around 6,000.
All right, got that. Let's get to the brokerage call of the day. The other Sudarshan, our in-house Sudarshan, now joins in.
So HSBC has upgraded JSW Infra to hold and target price is increased to 280 rupees per share. It says company is on track to double its EBITDA by FY28 from the level of FY25 and will meet FY30 400 million tons per annum port capacity target with execution offering the comfort. It has trimmed FY26-27 profit estimates but has increased the estimates for FY28. Macquarie maintains outperform call on L&T with a target price of 4,620 per share. It says strong overall prospects pipeline is up 29% year-on-year, and that is led by infra and hydrocarbon orders that company has been receiving, and it expects H2 FY26 to see pickup in the execution, including some extremely large orders that company might bag. CLSA maintains outperform call on HDFC Bank with a target price of 1,200 rupees per share. It says since Q3 operational update, stock price has corrected 6 to 7%, and feedback from investors remains pretty consistent, and deposit growth has moderated with loan deposit ratio has increased to 99%. But CLSA believes that most issues are either misconceived or temporary, and it is time for investors to overlook the noise and buy this great franchise.
Thank you very much for that. Keep your eye on HCL Tech. Could open up in the green on the back of a strong beat in Q3, where the company's top line went up by 0.8% ahead of expectations. Adjusted margins, adjusted for the impact on account of the new labor code. TCS took it below the profit line as an exceptional. HCL Tech has taken it in the employee expenses, but they've given an adjusted margin figure, and at 18.6%, it's ahead of market expectations. But what the street likes is the fact that the services business guidance has also been tweaked on the way up. So earlier the guidance was 4 to 5%. Now it stands at 4.75 to 5.25%, which means it's not just a narrowing of the guidance at the upper end. The services business, the mainstay of the business, has seen an increase in the guidance. And even on the margin front, for this year, they're maintaining the margin guidance at 17 to 18%. But this includes the restructuring costs. The company has been optimizing its facilities. They've been even on the employee front. So there was a one-time impact that the company has been taking every quarter because of restructuring. But if you strip that out, their margins would be closer to 18%. And I think the street expects that margins next year would be closer to 18-19%. That's the margin band they used to operate at. And then they had lowered it last year on account of the uncertainty, etc. So I think the street is hopeful that margin guidance too could be upgraded next year. So all in all, it's a good set of numbers. TCS is largely in line, but the street will watch Infosys, which comes out on Wednesday, post-market hours. So we react only on Friday. Infosys, I think in pre-open, is also moving up.
Okay. All right. Got that, Reba. Well, keep an eye out on some of those companies. Top of mind would be the rice companies. As we had the management of KRBL said, relatively small, but for the industry on the whole, the number was quite large at close to around $850 million. For the time being, KRBL down, I think, only around 1%. The Nifty, though, I will interesting to see whether it can hold on to these gains 100 points higher in pre-open. Prashant?
Absolutely. And I think just a minute to go as far as market open is concerned. 100 points higher on the Nifty, building on yesterday's gains. The Sensex is up about 200 points. 84,080 is where the Sensex is at. First rates on the Nifty, the Sensex will come up in just a bit, and then we'll look at the individual names and how stocks are reacting. What do we have? 880 or so on the Nifty and 84,200 on the Sensex. So those are opening rates. The Sensex is up 0.4%. The small cap index is up 0.4% as well. So you got 2:1 in terms of advances to decline ratio coming up on our screens right now. 66 now on the Nifty and about 288 on the Sensex. It's a much better start as compared to yesterday. Yesterday, of course, was gone till, of course, those comments from Sergio Gore came and the market took a U-turn. Well, the Nifty heat map should come up, give you a quick sense of where we are starting before we go any further. First rates, Eternal, Infosys, HCL on one end. On the other side, you've got Dr. Reddy's, HDFC Life and L&T, which are coming up as some losses. Rima.
Well, HDFC Bank is moving with some strength. Today, there's a CLSA note on HDFC Bank. They say, since the Q3 operational update, the stock has corrected 6 to 7%. They believe that most of the issues are either misconceived or temporary. FY27 is likely to be a bounce back year for the bank. And with the recent correction, the stock is now trading at a discount of 10 to 12% price to book to ICICI Bank. They say it's time for the investors to overlook the noise and buy this great franchise. So HDFC Bank is one of the big movers. Putting the spotlight on the IT names, HCL Tech had a positive start, but gains are now more tempered, just up close to about 0.5%. TCS in also absolutely flat. So no big gains coming through, but there is buying visible in Tech Mahindra and Infosys. Both these names are up nearly 2/3 of a percentage point. ONGC is now the big mover. ONGC is nearly up 1%. Strength seen in Eicher Motors. The rally on Hindalco continues. Since the start of the year, Hindalco is up 4.5%. Avenue Supermart seeing some green to begin trade with. On the way down, softness seen in HDFC Life, Max Healthcare, Tata Steel, Interglobe Aviation, Cipla, Dr. Reddy's. These are some stocks with cuts of nearly about 0.5%.
Well, from the broader markets, plenty of stocks are doing a jig of their own. So let's get a few of them up for you on the screen. JTL, well, that's taken a bit of a break. Yesterday, the stock was up close to 20%. They had won a large order, but the stock was up 20% today. It's seen some kind of pressure, some kind of recovery actually from the lows of the day. So JTL is a stock we keep an eye out on. Embassy Development, that stock is up close to 2%. Volume's quite large on that one. Billion Brains Garage Ventures, that's Grow. That stock, in fact, is up close to around 1%, but volumes are fairly large on that particular name. MRPL, as well as CPCL, both of them saw a big bounce up, but both of them have corrected a fair bit. Now, Q3 numbers could still be pretty strong, so interesting to see what the stocks do from here on. For the time being, MRPL is up close to around 3%, and I think Chennai Petro as well did see a bit of a bounce even in yesterday's trading session. So these stocks, remember, they've corrected close to 20% from the recent peak. GPTL Hathway, well, that stock is bursting away. That reacts to its numbers. That explains why that stock, in fact, is up and about in today's trading session. And another stock, Balu Forge, don't talk about this name very often, but this one, in fact, a few sessions ago, I think it was down close to around 18-20%. That's bounced back, and even in today's trading session, it's up close to around 5% as we speak. Frontline names that are moving up, GMDC has returned back to its winning base. Very volatile stock, had corrected close to 15% from the top. Now it's back to its winning base, up close to around 3%. And Ola as well is making it to the winners list. Well, that stock is up close to around 2%. Net, a positive start. Breadth of the market is heartening. Close to around 6 stocks advancing for one stock that's declining. Prashant.
KPI Green is coming up with some gains, 4% higher. Had a very, very volatile move after the deal was announced. Basically, had a big up move, then a big down move to below from where the price deal was announced, and now it's coming back a little bit. 460 on this one. Angel One is up about 2.33%. There is MRPL, which is coming up with about a 2.5% gain right now. The GVT&D is up 2%. I mean, sold off hard yesterday, and that is coming up with some gains. PVR Inox is up about 2.5%. And so it goes. So, I mean, these are first rates coming up. Very few names are down, and, even lesser with any volume, significant volumes at all. So, nothing very much. L&T is down 1.33%, and it's got some volumes on it. I think there's some information which I think we'll put out with Vivek in just a bit from now. So, that's what's coming through. Manish Gunwani is with us, Head of Equity, Bandhan AMC. Manish, good morning. Great to have you with us here. Thank you very much for joining us. 60 points and a little bit of a rebound and some breathing space, I guess, right? After those comments and the U-turn yesterday. It's been pretty bad to start to 2026, Manish. How are you thinking about markets?
Yeah, Prashant, I think we are in a bit of a very peculiar macro situation right now. The thing is, Indians are buying stocks and gold, which are, in a sense, both imported, which is putting a lot of pressure on balance of payments, which is in turn putting pressure on currency And that pressure on currency is discouraging foreigners to come partially into the stock market. So I think this loop needs to break. It could break by dollar weakening globally. It could weak by a bit of rupee depreciation. But yes, tactically, it does look like we are caught in this loop at this point of time. It's peculiar because actually gold going up improves the balance sheet of India. I mean, we are the biggest owners of gold and silver. So structurally, it should be very positive for India that gold prices go up. But at this point, definitely there is some pressure on the currency, I think, which is discouraging foreigners from buying Indian equities.
Manish, other than the currency issue, which is plaguing foreigner interest in India, is it just the sentiment towards India that is hit? Or do you think fundamentally also, other than the currency issue, there are factors which are keeping investors at bay and keeping our returns in check?
No, there are. One is, of course, we don't have any big AI play. And China, Korea, Taiwan, which are the big weights in emerging market index, they have very big companies in AI. Second is this US-India agreement thing, which increases risk premium for India. It's not a very big impact on the economy, but it definitely increases the risk premium, especially in the perception of foreigners. So yes, there are obviously factors beyond the currency. Earning growth is steady, but nothing exceptional. The point is, last 5 years, Nifty 50 earnings have outperformed nominal GDP. So you can't take a 2-3 year view that earnings will be anything spectacular. So there are a lot of things, but the good part is, as I said, that the macro stability at current account level, the inflation level, the household balance sheet, especially with this rise in very there are positives as well. So we just need to, I think, wait out the storm of this balance of payments being negative, which is actually also transmitting to monetary policy that while we cut rates, the volumes, etc., are not really coming back.
All right. Hi, Manish. Good morning and good to see you in. Manish, I recall last year, you were talking about maybe the small cap index is a good place to be into.
Yeah.
And maybe, in fact, the hope is that the small and the mid caps do better in 2026 because that's what makes portfolios feel good. So when you're allocating fresh money, do you think that, these broader markets are actually providing an opportunity, or do you believe they still have more pain from here on?
Yeah, I mean, we definitely think small cap space is very interesting. And obviously, as prices have corrected both in time and price, let's say versus 1 year back, we're more positive on small cap today. We continue to believe that on a 3-5 year basis, that is the asset class which will outperform because, as I said, for large cap, the issue is if earnings have already outperformed nominal GDP for last 5 years, then the best hope is they will mimic nominal GDP of, let's say, 10-11% over the next 3-5 years. Whereas in small cap, because it's such a wide universe, there's a lot of technology change, there's a lot of geopolitical change, there are different themes you can play. So we do believe that a lot of small caps are incrementally getting into very attractive zone. But as I said, tactically, you need to see a bit of currency stability. We all know that when liquidity gets tight, small caps will not work. And we are in that situation at this point of time where if your balance of payments is negative, obviously liquidity will not be great. So we just need to time our exposure. But beyond a point, you can't predict macro. So we keep buying gradually. We are reducing cash levels in our fund, which were relatively high, let's say 3 or 6 months back. So incrementally, definitely, I think exposure to small cap should go up.
Okay, and what's the current cash levels, Manish? Since you said that you have reduced it relatively, what was it 6 months ago, and currently what are the cash levels?
So this is fact sheet data. The small cap fund, we used to have 14-15% cash level. It is reasonably below that right now.
You're saying, Manish, that you would allocate more towards mid and small caps now. Yes. That's what you're saying, Manish, incrementally.
Yes.
Okay. Many of your colleagues across the industry are doing the opposite, Manish. They're increasing exposure to large caps. I mean, is that... Yeah, sorry, go on.
Look, it's not so much a tactical call. As I said, there are macro challenges for India. But the point is, if I take the universe that is available in small cap, I think the large and mid cap spaces are very restricted. And as I said, their earnings growth tends to mimic nominal GDP growth, which will not be anything great.
No, let me clarify, Manish. Bulk of what I have described, right? And the caveat is, I mean, what you do also what depends on what you've already done in that sense, right? So if somebody has a lot of exposure, then you trim and then go large cap. But the motivation from what I kind of picked up is not so much about capital appreciation, it's capital preservation. Protect NAVs, I mean, that kind of thing. By going into large, I mean, that's the underlying thread I could pick up. Go on, sorry.
I think clearly over the last 15 months, we have seen, as I said, time price correction. Rupee has depreciated. So in dollar terms, we are probably for last 15 months the worst performing market globally. And I agree, next 3 to 6 months, maybe we might get a bit more correction. But I think, and we keep saying that the small cap space, you need to see on a 3 to 5 year basis. And bottom up, I think incrementally you are seeing stocks which can potentially double in the next 3 to 5 years in the small cap space. And that's usually a good return to have. So yeah, timing based on macro is one thing, but macro can change very fast. For example, if the Fed governor comes and cuts 50 bps, then all these liquidity issues will get sorted. So we can't really time macro beyond a point.
Yeah, no, we can't, absolutely, Manish. Would you want to identify, I mean, just for, talk about maybe a situation, a stock where you think, it's becoming obviously very, very attractive, just, I mean, and like at a throwaway valuation, just as an example, Manish.
Yeah, so a lot of the global cyclicals, because they've not been the focus of the market, whether it's metals or shipping. I think the global economy is doing very well. Everyone thought US will go into a recession. That's not happening. China's kind of gone through a massive property deflation coming out of that. And I think the global cyclicals like commodities and shipping, they are cheap versus what assumptions that are being factored into earning estimates. So I think that, for example, is a space that looks where your heads you win, tails you don't lose kind of situation. I think very cheap lenders, price to book 1 or below, that continues to remain an attractive space as well. Because in India, as I said, household balance is pretty okay, growth is pretty okay. So we don't expect any big asset quality issues in lending. I think small tech platforms also are interesting. So there are a host of things that look interesting.
All right, Manish, one sector that you all were bullish on, which you briefly mentioned, was the metal space. And I think the second half of last year were quite bullish. Last quarter as well, you reiterated that stance. From here on, how do you approach it? And how would you play it? Metals have seen a melt up. Gold as well is doing well. You also mentioned about financiers. Would you go the gold financiers route? Do you think the industrial metals have more to go from here on? And within that, what would it be? Ferrous and non-ferrous. Give us some color with regard to that metals play.
Okay, the drivers are different, but I think all are interesting spaces. I think gold finances are a bit expensive right now because I think all lenders can do gold finance if it's attractive, but beyond a point. But I think precious metals obviously a trade on global liquidity. And I continue to believe that the debasement of paper currencies will keep happening. I think industrial metals also look interesting. I think non-ferrous is different from ferrous. I think non-ferrous is more about China and Europe doing fiscal stimulus, coming back. US continues to remain resilient. With protectionism, every country is doing capex, whether it's defense or semiconductors. The demand seems okay. Industrial metal stocks have run up, but maybe there's still some space to go. I think the ferrous space is a bit dependent on this anti-involution thing with China and also the Chinese currency, right? I mean, I think some part of your portfolio has to be positioned for extended dollar decline versus yuan, because both the hard numbers of current account and all, and the narrative about China now seeming to come out of this trade war pretty strongly. You could see yuan at 7, from 7 going to 6 or 5 over a period of time. Some part of a portfolio, which is probably steel, is the best on that. So I think a ferrous is a bit more dependent on what China wants to do in terms of capacity rationalization or how they want to handle the currency. The non-ferrous part is, I think, a bit more clear.
Absolutely. Interesting views there, Manish. It's always good to get that perspective and interesting conversation. We'll follow up on some of this in our next one. Thank you very much for joining us this morning here on CNBC-TV18. Okay, well, L&T is what we want to talk about, and there are news reports in global media suggesting that there could be some orders at risk from the Middle East. Vivek has got more details. Vivek, take it away.
Well, that's right. So L&T is in focus, like we've been highlighting. What actually transpired is that MEED, which is a Middle Eastern news publication, that has reported over the last couple of days that large orders, this is in the country of Kuwait, and Kuwait has started discussing cancellation of oil project tenders worth over $8.7 billion. Now, as per analysts and as per some of the data that we called out from both news reports as well as some of the order inflow announcements that the company has put out, we understand that from Kuwait itself, L&T in this particular order project pipeline, remember these are almost 6 to 7 large oil upstream projects, we understand that L&T was L1 or was favorably placed to win orders worth over $4.5 billion. So now this comes as a bit of a negative surprise, given the fact that the reason cited in the article for the likely cancellation of these orders is the fact that the order bids came in above what the Kuwait government or the Kuwait authority was actually anticipating. So this leads to a risk that there could be a sizing down, number one, of the order inflow, and number two, there could also be a cancellation of the order themselves. Now, early morning today, we've reached out to L&T as well. We are still waiting for a comment, but at this point of time, it's a slight negative development, and especially given the fact that L&T has been banking on the Middle East for further order inflows.
Thank you very much for that. On the flip side, Eternal is a big mover. Stock has surged close to about 3.5% now as we speak. So keep your eye on that. Very large volume, lots of buying seen there. And HCL Tech and TCS opened up mildly higher, turned flat, and now decisively lower. HCL Tech 1.5% gone. TCS up. TCS also down nearly about 0.6%. Remember, these are stocks which, like HCL Tech, for instance, went up 12-13% in the last 3 months. So tactically, people maybe have turned bullish after the recent underperformance. So some of those gains may be getting paired off. But let's talk about the new labor codes, because in TCS and HCL Tech's numbers, both the companies had to take a one-time impact, and quite sharp. In the case of TCS, it was more than 2,000 crore on the back of the new labor code. The Institute of Chartered Accountancy had directed companies that they must account for the impact of the new labor codes from Q3, so that's starting to play out. Sonal joins in with the details. Sonal.
Well, yes, ICICI had notified and asked all the companies to account for the impact of labor laws starting Q3 itself. And so this is something which is not a surprise and was expected by the markets generally as well. They issued FAQs on key accounting implications arising from labor costs. And they said that 21st November is the date from which labor laws will be applicable. Still, there's more clarity required for different states. So gratuity pay, which is a 15-day pay for every year worked, paid at the time of employee leaving the organization, and leave encashment based basically the accumulated leaves which are paid to the employees at the time of leaving. These have to be considered in the corporate pay structure. Now remember, salary structures are usually structured in a way that cash in hand is more, right? And now the new definition says that 50% of the total pay must be basic pay, and so far most of the industries must be keeping the basic pay between 35 to 40%. This is as per Jefferies, which is basically 2/3 of the companies in the industry were doing that. So for compliance with the laws, a lot of these companies have changed the salary structure, and this would mean that they will have to raise the total compensation by 3 to 5% in order to keep cash in hand at similar levels as before. And around 45% of the banking and finance companies are expecting the impact to be more than 5%. Some of the other companies would expect it to be between 3 to 5%. But considering all the mitigation factors as well, Jefferies is of the view that total pay hike due to labor costs will be around 2%, and that is not as big as the street was fearing in general. According to them, the key stocks which could be impacted will be the ones which have higher India employee cost to the profit before tax ratio. There could be some recurring impact for some companies, and some of them would take a one-time hit on their P&L. These companies would include the capital goods company, BHEL, Afcons, L&T, retail, which have higher employees at the store as well, Jubilant, Nykaa, Eternal, IT companies, of course, you spoke about it earlier, pharma companies as well, and banks themselves have a higher proportion of employees which are paid. So these are some of the sectors and companies which could be impacted.
Thank you very much for that. We have with us Balasubramaniam, a Senior Vice President, Team Lead Services, now joining in. Mr. Subramaniam, you want to, in a way, quantify the impact. And is this a big hit for the companies? This retrospectively, it's one time, but going ahead, is their annual recurring employee cost bill going to go up?
Hi, morning. Thank you so much for having me. As we speak, we are in the process of implementing the labor codes for all of our customers as well, and we have over 3,000 customers on a base of 3.5 lakh contract staff. And yes, the impact of the labor codes are such that there is unification and simplification of various non-CTC components, such as if you look at PF, ESI, statutory bonus, your gratuity, leave encashment, and all of these things have a unified and singular definition of what wages are. Because unfortunately, until before the labor codes, wages, the interpretation of wages was subjective. And now it's become just unified to one number, which is your total remuneration, which is your CTC. And because of the simplification, what ends up happening is that especially at the entry level, the cost of compliance, that is the PF components, and even the ESI bracket, that is the coverage of people under ESI, has gone up significantly. I'll just give you an example. If you look at how things were before the labor codes were implemented, up to 21,000 rupees of gross wages was the maximum limit under which a person would be covered under ESI. If you look at the entry level hiring in most formal jobs today, the salary should be just about 21,000, but below 42,000. But now they have made it 50% of total wages, which means whoever is even at 42,000 rupees of salary would still come under the ESI bracket. So ESI contribution is now an additional cost that companies have to bear in order to maintain the cash in hand or the net take home constant. So that's an additional cost. And apart from that, because the wages definition has been standardized now, the provident fund contribution has also gone up. But then when we did this calculation for, let me take the example of one large company for whom we implemented it very recently, on a base of 10,000 people, for about 4,000 people or so, the net take home actually went up. And for another 4,000 people, it actually went down, marginally though, right? Very, very marginally, but the overall CTC actually remained constant or slightly went up. So the cost may go up marginally, but then this is something that can be consumed within one increment cycle itself. So it's about making sure that this is absorbed within one increment cycle. Typically, companies pay out anywhere between 7 to 12% as annual increments, and it can be consumed well within that, and then we move on. So it gets regularized in just 1 year.
All right, let's get in Mr. Raghuvanshi as well into the conversation. Mr. Raghuvanshi, what do you make of these changes and the potential impact on companies?
Yeah, good morning, everyone. I think, the issue is that at one end, we are trying to, work on the ease of doing business, and codifying this new labor law is a positive step in that direction because it helps in several ways, especially with women in the workforce, enabling women in the workforce, and in several other ways, also creating a social security net for people in the gray collar or the blue collar job market. I think the issue is the cost of doing business as a result of this new labor law, which is going to go up significantly. And we have to remember in India, it's less than 7% of our people are in employment in the private sector. And these are jobs. So we're just basically increasing the cost of, employing people. And, that's going to have an impact on corporate margins. But I think it's going to be a little more nuanced. The Gratuity Act, the Payment of Gratuity Act 1972 limits the total amount to 20 lakhs. That doesn't mean that companies cannot pay more than that, but because of the income tax limit and the limit under the Payment of Gratuity Act, a lot of companies limit it to 20 lakhs. So I think you'll have to go company by company, analyze their annual reports to see what their gratuity computation rules are.
Mr. Subramaniam, I've just come in on the increased cost of doing business now. Particularly, the fear was the hit to quick commerce companies because they employ a lot more gig workers who will now come under the Social Security ambit. Now, Team Lease has also been providing, for your gig workers, quick commerce has been a big source of growth engine. It's been a big source. So can you give us some indication of the increased cost structure for them?
Not really sure if the overall cost of ownership, the total cost of ownership will actually go up even for gig workers. And the reason for this is because most, if not all of the platforms who employ gig workers or the logistics companies for that matter have been providing some form of insurance / coverage for them or the other. Now, what are really the demands that they have? You look at it in a fourfold manner. They look for health cover, accident cover, life cover, and retirement benefits. It's not like they have not been provided these things so far. It is just that companies at their own discretion have been providing them at a significant cost because they have been providing them through third-party insurers. If the government can step in, as they have announced as part of the Code on Social Security, and ensure some sort of cover and social security benefits for these people, then it's just a substitution of cost. Instead of paying insurers, you pay the government. And the government will be able to provide benefits, hopefully disproportionately compared to what insurers can. If you look at ESI, for example, the government has not really announced if the contribution from gig workers or towards gig workers will be made specifically towards PF or ESI. But I'll just give you the example of ESI. It gives unlimited cashless health cover for self and up to 7 people in the family. How many people even know this? And that's something that only the government can provide. No insurance company will be able to provide that. So it's just a cost substitution, like I said earlier, where instead of paying private parties, you're going to pay the government, and the benefits should probably be the same or hopefully will go up.
Okay, gentlemen, we'll leave the conversation here. Thank you very much for joining in. For today, we are seeing HCL Tech and TCS perhaps reel under the impact of the new labor code, which has impacted the company's bottom line. For TCS, it's more than 2,100 crore. For HCL Tech is a number in excess of 700 crore rupees, which is why both the companies missed estimates on the bottom line. Operationally, it was a good set of numbers, but all in all, these are companies which are not growing very fast. As Nomura pointed out, for TCS, the dollar revenue growth estimate, Nomura on TCS, is minus 0.7% this year, and that will go up maybe marginally next year, 2.5–3%. So these are still slow-growing companies. Even for HCL Tech on the whole, the revenue growth this year will be 4 to 5%. So which is why maybe investors are still on the sidelines, and these companies' stocks actually did well in the October to December period where there was a bit of a catch-up rally. So we had a conversation with HCL Tech CEO and MD C. Vijay Kumar, CVK, and CFO Shiv Walia, and we began by asking CVK more about FY27. What are the leading indicators suggesting? Will the momentum continue? Can FY27 be better than FY26? Listen in.
We have delivered a very, very strong quarter on all dimensions. And this is the second consecutive quarter of strong performance. So I think FY27, as you know, there is so many moving parts in the world. There's a lot of volatility. But what I can reasonably share is some of the leading indicators that we have. We have done very well in the last 2 quarters, and given the strong bookings in the Q2 and Q3, the Q2 Q3 booking is almost 30% higher than in the same period last year. So we are looking at some good uptick in revenue in Q4 in the services, and then of course Q1 as well. So I think given our booking, given our pipeline, and all the momentum that we have, we are looking at a good outcome in the next year. However, anything specific, we will really have to wait for the April meetings.
Shiv, there is this one-time impact on the back of the new labor code. But beyond that, what is the anticipated recurring income on the annual employee costs?
It's going to be minimal. We have taken the one-time drop charge. It's going to maybe 10 to, at best, maybe 20 basis point going forward. So we don't expect impact beyond that.
Okay, so 10 to 20 basis points. And on restructuring for FY26, what will be the total restructuring cost? But could you put that in rupee crore and the impact that you expect on margin shift? And will this restructuring cost continue into FY27? And what happens to, is there a possibility that if it doesn't, your margins can get back to the 18-19% band?
So as I indicated last quarter, the overall cost of restructuring is going to be around 50 basis point this year. We have done most of it, and hopefully the next quarter is also going to be the similar charge, around 40 to 50 basis point. Our endeavor is to complete this exercise this year and move to next year with a clean slate. So I don't think that's our endeavor, but we'll update you when we close our year in April.
Okay. So the overall impact in Q4 will be 40 to 50 basis points. And for FY26 also on margins, it should be about 50 basis points, correct?
No, the full year is 50 basis point. Yeah. And next in Q4 is going to be similar to what we had this quarter. Q3 is around maybe 60 to 80 basis point.
CVK, what has been the achievement out of this restructuring exercise that you've undertaken in terms of the overall employee headcount, in terms of utilization of your workspaces? Can you give us at the end of it, what have you achieved?
So I think in Q1, we saw a little bit of mismatch between skills and location where the people were available. And we also had some underperformance in some of our acquisitions, especially in the automotive segment in some of the Western geographies. So we have optimized some of this in the last couple of quarters. And that's what you see the restructuring costs are. Facilities as well across the world, there are many facilities which are not being fully utilized. So we have done some rationalization. All of this is has been the part of the plan since the beginning of Q2.
But have you had to let go of people on the back of this restructuring? If yes, what's the number?
Yeah, yes, we have had some very small numbers. We haven't called out any specific number, but largely it's outside India in some of our geographies. We've had some exits for sure.
This year, the guidance does not include the acquisitions that you've done, Jaspersoft, HPE. But next year, what will be the contribution of the acquisition?
It should contribute at least 1.5% in FY27, assuming things close by end of this year, which is by March or early April. Roughly 1.5% growth to the overall company is what we expect.
Will you continue to make acquisitions, bigger, bolder ones in size, perhaps?
We're not really looking at scale acquisitions. It's really capability-led or some geographies where we really want to accelerate our presence. That's where we will be looking at acquisitions. We don't think we're going to do a very large-scale acquisition. I don't think that's in our plan.
And getting back to margins of 18 to 19%, does that happen in FY27?
I mean, this year, Rima, we are, if you take out the restructuring cost, we're only some 10-11 basis points off this quarter after taking out the restructuring cost. So we feel pretty confident of getting to our 18 to 19% range in the next year.
Oh, that's good to hear. And a little more on AI. Now, it's been 2 quarters since you've been sharing the advanced AI revenues. It's about 4% of your overall consolidated revenue, growing very fast. What is the momentum that you're seeing on AI? And, what can that number in terms of revenue contribution go up to?
Yeah, I think there are 2 aspects to this. One is advanced AI, which is really a lot of work which is required to get AI infrastructure enabled, the silicon work that we do to build, design edge inferencing chips, some of the agentic solutions, some of the IP that we have in AI. That's really what we call as advanced AI revenue. But we have a much broader canvas where we have deployed AI in service transformation, application modernization, data lifecycle. So it's a much bigger canvas when you consider AI. And we think almost every part of our business should get significantly influenced by AI as the time progresses. But advanced AI is really a leading activities like build out of data centers, all the professional services around design and implementation of data centers, silicon, and all the IPs that we have built. All of that is what we call out. We think there is a strong momentum. It's growing now 20%. Even the previous quarter, it grew even higher because we had just called out we exceeded 100 million, but now we are at 147, 148 million per quarter. We think there is enough fundamental reasons why this will continue to grow at this speed for a few quarters.
That is HCL Tech saying that the momentum should continue in Q4 and Q1. FY27 margins should get back to 18 to 19%, which is higher than the guided band of 17 to 18% this year. And next year, the acquisitions done by the company will benefit their top line by 150 basis points at least. And going forward, the new labor code will have a very limited impact on the company's cost structure. Margins could be impacted to the tune of 10 to 20 basis points. So that's the summary coming in from HCL Tech. Get into a break. On the other side, Somil Mehta of Mirae Asset Sharekhan joins in for some technical trading ideas.
Welcome back. Somil Mehta is with us of Mirae Asset Sharekhan. He's joining in with what he'd want you to do as far as approaching the market goes. I mean, we're off the highs and I think the market's now in the red. Reliance, I think, is one reason, is down 1% again. Heavyweight, which is having outsized influence as always. Somil, what's the recommendation? I mean, sentiment still is fragile, even though we saw that rebound yesterday. But in terms of taking trades, what would you recommend?
Hey, hi, good morning to everyone. Now the trend remains negative on the in the short term. Trading below Nifty, trading below 20 and 40 daily moving average. A sell-off which we saw in the last week has broken an upward sloping trend line on the daily charts. The entire, the consolidation which we saw between 26,300 and 25,700, that has broken on the downside. The structure has looking a little weak from here. Now, the resistance from here is 26,000, which is the 20 daily moving average, and I'm not expecting markets to go above that. So my view remains negative in the short term. However, in the medium term outlook, we are still on the positive side, and I'm not expecting, too much of a sell-off from here. But on the downside, my targets would be 25,300 and 25,200, which is very close to a 200 daily exponential moving average on Nifty. So sell on rise should be the strategy in the very short term. And I think railways are looking really weak from here. However, metals and banking are looking flat to positive. So I'll be staying away from them. But mid caps are looking weak, definitely.
Anything on HCL Tech, TCS? The numbers were not bad per se. TCS, you could say, were not exceptional, no big, positive surprise, but not negative either. And HCL Tech, actually, we got a guidance upgrade at the services, the main services business. So what is it technically that the charts are looking weak, that we are seeing a correction today?
No, not on the IT side, not for HCL Tech and TCS. There could be a little bit of correction in the very short term where it can go till HCL can go till 1580 levels, but not in the medium term outlook. Medium term outlook still remains positive, and I'm expecting the stock to take support at these 1550, 1580 levels, and then again start the up move. But in the very short term, yes, we have seen a sharp sell-off right now today. Closing and trading below 20 daily moving average. So in the short term, yes, negative, but in the medium term outlook, it will be a buying opportunity around 1580 levels.
Yeah, got that. Your specific trades in terms of stocks, Saman?
My first trade would be on IRFC. IRFC is trading below 200 daily moving average. Have already started low top, low bottom formation. A small consolidation has also broken on the downside. So the stop loss would be 127 and the target would be 112. So that would be my first trade. The second one is Hindalco. Hindalco, very similar, very sharp bounce we've seen in the last couple of months. And then now again, a sharp sell-off closing below 200 daily moving average. My stop loss would be 220 and my target would be 205.
Yeah, those are individual trades. Samal, do you have a technical view on Reliance?
Reliance, very similar to Nifty actually, because it was trading in a very broad range of 1520 and 1600 levels. So that range has broken on the downside, forming low tops, low bottom, trading below the averages. Now, very crucial levels at 1430, 1450 levels for Reliance. I'm not expecting that to break on the downside, but if it breaks on the downside, because I'm being a little cautious on the markets now, if it breaks on the downside, then the next level is 1300, 1330 level. So sharp sell-offs if that crucial level breaks. So I'm hoping the medium-term levels to hold right now.
I mean, look at the market go, right? 87, 90 points lower now on the Nifty. As we were talking, and I think another 20, 25 points gone, Samal. So not being able to hold at all. With what we're seeing out there. I just have to say one thing though, so far, and maybe, this will also now follow what the Nifty is doing. Market breadth is still positive. So some 1700 stocks are higher and about 1100 stocks are lower. I'm talking about the NSE advanced decline ratio. Of course, I mean, the gap is converging and we'll see what happens. But for now, more up than down, even at this point in time. Just a few other names. MRPL is still holding with about a 3.5% gain. Ixigo is coming up with a 4% gain. I mean, these are all stocks which have seen large corrections. Ixigo high was about 350. It fell to about $200. So Ixigo is coming up. Jindal Stainless is up about 3.33%. Balaji Amines, fair bit of volatility recently around the 1,050 odd rupee levels. That is Balaji Amines. Rajratan Wires is up another up 5% or so. So I mean, here and there some moves, but nothing very large per se. Dixon is coming up with some pressure. 2% lower on Dixon at this stage. There is what else? Glenmark, which is coming up with about a 3% cut. So that is meaningful on volumes on the downside. Senco is down about 1.75%, and then there is Misho, which is down about 2% as well. So, well, broadly, you would recommend those if you're trading, especially if you're on the F&O side, etc. I mean, reduce position size and, you've got to be a lot more nimble.
Absolutely, absolutely. So, what my strategy would be to, if you're long, and if you're long, then stay on the large cap side. Don't go outside banking and metals, because those are the only sectors I'm looking as a very positive side right now. Not in railways, not in pharma. Also looking a little negative from here. Fortis giving up all the gains. Glenmark Pharma giving up all the gains. So I would stay with the large caps if I'm long, but if I want to go short, mid caps are going down. They are I'm expecting very sharp sell-offs in mid caps and small caps. So yeah, shorting opportunities definitely. Put options would be a great way to trade them, having a less risk on the side. But yes, going short would be the right strategy in the short term.
Short in the short term. Samal, thank you very much for joining us. Good speaking with you, and good to get those trading ideas. And broadly, I mean, the setup as things stand right now. We'll start to have a lot more budget conversations, because the budget is 15 days out, right? Now, here's Chirag Setalvad of HDFC Mutual Fund making a very pointed argument that maybe we should loosen the fiscal deficit as a percentage of GDP number a little bit. I mean, spend a little bit more like other countries have, and maybe this is the time to do it. Just listen in.
I think the budget, as you said, has lost relevance. But I'm sure post, I see the views post every single budget. Every budget has been a 8.5 to 9 on 10. Every budget has been growth oriented. Every budget has been sort of fiscally prudent. I think we got to go beyond it, right? We have 365 days for the government to introduce reforms and measures. Why are we focused on that single day? I think the key question, though, in more seriousness is how they view fiscal prudence, because this year your tax collections have been far below target, and your expenditure still has to be cut fairly substantially in the next 4 months to meet your expenditure targets. So chances are you'll exceed your expenditure targets and you'll underplay your revenue targets. So the question is, will this government stick with its discipline on the fiscal side or not? And I think there are a lot of people, and I suspect I could be one of them, is maybe we shouldn't, right? We don't have to have this holy grail of fiscal discipline. If we are in an environment of uncertainty, maybe you loosen it up a little bit. Other economies have done that, so why can't we?
Get into a break. We'll keep hearing more from these conversations. For now, we'll slip into a break with the news that the Nifty is down about 50 odd points. Manisha Gupta will join in and put the spotlight on the commodity space. Stay tuned. Welcome back. As promised, let's talk commodities, and commodities on a high once again. Manisha is here to give us more details.
Thank you so much for that. Well, gold, silver, copper all trading near all-time highs, and platinum is up 15% in this year. But what is also running higher is the crude oil prices. If you look at the Brent and WTI numbers, we're looking at gains coming in for that one. So 64 plus, and Brent with that is trading at a 1-month highs. If you look at the WTI, that is the US crude oil prices, they are trading at a 7-week highs as well. Overall, the prices have gained up by 5% in this week alone, and this is after prices declined 18% in all over 2025. Well, 3 or 4 factors which really seem to be supporting the crude oil prices at this point in time. One clearly comes in from Iran, with US latest levy of 25% tariffs on Iran's trading partners with immediate effect has led to supply disruption concerns coming into the market, and that has led the prices higher. Remember, the US president also have warned of a possible military action against Iran. Now, Iran exports 2 million barrels per day, and it is 4th largest producer exporter when it comes to within the OPEC cartel. So important country there, and with what seems to be happening within the country and with the US statements, we are looking at that premium building up in case of crude oil prices. The second thing, of course, is about the uncertainty over Venezuela's crude shipments. While we do understand that there are US companies which are willing to now move crude oil from Venezuela and invest on a longer term as well, but the near-term uncertainty just about stays. Third point really comes in from Kazakhstan, because here as well, the oil output is affected by adverse weather, and it is not just about a week or 10 days. It has been happening for last 3 months or so, supporting prices. The Russia has been yet another strong one when it comes to crude, and even as it has been 3.5 years of war there, we've seen Russian crude more or less continue to go out. But the infrastructure damage that has been caused by Ukrainian drone attacks in the last 4 or 5 months has led to 16 to 17% of a decline therein. And then it also is about Azerbaijan, where the oil exports have declined on a year-on-year basis. Last year was 24.4. The year previous was 23.1 million barrels there. So we have seen constant declines from major OPEC producers there, supporting prices. Dollar index declining. It has been about macros as well, supportive. And then the street will also watch out for the US Supreme Court ruling on the legality of US tariffs. That announcement comes in on Wednesday. Having said that, when you look at the outlook for crude prices for 2026, it has been a very range-bound trend that the markets believe you could be looking at in this year. The first quarter, street believes, is going to be of surplus, but going forward, then the demand will start coming back, and that is when you will see crude prices supportive as well. So between 60s is what UBS, Bernstein and DBS believe that you could be looking at the crude oil prices, $60 to $68 a barrel of a range forming there. But then the others are not so bullish. You have $55 of an average coming in from IEA, Goldman Sachs, ABN AMRO, Capital Economics, all of them believing that mid-50s is where the crude prices could be as an average for this year.
All right, Manisha, thank you very much for that. So that's oil price forecast into 2026. We'll take a quick commercial break here. Lata speaks with Macquarie Suresh Ganpati on what to expect from the banking, NBFC and insurance companies when they start posting numbers for the third quarter. Stay tuned.
Well, the IT companies have started the results season, but practically from today, tomorrow, it is going to become the finance companies that will hold the market's attention. Today's Bank of Maharashtra. Tomorrow, we have some insurance companies coming in. By 15th, you will have IOB, Union Bank, Indian Bank, a lot of banking, I think even Federal Bank. And by the weekend, that is Jan 17th, you're going to have ICICI and HDFC Bank also coming with the results. So we better understand what we are going to get from insurance, NBFCs and banks. Joining me is perhaps one of the best veterans to watch them, Suresh Ganapathy, Managing Director, Head of Financial Services Research at Macquarie Capital. Suresh, good morning, and thank you very much indeed for your time and for trying to put us a little ahead of the curve before the results come in. I want to start with your price target chart, which I saw in your latest report. The chart should come up on the screen. I mean, there is a sizable revision that you have made of the results of the price targets. I mean, some 100, 200 rupees for SBI have gone from 720 to 1150. For HDFC Life from 700 to 900. SBI Life, again, a huge 500 rupee price increase. Let me start with the insurance companies first, because there the price revision is high. Why are you so bullish on insurance companies?
Yeah, so look, I think what has happened here, if you look at the last couple of months itself, the sum assured growth numbers have been pretty good. Right, Lata? So clearly there is some good pickup in the protection numbers. Now, what's likely to happen here is the next couple of quarters is going to be a little bit more challenging because of the input tax credit. But I'm willing to look beyond the next 6 months because I think there is a lot of stability in this sector. We are going to see a lot more amount of reforms in terms of risk-based solvency measures, eventually getting implemented, moving towards an IFRS. And then eventually, if at all the protection growth sustains, which we believe could happen heading into FY27, that's going to be margin accretive. I mean, the volumes here are quite amazing, which is going on in this particular side of the business. And I think the market is missing the margin upside that can come from the protection business, because protection business margins are almost 4 times your company level margins.
Oh, I thought ULIPs give them more money. It's protection which gives them more money, is it?
Yes, indeed. Very high, because the protection margins are around 80 to 90%. The ULIP margins are just about 10% or so, Lata. So it's
like any AMC. Okay, yeah. I get your point. Okay, so one should look forward to that, because a lot of insurance companies are coming up with their numbers very soon. I think HDFC Life will be one first off the block. Let me then come to the NBFCs. I'll reserve the best for the last, the banks. In NBFCs, your report primarily says, don't look at the very large NBFCs because their growth could get challenged. Look for the low valuation and smaller NBFCs. Can you elaborate?
No, look, I mean, Lata, my point is there is a trade-off between growth and profitability. And of course, when you become really large, it becomes very difficult to sustain. So just to put in context, I'm just taking one example. Let's take, for example, Bajaj Finance. Now, in the non-mortgage portfolio, they generate closer to an ROA of about 5.5 to 6%. Now, you can't generate that ROA and keep growing at about 30% or 25%, right? At some point in time, you'll have to give way for the other. That is the reason I believe the opportunity is more in the smaller ones, which are trading at half or even lower than that in terms of its valuations. Growth is also pretty good, and there is no dilution of ROA. That's the reason the bias is a little bit more towards the mid-size, smaller size NBFCs, which give you somewhat similar growth potential and with a stable ROA and at a lower valuation.
Okay. So what's the pick of the pack there?
So the two stocks which you're pushing is AB Capital and Shriram Finance.
Oh, okay. Shriram Finance, still a large one. But just a word more on Bajaj Finance, for instance, since that is the example you took. Yeah. Even in the last reported number, Bajaj Finance AUM grew by 24%. Their guidance is 19 to 20%.
No, 22 to 23.
Yeah, okay. If that is the kind of guidance they're giving, you still think that they will not be able to, match? I think they're talking about a 10 lakh crore AUM before 2030. If at the moment it is almost like Kotak Bank, it's like almost touching 5 lakh crore, 4.62 lakh crore in September.
Yeah.
Given this pace of growth, you still think that you would not put your eggs in that basket?
Yeah. So of course, Lata, we are talking about the company which is growing at 30%. Now I will come down to 22,
Okay,
right? So there is a corresponding reduction in growth. Now 22% is not a bad number, but you have to look at in the context of valuations and the downward revision of growth which has happened over the course of last 12 to 18 months. So that's one thing which we have to look at. Secondly, even though they may have a target of about 10 lakh crore AUM or which whatever growth that translates into, it's tough, Lata, to maintain that at 4% ROA.
Okay. No, yeah, I suppose size brings with it its own problems. Let me now come to the banks. Most interesting. I am getting a feeling from your report that you have turned very positive on public sector banks. Of course, a huge upgrade for SBI itself. But should we, the first set of numbers are coming from IOBs and some of the public sector banks. Are we in for something positive? In fact, Bank of Maharashtra today itself.
Yeah, so look, I think, Lata, one area where the public sector banks continue to do very well is they are gaining loan market share. So let's admit that they're growing faster and they don't have the kind of LDR constraint that a private sector bank has. Now, of course, the Reserve Bank of India is no longer looking at LDR as a big constraint right now because there is a change in the regime and an approach and liquidity environment and inflation. So whatever is the macro-related factors which is making them look at the LDR numbers a little bit more favorable. But PSU banks don't have that kind of a challenge. Point number one. Second thing here is, Lata, and here is where I think we have underestimated the extent of benign asset quality that we continue to see in the corporate credit quality. See, the advantage here is because public sector banks have a large 70-80% book in corporate, that continues to be squeaky clean. Today, the slippage numbers of some of the public sector banks, Lata, are lower than the credit cost numbers of some of the private sector banks. It's an extremely high level of anomaly and good situation that persists. I don't see that changing. Can I see a large corporate asset going bad? Now, in the past cycle, Lata, you always used to know every month there used to be some thousands or tens of names which used to get thrown around, right? So, this guy is going bad, that corporate is going bad. That's not happening at all. So the benign credit quality continues. So you are at a low credit cost environment. You run at a 1.1% ROA. There's no risk to that, and your leverage is high at 14%. So you 14 times. So you have a 14% ROA, which is as good as that of a private sector bank, and available at 1 time price to book in certain cases, even below that. That makes us a little bit more positive on PSU banks this cycle, I would say.
Yeah, a huge outperformance is what you are, pointing out to in SBI. From underperform, you've straight away taken them to outperform. Any other PSU banks that you will now start coverage or on which you're positive?
No, we can't talk about what we would do it in future, but specifically stick to the larger ones is what our call is. Yeah.
Okay. I think BOB is also in your coverage. Let me come to now the private sector banks. Actually, what stood out in that large table in your report is that only in HDFC Bank, the EPS growth continues from FY26 to 27 to 28, whereas it seems to peak off for a bank like ICICI and Kotak. FY28 is lower earnings forecast compared to FY27, though 27 is much better than FY26. So, therefore, would that be your hierarchy? Prefer HDFC Bank over the others?
Yeah, so look, I think, of course, in the near term, markets are looking, Lata, beyond earnings growth. They are looking definitely at deposit growth performance for HDFC Bank. And the fact that the LDRs went up this quarter substantially has not been taken well. The deposit growth performance has been for this quarter, particularly HDFC Bank, has been subpar. So the markets would want a better deposit growth. So at the end of the day, the valuations and the multiples and the performance, the outperformance is not a function of just one earnings growth number. It's a function of a multitude of factors. So HDFC Bank is to get the deposit growth equation right. In the meanwhile, our preference is more towards a little bit high beta banks like an Axis and to some extent SBI. Because there the trajectory, for example, Axis Bank, if you look at our earnings growth number for FY27 is 30% plus because it's coming off against the weaker base of FY26, and that's where the opportunity lies in, and the valuation is also cheaper. So we're playing for that particular valuation catch-up game. ICICI, as you know, also has an uncertainty surrounding the CEO tenure because we really don't know whether Mr. Bakshi gets another full 3 years and maybe, he decides to leave or whatever could be the outcomes at that point in time. So therefore, there are some near-term concerns amongst the large two names, and therefore we are advocating a tactical shift in the near term towards cheaper valuation banks, be it an SBI or an Axis Bank, and when there is a valuation catch-up trade and there is a visibility of ROE that we see.
Okay. Time permitting, I'll come back to banks. But what about the two other companies that have captured the market's attention, Paytm and PB Fintech?
Yeah.
Do you think those deserve a bigger look in now in the Q3 numbers?
Yeah, look, I think, to be honest, we of course upgraded Paytm, and we have been quite a long, we've had a bearish track record on Paytm. But look, at the end of the day, what matters is EBITDA. And these EBITDA numbers which are getting reported by both Paytm and PB Fintech are without any adjustments, right, Lata? So we are not looking at some core EBITDA excluding certain ESOP costs or excluding certain one-off items. So they are actually going towards EBITDA margin being positive and getting that operating leverage into the business. And Paytm has done a pretty good job about getting into that process of delivering the operating leverage. Now, of course, the debate is how long can you sustain? Now, if you can indeed demonstrate the operating leverage continuously and surprise on the upside with respect to EBITDA numbers, then these stocks have further upside. Now, the way we look at it here is that typically the new generation companies, Lata, across the space, they trade at 50 times FY28 EBITDA multiple. That's where our target prices are converging, and therefore we get more like a neutral rating. But remember, it's a combination of a numerator and a denominator. If you can surprise well on the upside, on the EBITDA, the denominator, you of course have a greater upside on both Paytm and...
There is this problem with new age companies. Very quickly, I want to get to the mid-cap private sector banks. You know, the Federals, the RBLs, the City Unions. Where do you stand over there? AU Finance, where do you stand there?
Yeah, see, look, I think, Lata, we will have to understand that the expectations are running a little bit high on some of these names.
Okay.
Some of the names have both, some of the smaller ones, as you know, we don't cover them, but they have got capital and the market believes that there can be a turnaround. But let's admit, Lata, there are structural issues. Getting few senior management at the senior level in some of these organizations is not necessarily going to completely change the outlook of the picture. There are a lot more structural rigidities in some of these older private sector banks, which is not easy to turn around. So my preference is towards the likes, for example, we cover City Union Bank. Time-tested model, 90%, 99% of the assets are secured. They restrict in their core domain of SMEs and Southern India and can generate a 1.5% ROA. I would rather believe somebody delivering that number rather than buying a stock on a hope of delivering a 1.5% ROA.
Okay. Well, fair, out of time, but that's excellently argued. Thank you very much, Suresh Gadpati, for joining us. And I'll take a rain check from you to invite you once the major results of the banks are out. Thank you very much for joining us. But that prepares us for the banking results and the finance company results ahead. Wrap up on Bazaar on that note. Chartbusters up next.
TCS trades flat after the company reports an in-line set of earnings with the performance impacted by the new labour codes. Management tells CNBC-TV18 they will be more acquisitive going forward.
Meanwhile, HCL trades lower despite beating Q3 FY26 earnings estimates on all fronts, raises the lower end of the full-year growth outlook to more than 4%. The management tells CNBC-TV18 that they're looking at a good outcome next year based on bookings and pipeline, and are confident of 18 to 19% margins.
L&T under pressure today after reports suggest that Kuwait discusses cancellation of oil project tenders worth nearly $9 billion and is looking to rebid those tenders. Analysts say L&T was L1 in tenders worth over $4.5 billion.
Palu Forge is upbeat in today's trading session. The company clarifies that the IT rates is complete and no indiscriminating documents were found or seized during the operation. Well, hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel, with me is Mangalam, and as we speak, the markets as flat as can be recovered from the lows of the day, but off the top as well. Well, Mangalam, first of all, wishing all our viewers a very happy Lohri. We are celebrating at home as well, so wishing all our viewers, Punjabi folk out there, a happy Lohri.
You want to say that in Punjabi, Nigel?
I'm not yet.
Lohri di lakh lakh vadaiyan.
Lovely.
But be that as it may, you know, the market's recovered from the lows. It's that period of the year, you know, where the entire country celebrates. Maybe Maharashtra will have Sankranti and all of those things. And the Nifty is recovered from the lows and the next few days. And you'll have some happening in the southern part of the country, some happening in, various parts of the country. So it's a wonderful time of the year. And we also are looking at, this festive season celebrations extend into good results and thereafter maybe a blockbuster budget. That's what the expectation is. Let's see what the finance minister gives.
Well, that's right, Mangalam. Some kind of buying actually from lower levels. You know, look at Titan. That's clearly the stock in focus. They came out with a good quarterly update. The stock had opened up in the red, but that's seen a sharp spike up. So I think we should get that one up for you on the screen. Titan's the stock that we're talking about. Good uptake is what we're seeing. Max Health actually has cut its losses out there. So I think we should get that stock as well. And the Nifty Bank, that's the beautiful looking chart. Well on its way back to around that 60,000 odd mark, holding above the 20 DMA. That's the important mark that you're looking at on the Nifty Bank. So the tech index may not fall that much from year on going by the results. Nothing really to cheer. Yep. But if it doesn't fall, well, that's going to be an index to track. It's moved into the green. And the Nifty Bank is holding in the green. But I think we've got our first management on the show. Firoz Aziz joins us to help us out with Anand Nathi's results. Remember, the stock is trading a little bit higher. The company's net inflows improving on a sequential basis. Let's discuss the quarter gone by and the way forward. I think now we have Firoz Aziz, who joins us on the show, the joint CEO at Anand Randi Wealth. Hi, Firoz. Good morning. Wishing you a cracker of a year in 2026. The end of 2025 as well was quite good. And I think over many, many quarters, consistency is something that the street has liked with regard to what you'll report at Anand Randi Wealth. A couple of details, though. Your AUM target has almost been met. I think it's time to revise it. Tell us what's the new guidance you want to give us.
Good morning, Nigel. Wish you and your viewers a great 2026. When it comes to our guidance of AUM, we will not change the AUM guidance. Of course, like you rightly pointed out, we said that we'll set out to achieve 1 lakh crores of assets under management in the Anand Randi definition of assets under management, not the industry definition, where we count only assets where we are currently earning on. There we are just 1,000 crores short, give or take. And I don't think we will revise it because March 31st could have whatever in store for us because that's a 1 day's number. So we are trying to retain it for the moment because there's a lot of global uncertainty. And on 31st March, whatever is the reading will be captured. So we don't want to disappoint our shareholder by overcommitting.
Okay, you don't want to overcommit on, the AUM target because that's a lot of it is not under your control. It is market linked as well. But what about revenues and net profits? You know, you've achieved nearly 75-80% of both your revenue and net profit target. You'll obviously, by the run rate that's going on, you'll obviously do 10% more than you've guided for. You don't want to up that guidance and still surprise the street positively?
Mangalam, we want to keep the guidance, like I said on the AUM front. You're absolutely right. If you look at 76% penetration into revenue, 78% penetration into the PAT target of 375 crores, we also had a debate, should we revise it? Then we said we are anyways going to do what we are supposed to and a little more, hopefully, with God's grace, if there is, in this quarter. So we didn't want to revise it. But we don't believe in overachieving substantively. And then because you have to bring in consistency, like Nigel began saying that we like to be consistent. So if I start with a big base, then I have 25% or 20 to 25%, which is my long-term guidance on the larger base. We don't like to degrow or even not grow below 20%. So if you see our last 17 quarters, my worst quarter has been 23.7 year-on-year growth, and the best has been 41. That's also a wider range than we would have thought. So with reasonable probability, we will beat that guidance, but not revise the number yet.
All right, Feroz, you're a people's man. I've known you for many, many years. But as a boss, it'll be interesting to know how are the trends out there. Attrition, you normally boast about it being, I think, around zero or I think zilch. How has the employee behavior been? And, with this sort of competitive intensity in your industry as well, if an RM leaves, what about business? Will it get affected?
Nigel, this is an amazing question. Why? Because we are a people's business. If you see, our RM attrition was 0 for 6 quarters, then it went up. But in our case, now let's assume last year, financial year, we had 3 people leave. So each of them have a story. It's not like a opportunity which takes people away. One person was having some mental health issues, so we had to let him go for his mental peace, and so on and so forth. There were some cultural issues where I let go of one, and the other guy was a friend of his. So that was my 3 people. Now coming to the more important question which you asked, we had about 446 crores of assets across these 3 people. If I look at how much assets did I lose from this 446, which is the right barometer, I still have close to about 346 crores out of that. So that's 20% assets under management lost of these 3 people whom I had to let go last year. So 80% or close to about 78% of that asset has been retained. Now, this year we have had about 4 to 6 people who have left us. And again, there is a story behind each case. I don't want to put those numbers out yet because the financial year needs to be over to see how much did I as a company retain.
All right. When we spoke about you being a people's man or this being a people's business, etc., the nice touch that you all had was, on your presentation, the second and the largest space was given to Chetan Shenoy, and, in loving memories and with deep respect as well. That speaks obviously about Chetan, the person that he was, but more importantly, the organization that you all are as well. So with that on board, let's just wrap this with a couple of things. You said that you always plan 5 years ahead, and you had a target of, RM, the AUM per RM going forward. The number was closer to 1,000 odd crores. Do you stand by that?
Yes, Mangalam, I stand by that. Like you rightly said, and the great part about TV18 anchors is they hold you accountable to what is said in the previous quarters, which I think is the beautiful way for us to also undercommit or speak with responsibility towards the larger shareholder. Now coming to the point which I made, that we plan 5 years ahead. So I actually plan September 2030. And I think that if I have to do 20% growth in September 2030, I'm just putting these numbers, please take it with a pinch of salt. I have to do 224 crores of revenue in September 2030 if I have to do 20% growth, and 289 crores if I have to do 25% growth. That's my boss's long-term guidance on the public domain. Are we planning it like that? We are planning it like that. Can you plan a wealth management business like that? To my mind, yes. If you don't have secrets with the regulator or with the client, that's the key. You don't have secrets with clients or the regulator, you can plan 5 years ahead. And that's a long strategy of how we do that. Most of our structured product business gets rolled in as well. So my trail business has to go up. If I project very modestly, I think I'll be able to please my boss, who's Mr. Raval.
All right. Take that point. Thank you so much, Firoz, for joining in. Wish you once again a cracker of a quarter, and we will have a conversation. We'll hold you accountable once again at the end of the fourth quarter as well. With that, we'll take a short break, come back. Don't go anywhere. Good conversation coming up with the management of Lemon Tree Hotels after the recent big developments that the company did, restructuring, value unlocking and fundraising in Fleur Hotels. Stay tuned. Patanjali G. Keswani joins in.
Fly Emirates, fly better.
Well, the market continues to be volatile around the flat line. The Nifty is now marginally in red territory. It's led lower by a couple of these heavyweights. So we have, something like an L&T, which is lower. Alongside that, Reliance too has moved a little off the highs right now. Currently down by about 1.2%. But Lemon Tree is the big story of yesterday, this entire week. We had, Yash break the story where there had been, he had an insight or inkling into Warburg Pincus going ahead and investing in one of their important arms, that's Fleur Hotels, and that's exactly what the company announced. And to talk more about that, we have Patanjali Govind Keswani, who is joining in, the Chairman and Managing Director of Lemon Tree Hotels. Mr. Keswani, thank you so much for joining in. I remember this conversation we had 2 months ago. You said, Mangalam, wait for 2 months. It's going to be a very busy third quarter for me, not only from a business standpoint, but we are evaluating multiple things, pre-IPO, valuation, lock-in, maybe alternate structures for Fleur, and all those things. Turns out all those things have come now. So congratulations on actually achieving all that you had guided for. But there are a lot of questions that we need to, understand as well. It's good that, Warburg is going ahead and buying APG's 41% stake in Fleur. The question is, at what stake, at what value, at what price?
So, good morning, Mangalam. The value is actually what is reported is the primary capital, which is 900 up to 960 crores. What they have bought that at is multiples of this 960. I don't, since it was a transaction between a buying and selling shareholder, I do not want to comment on it. You can ask APG or Warburg.
Got it.
But as I said, it was multiples of this 1,000 crores that they are putting in as primary into Fleur.
Got it. So this, Warburg looking to invest another 960 crores in Fleur as well. What would be the stake dilution for that? What's the timeline for this? You said it's going to be in multiple tranches.
Okay, so see, this is committed capital subject to opportunity. So the dilution will not be very significant. We will still be by far the largest shareholders. But let me put it this way. Fleur is going to list in 12 to 15 months, number one. So whatever money we take from Warburg, we will take in that period of time. This money will not come post-listing. In post-listing, as in when we need capital, we'll go to public markets, look at QIPs and so on. Now coming back to pre-listing, which is next 12 to 15 months, Fleur itself has a free cash flow of a few hundred crores. So if you look at Warburg's 960 and Fleur and put it together, we would have equity available of about 1,700 crores. So, and if you add, overlay that with debt, so the total capital that could potentially be deployed in the next year or so would be about 3,000 to 3,500 crores, say about, $350 million. Obviously, now we will take money from Warburg only if it makes sense from a return perspective. So really, this is like a available capital. It is not capital that is being deployed in Fleur as till
No, Mr. Keswani, we get that point entirely. What the street basically just wants to know, it's understandable that, it's a transaction between Warburg and APG, and it's between two parties of which you aren't directly related. So it's not fair on you to comment on the valuations, etc. But what the street really wants to know is at what initial value has Fleur Hotels been sold? Because that is what will help them understand the overall valuation of the company then, right?
No, I don't agree with you there, Mangalam, because let me put it this way. There is always a buying and selling shareholder in a private company. And they could sometimes, the buyer could buy at a significant premium or at a significant discount. So let me just say it was not an unfair value from both sides, but I don't want to comment specifically on it. I think the more important thing is you can value Fleur quite clearly based on its current EBITDA, its likely EBITDA next year, which about 20 analysts have done. And I think we have said quite clearly that we are building about 800 rooms, which is the Nehru Place Aurika, the Shillong Aurika, and the Shimla Aurika. And we are in, very deep stages of discussion to acquire about 2,500 more rooms, which is where this capital will come in. So if all this goes through, Fleur will be 1.5 to 2 times the size of which it would be as we are currently deciding or describing, which is 6,000 rooms. So it will be a very large company. It will have a very large EBITDA. I had said earlier that its EBITDA would be $100 million, once this demerger happens. But it will be obviously much larger than that. Now you have public market multiples, so just multiply it. It will have very low debt. It will have a very large EBITDA. You have the multiples available. So anybody who's interested can do the math. It's very simple.
Hi, Mr. Keswani. First of all, congratulations on this deal. Making, it's quite an interesting deal. A lot of sell-side analysts as well will be waiting to quiz you a little bit more. But going by what you're telling us, 100 million of EBITDA, and if you give it a multiple of close to, say, around 20 times, very, very approximately, Fleur should be in the valuation of around 18 to 20,000 crores. Would that be a fair number?
I wouldn't, again, Nigel, good morning, but I can't really comment. I'll tell you why. So let me explain that. if you look at the asset companies in India, my best guess is they are basically trading between 15 to 25 1 year forward on EBITDA, which means 4 to 6% yield. Now, this seems a small number, a very small yield. But why is it so? Because many of them have a very large growth pipeline. So really what you're buying at this multiple is not next year's EBITDA, but the EBITDA that it will generate with new projects over the next, say, 3 to 5 years. So in our case, if we are going to deploy a few thousand crores of capital in fresh acquisitions, fresh build-outs, and so on, whoever wants to buy our stock, which is why I'm being a little careful. I'm sorry, I don't want to give guidance. But what I'm saying is, we own 41% of a company that will have 6,000 rooms and a very large pipeline and committed capital, which is a fairly significant amount. Now, you can do the math and you would know immediately what is the likely zone in which...
We did the math, and it turns out that you don't want to comment on that math or the direction of that math. But basis what you've said, that, $100 million is the EBITDA that you would do, you would obviously want to do much more than that. So I'm multiplying that by, about 25% more, and giving it a more conservative multiple of 12 times, it still comes up to around 13,500 to 14,000 crores in terms of value. But then again, I let you not comment on that because that may be giving a direction to the market. Having said that, you've spoken a lot about Fleur. What I want to understand is about Lemon Tree as well, because promoters' stake in Lemon Tree currently 22.28 stays. In Fleur actually goes down to 7.34%, and that will dilute even further with Warburg investing that 960 crores as and when the equity is required. Is this your way of cashing in on the Lemon Tree brand chips while leaving the business to the others? Just wanted to understand that.
No. So let me explain. How does this work out is that Lemon Tree shareholders are effectively getting 74% of the company. Warburg is only getting 26, as I think you are aware. So this 74% is remaining directly with shareholders at about 33%. Since I own about a quarter of Lemon Tree, I will get roughly, or as you said, 22.3% of this 33%, which is the 7%. So that is the shareholding I will get as a shareholder directly. So will all other shareholders of Lemon Tree who will get shares of Fleur in this demerger. Then 41% is the ownership of Lemon Tree in Fleur, which means all shareholders, me included, will indirectly own part of this 41% in Fleur. Am I clear on that? So Lemon Tree owns 41%. All the shareholders of Lemon Tree therefore have a indirect ownership of Fleur, and direct ownership is 33%.
Okay.
Now, what I do with that shareholding is obviously I have not thought about it, but it is going to be a fairly large sum of money.
Okay.
And maybe I will use it to increase my stake in Lemon Tree. Maybe I will leave it there. I haven't thought about it.
All right, so that discussion for another day, Mr. Keswani. But as you can see, we love our numbers. We love our holidays as well. But for the time being, we are going to force you to give us 3 numbers before we go. Debt, what will the debt look like, both in Lemon Tree as well as in Fleur? I think consolidated, it's around 1,600 crores ballpark. So how will that difference look like? And for FY27, what will the revenue look in both these two entities and margin outlook for both these two, debt and revenue and margins? Please go ahead.
So again, you're asking for guidance, so let me go back. Debt, we have, as you said, 1,600. 80% of that is with, or more than 80% is with Fleur. So when we do this demerger, all the debt will transfer to Fleur. So Fleur will be sitting on 1,600 less whatever debt we pay in the 12 to 15 months going forward. And that would be about 250 crores, I would guess, or 300. So really on a gross debt basis, Fleur would have a debt of about 1,300 crores. Lemon Tree would be debt free. Lemon Tree will have very significant cash flows from, direct cash flows from its third party managed hotels, which, as you know, is accelerating now. We signed 5,000 rooms this year itself.
Yes.
And the fees it gets from Fleur, which is itself, say 150 crores. So put together, Lemon Tree would have fees of, I'm just making a guess, it would be 300 odd crores, and then accelerating rapidly in the next 3, 4, 5 years, both from the new hotels that we will open inflow, and of course, from the hotels that we have signed, which will start opening again in the next few years. So this will be free cash flow, less corporate expenses and tax. There will be no depreciation. And what do we do with this money is the question.
All right, take that point. Thank you so much, sir, for joining in. Running out of time, but not out of questions. But we'll, revisit this as months progress to check the progress on this. At the same time, you can obviously guide us a lot better on the visibility as we come closer to time over the next 12 to 15 months. Sir, congratulations on this deal. We'll take your leave on that one. Take a short break, come back, focus on the markets and a lot more. Stay with us.
Welcome back. Well, the market's trading mildly in the red, actually more or less flattish. The good news is the breadth of the market is positive, with the number of stocks advancing more than the number of stocks declining. And the Nifty Bank, that's the solid one in there. That's holding on to those gains. We'll wrap up on this edition of Chartbusters. As we do that, a quick reminder, if you're thinking about where the real opportunities for 2026 lie, Market Forum, the alpha generators for 2026, is where that conversation begins. The alpha table awaits. Join CNBC-TV18 as we host the ultimate confluence of India's market movers. Tune in later this evening, 4:30 p.m. onwards, only on CNBC-TV18.
Good morning. It's time for Trading Hour. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I am Hormus Patakia. With me, as always, Mangalam Malu and Ritu Singh joining us as well. Guys, good morning. It's been, choppy as choppy can be. But the index for now is at least holding on, if not collapsing, as it did in yesterday's trade, Mangalam.
Yeah, it is not bad. In fact, after the recovery that we've seen yesterday, today, it is the weekly options expiry. The market's expected to, hold on to that range and not fall further from what we saw yesterday. So yesterday's low becomes extremely crucial. The index that's holding up in the green is the Nifty Bank, even as the Nifty is around the flat line. Hi, Ritu.
Yes, Mangalam, seems to be some expiry blues here on Tuesday. Flat to negative cuts on the broader markets. And yes, Bank Nifty, that seems to be the contrarian trade today. Up and about today, trading with gains of about 150 points. Some of the heavyweights there actually, keeping the enthusiasm up. You have names like SBI, ICICI Bank and HDFC Bank. HDFC Bank, by the way, interesting note coming in from CLSA titled, I'm sexy and I know it. Which says that most of the concerns around the HDFC Bank are sort of overdone. And it is, in fact, upgraded the target price. But let's go across to Hormas for more specific cues. In the meantime, you do have the market breadth, which is still in favor of advances. Almost 1.5:1 is the ratio. About 1660 stocks are advancing, while 1130 stocks are declining. Hormas, what are the specific names that we should keep on our radar today?
Well, a lot of these broader market names, but since it's been extremely volatile, right? In the morning, you have one stock higher, 1 minute, you other stock lower in the other. But there are some movers that are doing well today. One beaten down name that is making a bit of a comeback today is Godfrey Phillips. That's up 4.5% in today's session. The top gainer on the Nifty 500 today is ITI. Of course, you need to keep this in mind that ITI has very little free float in the market, but the stock is up 6.5% among the top gainers on the Nifty 500 in today's session. Jindal Stainless is having a good day today. MRPL is having a good day. PVR Inox is having a good day today, 3.5% higher on that stock as well. And City Union Bank, after the 6.5% drubbing that it took in yesterday's trading session, that is making a bit of a comeback, 3.5% higher on that as well. And among the losers, HEG, the top loser on the Nifty 500 today, almost 3% lower, followed by Brigade Enterprises. Real estate stocks continue to decline in today's trade as well, along with Godrej Properties as well. So KEI Industries and Newland Laboratories among the top losers in the broader markets in today's session. But the markets may be choppy as they may be, but primary market activity showing no signs of slowing down, Mangalam.
Primary market activity showing no signs of slowing down. As we speak, we have the Amagi Media Labs near 1800 crore rupee IPO that opens for subscription today. The price band of 343 to 361 rupees per share. For all those who are wondering, what exactly does Amagi do? It sits at the backbone of an ecosystem where content owners schedule shows, insert ads in real time, manage inventory and make money across all the platforms so that broadcasters don't have to rely on their infrastructure. So what was basically the infrastructure expense of a broadcaster is now being consolidated on the cloud by Amagi Media Labs. It's a bet on the way entertainment would be consumed on television going forward, but the question is whether entertainment would be consumed on television going forward or not. We do have Bhaskar Subramaniam, who's the co-founder and managing director, as well as the CEO of Amagi Media Labs, joining us now. Welcome to the markets is what we'd say, along with welcoming you to the show. Bhaskar, the question is that in a business like yours, where a lot of the investment has been front-loaded, cloud infrastructure in particularly isn't very cheap. But you've obviously broken even last year. That typically happens when companies go for an IPO. The 1 year before that, numbers suddenly start to look wonderful. Wanted to understand, now that most of the mission critical expenditure has been done, investments have been done for you, going forward, what's a sustainable revenue growth rate, and will profit growth outpace the revenue growth rate?
Yeah, thank you very much for giving us an opportunity here. As you rightly pointed out, Amagi is the media technology software company, primarily changing the way how TV networks worldwide take their content, operate on it, distribute it, and monetize it worldwide. So we largely work with people who want to create their streaming OTT solutions, taking content owners to a number of hundreds of distributors worldwide. That's the problem that we really solve today. Having said that, if you look at our last financials over the last couple of years, we've been growing at about 30% CAGR and demonstrating that the operating leverage of the business is starting to really run. If you look at our operating leverage across, we've kind of got our adjusted EBITDA from negative 21% to positive 8.5% over the last 2.5 years. Clearly, we're seeing the operating leverage work play out, not just on the verge of an IPO, but literally over the last 2.5 years that the company's been performing on that front. Why does it work is inherently because we are a SaaS business. The business has an inherent operating leverage built in. If you look at our net retention revenue run rate, if you look at it, is at 127%. This is equivalent to a same-store sales metric. That means our existing customers continue to spend. For every 100 rupees that they spent last year, they're spending 127 rupees with us. So it's a classic land and expand business, which has been growing for us. And if you look at our sales spend as well as our R&D expenses, as a percentage of revenue, they've continued to come down. Our cloud cost is continue to come down from a gross margin standpoint. So all indicators tell us that we are in a very, very good wicket of managing both growth and profitability going forward. And this is a continuing trend over the last 30 months that we've seen. And we would see this continuing going forward as well. That's the thought process here.
That your margins have seen an expansion from a negative, 20% plus to about 8%. How much more is the headroom here? Because typically the margins expand much faster once that inflection point is achieved, the break-even point.
And you're seeing this. If you look at it, last year we ended with 2% margin. And just in the last 6 months, we've kind of been able to expand it by 6.5 percentage points over the last 6 months alone, for example. So we truly believe that this is a directional call that's happening. We are a vertical software companies. And if you look at vertical software companies worldwide, typical margins, 25% is not an unreasonable margin that these companies have been able to deliver at stable state. And that sort of is a directional call I think we could potentially look at as we kind of progress this forward over the next 2 to 3 years.
Bhaskar, streaming unification is the largest source of your revenue. In fact, 55% or more, followed by monetization and marketplace and cloud monetization. But, does growth naturally taper then as the customer base continues to scale? And do you think this monetization and marketplace and cloud will then have to become your margin engine?
Not truly. If you look at it, see, we're in a very early phase of the market. If you look at it, both from a cloud transformation, less than 10% of the market has actually moved to the cloud worldwide. Second, if you look at streaming is the biggest growth lever across the country, across all of the media ecosystems worldwide. So in that sense, we're in a very early phase of the market. Almost 90% of the market has to transform over the next coming decade. We truly believe the possibilities and the opportunity is really in front of us, not really behind us to some extent. Right? We've only crossed less than 10%, which is actually moved to the cloud from a migration standpoint. Second, if you look at it, our customer base is about 10,000 plus. We are about 450 plus customers today as a company. I think there's a lot of leverage in front of us, both in expanding our current customers, where the 127% net retention is showing you, as well as the new customer base that we are starting to go global. So both are a big tailwinds for us as we move forward.
Bhaskar, let me get back to profitability because that'll be a key focus area for investors that are looking to put money in your company. There's been years of losses for Amagi, and it's only now that you've turned profitable. I guess the question is how sustainable that profitability is, because have you achieved this profitably purely because of cost controls ahead of this IPO, or what sort of trajectory do you see ahead here?
If you look at it, Ritu, and again, if you look at our if I look at our RHP, for example, you would have seen this. This is not a one-off. There has not been any sort of reduction in cost structures that we've done as a company, artificially or otherwise, for the IPO. If you look at it over the last 2.5 years, and that's the reason you see the operating leverage playing out. 3 years back, we invested in R&D, we invested in sales and marketing to really build a global workforce, which is what's kind of playing out for us from an operating leverage standpoint. We do not see big investments other than the AI investments that we're already doing in R&D and which is already expensed out in our books today. For example, we do not capitalize anything in our books. So we are what I see is really a secular trend going forward from a profitability standpoint. And that's because all the investments that we've made over the last 3 years is continuing to bear fruit. 2.5 years, we've demonstrated that where we have almost 20% plus EBITDA percentage points movement towards a positive direction. We will continue to see that going forward as well. That's the confidence we have in our systems today.
Right. You know, Bhaskar, in that light, two-part question. Part one, you mentioned investments made over the last 3 years. Are there more on the annual? One. And two, you have earmarked some of your IPO proceeds for inorganic acquisitions. Can you throw some light on A, competition, and B, what are the sort of companies that you are looking at acquiring from these IPO proceeds?
Three aspects. If you look at our business, fundamentally, if you look at it, as I told you, investments have already been made, and we are in the mode of literally primarily harvesting the investments going forward. And Amagi has built a platform called Amagi Now, which becomes the core infrastructure on top of what we built today. So that's an investment that's been completed. What we see going forward is really the AI investments, which are already being designed into our systems in terms of the operating leverage that you're seeing playing out. First, number one. Number two, from a competition standpoint, Amagi is a very unique position today across the globe as only glass-to-glass media company, which is essentially starting from the camera till the point of a mobile phone or a TV screen where you're watching content on internet networks. Amagi provides an end-to-end capability that doesn't exist worldwide. And truly, because we've been fortunate to be in the right place, right time, building this one software platform that the world really trusts on today. So we have an opportunity to really build it. Our competition is really hardware vendors, very legacy hardware vendors across the globe who are obviously transforming themselves to become software players today. So there's no software at scale in that context of the world, right? From an M&A standpoint, just to give you context, we are seeing adjacencies which could be interesting for us to kind of look at acquisitions. We would continue to score for technology acquisitions, which you could tuck-ins, which you could actually acquire as part of the whole thing, as well as for customer buying. So any customers where contracts exist earlier, we could potentially be able to accelerate that. We would actually buy them. That sort of is the directional calls to be taking from an M&A standpoint.
Right, we take that point. Thank you so much for telling us about your company. You've whetted our appetite, but obviously more questions and more pointed questions coming at your direction in the next few days as you list, and thereafter you report your quarterly earnings, etc. as well. Wish you good luck for the IPO, and all the best going forward as well. But let's move on. Let's talk about the latest that's taken place in the Tata Sons board rejig. Sources tell us that Neville Tata is likely to be inducted in the Tata Trust's board. Parikshit joins in with more details. Parikshit.
Well, yes, a very important board meeting at Tata Trust is set to take place this week on Saturday. That is January 17. And this is likely to pave the way for the induction of 32-year-old Neville Tata, son of Noel Tata, into the Sir Ratan Tata Trust, which is the other key trust apart from the Sir Dorabji Tata Trust. Now, Neville Tata and Bhaskar Bhatt were already included in the Sir Dorabji Tata Trust in November, which was seen as a very important change and a move by Noel Tata to strengthen his leadership over the Tata Trust as well. Now, people who have worked with Tata Trust, who have been very strong observers of the years, say that this is a move which will help Noel Tata make sure that there is a clear alignment as far as the future vision of Tata Trust is concerned, and it also paves the way for greater growth of Noel Tata within the Tata Trust and the Tata ecosystem as well. Neville Tata is 32 years old. He's head Star Bazaar, which is a part of Trent, the retail arm of the Tata Group as well. Let's see how this move pans out. But we will also see changes in the Tata Trust this year. For example, the likes of trustees like Darius Khambata, Pramit Zaveri, their tenures also come to an end this year, and they will be due for reappointment. Whether they will be reappointed or whether there will be new people, new faces who would come into the Tata Trust, that remains to be seen.
Take that point, Parikshit. Thanks a lot for that. I remember doing a piece on Neville Tata when he was first inducted into the Sir Dorabji Trust. Obviously, the next wave of Tata leadership, for those who are wondering what the connection with Ratan Tata is, he is the nephew of Ratan Tata, obviously the grandson of Simon Tata. Educated in Bayes Business School in London, holds a degree in business management, and also started his career in Trent. Like Parikshit said, he's heading Star Bazaar right now. But importantly, he played a key role in the success of Zudio. And all those who are tracking the Trent stock would know the kind of wealth accretion that happened to Trent as soon as the Zudio foray was announced, and thereafter became the growth driver for the company. So it's a big development at the Tata holding level and the mark of a generational shift coming in here as well, the Tata story, which enters its next chapter. We'll take a short break on that note, come back on the other side, bond market with Manisha Gupta.
You want to talk business? Meet me in the On-Board Lounge.
And India Bonds presents Bond Street.
Welcome to Bond Street, and a couple of things to watch out for when it comes to the bond market therein. The first one is the Bloomberg Global Aggregate Index. As of now, has deferred India's inclusion into the bond there. Well, the aggregate index does say that they will keep the review open at this point in time, while the feedback which ended in November did give a lot of positive ones there, but there were some concerns as well within that feedback. One, of course, was about operational and market infrastructure gaps, and that perhaps needs further review before the inclusion therein. What we do understand from the various statements coming in is that BISL will keep the review on with the Indian markets, and on open and ongoing in sense of conversation there. We also understand that the engagement with the investors, the custodians, regulators and market participants is something that will also be continued. The further update on the review is expected now by mid-2026, outlining the next steps when it comes to inclusion. So that's one part of it. Well, let me remind you that the markets were anticipating this. All of last week, every day we've spoken about the anticipation and possibility of this happening on Tuesday, but this is the latest one on coming into the markets. The second important thing is, remember, the SEBI chief over the weekend in an event has spoken about bond derivatives going forward. After that, there have been various reports also suggesting that SGX is now exploring launch of a new bond futures. Now, this is going to be linked to major Asian government debt markets therein. Various countries that you look into this one are going to be perhaps India, Indonesia, you have Malaysia, Philippines, Thailand. So major Asian economies are in conversation about this. The report also suggests that there have been various calls that have been made to regulators on behalf of this as well. Now, there is a lot of interest when we understand on the region's debt market. It has been rising steadily in the previous few months and quarters, and that is where this conversation perhaps arises out of. The Indian government bonds also have been joining global bond indexes. Bloomberg is one that has been deferred. But 2.5 years ago, remember, it was JP Morgan, and that is what the street is looking at in sense of preview there. Bonds are likely to be included, would follow under the FAR, which is the fully accessible route, which will allow unrestricted foreign investment. And that's exactly what we have happened from the JP Morgan bond inclusion as well. Within that as well, it was $21 billion, which has come in sense of overall bonds, sovereign debt that we have seen come in for the Indian markets therein. There is a reaction coming that we have seen from into the bond markets because of all of these reports as well coming in.
Well, Manisha, clearly Indian reforms have not gone far enough. That seems to be the grouse of Bloomberg for not including us yet. That review, like you said, remains open and ongoing. Thanks very much for joining in with that. Now, on the back of that news that Manisha was telling us, the 10-year benchmark yield has actually jumped by 30 to 40 basis points after this update came in from Bloomberg Index Services on the inclusion of Indian government bonds. If you pull up the bond yields, 6.629 is where it's at. That's up about 40 basis points from where we started. The deferring, seems to have upset the market because, like Manisha was telling us, all of last week, there was very strong chatter in the market that we may get a positive update by middle of this week, by the 14th January or so, but that is not to be. And the next update is only expected by mid-calendar year. Now, keep in mind, currently, India is being evaluated for a potential weighing of around 1% in the index, an allocation which will translate into, as per various estimates, about $25 billion of inflows spread over a period of 10 months or so, if it is admitted. And that's why the negative sentiment, because, if India were to be included, of course, the foreign inflows is one thing. Lower borrowing costs is also something that would have happened because of larger demand for these bonds, and therefore the prices would go up, and that means the yields would have come down. Apart from this, of course, there are other cues that we will be watching out for. The softer CPI print in the macro signal, if you've noticed, it has come in actually at about 1.3% for the month of December, and that remains below RBI's lower tolerance band of 2 to 6% now for the 6th consecutive month in a row, and that is building up some hopes of monetary easing in the current cycle as well. Let's also quickly pull up the rupee. That fell against the dollar in early trade, because of, again, these ongoing geopolitical tensions and uncertainties that has accelerated the dollar demand globally. And that is putting some pressure on the rupee, which is falling in line with some of the Asian peers as well. Now trading at 90.24 against the greenback. Brent crude, meanwhile, again, trading higher on the back of these concerns around Iran and then, any potential supply disruptions that are happening. So there's a fourth day of increase there as well. Before we take a break, quick look at the markets as well. Let's pull up the charts for you. The broader markets trading with cuts of about, actually now in the green. The Nifty is at 25,790 as we speak. The Sensex at 83,879. The Bank Nifty continuing to, perform well, up by about 0.3%. So that's where the market is at. We'll take a short break, but much more on market fundamentals when we return on the other side of this break with Rajesh Palvia from Axis Securities.
CNBC-TV18 and India Bonds presents Bond Street.
Welcome back. The index remains quiet as quiet can be, but what is not quiet is the Bharat Coking Coal IPO. Almost 50x now. Bidding has entered the final day. Retail and the existing shareholders have led the subscription. And look at the NII subscription figures as well. 157 times now as we speak. The final day of bidding today for the Bharat Coking Coal IPO. The couple of other names, Dixon Technologies is at the lowest point of the day. So 2.5% lower on that stock. And Godrej Properties has now moved to the lowest level since December of 2023. So a 2-year low for Godrej Properties as well. Good time to get in a chart check. Rajesh Palwaya from Axis Securities is now joining in. Rajesh, good morning. Thank you for joining in. Well, the Nifty recovered a great deal from the lows of yesterday, but well, still finding it difficult to sustain at higher levels. So your call on the index and your specific stock recommendations as well.
Good morning. So in previous trading session, we have seen a sharp recovery from the low, this corrective move. Nifty took support almost from its 100-day moving average support area. But still, Nifty is not able to surpass 50-day moving average, which is acting as a supply zone for this pullback. Looking at the data setup, some put writing activity has been witnessed at 25,700, 600 strikes. So these two levels are important for Nifty. If Nifty to continue further pullback, then this level needs to be protected by the buyers. On the higher side, again, call writing activity is still there at 25,900, 26,000 level. So this band is likely to act as a major supply zone. So major short covering would trigger about 25,950 level. If we crosses those level, then short covering may trigger in market, and then Nifty could show further higher level. But Bank Nifty, on the other end, Bank Nifty is showing sign of outperformance. Bank Nifty is now back about 20-day moving average, and the kind of buying action which we are witnessing in banking and financial, I think Bank Nifty can continue further more upside. We could see further higher level towards 59,900 to 60,000 level in the continuation of this up move. So at this juncture, I think one can remain on the long side of trade for Bank Nifty with stop loss of 59,300. Looking on the stocks front, I think banking, financial, metal, these two space are showing sign of strength. So I think trade opportunity is there in this two segment. So on the stocks, Vedanta is looking attractive. We believe that the way stock is now move back to the all-time high trajectory and the kind of buying interest which we are observing since opening, we believe that Vedanta has potential to extend its gain 655 to 665. We are projecting target. One can buy and accumulate on the downside, keep stop loss towards 625. Other stock from the banking basket, that is IndusInd Bank. Stock is comfortably holding above 900 mark, and the way stock has bottomed out in last couple of months, we believe that IndusInd Bank has potential to extend its gain. Possible target towards 935 to 940 we could see in near term perspective. So one can buy with stop loss of 890.
All right, take that point, Rajesh. Thanks a lot for that. We'll take a short break, come back. On the other side, we have market fundamentals with Sunny Agarwal, who's the head of research at SBI Securities. Welcome back. You're watching us here on Trading Hour. Perfect time actually for you to look at what's taking place in the F&O space ahead of expiry. The market's consolidating. No two ways about it. You know, with the kind of recovery that we saw from the lows yesterday, the street wants to pause for a bit of breath. So 25,800, between 25,750 to 25,800 is where the Nifty has been meandering for most part of today's trading session. The Nifty Bank's been doing well. The mid-cap index lower by about 100 odd points. Importantly, the Nifty Bank has been led higher by a couple of these large banks like ICICI Bank and the others. But importantly, also look at, you know, the kind of moves that we're seeing in a lot of these metal names. The metal stocks continue to be well bid for many days now. Jindal Stainless up 4.5%, Nalco up 2.5%, and Vedanta is up 2% as well. Barring individual sectors and individual stocks on the Nifty, the street expects, smart money expects consolidation and range-bound expiry. Why do I say that? Because if you look at the options, right, you have the 25,800 and the 25,850 calls come up for you, and the 25,900 call as well. So 25,800 call has a premium of what? 50 rupees, nearly 3 crore shares outstanding. In that, nearly 60% of that were added today itself. So the street expects some resistance around 25,850 to 25,870. Look at the 25,750 put. That too is fairly active, and that has a premium of almost 18 to 20 rupees. Again, telling you that there is support expected around 25,720. Were we to break out of this 25,850 zone and move like we did yesterday, a lot of these call buyers have taken punt positions at the 25,900 call as well. For 15 rupees a pop, makes sense to, you know, hope for a big move in the second half of trade. But that may not happen because the street is definitely, given the sort of activity that's taken place in 25,800 call and the 25,750 put, the street is poised for some sort of range-bound expiry between 25,720 and 25,870. That's the range that comes up for you on the screen. Individual stocks. We have seen a lot of long positions being added on Oil India, but a lot of short positions being initiated on Dixon Tech as well as NHPC. Both these stocks lower by about 2.5%, but Oil India is fairly well bid with a lot of long positions being added.
All right, Mangalam, thanks very much for bringing us those cues. Let me invite Sunny Agarwal, who's the head of Fundamental Research Retail Desk from SBI Securities, who's here to discuss market fundamentals and his top sectoral picks with us. Sunny, welcome to Trading Hour. Thanks very much for your time here. You know, you say the Nifty 50 earnings growth will likely return to double-digit growth for FY27 and FY28. What are going to be the key triggers for this that you'd watch out for? And when you say it's a bottom-up stock pickers market, where do you see pockets of opportunity at the moment?
Good morning, everyone. I think definitely, what we have seen post 1Q FY25, there has been a single-digit kind of earning growth for the entire Nifty pack, and going forward because of many efforts taken by an government and RBI, whether it is a rate cut, whether giving push to consumption through GST rationalization, income tax benefit. I think overall this is leading to a better consumption environment, and at the same time, after seeing a lackluster capex spent by government post-election, now we believe that with an capex back on track, so many cyclical businesses are also likely to do well. So it seems that FY27 is a year where we may see a Nifty reporting kind of 14 to 15% kind of year-over-year earning growth, and so maybe closer to 1290, 1300 is an EPS estimate for FY27. And even in valuation front, we believe that 1 year forward, that is on FY27, Nifty is trading at 20 times price to earning multiple. In terms of sector which are likely to drive growth for FY27, we believe financial services, both fund-based as well as non-fund-based, both the pack are likely to do well and should contribute to an earning growth for FY27. In addition to that, consumption, especially consumer discretionary as a sector, is likely to be a good contributor. We have seen a kind of a lackluster performance from an IT pack. So IT, as we have seen the numbers of TCS and SCL Tech, seems that the demand environment is likely to turn better as we move forward. And even IT should start contributing in terms of earning growth going forward. In addition to that, a smaller sector like cement, where we have seen a kind of lackluster growth in the first half of FY25, FY26. Now going forward, we believe that cement should also start contributing to an earning growth. So I think in terms of bottoms-up stock picking market, we believe that auto ancillary is a very well-placed sector going forward, as that sector is benefiting from multiple growth levers. One is obviously domestic demand continue to remain robust. At the same time, we have seen that many auto ancillary companies are diversifying into a new product, wherein they are venturing either into new territory or new product by acquiring a smaller businesses. And at the same time, with many large OEMs making India as an export hub, that is also leading to an growth lever for all the auto ones, major. So many players like Precol or Bellrise, we have seen that they have done the acquisition turnaround and they are able to scale up the acquired businesses. So I think Autoance is a one pack where we believe that there can be many wealth creation ideas over the period of next 12 to 18 months.
Where does real estate fit into that picture, Sunny? There have been concerns with regards to the upcycle facing some speed bumps with regards to demand on ground. Do you have any exposure to the segment as a whole? And if so, you're betting on the commercial real estate side or the residential real estate side?
Yeah, so coming to real estate pack, what we believe is that larger players which has got a capability to venture into another market. Recently, we have seen that many South-based players have put into Mumbai market, or for that matter, Lodha Developers, which is a Mumbai-based player, they have recently entered into NCR. DLF, which is a predominantly NCR-based player, they have ventured into Mumbai. So I think what we believe is that larger players which has got capability to enter into another territory, and at the same time have got a very robust balance sheet to mobilize the capital in to fund their growth. So we believe that players which has got a pan-India capacity are likely to deliver a healthy earning growth going forward. As we have seen, Lodha as well as Shobha has reported a very strong provisional business updates also. So maybe a smaller micro pockets may continue to face some headwind, as we have seen in the case of Signature Global, where we have seen that the momentum, growth momentum has slowed down significantly in the NCR Gurgaon belt. So I think if somebody want to bet on real estate pack, maybe residential players which have got a pan-India presence, and on commercial side, obviously consumption-based residential play. A case in point, Phoenix Mill, where we have seen a very robust provisional update also. So I think Phoenix Mill is the one stock which we feel is a well placed to ride on the commercial real estate side.
Sunny, from your house, what are the top calls right now in terms of sectors and stocks?
So again, in terms of sector, we believe Autoance is the one sector where we continue to remain bullish on. Within Autoance, we believe companies like Precol or for that matter, Bellrise, these are the two stocks which we are recommending to our clients. Among the consumption pack, we believe that CCL product is the one play where the company on the back of expansion in the capacity utilization is likely to deliver a 20% kind of earning CAGR over next 2 years. So CCL product is a one stock. Among the metal pack, we would like to ride this sector through an stainless steel, which is a stainless steel proxy, which is an ferrochrome, and Infa is the one stock which we feel that on the back of rapid organic capacity expansion and the recently acquired capacity of Tata Steel should lead to an rapid earning growth on in FY27 and FY28. So again, predominantly placed in a mid to small size company where we believe that earning can compound at 20-25% CAGR over the period of next 2-3 years.
Sunny, thank you for sparing time and joining us today with your views on the index and, of course, themes and areas where you are placing your bets as well. We'll take a short break, but just before we do that, a quick heads up. If you're thinking about where the real opportunities for 2026 lie, Market Forum, the alpha generators for 2026 is where that conversation begins. The alpha table awaits. Join CNBC-TV18 as we host the ultimate confluence of India's market movers. Tune in today, 4:30 p.m. onwards, only on CNBC-TV18.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
Welcome back. Markets still in the red. Volatility continues. The Nifty index down about 7 points. And the top loser on the Nifty today is the Larsen & Toubro stock. That is down about 2.4% as we speak. What's got the street worried? Vivek Iyer is joining in to tell us what exactly has happened there. Vivek?
Well, that's right. So over the weekend, last couple of days, there have been reports, and this is coming in from a Middle Eastern-based journal that say that Kuwait is actually discussing cancellation and rebidding of oil project tenders worth over $8.7 billion. So Kuwait is actually looking to rebid the tenders, and the reason for this is that even the lowest bid in the last round actually was higher than what Kuwait was actually budgeting in for. Now, why is L&T in focus? Now, as per analysts and as per some of the order inflows that the company had declared to the exchanges, we understand that L&T cumulatively would have had L1 position or lowest bidder positions in projects worth a little over $4.5 billion. Over 40,000 crores worth of projects are currently in limbo on the back of this particular development. Just for some context, the current order book of the company is 6.5 lakh crore. Order inflow guidance for FY26 was 10% higher versus FY25. Company at the end of H1 was comfortably placed to beat the guidance that it had given. But in case this particular development does come about, depending on what are the orders that are cancelled, what are the orders that the company has already declared to the exchanges, there could be some trimming as far as the order inflow guidance for FY26 is concerned. We reached out to L&T and a response from them is awaited.
Vivek, thank you for that. We'll take a short break, come back, getting more on the markets on the other side.
25 points lower on the index. What's keeping it afloat is the Nifty Bank, and that is ably aided by ICICI Bank, HDFC Bank and SBI, all of them contributing to the index. A slight cool off from the highs of the day, but continuing to remain well and truly in the green. Take your leave on this edition of Trading Hour. From Mangalam, Ritu and me, thank you for watching. Halftime report on the other side.
Markets recover from lows, real estate and pharma under pressure, while capital markets and metals pack trade with strength. NSE total advance decline ratio in the positive zone. The US announces 25% tariff on countries in doing business with Iran. The new tariff threat comes after Trump threatened to intervene militarily if Tehran killed protesters. India is one of the top trading partners after China, Iraq, UAE and Turkey, and the rice industry could be impacted in India with basmati exports, a meaningful chunk of what India sends to Iran. Large IT companies report numbers for the third quarter. TCS trades flat after an inline set of numbers. Management tells CNBC-TV18 they will be more acquisitive going forward. HCL Tech trades sideways after a good start, even as earnings beat on all fronts. Management confident of 18 to 19% margins in FY27.
The L&T stock is under pressure after news reports suggest that Kuwait is discussing plans to cancel oil project tenders worth $8.7 billion. Analysts tell CNBC-TV18 that L&T was the lowest bidder in tenders worth more than $4.5 billion. Hello and welcome to Halftime Report live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always is Ekta Batra. Ekta, good afternoon. We opened at around 25,899. That was the high of the day as well. We slipped 200 points from those levels. So the low today is 25,700, a 50-point recovery from the low. So we still continue to remain in the red. Bank Nifty, which is a heavyweight, which is in the green right now, has also come off from the highs. And that is something that can be seen in the moves on the Nifty as well. So yes, the likes of ICICI Bank, HDFC Bank, some of these stocks which are supporting the Bank Nifty. Overall, the index is seeing some pressure from the highs of the day. The mid-cap index, the headline index is in the red today. It's down 0.4%, but the advance decline ratio is in favor of advances. And that is not something that usually happens. We see while the index is in the green, we see some pressure on the market breadth. But for today, at least that is continuing to be in the green for now. But we'll see which way things go. It's been quite volatile, so much happening globally.
Hi, Sonal. Yes, absolutely. It's been a topsy-turvy number of headlines which are emerging globally and geopolitically especially. But as of now, yes, you'd have to say that it's a quiet day. Yes, we've recovered from the day's low, but if you had to peg a headline to what is taking place in terms of the markets now, it's a quiet day for the frontline indices, but the broader markets continue to underperform. So we have the mid-cap index, which is down around 0.4%. And the last time I checked, the BSE small-cap index was outperforming the broader markets. So maybe the BSE small-cap index should show up for you because that was showing some amount of resilience as well. But nonetheless, the advance decline ratio holding in positive terrain. We have the Bank Nifty, which is managing to hold up with a gain of around 0.3% as well. If you're talking about specific stocks within the broader markets, there's a lot which is buzzing around. But from the Nifty space, to watch out for L&T as well as Cipla, along with Geo Financial, Trent. All of these stocks are a couple of the top losers in today's trading session. So we're seeing losses coming in through all of these. Eternal, which is managing to hold up with a gain of around 3% along with the oil and gas space, ONGC, which is up around 2 to 2.5%. But we do have a very lively market on our hands in terms of the broader markets. And as usual, we're going to kick off the show with all of the buzzing stocks and all of the big stocks which are moving around in trade today. Vivek is here to take us through that list. Vivek.
Well, thank you so much for that. 2 days, 2 weekly expiries, and markets are quite volatile on the back of that advance decline ratio moving quite rapidly in either direction. In terms of individual stocks that we're tracking, GTPL Hathway, started off quite strongly, but has cooled off quite a bit from the day's highest point, up over 1% on steady Q3 numbers. Select IT stocks taking positive cues from the results of both TCS as well as HCL Tech. Some of these names doing quite well. Birlasoft, one from the mid-cap IT space, doing well. Tech Mahindra and Emphasis both up over 1% each. Balaji Amines, one particular stock from the broader end of the markets today, after a while, has seen quite a bit of positive inflows, up almost 11.5% on good volumes today. And Godfrey Phillips, after the recent beating that cigarette stocks have taken, today Godfrey Phillips is up quite strong. That particular stock, one of the top gainers as far as the broader end of the mid-cap space is concerned. On the other hand, quite a few laggards as well. You just mentioned L&T, that stock down over 2.5%, close to $4.5 billion of orders under limbo. This on the back of the fact that Kuwait is looking to retender some of the earlier orders where L&T had participated and had emerged as lowest bidders in. The other stock, HEG, one of the top laggards on the NSE 500 index. Cipla, you just mentioned Cipla, is one of the top laggards on the Nifty. Again, Aurobindo's likely acquisition target, that particular company has received a US FDA nod for generic version of Advair. Cipla seen as getting negatively or adversely impacted by that, down over 1.5%. And Godrej Properties, one name from the Realty Pack, continues to trade under pressure at a fresh 52-week low today.
Okay, some interesting names. Realty continues to be under pressure. We've been highlighting some demand concerns that some of the players have highlighted in Q3 updates. Thank you so much, Vivek, for joining us as always and getting us up to speed with broader market movers. With that, we'll slip into a short break. When we come back, we'll talk more about markets. We'll connect with the management of Metropolis Healthcare. Stay tuned for that conversation.
Fly Emirates, fly better.
Welcome back. Well, let's get talking to the first management that we have on the show. Metropolis Healthcare is the one that we're talking about. Ameera Shah, the promoter and the executive chairperson at Metropolis, joins in now. We will be discussing three key focal points. First is the launch of their Center of Genomics. Q3 FY26 has seen momentum in True Health, which is basically their preventive healthcare business. And thirdly, the integration of the recent acquisitions that they've made. Ameera, hi. Thank you very much for joining in and speaking with CNBC TV18. Wishing you a happy new year as well.
Same to you. Thanks for having me.
Well, Ameera, let's start with this Center of Genomics that, Metropolis has launched. Just tell us what it does and how does it differentiate you from the rest?
See, genomics is, it's not just another test. It's actually the most cutting edge technologies available globally now that are going to take the way we diagnose, the way we predict diseases, the way we treat to absolutely another level, especially in cases of oncology, neurology. So genomics is a very exciting area where we're really bringing what's globally available to India and to all Indians. There are a few centers or few labs that are offering genomics today. I think out of all the numbers, it'll be very few on a handful. But really, it's about doing it at world-class quality. It's about expanding the test menu and really doing it in a way that offers doctors some real insights that they're able to take actions on. And in our case, it's not just testing. We're bringing together testing with the best expertise in the country, the best equipment, the best people, clinical counselors, genetic counselors as well. along with bioinformatics. And all these together is what creates the Center for Genomics at Metropolis.
Okay, Ameera, can you give us some numbers in that case? Since you're saying you'll be getting on board a lot of specialists, and there'll be a lot more special treatments that could be done here as well, right? So what kind of investments will Metropolis be making on this one? And how does the margin profile differ from the other regular tests and the entire specialty vertical?
So we already do genomics. We already have about 220 tests that we are already currently doing. Why we are launching the center now is because we are really adding a lot of experts to it. We're bringing in the genetic counseling as well and really making it very holistic and well-rounded. We will be expanding these 220 varieties of tests to 500 over the next couple of years. And we're very excited about where we can take genomics in terms of how it's happening globally and bring that to India. These tests are not about volumes because you're not dealing with cholesterol and blood sugar. It's not those kind of tests. These are tests which you're dealing with for oncology, like I said, for strokes, for some immunity issues. You're talking about for gut, cancer, for colon cancer. So you're dealing with sort of very high-end complex diseases, rare genetic disorders, and talking about using genomics to find the chances of you having it, finding exactly what's causing it, and then being able to guide you in the right treatment so that you're able to solve it in the right way. Often what happens is when we don't know what the real cause is, what the genetic mutation that's causing it, we can keep trying drugs on a patient which have no effect. And that wastes time and wastes life of a patient. Here, by having very accurate genomics with the insights that a doctor can use, you can treat the patient better, faster, and you can hopefully predict and prevent some of these issues.
Okay. Well, Ameera, give us a sense in terms of the larger picture for Metropolis now, because you had your specialty business, which was up around 30% in the previous quarter. And I know you're in your silent period, so we're not going to go into numbers. But is there a trend that Metropolis is now focusing more on specialty tests? Is that going to be something which is going to be a larger piece of the pie for you simply because maybe the margins are higher, the competition is less?
So Ekta, actually, we've always been a specialty-focused chain of labs, and that really what differentiates us from everybody else. Today, even about 38% of our revenues come from specialty tests and super specialty tests, and this is an area that we're only looking to keep increasing and expanding. While gross margins are lower on specialty tests, the EBITDA per test or per patient is obviously higher. But I think what we find about specialty tests more than anything else, it really builds a moat around the business. And it makes your brand very relevant to doctors. It makes your brand very required by patients because you're treating the most complex diseases at the most critical time of people's lives. And therefore, you become a little bit irreplaceable along the journey. So yes, the specialty areas will continue to grow fast for us as they have been.
Ameera, just coming back on the margin front, you said it is not a volume game. It is largely for very minute details to figure out whether you have the bigger diseases or not. Just trying to put a number to it, would it mean that the margin per test would be higher here? And if yes, if you can just give us a range, how much higher would this mean for your own margins from the current levels?
The margin per test, like I said, from a percentage basis may not be higher, but these tests don't come as individual tests. See, what happens in pathology often is that one patient will come to you for multiple samples. So you're already having a certain fixed cost around collecting that sample from that patient. So if you're able to add any incremental specialized test to it, which is needed by the patient, then your margin on that actually will be significantly positive for you. If you are obviously just going and picking up the specialized test on its own, the EBITDA margin may not be as good as a routine margin. But overall, we believe that genomics will help us to continue to build a high quality business, which will lead to expanding margins in time.
Okay. Are you expecting this kind of run rate in terms of growth to continue, say for your True Health as well as your specialty segment, both which were up around over 30% in the previous quarter?
So, I mean, the numbers obviously that we've reported of the consolidated numbers are including the acquisitions we've done. If you look at the organic growth, actually were very strong numbers in Q3. where we shared that it's about 15% growth standalone for Metropolis, with the margin expansion as well. And we did share that True Health numbers were up quite fairly as well, and specialty was also trending well. So yes, these are all the focused areas of the business. Now, one quarter may not be fully reflective of the whole year, but over the year's period, if I look at FY26, FY27, we are looking at a organic growth between 13 to 15%, with the margin expansion from last year.
Okay. Any kind of acquisition that you'd be looking at within the genomic space, considering that you have had these, multiple acquisitions which you've made in the past year odd, but anything more specific on specialty and genomics?
Not at this time, Ekta. I mean, actually, if you look at it, the acquisitions we always do are always very strategic and very selective, right? What are you really getting in return? And honestly, in genomics, it's not like there are a very large number of companies which have anything more skilled than we do. So frankly, we would be already at the pinnacle of the market from a perspective of skilling and expertise. So usually you find people poaching from us, not the other way around. So in this case, we have now the best talent, we have the best machines, we have the expertise. So frankly, I think organic is the way to go.
Okay, so you do not have, if not for this particular segment, do you have acquisition plans in any other segment? And if yes, is there any kitty set aside?
Yeah, I mean, there's always a kitty set aside. We always have a sort of a fund for acquisitions that we're looking at. As you've seen, we've done 3 bolt-on acquisitions this past year in Dehradun, in Agra, and in Kolhapur. All of them in our mind were, obviously you get an arbitrage from a Metropolis shareholder basis because you're buying them at low multiples of EBITDA, but you believe that these businesses can be grown faster and can be bigger under the Metropolis umbrella. Margins are already reasonably good in these acquisitions, so they'll obviously continue to grow with scale over time. So we'll continue to do such bolt-on acquisitions year to year, along with growing the business organically as strongly as we can.
Just quickly, before we let you go, Ameera, interestingly, Dr. Lal's has started this diagnostic center, diagnostic/wellness center just recently. Are you looking to possibly diversify a little bit, maybe get into diagnostics, maybe get into radiology, maybe set up a center such as this?
So we already offer soft radiology across multiple locations. I think, ECGs, X-rays, sonographies, we offer across multiple, and we are expanding that in quite a big way. We continue to evaluate CT, MRI, and high-end radiology as well. I don't have an answer at this point for you, Ekta, but we'll keep you updated if we do have one.
Okay, so we'll come back to you for that conversation. Thank you so much, Ameera, for joining us today and taking us through the new plan and the outlook on the business going forward as well. That's the word coming in from Metropolis, the expansion plans and any further acquisition that the company has planned as well. But let's talk about what's happening in the F&O space. Mangalam is joining us with more details on this one. Mangalam.
Well, if you look at the markets right now, it is slightly off the highs, marginally in the red, but nothing really to worry about, because if you look at it, the Nifty Bank, as well as the mid-cap index, all of them are in focus. The mid-cap index, more in the red than the other indices, but importantly, the advance decline is still in favor of the advances. As we speak, Reliance is the top drag on the frontline index. There you have it. Advances marginally above the declines, though those lines are coming closer. If you pull up, the Reliance intraday, and that will tell you that we are seeing a fair amount of pressure on the frontline index, largely led by Reliance, because the Nifty Bank is in the green, as is the IT index. But ahead of expiry, it's the 25,750 mark, which is fairly active in terms of calls and puts. So the 25,750 call, about 30 rupees in premium, 25,750 put, that comes up for you. That has another 40, 45, 50 rupees in terms of premium. So it's about 70, 80 rupees around this 750 mark, where the street expects the expiry to move around. So if you put those numbers, it's around 25,670 to roughly 25,820 or thereabouts. That's the broad range we're looking at. If you want to extend that argument, you'd also see, writing at the 25,800 call and the 25,700 put. Again, the premium on this coincides with the range that the option writers are playing for right now. 25,700 put has a 30 rupee premium, telling you that, it is about 25,670 thereabouts where support is expected for the Nifty. Amidst all of this, we do have a bunch of stocks which are actually fairly well bid, And Manappuram and ONGC are the ones which are seeing a lot of long positions being added this hour itself.
Okay, all right, Mangalam, thanks very much for that. Well, we need to take a short break with the news that the Nifty is just about lower by around 66 odd points, but we're seeing incremental pressure coming in to the mid-cap index. We'll take a break, but on the other side, we'll focus on the likely NSE IPO. That conversation coming up next. Stay tuned. Welcome back. You're still tuned into Halftime Report. The market is at the day's low. Let's try and understand and get in some market opinion and also talk about the upcoming budget. Chirag Setalwar, the HDFC AMC, at HDFC AMC says the budget has lost relevance and it has to go beyond the regular. He tells Prashant Nair that the government needs to introduce more reforms and measures. Listen in as to what he had to say.
I think the key question, though, in more seriousness is how they view fiscal prudence, because this year your tax collections have been far below target and your expenditure still has to be cut fairly substantially in the next 4 months to meet your expenditure targets. So chances are you'll exceed your expenditure targets and you'll underplay your revenue targets. So the question is, will this government stick with its discipline on the fiscal side or not? And I think there are a lot of people, and I suspect I could be one of them, is maybe we shouldn't, right? We don't have to have this holy grail of fiscal discipline. If we are in an environment of uncertainty, maybe you loosen it up a little bit. Other economies have done that, so why can't we?
Okay, interesting comments coming in there. But as of now, we need to take a short break. But that promised conversation on the likely NSE IPO coming up next. Stay tuned. Welcome back. Still tuned into Halftime Report. Well, SEBI Chairman Tuhin Kanta Pandey indicated that the process of granting an NOC for NSE IPO is nearing completion. Let's listen into what he had to say.
We are at very advanced stage of issuing the NOC for NSE IPO. When can we expect? Maybe within this month.
Okay, imminent possibility of the NSE IPO possibly in this month itself. But Nimish has been doing a lot of number crunching around it. He joins in with the key metrics with regards to this much awaited IPO. Nimish, over to you.
Thanks, Ekta. So as you rightly pointed out, it's a much awaited IPO, but it looks like finally should be on the cards, given that what you heard from the SEBI chairman as well. So I'm putting the spotlight on NSE and in terms of numbers and what are the key metrics to watch out for. Now, the total outstanding shares of NSE after the adjustment of bonus shares is 247.5 crore shares. I'm taking an unlisted current price is around 2,000 rupees, which means that NSE will command a market cap of 4.95 lakh crores as in if it listed around 2,000 rupees per share, which is nearly 5 lakh crores of market cap for NSE. Now, we all know that the self-listing is not allowed. So obviously, NSE has to be listed on some other exchanges. Just for an example, I've looked at the BSE top 30 companies. Only 10 companies are actually commanding a market cap of more than 10 lakh crores. So assuming it lists on BSE, it will be among the top 10 companies for sure, as and when NSE lists. So that's just a number to watch out for. Now, in terms of earnings and what are the valuations for NSE? The first half of FY26, NSE reported an EPS of 25 rupees. For the full year estimated, Street is anticipating 50 rupees of EPS. And for FY27, I just took the BNK estimate, and they were estimating 51 rupees of EPS. Now, given that if it earns 51 rupees with a market cap of nearly 5 lakh crore, NSE would be quoting at a multiple of close to 39 times. Now, let's compare this with the Indian peers. BSE, MCX, and IEX, the other three listed entities. BSE on FY27 earnings is quoting at close to 43 times. MCX is at 48.5 times, and IEX is close to 25 times. So that's the valuation metrics for NSE versus the Indian peers. Now, I've also looked at NSE's comparison to the global peers, the likes of Hong Kong Stock Exchange, London Stock Exchange, the NYSE and others as well. Versus NSE at 39, all others are between 20 to 25 times. But it's not a like-to-like comparison, so to speak, because the growth metrics, the earnings metrics are way, way different for NSE. For example, Hong Kong Stock Exchange last year grew at just 4%, and NSE is growing at almost 40-50%. So that's the kind of growth NSE has been reporting. Now look at the shareholding pattern. This is going to be quite important because all will be selling shareholders in NSE. It won't be an IPO, it will be a FPO. LIC owns the highest stake in NSE at this point in time, close to 10.7%. And remember, LIC is listed as well. Stockholding Corporation owns 4.4%. SBI Capital owns 4.3%. SBI, the bank, owns 3.2% stake in NSE. The likes of GIC owns 1.6%, Oriental Bank 1.4%, and New India Assurance own 1.4%. Some of them are listed entities as well, so they will be selling shareholders. So watch out for value unlocking for all these companies. If you just look at the overall shareholding pattern, the PSUs, within the PSU basket, the PSUs in total own close to 31.3% stake in NSE. Within that, the insurance company is 17.5%. Of course, LIC is the highest in that, 10%. Financial firms own 8.9%, and banks own close to 4.5%. So that's the PSU which owns into NSE. I've also picked up some individual shareholders from that list of what I've picked up. Rekha Jhunjhunwala owns a big stake in NSE. So is Radhakishan Damani. He's been known as the guy who having a Midas touch. He was one of the first holders to buy into NSE, and the likes of personalities like Sachin Tendulkar and Shah Rukh Khan as well. They are the prominent holders of NSE. So long list of holders in NSE. But just to give a number on FY27 estimates, NSE will be quoting at close to 39 times, which is not very expensive given the kind of growth they've been reporting for the last many years. So that's just a spotlight on as and when NSE gets listed. That's the kind of number to watch out for.
Okay, all right, Nimesh, thank you so much for bringing us all those details, the much-awaited IPO, and some commentary coming in from SEBI on that as well. Let's get in Gurmeet Chadda, the managing partner and CIO at Complete Circle, to understand more about the possibility of this IPO getting approval or the NOC coming by this month itself. Gurmeet, good afternoon. Thank you so much for joining in. First up, what do you make of the valuations 39 times? And considering that it has seen so much up and down in the unlisted market as well, what would the listing look like? Because we did see some disappointment in Tata Capital. People did buy it at hefty premium. How are you, analyzing all of this that's happening in the market?
Hi, Sonal, and festive greetings to everyone. I think NSE is one of the most awaited IPO, especially since the ISIN got unlocked and free trading was allowed. Well, earlier, there were only large blocks, and all these marquee investors actually started entering in 2019 when SCI and large institutions offloaded large blocks. But it has consolidated. It reached a peak of 2,400 odd levels, and then I think it was about 1,900 odd rupees for a very long time. Right now, it's about little over 2,000 rupees. So at that, it's almost 40 times. So it's definitely not like very cheap. And I think going by the NSDL listing, the IPO price could be around this price. It could be also slightly softer. So if you have to enter NSE, you have to take a more 3 to 5 year view in terms of holding the stocks. You'll find a lot of interest from endowment funds, large institutions, MFs, long-only funds, because this is a 25-30% compounding machine. Their market share is almost in 90s in most segments. Options, they are at about 80%. And also, I think I saw one data. There's one concern around this expiry cycle changing. The spreads of option now on a daily basis now pretty even, with a little bit of spike which comes on expiry. So I think once that overhang goes, the stock may see further movement, but it's a great stock to hold for long term. They are also diversifying, Sonal, in terms of electricity futures. They almost now have 4 lakh contracts since the time it was launched in something around July. The MF platform 2.0 is seeing a lot of traction. So it's the obviously there is dependency on transaction charges, which is 80% of the revenue, but it's also getting a little diversified now.
Gurmeet, hi. Thanks very much for joining in and speaking to us about this much-awaited IPO. You're not concerned about the previous quarter numbers where, say, the profit was down over 30%, revenue was down around 18%. It's expected to deliver maybe a softer Q3 as well?
See, it was, if you remove the one-off, which was, I think, 1293 crores, which is related to settlement charges, the profit was around 3400 crores. So there was a minor dip. Obviously, it was coming from a very high base in 2024 when market was seeing what it was seeing. So I'm not really concerned on some softness quarter on quarter. See, end of the day, so if you see, for example, H1, almost 122 listings happened in NSE. Almost 80 to 83% of bulk deals and block deals happen on NSE because of obviously volume and superior price discovery. So it's kind of a play. It's not even a duopoly. It is one player having 85-90% share. So quarter on quarter weakness can happen. Also, they have a lot of subsidiaries which are doing well, whether it is NSE Academy, NSE IT, the Gift City. So there's some valuation even in subsidiaries. So, but as I said, don't go for listing gains. Maybe the price could be very near to or lower to, where the IPO price will come. A little early to comment on that. If you want to have a 3-5 view, you will see a lot of institutional interest in this. And if you want to hold it for long term, may not be a bad idea to even get it now at this price.
Hi, Gurmeet. Thanks for joining in. Sorry, I should have put in your photo as well as one of the holders of NSE. I missed that. But nevertheless, as and when it happens, it'll be a good gain for you as well. From a listing point of view, Gurmeet, now that it's much certain that this year the listing will happen, obviously, there is a discount because it's an unlisted right now. What would be, in your mind, a fair value in terms of P multiple for a stock like NSE when it lists? Okay, so that will give a fair idea. Assuming if you're giving a multiple of 50, then people know if that's the earning of around 50-55 rupees, then that's the kind of number you can watch out for. So, but that is one. And two, from a long-term perspective, we've seen what happened to BSE in the last 5 years. We've seen what M6 has done. All the stocks have been 10x in the last 4, 5, 7 years. So from that perspective, at 5 lakh crore market cap, is it good to anticipate that even from 5 lakh crore market cap, NSE can be a 10x story?
Yeah, even if NSE also, Nimesh, for that matter, from 2019 is a 10x story. In fact, it's for the past 2 years, right? Yeah. I don't think so. You should expect 10x going forward, because as the base goes up, see, we took 15 years to add 1 crore customers in NSE unique. Then it took 6-7 years. Today, we are adding 1 crore customers every 6 months. So I think it can grow at 25-30%, even for next 4-5 years. And with that, you can come, maybe it can double 3 years, 4 years. So I think right now is what the valuation, in my view, is a good valuation over long term. You might get a bit of a spike on listing because there will be a lot of interest on this. As I said, a lot of endowment funds. I've been speaking to a lot of institutional investors. There's also renewed interest now in the unlisted market. So a lot of big investors will come in. It's a very marquee name to have in, and a perfect play on financialization of savings, capital market infrastructure. At some point of time, there'll be value unlocking also in subsidiaries, going forward. So get in with a long-term steady compounding play, not for listing gains, alone, and keep the story long.
So, Gurmeet, we've spoken about all the fundamental triggers going forward. What are some of the risks investors should be wary of, right? That's very important to understand.
See, it will get listed on BSE. So there could be an advantage maybe BSE get. And I've also heard Metropolitan Stock Exchange is starting operations, but it's very speculative in nature. See, these kind of businesses have, and if SEBI goes down very hard on index options in terms of cycle of it, there could be a sentimental impact on the near term. So those are the things you have to be a little careful of, because transaction revenues out of, let's say, 3,500 crores it does quarterly, 2,800 crores is transaction. And other, like are picking up. So that's the near-term risk in my view, but it's a steady long-term play.
Okay. Just on the price, the unlisted price is at around 2,000 odd rupees. The peak was 2,400 odd rupees, and some analysts are pegging the range maybe between 1,500 to 1,800. On the unlisted side, where do you expect the stock to possibly settle? Do you think that it'll possibly go back to that peak of 2,400, or do you think that it's going to be range bound? What's your sense? And, consequently, what is the possible price that we would probably see on listing as well, considering that the IPO could be around the corner?
Very difficult data, but as I said, there is an interest in the stock. It's moved up from 1850, 1900 levels to closer to 2050, 2100 already in the unlisted market. If the market sentiment turns around, maybe it can go up. It can maybe touch 23, 2400 also, but that depends on how the overall sentiment is. It's just that the market has not been in a great space, sentimentally speaking, because of the supply pressure. I sense that NSE, going by NSDL, will price it slightly cheaper for retail investors. That's my sense. I could be wrong on it. But you will not get much allotment because there'll be a lot of interest in the IPO. So if you want to get in for a long-term play, you can get in at this price. If you only want to go for listing gains, I don't think so. This is the right space to target.
Okay, long-term story, Gurmeet. That's the word coming in for the NSE IPO, as well as Nimesh. Thanks very much for joining in.
Two takeaways for me, Ekta. One, as what Gurmeet said, that NSE will list on BSE. Obviously, self-listing is not allowed, but there could be multiple options to list. So, let's wait and see as to where it lists. And two, as and when the IPO comes, I'll be focusing on all the selling shareholders. So there will be a value unlocking for all those guys.
Will it be as glitzy and glamorous in terms of shareholders as it is now? But thanks very much, Nimesh, as well as Gurmeet, for joining in and taking us through that conversation. We need to take a short break, but before we do take that break, just a quick heads up. If you're thinking about where the real opportunities for 2026 lie, Market Forum, the alpha generators for 2026, is where that conversation begins. The alpha table awaits. Join CNBC-TV18 as we host the ultimate confluence of India's market movers. Tune in on 13th Jan, Tuesday, 4:30 p.m. onwards, only on CNBC-TV18.
Welcome back, and Rajesh Paharia now joins us for a conversation on the impact on the rice trade or exports from India, given the fact that there are 25% tariffs put on from US on Iran's partners therein. Mr. Paharia, hi, thank you so much for joining in. What is the sense that you make? Second largest country in sense of partners or the exports that India does in sense of basmati rice with this 25% tariff and the fact that Iran is going through a lot within the country as well. What does it mean for trade and for the rice exporters in India?
Namaste Manisha ji, thank you. This is a very crucial topic which you have taken up today, and we all rice exporter, or rather I can say rice and tea exporters, are suffering from this. Since not from today, before the 25% duty which was imposed, we have been suffering for this. A lot of things has been happening in case of Iran, like the payment delays has been over 180 days now. There has been a sharp depreciation in Iranian rial. Then apart from that, so much of restrictions are being there on banking transaction, channels of modus of payment, and the shipping and the insurance cost also has been rising, hovering like anything. So 25% increase tariff which has been levied, that also is going to be impacting the rice exports from Iran to Iran from India. And apart from that, the most important thing is that Iran is completely dependent on India. So how these things and modus operandi has to be worked out, that our government has to think about it, and exporters have to be very particular while trading to Iran at the moment.
Mr. Paharia, as you mentioned, that almost everything seems to be at a standstill right now. Are there any conversations that you as a trading fraternity have had with the Indian government on this?
Ma'am, a couple of days ago, only we have spoken to authorities like APEDA, and wherein they will be issuing guidelines for how to mitigate the risk of trading with Iran. So hopefully, Ministry of Commerce and under APEDA will be issuing some guidelines, what kind of precautions we as an exporter should take, what remedies they are going to provide us to secure our payments. There is a lot of cargo which is in transit also. How to mitigate the insurance risk also in that case.
Mr. Paharia, the other thing really is about the rice availability and rice prices itself in the Indian markets. I mean, we've seen a huge bumper crop this time around. The prices have been under pressure. The global rice prices are trading at an 8-year lows as well. What does this mean for the overall availability and the prices going ahead?
Manisha ji, in this case, I would rather say that in Hindi we call it पेट भरने से पोषण का चावल ज़्यादा जरूरी हो गया है. So a lot of shift has been there from normal consumption to nutritional food. So a lot of rice millers, the basmati one, they have come up with glamic rice and a lot of added values rice. So the consumption in India has persistently has been increasing. So that can be one of the reasons that Indian prices have increased despite the good production number. Globally, non-basmati prices are lowest since last 8 years because of the oversupply and the stock holding which is there with the government of India at the moment. We are having the highest MSP price and the lowest realization value on FOB terms.
Oh, absolutely. Also, how are you looking at the other markets? Because I remember having a conversation with you where you said that after 50% tariff that US put in, you were looking at other markets. Now, Iran is another big market and you have a 25% tariff on this as well. What is your sense on exports from here? And what kind of newer markets do you think that the Indian rice exporters could be looking at now?
Manisha ji, combined together basmati and non-basmati, there is hardly any market where the Indian produce has not been shipped, whether it is smallest country or to the largest consumer, even like US also. Main issue is with the expat Indians in US market, wherein they have got no option else the taste of Indian rice that has to reach to their kitchens. So whatever the tariffs or whatever the way the government of America is going to put it, the consumption is not going to change. Apart from US, a lot of way have been taken out, like they have been trying the Brazilian varieties, but that is not acceptable to the Indian consumer or to the restaurant owners. Number one. Number two, if I say that new markets, many of the markets are trying to become self-sufficient in rice. Nigeria, which happens to be one of the West Coast African market, happens to be one of the largest one. they are supporting their own produce like anything. And despite their cost of production, despite their quality is very low, but still they are preferring that self-sufficiency has to be gained, maybe not in a year, maybe in a decade or so, but they are also working accordingly. It is going to be a tough time for Indian rice exporters, wherein we have to penetrate into the market where other origins are also there. And we seek the support of the government in this, when whatever senses, whatever ways they can support, because Indian rice holds almost 20% of the agriculture exports.
Right.
So they have to have a blessings on all the exporters, so we survive and we cater to the whole of the world.
All right. So all of agri-export, 20% of that is rice, and with the concerns coming in from US and now from Iran, there clearly is a bit of a problem that the Indian rice exporters seem to be facing right now. Mr. Padia, as always, thank you so much for joining in. And with that, we go for a short break, come back and talk more markets and stock specifics.
Welcome back. Well, for the market sluggish, but just want to point out one particular stock which stands out in today's trading session, that Cipla has recovered from the day's low. But there is some amount of incremental competition that we could see for its respiratory drug Advair generic. That is because the company Lannett, which Aurobindo had acquired in July for $250 million, and that acquisition is still to close, has received approval
for that drug as per analysts. So that means that there will be more competition coming in for Cipla. Remember, they've been awaiting approval since 2020 for this particular drug. But on that note, we need to wrap up on the show. Stay tuned. Business Lunch will take all of the action forward.
The markets fall to the lowest point of the day on the Nifty weekly expiry. Real estate and pharma stocks are under pressure, while capital markets and metals pack are bucking the trend. The US announces a 25% tariffs on countries doing business with Iran. The new tariff threat comes after Donald Trump threatened to intervene militarily if Tehran killed protesters. India is one of the top trading partners with Iran after China, Iraq, UAE and Turkey. And the rice industry could be impacted in India with basmati exports, a meaningful chunk of what India sends to Iran. Large cap IT companies report numbers for the third quarter. TCS is flat after an inline set of results. The management tells CNBC-TV18 that there will be more acquisitions going forward. HCL Tech, though, is having a choppy session despite a good start. Even as earnings were a beat on all fronts, the management is confident of margins being between 18 to 19% in FY27. And Larsen & Toubro is under pressure today after news reports suggest that Kuwait is discussing plans to cancel oil project tenders worth close to $9 billion. Analysts tell CNBC-TV18 that L&T was the lowest bidder in tenders worth more than $4.5 billion of them. Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I am Hormuz Fatakia, and contrary to the recovery that we were seeing in the markets just 24 hours earlier, that recovery is now turned into a bit of a reversal from those higher levels. We opened higher this morning, and since then it's been a bit of a choppy move, but the last 30 minutes it's been a bit of a one-way slide down for the Nifty. 25,630 is where the index now stands. So we most probably have given up 2/3 of what we had recovered from yesterday's low, which was 25,473, and it's a 270 point downtick from the highs of the day. Remember, we closed around 320 points off the lows of the day yesterday, and now we are around 270 points off the day's high. The one index that was holding the Nifty in the green for the first half of the trading session was the Nifty Bank, and that has now given up all of its gains, has moved into the red, and as a result of which it has had an impact on the index as well. There you can see the sharp fall that you have seen on the Nifty Bank. The screen will show you that it's only down 0.1%, but it's a 400 point fall from the highs of the day. Levels of 59,700, 800 is where the index had earlier reached, but now it's back below that 59,500 mark, which was an important level to watch on the index. It pull up the index heavyweights, HDFC Bank, ICICI Bank and SBI. They were the three names that were the ones that were pulling the Nifty Bank higher and resultantly the Nifty as well. HDFC Bank has now moved to the lows of the day as well, as is ICICI Bank. That has been an outperformer that continues to remain in the green, still 1.5% higher on ICICI Bank. So good going for the other index heavyweight other than HDFC Bank. But the other major talking point today has been the big IT results to which these stocks are reacting. TCS kicked off the results season with a steady quarter, but HCL Tech's results were a beat on most parameters. Rima is here with the earnings fine print. Rima.
Thanks so much for that. So for TCS, as you said, largely in line with expectations, no big beat. The company's top line came in at 0.8% quarter-on-quarter in constant currency. They managed to hold on to their profitability as well, margins unchanged at 25.2%. But as Kotak encapsulates it very well, which explains the price action also. Now, FY26 has been a year of growth underperformance for TCS. TCS is taking measures to close the gap with peers. The initial results are encouraging, but for a re-rating, a sustained re-rating, more needs to be done, a sustained execution. Nomura says, and that's on the top line. On the margins, unless we see growth, it's very hard to imagine a very strong margin expansion. HCL Tech, as you rightly pointed out, surprised positively in Q3, revenue growth coming in strong, 4.2%. And also the management in the interaction with CNBC-TV18 said they feel pretty confident about 18 to 19% margins going ahead. But the problem is, as Kotak says, the stock trades at 23 times forward multiple at a premium to peers and therefore fully valued, according to Kotak. AI is growing. It's a very small portion of the IT companies, but it's growing fast. For TCS, annualized AI revenue stand at $1.8 billion. For HCL Tech, AI went up 20% on a quarter-on-quarter basis, and now on a quarterly basis, advanced AI revenues are close to $150 million. Goldman Sachs is inferred from both these results and what it means for the IT sector. They say the results suggest that demand environment is stable to improving, but companies still have limited visibility on the extent of recovery in this calendar year. The BFSI vertical has been strong, and they see a neutral to modestly positive read for the rest of the IT stocks. Back to you.
Rima, thank you for summarizing that for us. HCL Tech still 1% lower, so some choppy moves seen in both of these names, TCS and HCL Tech. Listen in to what the top managements of both of these companies had to say.
Our ambition is to be the world's largest AI-led services company. And we laid out 5 pillars through which we are going to achieve. And one of the pillars about that is how do we play in the larger ecosystem. And we said we are going to be more acquisitive going forward.
We have done very well in the last 2 quarters, and given the strong bookings in the Q2 and Q3, The Q2, Q3 booking is almost 30% higher than in the same period last year. So we are looking at some good uptick in revenue in Q4 in the services, and then of course Q1 as well. So I think given our booking, given our pipeline, and all the momentum that we have, we are looking at a good outcome in the next year. However, anything specific, we will really have to wait for the April meetings.
Just before we move on, pull up two names that are dragging towards the lows of the day. One is Dixon Technologies. The stock is now down 5% as we speak. So a very sharp fall seen in Dixon Technologies at a 52-week low now is where the stock is. And the other one that has moved below the mark of 4,000 is Trent. And that too is now down 5.5%. Among the top losers on the index is what Trent is. Dragging the index lower as well. So 5% lower, a very sharp downtick there in the last few minutes for Trent. But the other big headline for the morning was the fact that the Bloomberg Index Services has deferred the inclusion of the Indian government securities in the Bloomberg Global Aggregate Index, citing the need for further evaluation of operational and market infrastructure aspects. Ritu is here with the breakdown of this. Ritu.
That's right, Hormaz. Bloomberg Index Services seems to have deferred the inclusion, the much anticipated inclusion in the Global Aggregate Index. But importantly, it has said the review is still open and it is ongoing. Now, remember, India is currently being evaluated for a potential weighting of around 1% on the index, which could translate into inflows of about $25 billion over 10 months is the estimate, if admitted, of course. So no decision that we've got today, but the Bloomberg Index Services, update did say that they will have an update on the matter by the middle of this calendar year, that is by 2026 mid-year. They also pointed out that there were, some acknowledgements from the market participants that backed India's bond market trajectory and the eventual inclusion in the global investment grade indices, acknowledging some of the progress that has been made, whether that is better market access, the fully accessible route. But at the same time, there are quite a few concerns that it has flagged operational and market infrastructure gaps that still need work, and that includes limited automated trading, the post-trade tax-related settlement delays, etc. And as a result, the review is still open and ongoing. And, we are expecting this update by mid-2026. Bloomberg Index Services also says that the decision on inclusion is going to be announced well in advance and implemented in a phased manner, so there is no disruption in the market, and there'll be a one-year gap between the announcement and the commencement as well. Now, an important event for the market simply because the inclusion is going to attract foreign inflows. The higher demand for our paper can lower the borrowing cost and also, of course, boost the long-term market liquidity as well. The bond market reacting negatively to the news because most of the participants had actually anticipated the inclusion to be announced this week itself.
Ritu, thank you for summarizing that for us. Take a short break, but before we do that, here's a quick note for our viewers. Get ready for CNBC-TV18's all-new lineup in this new year. Incisive analysis, sharp commentary with CNBC-TV18's brand new offerings. You can watch our new segment, Cut the Balance Sheet with Mangalam and Sonal Bhutra. Watch macro signals with Ritu that isolates the macro forces that actually matter for the day. And finally, stay ahead of the curve with CNBC-TV18's most trusted in-house technical experts.
Fly Emirates, fly better.
Welcome back. Now, in a move aimed at increasing pressure on Tehran amidst the ongoing anti-government protests, US President Donald Trump has said that any country that does business with the country will be subjected to a tariff rate of 25% on any business conducted with the US. CNBC's Dan Murphy is here with the latest updates.
Indeed, well, Ritika, President Trump certainly escalating the pressure on Iran with this new warning, saying that any country that continues to do business with Tehran will be hit with this 25% tariff. Now, this move could ultimately hurt some of Iran's biggest trading partners, including China, of course, which maintains key commercial and energy ties with the Islamic Republic. Iran produces about 3.4 million barrels per day of oil, and about half of all of that is exported to China, according to Kepler. So keep in mind that China would probably be the hardest hit here as a result of these new tariffs. But at the same time as well, there are other trading partners, including the UAE, that could also be caught in the crosshairs. I spoke with the US Undersecretary for Economic Affairs, Jacob Hellberg, on Access Middle East this morning. He says the president is currently weighing options and keeping all options on the table. Listen.
The Iranian regime has neglected its economy, its agriculture, its water, and its electricity in order to squander Iran's vast wealth on terrorist proxies and nuclear weapons research, all the while denying the Iranian people their basic rights. They want and deserve a better life. Ultimately, their future is in the Iranian people's hands. The United States, as President Trump has made clear, will not tolerate massacres in the streets. And ultimately, we're monitoring the situation in Iran very closely and have yet to deliberate on how we're going to respond to events as they unfold in real time.
You heard there a key US official saying the president's still deliberating on exactly what he'll do next. But of course, this tariff threat also comes as Trump says Iran's leaders have actually reached out. They claim they want to negotiate now, even as the president still considers military action here, which he says could come first. Now, it's understood the president will receive another briefing today on the situation as he weighs his options, of course, ranging from economic pressure, including the tariff measures that you've just heard, to full military action as well. Certainly the worst case scenario for risk assets. Meanwhile, on the ground inside Iran, activists say hundreds of people have been killed as security forces move to crush those protests, sparked, of course, by soaring prices and Iran's crashing currency. Internet and phone blackouts have made it really difficult to verify the full scale of the crackdown. But some of the pictures that we've been seeing coming out of Iran over the last 24 to 48 hours have been quite extraordinary. And of course, this is certainly capturing the attention of not just Gulf leaders, but leaders all around the world.
Now, for India, this move could especially affect Indian rice exporters, as Iran is one of the top destinations for Indian basmati rice. In FY25, India exported around 8.5 lakh tons of basmati rice to Iran. Earlier today, we spoke to Akshay Gupta of KRBL and Dev Garg of the Indian Rice Exporters Federation to understand the impact these fresh tariffs would have on the Indian rice exporters. Listen in.
We used to do about 250,000 tons of business only to Iran market, which translated to about $100 million at that point in time, which was about 2018 is what I'm talking about. But business since then, sanctions have, been imposed and business has been constrained more and more over the years. So today our total exposure from KRBL's point of view is about $8 to $10 million, which we manage on a day-to-day basis because of the restricted markets. But we are industry-wise, Iran is a major market for the basmati rice industry. And the sanctions from the US, the 25% tariff from the US is just another, layer on top of the uncertainty. But what was happening in Iran itself was a point of concern for the industry.
Iran is one of the most important markets for Indian exports. Currently, for the last many years, Iran has been the second largest market for Indian rice. And Iran is importing more than 99% of all exports to Iran are of basmati rice. If we talk in terms of numbers, from April till November this year, we have exported goods worth $470 million USD to Iran. That is around 6 lakh metric tons. And if we look at the figures for last year, it was 8,55,000 metric tons, and the total export volume was 880 million USD. So Iran is one of the largest markets for Indian exports. And since this news has come in, we have seen a drastic fall in basmati rice prices in the domestic market.
Let's also now bring in Parikshit on what the Indian government plans to do after this tariff announcement on India's trading partners. Parikshit, over to you.
Well, definitely it would be a setback for Indian exporters. Now, Iran is one of our major trading partners in the region. The total trade with them in FY25 was close to $1.6 to $1.7 billion. We exported close to $1.2 to $1.24 billion worth of products. Largely, this was basmati rice. 61% of our exports to Iran, or roughly $725 million worth of exports, was of basmati rice. And then you have tea, essential oils and fruits as well. So these are the sectors which could be largely impacted if this 25% tariff were to come into effect. Now, at this stage, the Indian government does not have a reaction. Why? First of all, this is a post by Donald Trump on Truth Social that there will be maximum pressure on Iran. Countries trading or doing business with Iran will be slapped with a 25% tariff with immediate effect. Now, putting it on Truth Social is one thing. You have to notify it legally. The USTR will have to put out a statement. The US Customs and Border Control will also have to put out a notification. So these are the points that the Indian government will first watch out for. The exporters will watch out for. And only then will they try and get some sort of clarification from the US government. Having said that, there are 2 or 3 things that we'll have to look at over here. Is whether the 25% tariff that is being threatened, is it for future exports, future business with Iran, or the trade that has already taken place? Number 2, will it be over and above? Will this 25% tariff be over and above the tariffs that the US is already imposing? For example, in the case of India, the US is imposing a 50% tariff. So does this mean it will become 50 plus 25, 75% tariff? No one knows for the moment. Thirdly, whether it's going to be sector, product specific or across the board. That is something, again, we need clarity for. Number 4, very important from a connectivity perspective. India has huge stakes in the region through the Chabahar port, which connects us not just with Iran, but Afghanistan and Central Asia as well. It is a major connectivity project in the region. We had a sanctions waiver given to us by the United States in October last year. That is a 6-month waiver. It exhausts in April. Whether that will be scrapped now or does it stay till April, that is also something that we'll have to wait in for. And I'm assuming that in the next few days, the officials will be seeking clarity from the US government, and the US government too will come out with certain clarifications.
We'll await those clarifications. Parikshit, thank you for that update there. Take a short break, but just a heads up before that, if you're thinking about where the real opportunities lie for 2026, Market Forum, the alpha generators for 2026 is where that conversation begins. The alpha table awaits as you join CNBC TV18 as we host the ultimate confluence of India's market movers. Tune in on the 13th of January, that is today, and 4:30 p.m. onwards, only on CNBC TV18. Welcome back. On to the latest in the Tata Sons board, Rijik. Sources tell us that Neville Tata is likely to be inducted in the Tata Trust's board. Parikshit is back with us with more details on this. Parikshit.
Well, Neville Tata, who is just 32 years old, also the head of Star Bazaar, part of the Trent group, part of the larger Tata group as well. He's set to be inducted into Sir Ratan Tata Trust. Now, this is the key trust apart from Dorabji Tata Trust. In November last year, Neville Tata was inducted along with Bhaskar Bhatt into the Sir Dorabji Tata Trust. Now, with this, he will be on both the main groups within the Tata Trust, which control 51% stake in Tata Sons. Now, many say that this was already on the cards. He was a part of Dorabji Tata Trust, and it was assumed he'll become a part of Sir Ratan Tata Trust as well. This is likely to be on the board agenda when the Tata Trust meet this Saturday, the 17th of January. And it will have to be passed unanimously by all board members. Many outsiders don't see a problem to it. How they see it is this, that this could be Noel Tata's way of trying to restore some amount of balance within the Tata Trust after the differences and the exit of Mehli Mistry, which we had seen in 2025. That was a bitter picture in the history of Tata Trust, and we had seen a lot of tensions. So Noel Tata may want to bring some sort of balance and also make sure that he brings people, and there may be more people who will be inducted into Tata Trust this year after the likes of Pramit Zaveri, Darius Kambata. They are also due for reappointment this year. So it remains to be seen whether they will be reappointed or somebody else will come in. And it could be seen as a move by Noel Tata to bring people who are aligned with his thinking as far as how Tata Trust and Tata Sons should function in the years to come.
Parikshit, thank you for that update there. Numbers from ICICI Prudential flashing at the bottom of your screen. The values of new business up 19% from last year, 615 crore compared to 517 crore. VNB margins have seen an expansion compared to last year, almost 320 basis points, 24.4% compared to 21.2% last year. The stock has now moved to the highest point of the day. Good going for ICICI Prudential. We'll get more on this from Yash in just a bit. But for now, prima facie, the numbers appear to be on the higher side compared to last year. Take your leave on this edition of Business Lunch from me and the team. Thank you for watching. Midcap Radar on the other side.
Good afternoon. Welcome to Midcap Radar live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra and with me as always is Vivek Iyer. Very close to the day's low. We are off around 250 points from the highs of the day. We started the day at 25,900, very close to that mark, but now we are at the 25,650 mark. So big cut from the highs, and mid-caps too contributing to those losses that we are seeing in Bank Nifty, which was in the green, has also slipped into the red now.
Good afternoon, Sonal. You know, every buying is actually being seen as a selling opportunity, especially as far as the bears are concerned. And remember, 2 weekly expiries today as well as tomorrow, given the fact that 15th is a holiday. So that's also keeping the market under significant pressure. But a lot lined up on the show, so let's start off with the top headlines. Market slips to the day's low ahead of the Nifty weekly expiry, giving up all the gains from yesterday. Real estate and pharma under pressure, while capital markets, metals and financials trade in the greens. Mid-caps fall in line.
Realty stocks under pressure for the second straight session amid concerns of a slowdown in demand due to weak macro environment. The Nifty Realty Index is down over 1% and down nearly 19% from its 52-week high.
Balu Forge is upbeat and up over 10% in trade today in a volatile market as the company clarifies that the IT raid is complete and no incriminating documents were found or seized during the operation.
Metropolis Health shares recover sharply from lows after the management tells CNBC-TV18 that they will be expanding to 220 genomic tests going forward and that they are looking organic growth of around 13 to 15% for FY26 and FY27. All right, those are the top headlines as we've been discussing the market fall and the fact that most of the sectors are contributing to that as we speak. We do have the Bank Nifty, which was in the green for a larger period of time, but that has slipped into the red. The advance decline ratio is in the favor of declines, and at a point in time, it was in favor of advances. So the advance decline, those lines should come up here on the screen. They've merged and now in the favor of decline. So that's the texture of the market. The small cap index is in focus as well. It was in the green for a bit, but again, let's take a look at what it's doing right now. The small cap index, that one too. The mid cap index, of course, is lower in trade, 0.5%. The small cap index, though, bucking the trend up around 0.3%. But the texture continues to be on the bearish side.
That's right. You know, like you mentioned, realty has been under pressure for a while. Even the capital goods space, right? You know, that particular pocket, today L&T has joined the pack. A lot of the large cap names, mid cap names, all of them under significant pressure. That's also contributing to the fall as far as the markets are concerned. But this is our special segment, Mid Cap Movers. Sudarshan is standing by the wall to take us through all of the mid caps that are moving around in the session.
So while the market is under pressure, one stock that is holding on to the gains is Manappuram Finance for the second straight day. If you remember, on the Friday, there was a big fall on the Reuters report. But for the second straight day, we are seeing a big gain and also the support coming in from the price, gold price, and that's trading around the record high. So Manappuram currently up almost 4%. Now, some of the stocks have slipped to 52-week lows amid the weakness that we are seeing in the market. And on top of the list is Dixon Technologies, currently down almost 4%. At one point, it was down almost 6%. There is an expectation that there might be some moderation in the mobile revenue growth, and also in FY26, companies in all probability miss the guidance. Second name comes to Godrej Properties. Amid the weakness in the entire realty space, one stock that has fallen the most in last few trading sessions is Godrej Properties, and currently the stock is below 1900 rupees and trading at 52-week low. Next name is IRCTC. Amongst all the railway packs, in the last few, in the last 2 to 3 weeks, we had seen a big move. But after that big move, we are seeing a big fall. And one stock that has fallen the most in the last few trading sessions is the IRCTC, currently at just around 630 rupees and at fresh 52-week low. Last one, ahead of the earnings, Tube Investments has slipped to 52-week lows, currently around 2400 rupees. Lastly, about the few stocks that have seen unusual moves in the last 1 hour. First name on the list is Oriental Hotels, currently up almost 4%. At one point, it was up almost 7 to 8%. Company has released Q3 earnings, and by the first look, earnings looked strong, and that's the reason you are seeing a You can see the chart that that had seen an uptick in the last 1 hour. Second name, Reddy Industries, after the stock was under pressure for the last few trading days, after the dire star news and the company's commentary that company had said to our channel regarding the proceeds that company is going to use, we had seen a big fall. But today, this stock is up almost 9%. Last one, Oil India, currently up almost 4%. Even big gains we are seeing in ONGC, tracking the move in the crude that we are seeing. So that's the reason upstream oil companies are higher.
Okay, all right. Some interesting names there. Thank you so much for joining us with all those names, Sudarshan. A big move on the market on the downside. Let's get Shrikant Chauhan, EVP and Head Equity Research at Kotak Securities. Shrikant, what's the market texture suggesting? Will we see further lows from these levels? It is a truncated week again, and because of those two expiries, do you think we'll see more volatility now?
So for market, yes, we are finding a lot of difficulties for the market to hold at higher levels. There is like volatile news flow, and because of which the market is finding difficulties to regain the lows that, to regain the highs that it has made in the near term. While looking at the entire setup of the market, it is very clear that we are going to see further more weakness if it breaks the levels of 25,500 in the near term. Because yesterday, the way it recovered, we are of the view that 25,500 is now going to act as major support for the market. But at the same time, at higher levels, 26,000 and 25,900 going to act as major resistance. And today we saw some profit taking after hitting the levels of 25,900. So broadly, I am of the view that for the next few days, the market will spend some more time within the range of 25,500 and 26,000, and we can see some sideways or stock-specific activity in the market.
Well, Shrikant, amidst the broad-based sell-off, any individual trades for the day, all buys, or do you also have a few sell calls?
So I think, say, like in this type of market, we need to go for those bets where we can take some positional bets, because with a very intraday view or with a very short-term view, it's very difficult to trade because of the news flow. In that specifically, we like ONGC, which is currently around 240, 242. Here, if we see the technical pattern of the stock, then it has spent a lot of time between the range of 230 and 260. And the way there is like specific news flow on the crude side, we are of the view that the stock has completed its downward correction, and now the stock can move towards the levels of 260. So there is clear cut and upside from current levels with a very minimal downside in the near term. The other stock on which we are bullish is Eternal. Here also the stock has spent a lot of time between 280 and 290. Today, eventually it has broken the level of 290 and it is consistently sustaining about the same. So while looking at its entire setup, it has spent six months nearly to double from the level levels of 200 to almost 400, and from there all the way it has spent nearly 3 months, 4 months in consolidation period. So I'm of the view that the stock has completed its time-based correction, price-based correction, and now the stock is ready towards the to move towards the levels of 320 or 330. So Eternal also looks attractive at current levels.
Okay, all right. Take that point. Thank you so much for joining in and telling us the next important levels to watch out for and individual names as well. Let's talk about the insurance space now. Sources say an IRDAI consultation paper on regulating commissions is likely to be put out next month. Yash is joining us now with more details on this one. Yash.
Well, Sonal, we finally, looks like we're reaching the point where the whole suspense in terms of how the IRDA, the regulator, wants to regulate insurance commissions would be reaching. What we've been given to understand from our sources is that the insurance regulator is likely to release the consultation paper on regulating insurance commissions as early as next month. There is a bit of process which will be conducted in the current month towards that consultation paper, and finally expected to be launched in the next month itself. The regulator at this point of time is looking to implement new commission regulations from 1st April, that is the next financial year. What we've been given to understand is that the regulator is expected to block all leakages when it comes to ambiguity over insurance commissions, and at the same time see to it that insurance commissions come down as well. First thing what we've been given to understand is the regulator is looking to cap segmental commissions as well as lowering expenses of management limit. Of course, expenses of management includes both commission as well as operational expenses. One thing the regulator is considering going back to the earlier regime of capping segmental commissions, which means motor commissions will be capped at certain level, health commissions will be capped at certain level, term life insurance commissions to be capped at certain level, and lowering the current expenses of management limit as well, which is about 30% for general insurance companies and 35% for health insurance companies. Also, what we've been given to understand is the regulator is also looking to rationalize the expenses of management limit, which means if it is at 30% for general insurance companies, in all possibilities, the expenses of management limit could come down further from that 30% and 35% for health insurance companies. Similarly, for life insurance companies as well. So two things, bringing caps on segmental commissions is what the regulator is looking at, along with continuing caps and rationalizing those caps on expenses of management limit. What we've been given to understand, this idea has been floated amongst the regulatory body and all nodal departments, life, non-life, actuaries, distribution, all of them are expected to submit their responses to the IRDAI chairman by the end of current month. And next month is when we can expect the consultation paper to be released as far as regulation of commission itself is concerned.
Well, thank you so much, Yash, for joining in, giving us all of those details regarding the capping of commissions as far as the insurance space is concerned. But Yash, ICICI Prudential Life just came out with its Q3 numbers. It appears to be a strong set. The stock is at the day's highest point. What's your first take on it?
Well, the numbers for ICICI Prudential Life certainly look strong, and what particularly looks strong is the value that they've been able to derive out of the revenue growth that they've done. If you just look at the revenue growth, the premium growth, APE, not very impressive, growing at about 4%, coming in at about 2525 crore versus 2438 crore. The expectation was much higher as far as brokerages are concerned from the annualized premium equivalent. So that has grown at just about 4%, but the value which they've derived from the APE looks pretty strong. Value of new business growing at 19%. That has come in at about 615 crore rupees. Versus 517 crore rupees. Now, the second thing which they've been able to do very strongly is the margin performance. That has been very strong again. In the third quarter, the margins have come in at about 24.4% versus 21.2%, so about 350 basis points improvement as far as that margin performance itself is concerned. The expectation from brokerages was about 23.2%. So, of course, VNB margins have come about 100 points higher than what the brokerages were expecting on that front also. So, strong performance on a year-on-year as far as value is concerned, also on the margin front ahead of what the brokerages were anticipating.
Okay, all right, 3.5% higher. What a spike on the stock. Good numbers. Margin expansion is what the street seems to like. ICICI Pru on our radar. Yash, thank you so much for bringing us all those details. We'll give you some more time to analyze these numbers in greater detail. But with that, we'll slip into a short break. Before we do that, just a quick heads up. If you're thinking about where the real opportunities for 2026 lie, Market Forum, the Alpha Generators for 2026 is where that conversation begins. The Alpha table awaits. Join CNBC-TV18 as we host the ultimate confluence of India's market movers. Tune in on 13 Jan, Tuesday, 4:30 p.m. onwards, only on CNBC-TV18.
Very much an open secret.
Welcome back. You're still tuned in a Mid-Cap Radar on CNBC TV18. This is our special segment, Mid-Cap Spotlight. Sudarshan is joining us now. In a weak market like this, one stock which is bucking the trend is Balu Forge. Sudarshan, tell us more. What happened here? What does the company do? And some more metric.
So before I talk about the company and what exactly the news is, take a look at the stock move. So there is a big gain today. Stock has moved as high as 10%. But from January 6 to January 12, there was a fall of 24%. On January 6, the price was as high as 582. And on January 12, it had fallen to as low as 440. And from that level, today it has seen a big surge and moved to as high as 480 rupees. So now what exactly company does? It's a manufacturer of crankshaft and used in automotive, agricultural, marine and industrial, and it supplies to OEMs in India and the overseas. Now, what's the news? What exactly made the stock gain this much today? So there was an IT raid which had started on January 7th by IT Income Tax Department, which got concluded today. And now after that, company released the statement, and which company is saying that it has provided all the details that was asked by Income Tax Department, and there was no incriminating document that was found or seized by the tax department. Also, business operations and the production continued as usual, and there is no impact as far as the financials are concerned. So the reason is the conclusion of Income Tax Department search, and there was no document which was seized by the tax department. That led the big gain in the stock price, but still it's much away from the price that was ahead of the Income Tax Department search.
Well, thank you so much, Sudarshan. Clearly, Balu Forge an unusual gainer in today's overall market weakness. Well, ICICI Prudential and HDFC Life are two names from the life insurance pack that are doing quite well post the results of ICICI Prudential Life. But we'll now slip into a short break. We'll get you more on the markets and stock-specific action on the other side. Stay tuned. Welcome back to Mid-Cap Radar. Well, the news on the Bank Nifty is that it's attempting a mild recovery, 0.3% recovery from the day's lowest point. When you're looking overall at the markets, the Mid-Cap Index continues to languish 0.6% down. But with that, it's all the time we have on this edition of Mid-Cap Radar. MF Corner when we return.
Hello and welcome to MF Corner. I'm Sonal Bhutra, and today on the show we are going to discuss something that everyone's been talking about, what's happening in gold and silver prices. To discuss that, we are going to put the spotlight on Bandhan AMC's new fund offer, which is Gold ETF Fund of Fund and Silver ETF Fund of Fund, which opens on 12th of January and closes on 20th of January for subscription. We'll focus on investing in these two funds. What is the outlook going forward? Why one should be investing in these funds, and what is the outlook going forward? Whether there is more legs to the rally. With our guest today, Gaurav Parija, Chief Business Officer at Bandhan AMC, and Sachin Jain, CEO at World Gold Council. Gentlemen, good afternoon. Thank you so much for joining in. We have been talking about record highs on gold and silver every day. Actually, it's been a one-way rally. So there is the ETF or the ETF fund of fund that has been introduced by Bandhan AMC. Gaurav, the question is to you now, because silver and gold are already at record highs. Why an FOF now? And do you think the timing is correct? Because it has already surged big time in 2025. Do you expect similar returns?
Firstly, thank you, Sonal, for having me back on the show. It's great to be on the show. You always seem to be starting off with a trick question to me. So let me take it step by step. First things first, I think as a fund house, we always believe that fund launches are not basis the timing of the underlying pricing, but more importantly on the sustenance of the theme, and believe that this theme is going to be lasting for a long period of time. And hence the timing is more incidental. Like you rightly pointed out, it appears that the prices of gold and silver have rallied significantly. And like any other asset class, if there is a sharp movement in prices, there could be a potential time correction or a price correction, and that can't be ruled out. Having said that, I think it's also important to know that traditionally, when we looked at both gold and silver, we used to treat them as hedges against inflation, currency, geopolitical risk, and all of that. But given that the central bank has been, most central banks have been starting to buy gold, I think there's clearly a structural shift in the way we need to look at these asset classes. And I think the point we're trying to make to investors is please look at these asset classes as a long-term allocation as against a tactical play. And hence price movements in the short term need to be not looked at in too much earnest and look at it more from a long-term play.
Okay, so one should look at these two funds from a long-term perspective. Sachin, let me come to you in that case. Do you expect gold to see similar returns that we saw in 2025? If not, what are you expecting, and what could be the triggers this year? Because globally, geopolitically, it's been volatile every single day. What's leading to the returns or the record highs that we're seeing now?
So first and foremost, my big thanks for having me on your platform, and it's always a pleasure. Well, the fact is that over the last 18 months, we've seen 83 all-time peaks of gold pricing. And the earlier conversation, which I would agree to my previous speaker around central banks buying, that has been continuous. We've seen the interest of investors in the asset class over the last year. So all those things are good. But if you ask me around the principal triggers of why this is happening, I think it's almost underlying now that the reason of this has been the global debt, and also particularly the US debt, which tends to be at a very critical stage. And that, alongside with the geopolitics, with, of course, a lot of tensions, trade wars and everything. And if you look into the future, I mean, as World Gold Council, we don't predict a price, but we can certainly give you scenarios. And if you look at the three scenarios of very positive, mild, and something which is negative, I would say that if there's great peace in the world and the leadership of Russia, China, America become the great friends and lead the future, yes, the price of gold might drop. If you think that there'll be excruciating wars, which could be the second scenario, then price of gold might go astronomically high. And both these scenarios seem very unlikely. What seems to be the situation is be somewhere in between, where we think that the global debt, which is the principal reason why we see what we're seeing in gold, alongside with the current geopolitics, which is the new way of living that we have. I think in that perspective, the pillars on which the price of gold is built on are certainly in favor of gold.
Okay, I like how you put it, the new way of living, because it's a new way every day and new levels on gold every day. Gaurav, you did indicate that yes, there will be some time correction, there will be some value correction we could see. But are there enough triggers in place in at least 2026 if somebody is looking at investing in the ETF, FOFs today? Do you think 2026 is not the year they should be looking at major returns come by for gold and silver?
Sonal, I think, like I said, forecasting one-year returns is going to be very dangerous from all perspectives. I think investors need to understand why are they allocating to this. And if you have to look at most investors' portfolios, we think they are underinvested to both these asset classes. Do remember, like what Sachin said and what I've been saying, we believe there are now structural changes in the global economy, which is leading to both these commodities doing well. If I have to look at gold, it's now clearly coming through as a store of value. If you have to look at silver, we find that silver is now playing on two aspects. One is industrial use and one is the precious metal use. And increasingly, what we find is that the consumption of silver is now 60% of industrial across EV, electronics, and all of that. So I think more than just a pure play ornamental / precious metal play, I think there are structural changes which is coming through. And hence, one believes that this needs to be more of a strategic asset allocation as against a tactical asset allocation. And again, I reiterate, at the cost of repetition, I don't think we should be looking at near-term price movements to determine whether we should be investing or not.
Okay, all right. Gaurav, I'm coming back to you because, this is a much discussed conversation and much discussed commodity, both gold and silver, because retail investors, they often enter silver and gold after sharp rallies. Are there any signals they should look at to understand that prices are already overheating? Just for knowledge perspective, I'm not talking about whether they should invest or not, but if they need to understand the market.
It's back to the same fundamental question of what is the right price to get in. I think I'll leave Sachin, the expert on gold, to talk about gold. But if I have to look at silver, increasingly what we find is that because the supply of silver is getting limited because mining is limited, silver is a byproduct commodity and hence that's also getting limited. A lot of countries are now trying to protect precious metals. Fortunately, unfortunately, the use of silver or the substitute for silver is very limited. So hence, I think silver is not going to be easily replaceable. And one of the aspects also to keep in mind is as gold prices go significantly high, we think the next preferred option, even from a precious metal perspective, is going to be silver. So one believes that there is enough and more room in both the asset classes and commodities, but what exactly will pan out over the next year is a very difficult call to take. And hence, I won't be betting my neck out and saying that, look, next year would be either positive in a significant manner or you could see a significant downturn.
Of course, it's very difficult to predict moves considering the volatility that we're already seeing in global markets. But Sachin, coming on this, you must be getting this question already, right? What is the right time to enter? Of course, there's no right answer for that. But how can one at least understand some signals whether prices are already overheating? It is not only from an investment perspective. A lot of people do it for personal consumption as well. So what is an answer to that?
Well, I think I'll agree to Gaurav here because there are two things that one needs to keep in mind. We at Global Council always recommend that in your diversification strategy, gold should be between 10 to 15%. And we've also realized that while we all have a certain belief that gold is a part of my portfolio and henceforth, but we realize that the investors have gotten very sophisticated over the last 4 to 5 months. And people are generally getting to that level of 10 to 15%. And that's a great figure. And it does a great health to your portfolio at that level of diversification is one. But if you look at the lens of investing in gold, at what price and so on and so forth, I think gold has to be looked at from an extremely long-term perspective and what it does to overall portfolio. Gold certainly isn't a case where you invest today and want to get some returns tomorrow. That will, of course, risk out your sort of portfolio's overall health. So my bits are a long-term strategy, look at that. And when you look at diversification, decide a number, whether it's 10%, 15%, or whatever it is, but then get to that number in products like perhaps EDF and other ways.
Okay, all right. Take that point, Sachin. Gaurav, let me come to you for silver now, because that's another commodity that surreptitiously saw that increase and not spoken about so much. You highlighted 4 consecutive years of global silver supply deficit. We saw that in 2025 as well. How much of this deficit is structural versus cyclical in nature? And is this expected to continue now that we are continuously seeing higher demand in the industrial segment?
You're right. I think silver has seen a multi-year supply deficit, and we honestly believe that the supply deficit is now predominantly structural and not cyclical. And this is coming through because of the long-term demand of silver. Like I stated, silver is now increasingly used from the industrial consumption as also from a precious metal perspective. Mining of silver is getting very, very limited for multiple reasons of economic reasons, regulatory reasons, and hence, and silver is also a byproduct of it's also a byproduct commodity. Given all of that, we think the demand will continue to outpace supply, and hence the leg or the price movement of silver, there is enough and more scope. Given that this metal is used for both industrial and the precious metal, the volatility of this underlying commodity is going to be higher than gold. Because as economic cycles across the world move, industrial growth would be impacted, and hence the underlying commodity used in that could be impacted. And that's where I think silver would tend to be a little bit more volatile than gold in the long run.
Okay, all right. Take that point. I have a lot more questions on both the commodities because it is the hot topic. But gentlemen, I have to slip into a quick break. On the other side, we'll continue our discussion with Gaurav and Sachin on what kind of portfolio allocation an investor should have and what is the outlook going forward. Stay tuned for that conversation.
Fly Emirates, fly better.
Welcome back. You're still tuned into MF Corner. Still we have with us Gaurav Parija of Bandhan AMC and Sachin Jain of World Gold Council. We are talking about investing in gold ETF fund of fund and silver ETF fund of fund offered by Bandhan AMC and understanding the entire fundamentals around gold as well. Gaurav, let me start with you first. In the presentation, you've spoken about how the gold-silver ratio is currently well above its long-term average. Is this a metric a retail investor should be looking at every time when they're making allocation decisions? How does it help them?
So firstly, I think investors need to look at their portfolios as against looking at what your neighbor is doing. I think you need to understand where you are invested in your portfolio. Let me make a confession that over the years, one has always believed that gold and silver are not growth assets and hence only provide hedge against inflation. And so typically we've tended to underinvest in these asset classes. But like I've said, over the years, given that what's happening geopolitically, how central banks have moved from holding dollar versus holding gold, I think this strategy is not going to hold forth. We believe both gold and silver are now more strategic asset allocation, and hence you need to have it as a core portfolio. Depending on what your underlying risk need is, underlying risk profile, the percentages can vary. But looking at a broad metrics of ownership of gold and silver in the overall economy, I don't think is the right starting point for making an investment decision.
Okay, all right. Sachin, coming to you, we are talking about how 2026 could be different than 2025. We really don't know. But what are the biggest risks an investor should keep in mind while investing in gold at this point in time?
Well, I think there are a few things that one should know that are happening structurally also on gold. And new consumption areas are coming up. Like this year, we've seen the demand for technological products has crossed about 8%. And this is largely to do with the artificial intelligence chips, the fast-paced artificial intelligence chips that are getting more and more democratic. And we foresee this, getting more and more strong as we go forward. There are two other areas. I mean, China government has opened up the investment of the insurance sector into gold, which is a very new development. They've started with 1% of the AUM, and we believe that's going to continue. In the Indian perspective, having very detailed conversations with the insurance sector, also the provident fund sector, where there's openness now to invest in ULIP via gold. So there's some new areas of development coming up. But I think I again repeat what I said before, that when you look at 2026 and beyond, one should look at balancing your portfolio scientifically and not just for the perception, and see whether your portfolio has between 10 to 15% as minimum on invested in gold, because that's going to do good to the long term. And secondly, have a long-term view in mind. Gold is certainly not.
That has worked, right? The long-term view has worked for every investor who's invested in gold. There are no two ways about it. It has seen stellar rally in last couple of years. So Gaurav, in your case or in your mind, in portfolio construction terms, you're saying it is the strategic part of any portfolio. What is a sensible allocation range to silver and gold for a retail investor? Is this 5% idea or a much smaller satellite exposure? Or do you think, as Sachin says, it should be at least 15 to 20%? But again, it's different for different people. But what would the common idea be here?
So again, Sonal, I won't say one size fits all. If I had to take myself as an investor, and I'm at 54 and I believe I'll live till 100 years, that's another 40 years of survival. I would now tend to have 15 to 20% of my portfolio now into these two asset classes. Given the runway of 30, 40 years of my portfolio, I think it's a decent allocation. Now, clearly, like I said, depending on what you're investing for, the allocations will change. But if you're looking at a long-term perspective, and like Sachin alluded to, I think it makes sense to have anywhere between 10 to 15% across the two commodities. And again, personal preferences could have someone investing more in gold over silver.
Okay, so in that case, how does a silver and gold ETF fund held investors who do not have demat accounts? Some of the trade-offs they should be aware of compared to a direct silver or gold ETF.
So I think rightly said, buying through an ETF requires you to have a demat account. And if you look at the number of demat accounts in India, it's still very low. What the ETF FOF structure does is it brings all the advantages of convenience of a mutual fund into play. So you could literally start minimum investment of 5,000 rupees. You could choose to invest to a SIP mode. You could choose to do a systematic transfer. Subsequently, when you want to withdraw from these two asset classes, you could choose to do a SWP. Secondly, given that these are mutual fund structures, from a dashboard perspective, from your view, the perspective of seeing all your investments in one, this is the same as any other mutual fund. So I think from multiple perspectives, while ETFs are very much suited to institutional investors who have the ability to trade in the markets, I think for a lot of retail investors, the ETF FOF is a far more convenient and superior alternative to investing in the underlying asset classes.
Okay, all right, take that point. For most of the commodities, it does work that way. Sachin, you have been at the helm for such a long time, right? You've been speaking to more retail investors, institutional investors. What are some of the common misconceptions that you've seen which people have when they go buy gold, be it physical, or now we have so many digital modes as well, right? We had sovereign gold bonds, now we have mutual fund products as well. What is it that your discussion with clients or with retail investors or institutional investors indicated?
Well, actually, there are a few things. One is that there is always a sort of belief that when you buy physically, are you losing money? What's the making charges and all of those things? But I think there's great effort done by BIS on mandatory hallmarking of jewelry, and now there's also going to be mandatory hallmarking on bullion, which of course gives that comfort. But I think the investment areas like ETF, for example, as a product, if you look at the AUM over the last couple of years, 1st of January 2024, we were at an AUM of about close to about 56 tons. Right now, we are almost surpassing 95 tons, and that's purely indicative of a younger India, a more confident India digitally, and with such a superior product which is regulated and backed by physical gold. I think it still lacks the education and the awareness, and products like ETF will perhaps grow leaps and bounds as we go forward. So I think I would say that from a misconception perspective, it's about transparency, it's about confidence, and also lack of awareness of products like ETF, which are going to really do really well, I believe.
Yes, that's what we are discussing with guests, experts on the show as well, to make them understand this different idea of investing into products, be it some precious metals, some sectors specifically. But thank you so much, gentlemen, for joining us today, explaining to us the aspects of this ETF fund of fun and also gold generally, because this has definitely been the talking point of late. Thanks a lot for your insights today.
Thank you very much. Thank you very much.
Okay, all right. With that, we'll take your leave on this edition of MF Corner. But before that, since we are talking about gold, you have to take a look at what the gold ETF flows looked like in the month gone by. That is the month of December. We got the AMFI monthly data last week. And gold ETF, those numbers are at a record high, 11,646 crore rupees. That's a 3-time or a 4-time jump that we are seeing on a month-on-month basis. This number is at a record high, shows the kind of interest that we are seeing in gold and gold products as well. And that's the reason we thought it's a good time to have that conversation with Bandhan AMC and World Gold Council as well. With that, we'll take your leave on this edition of MF Corner, but stay tuned for Closing Bell to take you through the last hour of trade.
to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
It's a fairly positive start considering the recovery that you saw on Wall Street overnight. US President Donald Trump has said that any country that does business with Iran will be subjected to a tariff rate of 25%.
So US equities, not very much price action wise. S&P about 0.16 higher.
Yeah, industry wise, Iran is a major market for the basmati rice industry. For the last many years, Iran has been the second largest market for Indian rice.
Our ambition is to be the world's largest AI-led services company.
66 now on the Nifty and about 288 on the Sensex. It's a much better start as compared to yesterday.
Kuwait has started discussing cancellation of oil project tenders.
This is the second consecutive quarter of strong performance.
The dilution will not be very significant. We will still be by far the largest shareholders.
Likely to pave the way for the induction of 32-year-old Neville Tata, son of Noel Tata.
We all know that the self-listing is not allowed. So obviously, BSE has to be, NSE has to be listed on some other exchanges.
Well, definitely it would be a setback for Indian exporters.
Very close to the day's low. We are off around 250 points from the highs of the day.
Well, that was the day so far. Hello and welcome to Closing Bell. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel. With me is Rima. And joining us today is Mangalam as well. Well, the market's at the low point of the day, guys. Yesterday, we had a bit of a Sergio support that did come in. Today, no sign of him and no sign of the bulls as well. And we have the expiry-related factor as well. I think on a closing basis, you'll at least want to defend this 25,600 odd mark. But selling across the board as we speak.
And now we're precariously close to that 25,600 mark, and it's expiry today and expiry tomorrow because Thursday is a holiday. So the Nifty weekly expiry has been preponed to Wednesday.
The Sensex.
Sorry, the Sensex. The Nifty is today, Sensex is tomorrow.
Yep. You know, just a word on the mid-cap index, because yesterday as well, the mid-cap index was underperforming. Even though we saw a dramatic recovery from the lows of the frontline index, the advanced decline was firmly in favor of decliners towards the end of trade, even though those lines came close. But today, as well, you know, at one point, the lines were fairly close to each other, intersected, and the green one is below the red one as we speak. 1,800 stocks in the red for about 1,100 in the green. Yesterday's low of around 25, just a little below 25,500 will be an important level to watch, though we're still a fair distance away from that. It's just the ferocity of the fall, because a lot of the options that were written, those option writers were hoping for some support to come by around that 25,670, 25,680 odd mark. As soon as that got taken out, you know, the decline happened much swifter.
And quite a few sectors are actually trading with cuts of more than 1%. The defense sector, 1.7%, realty down 1.5%. Consumer durables has got a cut of 1.3%. The pharmaceutical and the auto index also reeling with cuts of about 1%. And in the frontline pack, you've got heavyweights like L&T. Reliance Industries is struggling. That's down 2.5%. HUL, ITC also weak in trade. You've only got an ICICI Bank, which is trying to perhaps fight for the bulls in the large cap space. But other than that, as you know, I think it's the mid cap, small cap screen, which is looking quite weak.
Well, that's right. You know, just two stocks, two sections of the market actually of the Nifty that I want to point out. One is Reliance Industries. As you said, you know, that's come under pressure. I pull up Reliance Industries, but pull it up with the 20 MA. Now, that's the important mark that we're looking at. Reliance Industries in the last few trading sessions has corrected very, very swiftly from around that 1,600 rupees all the way to this 1,450 rupees odd. Remember, the 200 DMA is coming in around this vicinity. So extremely important that it doesn't breach that mark. That's one part of the market. The other part is the Nifty Bank. Remember, tech, you know, at most it won't fall, but it's unlikely to lead from here, going by what we are seeing on ground. So the Nifty Bank that's actually been, you know, aiding the market in terms of an upward move, that one's holding around the 20 DMA. So both these two levels, the Nifty Bank at around the 20 DMA, you don't want it to breach it decisively, and Reliance Industries at around the 200 DMA, you want it to protect that. How do you position yourself though for the final hour of trade? Mitesh Thakkar is back with us. Mitesh, a bit of a bounce is what we saw yesterday, but the joy for the bulls has been short-lived because we're coming for selling yet again. Where does support lie, Mitesh?
So I think, we always thought it was a pullback, but I was hoping that the index would at least try and test 25,950 zones. It kind of came back from 25,900. And on the downside, that 25,400 and then 320 remains the two support areas. So, in case we don't recover, a good chance that we'll head towards those levels. I have a sell on two stocks. Indian Hotels is breaking down. So, sell with a stop at 692 half for targets of 650. And IDFC First Bank is another one. That's a conditional sell. It needs to break the supports of around 82. Sell below 81.9. Keep a stop at about 83 half. Look for targets of 78.
Okay, all right. Just one factor, Rima. Pull up the Nifty Bank. The Nifty Bank has done 150 points in a matter of 3 minutes, I think. So the Nifty Bank should come up for you on the screen. There's a big uptick is what we're seeing on the Nifty Bank. It's bounced off that 20 DMA, and that explains why it's almost in the green from being down close to under 150 points, and it's helped the Nifty as well recover by close to around 50 points. Yeah, Rima, you're making a point.
No, I was just saying, actually, in the morning when we asked Sudarshan and Mitesh that, does yesterday's price action suggest some sort of a trend reversal? And both of them said no. It was too short a time frame, not enough to convince that, we're out of the woods when it comes to the downturn or weakness that we were seeing for some time.
I just want to ask Mitesh one question on Godrej Properties. Mitesh, the Realty Pack, that's been a severe underperformer all of last year as well, and now starting 2026 with a cut too. Godrej Properties currently at the low point of trade. Do you think there's a visible shorting trend out here, or do you think the selling is overdone in the Realty Pack?
No, I don't think it's overdone, but the only thing is that, because, for example, if you just look at the chart of Godrej Properties, we had a weekly closing at about 1936 way back in February 25, then 1948, April 25, then 1936 again in August 25, one more towards the end of the August was 1947. And now we are breaking through the entire 1940, 1930 zone. So I think this suggests that the declines could be much stronger. I would be happy if I get a pull back to about 1930, 41 levels to take a short position over there. And I think eventually the stock could head towards levels of 1700 to begin with, maybe slightly lower.
Thank you, Mitesh. We'll come back to you. For now, let's invite Dharmesh Kant, Head of Research, Chola Securities, on the show. Dharmesh, the biggest stock drag today is L&T. Stock is now down 4.5% at the day's low. What is your analysis and read of Kuwait potentially cancelling orders worth $8 billion and asking for re-tendering? And generally, crude prices are lower, which means Middle East fortunes have also been hit. So their ability to pay also comes down. So companies like L&T, which enjoyed high profits from the Middle East, that also comes into question. How have you all analyzed this news flow for L&T? Because the stock is under severe pressure today.
Yeah, Dr. Rima, I don't think it's anything it has to do with the earning capability of Middle East countries. Though the crude prices are low, I think there's more to it. It may be a US angle attached to such kind of a news flow, but let it be confirmed. I mean, it's not a confirmed flow that this is going to happen. It's just that people are, expecting this to come through. So if it comes through, then definitely it's a hit on the, it's a meaningful hit on the L&T order book. It's not only about this one, because more than 40% of the projects L&T does in the Middle East countries. So those all can come under scanner. And future renewability and future deal wins will be, renegotiated at a new price, which may not be that margin accretive for L&T. So I think that is playing out. And let's not forget the stock price has done phenomenally well. It has, irrespective of the market conditions, the stock price was doing well. So some profit taking on account of such news flows is expected. We are waiting. I mean, 4-5% more decline for here will definitely warrant at least, a trading buying opportunity in L&T. So maybe a bit of more correction tomorrow if the follow-up correction is there. We would be looking at a buying opportunity as of now. And that is all we can, we can make out at this juncture.
Okay, buy L&T. If the stock drops a little bit more, that's a buying opportunity. But stay on, Dharmesh. There is another important story. So if you remember, towards the end of 2025, particularly in the holiday season, the standoff between gig workers and platform owners like Zomato, etc., hit feverish pitch. The Union of Gig Workers went on a strike. They were asking for more money, stopping this 10-minute delivery. Platform companies also reacted. Dipinder Goyal tweeted about it. His response to it said how much the gig workers earn. Now, this story is important because it affects the profitability of many of these e-commerce, quick commerce companies. So let's get you an important update on that. And this is a CNBC-TV18 exclusive, where Tim C's learned from sources that the Labour Ministry has asked quick commerce players to stop marketing the 10-minute delivery. Let's go across to Tim C for more details.
Well, yes, as you rightly mentioned, what sources are indicating at this point of time is that Labour Minister Mansukh Mandaviya held series of meetings with quick commerce companies to stop marketing and branding of 10-minute delivery. Labour Minister held series of meetings with quick commerce companies in the last 1 month, and Labour Minister in these meetings nudged the companies to discontinue the branding of 10-minute delivery to protect the rights of gig workers. Union Minister Mansukh Mandaviya, sources claimed, has persuaded during these meetings the major delivery aggregators to remove the 10-minute delivery branding and marketing. Also, these meetings were held with leading platforms, is what sources indicated, which included Blinkit, Zepto, Zomato, Swiggy, to address concerns related to delivery timelines. Other aggregators, according to these sources, is that they are expected to follow suit in the coming days. And sources in the nutshell actually said that this move is aimed at ensuring greater safety, security, and improved working conditions for gig workers. Meanwhile, CNBC-TV18 has reached out to these quick commerce companies and is awaiting their responses. But yes, as of now, sources indicating that Labour Ministry has managed to nudge these companies to stop the 10-minute branding and marketing. They might be able to deliver in 10 minutes. That can still be the case. But when it comes to marketing and branding, that needs to be addressed with this nudge, is what Labour Ministry sources are saying.
Take that point, MC. Thanks a lot for that. Just 2 points from a stock market standpoint out here, right? They need not brand it as 10 minutes anymore for people to know what exactly quick commerce is. If you say the word Blinkit, if you say the word Zepto, if you say the word Instamart, people know that things come instantaneously. And the other part is that whether you use the 10-minute branding or not, there is no disincentive for the delivery not being in 10 minutes or not being made in 10 minutes. So there is definitely no disincentive for the rider to actually deliver it within those 10 minutes. So there's no rush out there. Oftentimes when you and I use those products, you will get those products in 16 minutes, sometimes 18 minutes. It's not 30 minutes, neither free offer, right? It's a 10-minute branding which they've used. So the government's just basis what Tim C is saying, what we understand is just ask them to remove that 10-minute branding. Right. It's a branding, not a guarantee. Yeah. That's point number one. Secondly, if this is done to basically, ensure safety among people, etc., the gig workers, it may not be the case, because the incentive of the gig worker is to deliver as many products as they can or make as many deliveries as they can in the matter of the day that they are working at. So if, whether a company says you have to deliver it in 10 minutes or not, the fact is that if I'm a gig worker, if I don't deliver it in 10 minutes or as quickly as I can, I won't get my next order. So my earnings per hour will be reduced. So does this incentivize the gig worker to deliver faster? Definitely not. So those are two important points that we need to watch out for. Any other changes which are marketing related would perhaps be just cosmetic and not impact the stocks, which is why we are not seeing a big gash on either of these stocks. So this is not a business risk. This is just, just a nomenclature sort of thing which changes.
Okay. All right. Mangalam, thanks a lot for making sense of that. Dharmesh, coming across to you for your view on them. But by the way, keep your eye on the bottom of your screen. L&T has come in there. They are clarifying. They're saying that the projects that were referred to in the said report were not part of their, of the order book. They've clarified with regard to the Kuwait discussing cancellation of the oil projects. The stock was down post that clarification that's come in there. We've seen a bit of a recovery. The stock actually is cutting its losses. A few minutes ago, it was down close to around 4%. But the street taking note of that, the clarification that they put up there, that's where we're seeing the stock actually has bounced off the low point of the day. Yeah, all right. Those are the flashes that come up in the screen. Dharmesh, you want to come in on Eternal and Swiggy?
Yeah, good afternoon, Nigel. The point Mangalam made was totally valid. How it should be structured is distance-wise delivery time. So that will save not only the gig workers, but also the commuters who are on the street. Sometimes the yellow bikes are so low that you don't even notice from your car that the guy is passing and signal jumping is quite rampant out there. So, I mean, definitely this 10-minute rule should not be there as a branded. But at the same time, they should structure it like 1 kilometer, 2 kilometer, you do in 10 minutes and 5 kilometer in 15, 20 minutes. So that will be well welcomed out there. Valuation wise, I still think both Eternal and Swiggy is far-fetched on profitability front. Cash burn is continuing and this competition is hitting up. So such trading pops if it is there. And if you are invested for a long time, it's good time to lighten on Eternal and Swiggy if you are holding as an investor. So that's our house view and call on both the quick commerce companies because 75% is through quick commerce now, and I don't see a light at the end of the tunnel.
All right, you don't see any light at the end of the tunnel for these quick commerce players when it comes to profitability. Dharmesh, we'll come back to you because another stock which is reacting very well to its third quarter numbers is ICICI Pru. Yash joins in to tell us more about the internals of these numbers and why the stock is higher. Yash.
Well, Mangalam, three important things, of course, as far as the top line is concerned and the value which comes out of that top line is concerned for ICICI Prudential Life Insurance. As far as the top line is concerned, not a very impressive growth. The expectations from the street were on the lower end. The growth which has come about as far as the annualized premium equivalent or APE is concerned is just about 4%. Very modest growth, but that is as per the low expectation from the street itself. But what has indeed surprised the street is the value that they've been derived. They have derived out of the top line growth. So your value of new business that has grown by 19%. Which is a very strong growth at 615 crore rupees. And the margins, particularly impressing the street as far as the margin performance is concerned, VNB margins coming in at about 24.4%. This is, of course, as compared to 21.2% on a year-on-year basis, about 300-350 basis points margin expansion on a year-on-year basis. The street was expecting a number of 23.2%. It's come about 100 basis points higher than that as well at 24.4%. So particularly the value is what the company has been able to derive from its top line growth is what has impressed the street, and that is largely because of a favorable product mix which ICICI Prudential Life Insurance has been able to do in the third quarter.
One more word, Yash, you've learned from sources that an IRDAI consultation paper on regulating commissions is likely to be put out next month. So what have you learned? What could be the contents of this paper?
Well, this is very important for the entire sector. The street has been, waiting for that important consultation paper from the insurance regulator when it comes to regulating insurance commissions. There have been, of course, comments which have come starting from Finance Ministry to the regulator, IRDAI, and, of course, the Reserve Bank of India as well as far as the financial stability report is concerned. What we've been given to understand is that the insurance regulator, IRDAI, is likely to release the consultation paper when it comes to regulating insurance commission as early as next month itself. There is certain amount of process which will happen in the current month as well. What we've been told as far as the details of the consultation paper and the likelihood of what comes through is concerned, IRDAI is likely to suggest capping segmental commissions and lowering expenses of management limit. What this means is that IRDAI is likely to suggest moving to the older regime of having segmental commissions, which means that you can pay up to a certain limit when it comes to motor, up to a certain limit when it comes to health, term life, so on and so forth, different life and general insurance segments. Also, currently there's a limit on expenses of management under which commissions fall, and that limit is expected to be rationalized further, which means brought down further, continuing with the cap at the lower point, which means the IRDAI is looking to essentially pin both ends of this particular dimension, where under one circumstance they put segmental commissions, and on the other hand they rationalize expenses of management limit and continue with the caps on that side as well. What we've been given to understand is that all nodal departments of the regulator, that is life, non-life, distribution, actuary, all of them are expected to give their suggestions on this particular proposal by end of current month, and next month is when that important consultation paper on regulating commissions can be expected from the regulator's door.
All right, Yash, thanks a lot for that. So those are important news pieces that have come in so far. Dharmesh, you heard Yash on both ICICI Pru and the commission-related issue, which the regulator has been speaking about quite vehemently over the last month and a half or so. Do you think that some of the listed companies get impacted by lower commissions out here? And your view on ICICI Pru's numbers?
Yeah, definitely, Manglam. I mean, if they lower down on the expense ratio and all the, permutation combinations they have been working on, it will have a hit on the profitability. I mean, that's the objective of the regulator to rationalize the expenses on the part of for the benefit of the consumer. So that is definitely there, but these are all still not, it's in a formative stage. So unless firm, black and white regulations comes through, it's hard to, take a call on from a long-term perspective. Even from trading perspective, one can go long. ICICI Lombard numbers were okay types. VNB margin was, I mean, that VNB growth was good, but at the same time, it was more or less so-so kind of numbers. What we are, really looking forward to is Life Insurance Corporation of India business report this time around. Business update was, strong based on a favorable base effect. But if the numbers are also true, valuation-wise, that looks the topic out there. I mean, they are trading at 1/4 of the valuation multiples. So we are having an eye on, insurance companies. LIC looks the best bet from a long-term perspective. But otherwise, like PB FinTech and all, we are avoiding as of now till the clarity and cementing of the regulations takes shape.
By the way, recovery in the markets. The Nifty was on the brink of breaching the 25,600 mark on the way down. Now we've climbed to 25,700. The Nifty Bank has put its head above, in the green line, 63 points up. ICICI Bank is a big mover. But outside of that, ONGC is your top gainer. Eternal going strong, 3% up. A couple of IT names also in the green line. Tech Mahindra inching towards a 2% gain. TCS up nearly about 3/4 of a percentage point. So some recovery afoot in the markets. The mid-cap index was down 1% when we started the show, now down close to about 0.5%. Ramesh, what is your read of the IT numbers that have come through on HCL Tech and TCS? I was reading some notes on HCL Tech because the numbers look good. Q3 was a decisive beat at 4.2%. They raised the services guidance also, but the stock was struggling. And then you see that the valuations of HCL Tech at 23 times forward multiple is actually maybe at par or slightly premium to an Infosys or TCS. So maybe analysts believe that it's priced in, which is why you aren't seeing incremental interest in HCL Tech at this juncture. In the large cap space, I mean, first, give us your read of the IT numbers. Do you like anything? And is there a read-through for the other companies, other stocks in the mid-cap IT space?
Yeah, Rima, I mean, the mid-cap is a totally different play from the large-cap players in the IT space. So going by the numbers of HCL Tech and TCS, again, the valuation disconnect is what is, troubling. And if you look at the numbers and if you look at the numbers reported in INR terms, not in constant currency or the US dollar, because that is what matters as far as the INR numbers are concerned, is despite of a currency tailwind, even 8% kind of EBIT EBIT profit growth is, I mean, it's too far lower number. So what we are expecting is 2 or 3% kind of a profitability growth for FY26. And going into 27, it can be a mid-single digit, say 5 or 6% kind of a PAT growth. Because business-wise, vertical-wise, what we analyzed was we don't see a turnaround of say 10-15% kind of a growth coming in there. And then if you are looking at 23-24 times 1 year forward PE multiple, it does warrant a careful attention, and that's the reason why I think the stocks will languish or will see a mild correction playing out there. TCS, on the other hand, I mean, return ratios are far higher than that of HCL Tech. TCS is an ROE of 50%, whereas HCL Tech has an ROE of 25%. So some trade-off out there may still play out. But we see this as a, trading or zone-based kind of a rallies, nothing meaningful or, structural upward swing we don't see happening in IT companies as far as large caps are concerned.
All right, we take that point, Dharmesh. As before we slip into a short break, just pull up Apollo Tyres. It's zooming ahead, up around 4% from the lows, currently sitting with a gain of almost 3%. Was in the red for a bit in today's trading session, but continues to surge. Apollo Tyres, and looks like in the tyres pack, this is the only one which is at the high point of trade right now. I looked at MRF, looked at CEAT, haven't seen a spike on the others, but right now Apollo Tyres seems to be the only one. CEAT is the other one which has actually moved higher, but not so much for MRF, which continues to stay in the red. We'll take a short break, come back on the other side. Dinshaw Irani of Helios Mutual Fund joins in.
Welcome back. Good recovery is what we've got from the low point of the day as we speak. We're getting some news, heartbreaking news actually, that's coming in there. The BCCL coal mine in Asansol collapses. Several workers appear to be trapped inside. We're waiting for further details on that front. Just prayers to all those who are, who have got trapped out there, and hopefully there are no fatalities out there. So hoping things are pretty okay, at least on that front. Remember, in terms of a financial news point, your BCCL, that the IPO is closing out with subscription of close to under 100 times. But that's secondary for now. The safety of the workers is something that we're looking forward to, and hopefully we get some kind of clarity on that front itself. Well, let's welcome our next guest then. We have Dinshaw Irani, CEO at Helios Mutual Fund, who joins us on the show. Hi, Dinshaw. Good to see you, Dinshaw, this afternoon. Everyone started 2026 with some optimism, hoping that it's going to be a good year. Well, the first couple of weeks have been anything like that, right? We don't know what's flying around in terms of news flow. How are you feeling about this year? And also, because of the underperformance we saw in 2025, and over the last few trading sessions, in the first couple of hours itself, the Nifty is down 100 points, your stock's down 5%. How bad a year could it be? Are you in the camp that believes we could actually see a big price correction in the broader markets yet again?
Nigel, first of all, thank you for having me on your show, and a very good afternoon to you, your team, and the viewers. Nigel, actually, it flummoxes us also. I mean, if you look at how the macros are placed out, it seems like a decent year going forward. In fact, 25 also wasn't that bad a year, given that all the kind of negatives were thrown at the markets, be it the tariff tantrum, or be it the war between India and Pakistan limited time war, or for that matter, the quarterly numbers, which are not that exciting. But still, the market did fairly well. So from here on, I think mainly it's mulching those small amount of gains. But our feel is that 26, the quarterly numbers are expected to be good going forward. The government and the central bank both have done a great job in fiscal basically giving out more liquidity in the system as such, and that should in fact work towards at least on the demand front. And that's why we believe that the going forward quarters should be looking very exciting. September, if anything was to go by, I think December also will be that kind of a number, a mid-teens kind of growth earnings number, where obviously the large caps won't grow as much as the overall numbers, but the mid and small will outperform. So our feel is that the mid and small are the segment to be in this, and that's a very aggressive call actually. And in fact, today also, you've seen the market did make an effort going up, but somehow in the middle, selling happened. I think the world is very angry with us for some reason, the FPIs rather. So let's see how that pans out.
Seems that the world may be angry, but we are recovering from lows. That's exactly what happened yesterday as well. Today too, we at one point were at the danger of breaching the 25,600 mark. But from there, we've seen a recovery, and the Nifty is back above that 25,700. And it's the IT pack as well as the Bank Nifty which is powering ahead. The IT pack is off lows currently. The index is 0.5% higher, and we have the Nifty Bank as well, which has bounced off almost 120 points in the green for that index too. Dinshaw, but it's a bold call that you said that you are expecting business earnings to recover and the mid and small caps as a good place to be in right now. Any fresh purchases that you've made? Any specific sectors / names that you can divulge?
So actually, Magalam, the fact is that we have a small cap fund, and there are some 60, 70 odd stocks out there where we've been purchasing every time we see some kind of a correction in the markets, and obviously the fresh money has to come in for that. But I won't give you names as such. There are no new names that we added of late, but we've been fairly comfortable with that pack. Given that the earnings growth there is going to be much higher than the mid and the large cap segment, we are more comfortable with the small caps. In fact, if you discount the price earnings by growth, which is the price earnings to growth multiple, it works out roughly around close to 1.1 or so for that segment. And that's what keeps us fairly optimistic in that segment. If you go down the chain, the mid caps is at a PEG of 1.5 and large caps are somewhere close to around 2. So I think this is the segment to be in. And if at all you want to take better bets, obviously you can spread your risk with mid and small also. Mid and large, sorry.
But Dinshaw, what are the triggers going ahead? In terms of rate cuts, we've already had it front-loaded, 125 basis points done. The government did what it could in terms of putting money in the hands of the taxpayers. And even earnings recovery coming to mid-teens is well advertised and perhaps anchored into the prices also. It's not something that's going to take everyone by surprise. We've been expecting a pickup in earnings. So what are the fresh triggers to get us out of this slump?
So, Reema, actually, the rate cuts have been fairly aggressive, but you have seen that it's not trickled down to the end consumer. The yields have remained firm. I think that's where the reversal has to happen before that. And I think it's a quarter or two before that reversal happens and trickles down to the actual consumer when he starts buying. So this euphoria that we've seen is purely on the back of GST rationalization and not rate cuts getting passed on to the end consumer, right? So that's going to happen later. That's one. Secondly, you said that it's well advertised, the mid-teens kind of growth. But the fact is, it always surprises. I mean, the last quarter was expected to be mid-teens, given that there was a pent-up demand which was creeping in. And obviously, the base also was very low. If the same continues into this quarter, please understand the last December quarter wasn't as bad as the September quarter of 24. December quarter was a 3-4% growth quarter. So on that growth quarter, you're showing mid-teens kind of growth. You really cracked it big in terms of growth numbers as such. So I think that's going to work out. Inflation is going to remain benign. The way RBI is after throwing liquidity in the system, rather easing as such, I think that also will work out going forward. And obviously the biggest, I think the euphoria that we have is on the labor pool today. The millennials, the Generation Z is now 38% of this pool. And obviously, this has not happened overnight. This has happened over a period of time. But please understand, I mean, I've got two Generation Zs at home and I know how aggressive spenders they are. So I've got full faith that this is the segment which will pull up the domestic consumption plays. And obviously, the financiers to that domestic consumption will follow suit.
All right. Talking about a quick couple of stocks, Dinshaw, before we let you go. Swiggy and Eternal were, I think, you all were tossing up between the two. You'll continue to remain your positive stance, and between the two, what is the preferred one? You could correct me if you'll have already exited positions out there. And Ola, the last time we spoke, I recall that large trade got out of the way, and you all said you'll believe it's still good for more. I think the stock has bounced up reasonably from those lower levels. They pulled back some market share in December. Your view on both these two, the electric vehicle space as well as the delivery space?
So basically, Eternal and Swiggy both remain with us. We are fairly clear that the end winners are going to be these two. I mean, whatever you may say, whatever the competition is saying, the fact is that globally, two players survive, and probably the two who survive are normally the first movers. And both these guys are probably, if anything, not first movers, but they're equal movers as such. And I think both of them will survive. If you want weight-wise, Eternal is much higher than Swiggy for us, because I think Swiggy is yet to get the game right in the sense, at least on the Zepto front, he's yet to get that game right. Eternal has got it perfect as such. So let's see how the quarterly numbers come out. And obviously our faith in both the stocks is fairly high. We continue to hold going forward also. In terms of Ola, well, I had said earlier also that though it's a tech company, but the bread and butter for the tech company is the two-wheelers, EV two-wheelers, that is. Once the market shares start moving up, that's when we'll start looking at this. They did show a gain in December in terms of market share, but the same hasn't held out in Jan. So we'll wait for some sustainability before taking a call on the stock as such. Otherwise, we keep on holding on to our old positions.
All right. So you haven't trimmed any positions despite the drawdown that we've seen from the top on that stock, right?
No, in fact, the last tranche of that offer, which was happening from the promoter end, did pick up a bit.
Take that point. Thank you so much, Dinshaw, for joining in and giving us your outlook on a lot of sectors. You like the small and mid-cap space in particular. Believe earnings will come back, and holding on to your positions on these quick commerce, new age platform players as well. Speaking about those quick commerce players itself, Eternal has moved to the high point of trade, and Swiggy too has moved into the green. As we are pointing out that this nudge from the Labour Ministry may not make a big business difference to these companies. The streets perhaps taking note of that, those stocks of those lows. But are all the stocks off lows? Perhaps not. Hormaz joins in his stock check of the market move in the new year so far. Hormaz, some interesting data. Take it away.
Well, the market may have seen some recovery in today's session, but the first 9 sessions of 2026 have been anything but quiet. And if you take a look at the market moves as well, the Nifty is down almost 2% in the first 9 sessions of the year. The Nifty Bank, courtesy of only ICICI Bank, is managed to outperform in relative terms. The mid-cap index is down a similar quantum, almost 2%, and the gash is far bigger in the small-cap index, almost a 3% cut if you see. But for the Nifty itself, it's been even Stevens even after this 2% fall. 25 stocks trading with positive returns, 25 trading with negative returns. Now, if you take a look into the Nifty mid-cap index, we have 65 out of 100 names that are trading with negative returns so far, and 8 stocks are trading with losses of 10% or more. If we go further into granular details, there are over 22 stocks that are trading with losses between 5 to 10% on the mid-cap index. Now, on the small-cap front, the situation is a little worse because 75% of the stocks are trading with losses in the first 9 sessions of the year. The 6 stocks are trading with losses of 10% and more, and over 30 stocks are trading with losses between 5 to 10%. So almost a fourth, almost 4/10 of your index is trading with losses of anywhere between 5% to 20%. One standout name among the Nifty constituents is ITC. It's down almost 17% so far this year. That is, of course, of the New Year's Day's move that the stock saw on the downside. And the last instance of the stock seeing a double-digit move on either side in the month of January goes all the way back to 1998 when the stock had gained or declined actually 12-odd%. Now, among the broader market losers, among the top names, you see Vari and Premier Energies. Ever since they have entered the F&O space, there has been relentless selling pressure here. Godfrey Phillips, in line with ITC, is also down around 20%, and Cummins, along with the capital goods names, down 11% so far. In the small cap space, Allied Blenders, that stock saw its shareholder lock-in end recently, is down around 21% so far this year. Signature Global, after a poor business update, Elecon and Tejas Networks earnings reactions, and Ather Energy, after hitting record high levels, is seeing some profit booking. So the index may not have seen significant moves, but the broader markets is telling you the actual story as the stocks being down but not out, at least as of now.
All right, Harmas, take that point. Thanks a lot for that. Meanwhile, we have some sources to Reuters at the bottom of your screen. Red Tape seeking buyers as founders eyes stake sale up to $500 million. The stock's seen a rise on the back of that news. Founders have reached out to Blackstone, KKR to invite interest in their stake. Red Tape founders also own Mirza International, so want to see if there is any rub-off impact on that stock as well. So the Mirza stock comes up for you. As of now, this is what sources are telling Reuters. I'm just doing a back-of-the-envelope calculation here. The market cap of Red Tape currently is closer to 7,000 crores, which is roughly $80 to $90 million, rather $800 to $900 million. The promoters of the company own 70%. Stake about 70%. So $509 million, if Reuters' story is to be believed, then they're actually selling at a discount, which is not a big positive. It's a great brand. There is Blackstone, there is KKR, etc. And if it's saying that the founders have reached out to them, then obviously the prices won't be as big a premium as the stock price rally is suggesting. Again, this is a source-based story, sources to Reuters, and back-of-the-envelope calculations of the story suggest that the sale may happen at a discount.
All right. So that's Mangalam. Red Tape, the current market cap, if I got it correct, it's approximately 6,500 crores.
Exactly.
Or
about 7,000 crores.
Got that. All right. And okay. All right. Yeah, perfect. Approximately. So it's there's no big premium as such.
There is no big premium. I mean, if the current market cap is close to around 6,500 crores or closer to 7,000 crores, then you are looking at a promoter's stake, which is worth nearly 5,000 odd crores. 5,000, and if the promoter's stake, as per that, is deal is worth $509 million.
Yeah, so it's in line
at par, or
it's
maybe slightly at a discount. So the question is whether this happens or not. One, and second, if this does happen, is there an open offer and all these things? We've seen many a story on Red Tape through the time that we've been here. So let's see how that pans out. We'll take a short break, as always. On the other side, a check on what the dealing rooms are saying in our special Tea Street Chatter segment. Also get you buy today, sell tomorrow calls. Welcome back. Oil India continues to do well, up around 5.5% of that stock. ONGC is the other one. So a lot of these upstream oil companies doing extremely well. Brent at around $65 per barrel as well. You're watching us here on Closing Bell. We are live to you. We come live to you from the CNBC-TV18 Motilal Oswal newsroom. And time now for our favorite segment, D Street Chatter. Nimesh gets us an insight into what dealing rooms are saying and a few tidbits about the stocks that are up and about in trade. Nimesh.
A bit of a volatile day of trade. We've seen a bit of a recovery in the last 30 minutes of trade, and I guess that's largely to do with an MOC basket buying. There was a sense in the morning that a leading FI has got a decent size MOC basket, which normally plays out in the last 30 minutes of trade. All MSCI related stocks in that basket, so maybe that explains a bit of an uptick in the Nifty as well in the last 30 minutes of trade. But otherwise, from a sector perspective, the only sector which stands out and has relatively outperformed of late is metals. And there is where I understand the buying flow continues, and a lot of institutional interest is there to buy into metal names. So that stands out. Technically, 25,450 is a level to watch on the downside. If that gets taken out, then there is going to be a big fall, is what the sense is. Generally, the sentiment has turned quite negative of late because of the kind of sell-off we've seen. But frankly, from a flow perspective, I guess today's recovery in the last 30 minutes could to do with a bit of MOC basket buying at a leading FI desk.
What about stocks, Nimesh?
Well, so the first stock that stands out today is SBI. I've been saying for a while now that within the financial there is a bit of churn happening, and SBI and ICICI Bank stands out. Even today, I understand there is limit buy orders in SBI from a leading FI desk. So some institutional interest seems to be clearly there in SBI, even at current levels. So that's the first stock which is relatively outperforming in today's market. So that is the first one is SBI. Flows have been quite mixed is what my sense is across large cap names as well. The one stock which stands out off late is Chalet Hotels. It's been consolidating but haven't collapsed in the broader market stock, so to speak. And one of the reasons is that one domestic mutual fund has been an active buyer as well in Chalet Hotels of late. There was a clean out trade is what I understand from one of the domestic mutual funds recently, but that got cleaned out, and now some domestic mutual funds are buyer as well. So these are the few names that stands out today. SBI, Chalet Hotels, very selective buying, but broadly today's market recovery seems to be because of that MOC buying.
Thank you very much for that. SBI is up 5% since the start of the year, while HDFC Bank is down 5%. So that rotation that Nimesh was talking about is indeed playing out. Mitesh is now back with us for a few BTST calls. Mitesh, any thoughts on SBI? And then tell us what's on your list.
SBI is making a fresh high, and this is one stock which is kind of keeping the Bank Nifty outperforming and still continues to do that. I think as long as the stock is above 1,010, 1,009, I think the short-term trend will be on the upside, and the targets haven't been achieved, which is about 1,060, 65 to begin with, but possibly even 1,100. So quite positive on SBI.
All right. Yeah.
Sorry.
Go ahead.
Yeah. So coming to the stocks, I think Max Health is rebounding from oversold levels. So that's a BTST. Will keep a stop at about 1,020. Sorry, 1,020, and look for a target of around 1,050. And Emphasis is another one. Emphasis is a buy for BTST with a stop at 2,862 for targets of 2,900.
Okay. All right. Thanks a lot for that, Mitesh. In fact, Emphasis moving with some solid strength in the last few minutes. And just one more stock, JTL. One of those big underperformers. Yesterday it was up 20%, and then they won that order. The stock was actually down, a couple of hours ago. I recall at around noon. JTL is now spiked up, suddenly up close to around 85%, following yesterday's 20% move. Big uptick is what we're seeing out there. Quick check on the F&O space. So we're having a weekly contract that's getting expired right now. The markets have seen a good recovery actually from the lows. L&T is the stock, post that clarification that they put out. That stock, in fact, has bounced off the lows. And the Nifty Bank, that continues to trade above the 20-day MA. So that as well is heartening from a bullish perspective. To give you a couple of levels, well, the high of today is around 25,900. The low of the day is around 25,600. So it doesn't appear that either of those two levels are going to get violated. The Nifty, well, at around the 25,700 call, we saw aggressive writing. So that's giving you a heart that, just in the next 30 minutes or so, we shouldn't get past the 25,800 mark, because the premium from around 130 rupees, that came down to around 14 rupees. And now, in fact, it's popped up again because the Nifty has bounced up. So currently holding at around 35 rupees. Individual stocks that are in focus, we're seeing fresh buying on SBI. So big open research out there. The stock as well moved up. Nalco, well, that's seeing a bit of a short covering bounce, in trade today. So that one as well comes up on your radar. And ONGC is seeing some fresh buying in today's trading session. So good move is what we're seeing on that one. SAIL, we'll have to keep an eye out on that stock. You know, the last couple of trading sessions, there has been some unwinding of positions. So in the next couple of days, probably that one could stand a good chance of actually coming out of the F&O band. We'll keep an eye out on SAIL. That as well could come up for you on the screen. Let's move on though, and let's get in Jay Bala, CMT cashchaos.com, who joins in. Jay, that date with higher levels, you can't, is what you have been telling us. But where do we head first, Jay? Do you think the markets are looking like they want to visit 25,000 first and then move up? Or do you think from here on we'll gradually see that recovery to those levels? I think you're predicting a much higher level from here on by the end of this year. Go ahead.
Hi, Nigel. Thanks for having me on your show. I pointed out last few times that if Nifty were to break below 25,690, it runs the risks of going and revisiting the August lows of last year. So that's about 24,400. It's probably could go below that and touch somewhere about 24,000. So the interim support for the market though is around 25,250 to 25,100. I think unless markets reverse immediately from here, I think the risks of markets revisiting the August lows of 24,400 is higher. I would put that as a higher probability event. But as I pointed out a few weeks ago too, shorting this market is going to be a little bit difficult. Exercise a bit of caution. Once 25,100 is broken, I think the shorts between 25,100 and 24,000 will get a little more easier. But that doesn't impact our medium-term picture that I've been maintaining since the April 2024 low, that the market is heading to 29,000. So this potential visit to 24,400 is going to merely delay the onset of the market's move to 29,000 by a few weeks, probably a couple of months. But the medium-term trend remains intact. The short-term could get a bit negative from here on.
All right, the short-term negative, but medium-term remains intact. Your targets of 29,000 on the Nifty. If the market were to move to those levels, what would be the components that would take it higher? Obviously, the three big weights, banks, IT, and Reliance. What is your call on either of them?
See, we shouldn't be focusing on that now, Mangalam, because if the markets were to go down to 24,000, we'll be left with a mark-to-market loss, which in my trading books is a no-no. So let's wait for the market to confirm that this is, the recovery the market saw from yesterday's low is actually trying to put pressure on the all-time highs. But I put it the other way. If the markets were to go down, I think it will be the capital goods space and Reliance. Reliance could revisit the September lows. That's about, about 1,300 odds. But then again, the Reliance is painting the similar picture to the Nifty. In fact, I would say Reliance could be the reason for why the Nifty is looking like this. So exercise a bit of caution. The autos, metals, and real estate could be the candidate, but that focus should come much later with the markets is starting to put pressure on the all-time highs.
Reliance, you said, is headed down to 1,300. We're currently at 1,450.
That's right.
So should we play for the downside? Can you go short now at this juncture?
Yes, I'm always very cautious when playing Reliance on the downside. It's a very tricky trade to play. But yes, if you are having greater risk potential, yeah, it can be played short. The potential is about 1,340. I don't think Reliance is heading about 1,540 in the short term. But yeah, Reliance always comes with a risk on the short side. So potential for 1,340 with a stop loss at 1,540, 1,525.
Last earnings on Friday, post-market hours. And it's already down 7.5% since the start of the year.
Jay, any individual mid or small cap stocks that stand out in terms of charts?
Yeah, I think the chemical space is starting to look interesting. Navin Fluorine and Aarti Industries, Aarti Chemicals, I don't recall the exact name, Aarti Industries, yeah, I think. Yeah, so these two names are looking interesting from a very short-term perspective. Navin Fluorine could probably get to 64.50 as long as it holds above 56.50. So you can use that as a stop loss. And there's even a large cap that looks interesting from the IT space. Wipro looks interesting with a stop loss of 259. Be free to give these two calls a pass because we are in a in between phase. You might want to stand out of the market and protect your capital, or you might want to get into this with very small positions.
Got that. All right. Jay, request you to stay with us. We're going to take a quick break. Come back. We'll get Jay's remaining views. We'll also wind down the weekly expiry. But we'll have more market talk on the other side. Stay tuned.
Welcome back. Less than 5 minutes to go before we wrap up the trade. Looks like the Nifty will manage to close above the 25,700 mark. Brent crude price made a big move overnight. Today, it's now at $65 per barrel. This is after the US-Iran, the sanctions on Iran. We've seen a significant surge in crude oil prices. Jay, do you want to give us some levels on Brent crude prices? It just looked like Brent crude prices, were subdued and it's going to stay like that. But now there is a sudden flare-up.
Hi, Rima. If you've been reading my notes of the last few weeks, I've been pointing to a bump up in crude prices. I've been pointing to NYMEX rising to somewhere about 61.5 to 62.5. This is well within the expectations. But here are the possibilities that could happen. I'm anticipating this bounce to get stopped at about 61.5, 62.5 for NYMEX. And then head back to fresh lows below the 2025 low, somewhere about $52 to $50. But if Brent were to, if NYMEX were to cross 66.5, then there is a risk that it's going back to the July highs of about 78 odds. That's so when it comes to Brent, it's about a little bit higher. That's probably about $79, $80. So watch 66.5 on the WTI as a very important level. I'm not anticipating that to get crossed. In fact, I'm anticipating crude to get stopped at 62.5 and then turn lower. If that doesn't happen, then it's going much higher.
Oh, all right. Hopefully it doesn't happen, Jay. With Brent crude so subdued, still the Nifty is not able to outperform. And that's one of the catalysts out there. Got that. Quick view on the dollar index. That showed spurts that it wants to burst up, but then it's cooled off a little bit. What's your take on dollar index? And if we talk about dollar index, obviously we are focusing on the gold as well. No signs of it topping out, at least as of now.
A very, very important point here, Nigel. See, the dollar index has built a base for the last 6 months between 100.3 and 96.2. But the intermediate important resistance is about 99.3. If a dollar index closes about 99.3, there's a real chance that this base that is built over the last 6 months is going to get taken out. But here's the important thing when it comes to related markets like gold and silver. USD JPY cross is clocking a fresh 52-week high today, and the 2024 high is about 161.5 on the USD JPY cross, and that it looks like it's going to get taken out. Here are the contradicting points here. If that gets taken out, the dollar is likely to strengthen a lot. But the reason why USD JPY is probably strengthening is because of the Japanese debt. So that can in turn trigger much higher levels for precious metals. But the dollar index is also strengthening. So how far this relationship is going to play out? Is the dollar index and the precious metals going to rise together? That's a tricky thing to play out. So be very careful in the precious metals place. The medium-term picture is quite strong, but you could see a short-term volatility. So be very careful. Maintain strict trailing stops for your longs if you're long. If you're not long, stay away from the market.
All right, Jay, thank you so much for joining in. We'll ask you to stay back for your calls on markets forward. But in the meanwhile, let's start wrapping up. It is expiry session, weekly options expiry, and the market ends very close to what the option writers were expecting it to. It was a volatile day. We saw 25,600 at the lower end and 25,900 at the upper end. The market recovered from lows in the last half an hour, led by a couple of these names like ICICI Bank. Eternal did okay. We saw SBI and Reliance as well recover from the lows, though it had been pressurizing the market from the word go. So Reliance as a stock was among the top losers on the Nifty today, at least the top dragger. Among the other top losers was Trent, down 4% after a pause for breath from the falling that we saw yesterday. Declined today, and L&T on fears of a rebidding of the order was down about 3%. The stock recovered from the lows after the clarification that came in, but nothing really dramatic. A 3% cut is what we saw there. The broader markets as well ended at an even keel with 1,500 stocks advancing for the similar number of stocks which are declining. Dixon Tech, Vodafone Idea, AU Small Finance were the top losers, whereas on the way up we had Oil India, Manappuram and Apollo Tyres that did well.
Spotlight on the IT names. TCS ending up 0.7% after reporting an operational beat. HCL Tech ended mildly lower despite a good Q3. Analysts concerned that the valuations right now at 23 times forward multiple adequately captures the risk reward. Focus will be on Infosys as it comes out with numbers tomorrow, but some mid-cap IT companies had a good session. So Firstsource, Birlasoft, Cyan, RateGain ended up in the green, and even some of these rice, basmati manufacturers like KRBL, LT Foods managed a positive close. On the way down, Dixon Technology, Misho were some of the drags. Well, that brings us to a wrap on this edition of Closing Bell. Thank you very much for watching. We leave the markets defending the 25,700 mark, 25,732, a minor downtick of 58 points. On the other side, markets forward will come up next and prep you up for tomorrow.
The market closes on a mixed note. A sharp recovery in the final hour ahead of weekly expiry helps limit losses. The Nifty holds above 25,700 mark, while the Bank Nifty holds on to its gains.
US President Trump announces a 25% tariff on countries doing business with Iran, says the new tariff is effective immediately. Indian rice industry could face an impact, with basmati exports forming a significant share of shipments to Iran.
The rise of the Gen Next at Tata Group. Sources say 32-year-old Neville Tata, the son of Noel Tata, is likely to be inducted into the board of Sir Ratan Tata Trust this week. He is already on the board of Sir Dorabji Tata Trusts. Both these trusts own more than 51% stake in the group's holding company, Tata Sons.
Hello and welcome to Markets Forward, your go-to show where we aim to get you all of the key data points to gear up for the next trading day. I'm Ritu Singh and with me is my colleague Ekta Batra. Hi Ekta, what a recovery in the last hour of trade. With that said, the Nifty ended with cuts of about 58 points and the Sensex with cuts of 250 points. The mid-cap index also down 120 points to close. But the Bank Nifty, Ekta, bucking the trend, closing up 128 points.
Hi Ritu, yes, absolutely. Overall, you'd have to say today was a bit of a choppy day. So we did recover from the day's low by around 129 odd points. But from the day's high, we were off around 167 odd points. There was a recovery which took place in the broader markets as well. So we had the mid-cap index, which ended lower by around 0.2%, and the Bank Nifty, which went home with gains of around 0.2% as well. So overall, a even keel in terms of the advanced decline ratio, which went home at around 1:1. But that's what the day was like. But let's tell you what we have lined up for you on the show today. We start with the top movers and shakers of the day with Vivek. And well, it is earnings season starting to gain momentum. So we'll get you some report cards along with some news-based action in terms of stocks such as L&T and Cipla. Last but not the least, we delve into the key market events to watch out for in tomorrow's trading session. All right, well, on to our first segment of the day. We have Vivek Iyer, who's joining in now from the wall with all of the top movers and shakers he's tracking today. Vivek, over to you.
Well, thank you so much for that. Well, 2 days, 2 expiries. Remember, 15th is the holiday, so even the weekly expiry on Thursday has been pushed forward to tomorrow. So a lot of volatility was expected, and that's what we got today, a sharp recovery, especially in the last hour of the trading session. In terms of individual movers, well, oil sensitives, oil prices have been gaining, especially in the last 3 to 4 trading sessions, and ONGC and Oil India, both of them who benefit from higher oil prices, did quite well in the session. Oil India ended by over 5%. From the broader end of the markets, Balaji Amines, has been moving continuously ever since the positive news, so it's received today higher on sharp volumes as well. Godfrey Phillips, again, after a while, this particular stock that has seen quite a bit of a sell-off, a choppy trading session, but nevertheless recovered quite smartly, a 4% up move for the stock today. Towards the last hour of the trading session, you did see some news come about as far as red tape was concerned. Founders tapping PE investors for a stake sale in the last half hour. You saw a sharp 11% spike on that particular name. And a lot of mid-cap IT companies actually saw quite a bit of a recovery post the recent drubbing that they've seen. So names like Techem, Emphasis, Birlasoft, all of these stocks managed to end the day with smart gains. On the other hand, quite a few laggards as well. None bigger than L&T, the top Nifty laggard. An overhang in terms of the ordering activity, tendering activity, and the orders where the company was L1 in as far as Kuwait was concerned led to a 3% downtick. On L&T today, HEG again, significant volumes today, down over 3%. Wires and cable stocks after a while did see some selling pressures. So names like KEI, Polycab, both of them ended the day with minor cuts. And Dixon Technologies, again, the fall over here continues today, again hit a fresh 52-week low of 5% fall on Dixon, has been a significant underperformer, especially in the last 2 months.
All right, Vivek, thanks very much for bringing us that. We'll move on to the IT pack where, the IT companies have kicked off the third quarter earnings. TCS has been trading flat today after it reported an inline set of numbers. And HCL Tech, meanwhile, also traded sideways after an early uptick, despite delivering a broad-based earnings beat. Reema Hindalco joins us now with a fine print of all of these numbers that have been reported in the IT space.
Thanks so much for that. So for TCS, as you said, largely in line with expectations, no big beat. The company's top line came in at 0.8% quarter-on-quarter in constant currency. They managed to hold on to their profitability as well, margins unchanged at 25.2%. But as Kotak encapsulates it very well, which explains the price action also. Now, FY26 has been a year of growth underperformance for TCS. TCS is taking measures to close the gap with peers. The initial results are encouraging, but for a re-rating, a sustained re-rating, more needs to be done, a sustained execution. Nomura says, and that's on the top line. On the margins, unless we see growth, it's very hard to imagine a very strong margin expansion. HCL Tech, as you rightly pointed out, surprised positively in Q3, revenue growth coming in strong, 4.2%. And also the management in the interaction with CNBC-TV18 said they feel pretty confident about 18 to 19% margins going ahead. But the problem is, as Kotak says, the stock trades at 23 times forward multiple at a premium to peers and therefore fully valued, according to Kotak. AI is growing. It's a very small portion of the IT companies, but it's growing fast. For TCS, annualized AI revenue stand at $1.8 billion. For HCL Tech, AI went up 20% on a quarter-on-quarter basis, and now on a quarterly basis, advanced AI revenues are close to $150 million. Goldman Sachs is inferred from both these results and what it means for the IT sector. They say the results suggest that demand environment is stable to improving, but companies still have limited visibility on the extent of recovery in this calendar year. The BFSI vertical has been strong, and they see a neutral to modestly positive read for the rest of the IT stocks. Back to you.
Okay, all right, Reema. Thanks very much for that. On that note, let's listen in to what the management of both TCS and HCL Tech had to tell us earlier today.
Our ambition is to be the world's largest AI-led services company. And we laid out 5 pillars through which we are going to achieve. And one of the pillars about that is how do we play in the larger ecosystem. And we said we are going to be more acquisitive going forward.
We have done very well in the last 2 quarters. And given the strong bookings in the Q2 and Q3, the Q2, Q3 booking is almost 30% higher than in the same period last year. So we are looking at some good uptick in revenue in Q4 in the services, and then, of course, Q1 as well. So I think given our booking, given our pipeline, and all the momentum that we have, we are looking at a good outcome in the next year. However, anything specific, we will really have to wait for the April meetings.
All right, let's go across to our guests for the day. Jay Bala, CMT at cashthechaos.com, and Sudeep Bandyopadhyay, the Group Chairman at IndiTrade Capital, are with us. Gentlemen, thanks very much for joining in. Sudeep, to start with you, any thoughts on the IT pack? We've got 2 of the big companies reporting the numbers. Infosys expected later tomorrow. A bit of an underperformer last year, but do you see more opportunities going ahead?
Well, I think the numbers were pretty decent, I would say. Nothing extraordinary, not bad as well. Of course, as far as revenue is concerned, currency depreciation did help as far as top line is concerned and profitability is concerned. But even otherwise, I think, it looks a stable set of numbers from both the companies. But having said that, I think visibility is still not there as far as this calendar year is concerned. And I would be cautious on IT, definitely, and I would advise caution also. The opportunity exists in pockets in mid-cap and small-cap IT companies, and those needs to be explored. As far as large-cap IT is concerned, they will be market performers, and I expect single-digit return from these companies in the current calendar year.
Okay, single-digit returns in terms of stock performance, I'm presuming, Sudeep? Okay. All right. Well, Jay, HCL Tech and TCS are already up around 1 to around 2.5% at this point in time on a year-to-date basis. Do you think that this is going to be a year of single-digit returns for these companies?
See, Nifty IT index is coiling up for a long-term breakout, but it's been forming what we call in technical parlance as a triangle pattern. So for that to complete, we need one more drop for the Nifty IT index somewhere closer to the October low of 2025. But the 2025 low of the April, that will get protected. So I think a little later, the IT stocks, frontline IT stocks, are due for a breakout. And once that breaks out, we are looking at the large and the small mid caps and small caps to outperform the large caps. But we might have to wait a little bit. Maybe it may not be this quarter. Probably a little bit into the start of the next quarter. But it's a long-term bottoming process that's in play. So I'm right now neutral there. But once the breakout happens, I will be quite bullish on the Nifty IT index.
All right, take that point. Sudeep, quick word on, these quick commerce companies as well. Eternal, Swiggy, these shares were in focus in the back of this news coming in that, the government is asking them to scrap the idea of advertising this as a 10-minute delivery, although, investors seem to have shrugged off any concerns because, it is pretty much just a marketing tactic. It's not that they're not going to do 10-minute deliveries or, not do these 30-minute deliveries. Your thoughts on trades for those companies, keeping in mind some of the profitability concerns given the huge competition?
Well, Ritu, first of all, today's government directive is good for everybody, including these companies. This was just a marketing gimmick which was creating a lot of hazards on ground, both in terms of the accident-prone nature of the rush for delivery, and also I think there was nothing like a 10-minute. What can come in 10 minutes can come in 15 minutes, 20 minutes, half an hour also. Nothing changes. And of course, it was just a marketing gimmick, which became the motto for most of these quick commerce companies. And stopping that, I think, is good for the industry. As far as these companies are concerned, nothing changes because of this directive. Everything remains same. The kind of quick delivery which they are mandated to do, they will continue to focus on that. But having said that, as far as valuation and business model is concerned, I think the profitability is still to be proven. All of them are trying to increase the volume and gain market share. At this stage, it's very, very difficult to comment on the profitability of these business. I would rather focus on the entire platform. Like in case of Eternal, I think their food business is kind of started making money. And if I have to buy one of these stocks, I will definitely buy Eternal. This businesses also have the tendency winner takes all. So Eternal definitely is a leader by far in both quick commerce as well as food delivery. The Swiggy interest I have little because of the valuation comfort which we find now in Swiggy. Their food delivery as well as Instamart, which is the quick commerce, are running behind Eternals. But I think that also has a potential for significant growth on the back of fundraising, which they have done recently.
Okay. All right, so that's on Swiggy, but shares of L&T, Larsen & Toubro slipped nearly 5% after Middle East Digest reported that Kuwait is in talks to cancel oil project tenders worth around $8.7 billion. The Gulf nation is also considering rebidding these tenders. Vivek is here with the key details of this report. Vivek.
L&T was the stock in focus today, a very volatile trading session. This after Mead, a Middle Eastern reporting agency, reported that Kuwait is looking and discussing cancellation of oil project tenders worth over $8.7 billion. In fact, they say that Kuwait is looking to rebid tenders as the bids that actually came in were way over budget for 5 major upstream contracts. Why is L&T in focus? Now, as per analysts, as per various news reports, and also as per Mead, L&T was favorably placed. When we say favorably placed, it was either L1 or the lowest bidder in tenders worth over $4.5 billion. Remember, this compares against an order book of 6.5 lakh crore. So close to 40,000 crore worth of orders was something that was in focus. One thing that we need to watch out for, especially when it comes to L&T, is the fact that the company plays it safe when it comes to going ahead and declaring order wins to the exchanges. They typically wait till they receive a letter of award from the issuing authority. So in all likelihood, like the management went ahead and told the exchanges They say that the projects referred to in the report are not part of the company's order book, and they cannot comment on status of tenders or commercial decisions of its clients. But this does leave a few questions that the management will need to answer, especially at the end of Q3. Status on orders, where the company was the L1 in as far as Kuwait was concerned. Does the development require tweaking of the FY26 order inflow, and concerns of tendering activity, especially when it comes to the Middle Eastern region?
All right, important clarification coming in from L&T, but the stock remained under pressure at the close of trade. Vivek, thanks very much for joining in with that. But we also focus on shares of ICICI Prudential because the company reported its third quarter earnings. Now, the value of their new business and the VNB margins as well, they both improved in the December quarter. Yash Sen has been poring over the numbers and joins in with the details. Yash.
Well, as far as the top line is concerned, the street had low expectations as far as the APE growth is concerned, and the company delivered similar low single-digit APE growth of about 4%. The number that came as far as the annualized premium equivalent is concerned was 2525 crore versus 2438 crore. As I said, a growth of just about 4%. What sort of came out striking for the analyst community is the value that the company has been able to derive out of its top line growth or the APE growth. Value of new business that grew by a strong 19%, coming in at about 615 crore versus 517 crore. So of course that was very important to note as far as the Q3 numbers are concerned. The second important point particularly was the VNB margin. The company was able to derive margins of about 24.4% as compared to 21.2%, so about 350 basis points margin expansion on a year-on-year basis, and not just an expansion on a year-on-year basis. The street was anticipating 23.2%. The company went ahead of those estimates by about 100 basis points, so that worked as far as the Q3 results are concerned. And largely margins seem like they've been better because of a better product mix. The top line did not grow much in a strong way, but of course strong outcome coming out of that moderate top line growth of about 4% working for the company as far as the third quarter is concerned.
Okay, all right, Yash, thanks very much for that. Sudeep, any view with regards to ICICI Pru?
Well, I think it's a good business and they're growing pretty well. But if I have to pick one in this sector, I will go for SBI Life at this stage. I think they have got many more growth vectors, and irrespective of whatever the changes come as far as the commission and expense norms of the insurance companies, I think SBI is very well positioned because their cost to income ratio and the overall distribution cost is significantly lower compared to every other player in the industry. So, assuming there is a regulatory change, I think SBI Life would be my bet.
All right, Sudeep, thanks very much for that. We'll shift focus to, the geopolitical developments. Now, India is a major trading partner of Iran, but it has not yet responded to Trump's announcement. But how are these new tariffs going to impact India's exporters? Manisha Gupta is here with more on that. Manisha, how will these duties impact India, particularly for agriculture exports?
Iran is also the second largest basmati export destination for the Indian exporters there. If you look at the overall numbers, Ministry of Commerce and Industry data shows that in 2024-25, nearly $753 million of worth of basmati rice was exported to Iran. Now, overall agriculture exports that India does, 20% of that is rice, and much of that goes to Iran. So clearly not very favorable right now. The same goes in for tea as well. The tea as an industry also is quite moved right now, and there are various reasons for that. To begin with, tariffs is just about one part of it, but it also is issues within Iran as well. And while Iran has for many years seen a lot of internal political unrest, etc., but the markets believe that this time it's going to be quite difficult, and whether or not Iran can bounce back quickly from that is going to be something to be seen there. You also are looking at a sharp depreciation when it comes to Iran's currency. That's one part of it. And then there is a lot of cargo in transit. Indian rice and tea exporters do not know on what is going to really happen happen to that. The second point also is about the shipping costs, which seem to be surging on a day-to-day basis there. And the payment delays is yet another thing that is bothering. Much of the payment, which should come in within 180 days as per the clause of transactions, has not come. So whether or not these payment remittances will happen, when will they happen, how will they happen, are a lot of questions that the trade seems to be asking ministry and various regulators like ABIDA, etc. We do understand from these traders and companies that Indian regulators and ministries have told them that very soon that they will be coming out with a guideline or a framework on how to trade with Iran. That is something that the street is awaiting at this point.
Okay, fair enough. Thanks, Manisha, for that. Well, Jay, I just wanted your thoughts from a market perspective, because yesterday was positive news, after the US ambassador's comments with regards to their relationship with India. And today we do have the news with regards to Iran and the 25% tariffs to reckon with. From a market perspective, how do you think the market is probably going to absorb a lot of these pieces of news when it comes to, the uncertainty around tariffs?
Yeah, good point. The market seems to be taking a little bit of cautious view on the developments, and the recent break below 25,690 seems to suggest that the market has the potential to go back and revisit the August 2025 low of 24,400. So a bit cautious here, although there is some interim support around 25 to 250 to 25,100. But my guess is that this market is likely to be taking a hit in the short term without impacting the medium-term objective of 29,000. So in the very short term, to slightly, say from 2 weeks to 8 weeks time frame, this market could drop somewhere close to 24,400 and then recover to fresh all-time highs of 29,000.
All right, Jay and Sudeep, both of you, thanks very much for joining us on the show with your thoughts. On that note, we're going to slip into a short break, but don't go anywhere. We're back with key market events to watch out for on the other side of this break.
Welcome back. You're still tuned into Markets Forward on CNBC-TV18. Well, let's get you some key events to watch out for. Gaurav is here. standing by with what we should focus on in tomorrow's trade, Gaurav.
Well, as for tomorrow, we have a couple of earnings. First is Infosys. Let's watch out if the company is coming up with the good numbers. And apart from that, we have got companies like Grow, HDB Financial, HDFC AMC, ICICI AMC, Indian Overseas Bank, Union Bank, and others. So tomorrow is a day which is going to be heavy on earnings, specifically for these companies. Other than that, let's also not forget about Kotak Mahindra Bank. Tomorrow is the record date for the stock split. Remember, the bank is going to split its stock in the ratio of 1:5. So apart from that, let's also watch out for Bajaj, because tomorrow is also a day of festival called Makar Sankranti in India. And on the same day, Bajaj is going to launch its new Chetak EV scooter. So let's see how the numbers come, and rather how the pricing is targeted by Bajaj on this specific EV scooter. Other than that, from the macro point of view, we will get WPI data for India. It is actually important to watch this, and the reason being that recently we have seen CPI has been low, and at the same time there are some fluctuation in the forecast for inflation going ahead. From the global market, we have got PPI index from USA, and other than that, existing home sales data. Now that is also a key thing to watch. And lastly, let's also not forget about the current account data, which will be presented from the US market. This is also important, specifically given that there have been turbulence around the overall tariff scenario in USA. So let's see if these events and these data points have any grip on the Indian market for the day ahead.
All right, lots of cues for tomorrow. Gaurav, thank you very much for joining in with that. On that note, we're also going to wrap up on this edition of Markets Forward. From Ekta and me, it's a goodbye. But stay with us, more news and updates continue on the other side.
Good evening. Thanks for joining us on Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. The Sensex and the Nifty end in the red despite a sharp recovery in late trade. Defense stocks lead the decline. Bank stocks buck the trend. The rupee remains above the 90 mark against the dollar. President Trump announces a 25% tariff on countries doing business with Iran, says the new tariff is effective immediately, even as further details are awaited. China, UAE and India are among Iran's top trade partners. Beijing opposes what it calls unilateral sanctions. India is yet to respond. Thousands of pro-government demonstrators take to the streets in Iran as the regime attempts to downplay the nationwide protests. Iran's supreme leader warns U.S. against any military action. More than 600 protesters killed so far, over 100 security personnel also killed. India's government bonds decline after Bloomberg defers inclusion to a global index, cites operational and market infrastructure gaps, also acknowledges significant progress, keeps the review open for more feedback. Labour Minister Mansukh Mandavia nudges quick commerce companies to stop marketing and branding the 10-minute delivery promise. Blinkit makes the first move, drops 10 minutes from its tagline. However, 10-minute delivery has not been stopped and there is no government order suggesting the same. The rise of the Gen Next at the Tata Group. Sources say 32-year-old Neville Tata is likely to be inducted into the board of Sir Ratan Tata Trust this week. He's already on the board of Sir Dorabji Tata Trust. Both these trusts own more than 51% stake in the group's holding company, Tata Sons. NSE gears up for its long-awaited IPO after SEBI chief hints at a green signal this month. The stock exchange eyes a market cap of nearly 5 lakh crore rupees, which will make it the 11th biggest listed company in India. Apple chooses Google to power its artificial intelligence tool, signs a multi-year deal to integrate Google's Gemini across Siri and other features. Elon Musk criticizes the deal, calling it unreasonable concentration of power for Google. Loudspeakers go silent as campaigning for Maharashtra civic elections end. Voting will take place on Thursday for 29 municipal corporations across the state, including BMC, Asia's richest civic body. Well, let's start with the day's market action. Another volatile session. The Sensex and the Nifty closed largely in the red, but they did recover sharply off their intraday lows in the last hour or so. The Nifty holding on to the levels above 25,700, finally closing flat. The Sensex down 250 points. The Nifty mid-cap index was down by about 100 points. The Nifty Bank closed in positive territory, so that was bucking the trend today. Now, nearly 30 Nifty stocks closed in the red. That was despite the recovery that we saw towards the close. Nigel joins us now with more on the day's market action. Nigel, volatility, the name of the game.
Well, the markets bounced off the lows yet again, and today the weekly expiry could have played a role out there, and there was some basket buying that was expected towards the end. The good news is the markets managed to end off the low point of the day. The Nifty Bank, that's been the outperformer, it continued to outperform. And the breadth of the market wasn't that bad. In fact, it was split down the middle. You had one stock that was advancing for around one stock that was declining. From the Nifty Pack itself, there were some large gainers out there. ONGC popped up in trade. Remember, crude oil prices had bounced up a little bit, and now there are calls that, in fact, there could be a bit of a bottoming out process in terms of global crude prices. So that did pretty well. Eternal as well was higher, and you had numbers coming in from HCL Tech as well as TCS, but Tech Mahindra actually was the outperformer. That stock ended up close to around 2%. On the flip side, Trent went back to its losing base. On L&T, there was some uncertainty with regard to a Middle East order, and big boy Reliance Industries was down, but keep in mind it continues to defend that 200 DMA mark, which is extremely crucial on a technical basis. And from the broader markets, there were select gainers. Manappuram Finance has bounced back nicely, post the clarification that the deal with Bain Capital is actually on. Angel One did well. That was one of the capital marketplaces that's seen a good correction from the top. That appeared there was some buying today. And Tata Elxsi as well did pretty well in trade today. Remember, the stock has corrected a goodish bit from the top. On the flip side, you had some losers, stock that have actually done well in the past. You had Dixon Technologies that came in for profit taking. EU Small Finance as well did see some selling. And Vodafone Idea, after the bounce that we've seen, that stock, in fact, did see some bit of selling. So net, it appears the Nifty in the near term is in that band. 25,500 on the downside. On the upside, the 26,000 odd mark, the 500-point range is what we're looking at. And there are going to be three big triggers from here on. Earnings, progress on the US-India trade deal, and some optimism with regard to big bang announcements in budget 2026. So a bit of a range for now. The markets, though, managed to defend the lower end of the range today, and the bulls will take heart from that.
Well, yes, they certainly will, coming off their intraday lows. Nigel, many thanks, but we're going to come back to you in just a second because you can catch top market experts and economists on our special broadcast, the CNBC-TV18 Market Forum. We kick off the Market Forum with an expectation of what 2026 will hold for our markets. 4:30 p.m. onwards, the biggest names from the markets, Ramdev Agarwal, Sanjay Agarwal, Manish Chokhani, Sandeep Tandon, Tahir Badshah, Nilesh Surana and many others will join us to take us through what the outlook is for 2026. Neelkant Mishra, Sajid Chinoy and Gautam Chowcharia on the macro signals that we need to watch out for. That's coming up for you live on CNBC TV18, 4:30 p.m. onwards. Well, the big global story. President Trump has announced 25% tariffs on Iran's trading partners. The Islamic nation has been roiled by massive anti-government protests, its biggest in decades. Now, Tehran is blaming the U.S. for fueling the unrest. In a post on social media, Trump said, and I quote, "Effective immediately, any country doing business with the Islamic Republic of Iran will have to pay a tariff of 25% on any and all business being done with the U.S. This order is final and conclusive," end of quote. Now, the announcement comes days after Trump warned the Iranian regime of military action if security officials continue to kill protesters. Iran's foreign minister said they are ready if Washington wants to test its military might. Meanwhile, tens of thousands of demonstrators took to the streets across the nation in a show of support to the regime. State media showed visuals of a massive crowd of people streaming through the streets of Tehran. Iran's supreme leader has called the demonstrations of warning to American politicians. Iran's president also participated in a pro-government rally, promising that he was ready to listen to the concerns of the people. However, the Islamic nation continues to be cut off from internet for the fifth day. A Norway-based NGO reports close to 700 deaths, a US-based human rights group reporting over 10,000 arrests. So who does Trump's latest tariff salvo impact the most? China is Iran's largest trading partner, followed by Iraq and the United Arab Emirates. Iranian exports to China amount to $22 billion in 2022. According to the World Bank, Iran's exports to Turkey hit $5.8 billion in the same period. China said it will take all necessary measures to safeguard its interests. In a social media post, the Chinese embassy said that China's position against the indiscriminate imposition of tariffs is consistent and clear. India is also a major trading partner of Iran. It has not yet responded to Trump's announcement. Manisha joins us now with how this latest set of tariffs is likely to impact India, particularly Indian agricultural exports to Iran. We are, of course, waiting for clarity from the government, Manisha. We're also waiting for clarifications from the US on whether this is going to be 25 over the existing 50% tariffs on India. But take us through what the likely hit is going to be.
Iran is also the second largest basmati export destination for the Indian exporters there. If you look at the overall numbers, Ministry of Commerce and Industry data shows that in 2024-25, nearly $753 million of worth of basmati rice was exported to Iran. Now, overall agriculture exports that India does, 20% of that is rice, and much of that goes to Iran. So clearly not very favorable right now. The same goes in for tea as well. The tea as an industry also is quite moved right now, and there are various reasons for that. To begin with, tariffs is just about one part of it, but it also is issues within Iran as well. And while Iran has for many years seen a lot of internal political unrest, etc., but the markets believe that this time it's going to be quite difficult, and whether or not Iran can bounce back quickly from that is going to be something to be seen there. You also are looking at a sharp depreciation when it comes to Iran's currency. That's one part of it. And then there is a lot of cargo in transit. Indian rice and tea exporters do not know on what is going to really happen to that. The second point also is about the shipping costs, which seem to be surging on a day-to-day basis there. And the payment delays is yet another thing that is bothering. Much of the payment, which should come in within 180 days as per the clause of transactions, has not come. So whether or not these payment remittances will happen, when will they happen, how will they happen, are a lot of questions that the trade seems to be asking ministry and various regulators like ABIDA, etc. We do understand from these traders and companies that Indian regulators and ministries have told them that very soon that they will be coming out with a guideline or a framework on how to trade with Iran. That is something that the street is awaiting at this point.
All right, Manisha, many thanks for joining us. The U.S. Embassy in Iran has issued an advisory urging American citizens to leave the country immediately amidst escalating nationwide demonstrations. The U.S. advisory has warned of road closures, transportation disruptions, internet shutdowns and limited communication access. Several airlines have already cancelled or suspended flights to and from Iran. The statement advises Americans to consider leaving Iran by land to Armenia and Turkey. Now, IT Minister Ashwini Vaishnav attending the G7 Critical Minerals Ministerial meeting hosted by the U.S. Treasury Secretary Scott Bessent in Washington. The ministers discussed focusing on supply chain resilience amidst China's dominance in mineral refining. Vaishnav has said that centering critical mineral supply chains is vital to enhancing the resilience of India's manufacturing.
It's very important for all the countries, including India, to have a resilient supply chain of critical minerals. There were discussions around funding new projects. There were discussions around technology sharing between different countries. There were very important discussions about recycling, because that's a good way of harnessing the minerals out of the waste products.
Well, that's Ashwini Vaishnav in Washington. Ukraine has said that Russian forces have killed 4 in drone strikes that targeted Ukraine's 2 largest cities. Kyiv has said the attack was the most concentrated barrage of the year so far. This comes hours after the U.S. accused Russia of dangerous escalation during an emergency meeting of the United Nations Security Council. Washington is expressing particular alarm about Russia's use of a nuclear-capable ballistic missile last week. Now, Republican Congressman Randy Fine has formally introduced the Greenland Annexation and Statehood Act. The legislation is aimed at providing the Trump administration legal authority to pursue annexation and eventual statehood for Greenland. In a social media post, Fine said that America's adversaries are trying to establish a foothold in the Arctic, and the government will not let that happen. Former Fed chairs Janet Yellen, Alan Greenspan, Ben Bernanke have extended their support to current chair Jerome Powell, who's currently being investigated by the U.S. Justice Department. A joint statement by Powell's last 3 predecessors condemned the criminal inquiry as an unprecedented attempt to use prosecutorial attacks to undermine the Fed's independence. The joint statement also added, and I quote, "This is how monetary policy is made in emerging markets with weak institutions." End of quote. International central bankers have also reacted to the proceedings against Powell. In a social media post, central banks have said that they will stand in full solidarity with the Federal Reserve System and its chair, Jerome Powell. The post added that Powell has served with integrity, focused on his mandate, and an unwavering commitment to public interest. India's government bonds declined after Bloomberg Index Services has deferred the inclusion of Indian bonds in its global aggregate index. The service provider cited operational and market infrastructure gaps. Ritu joins us now with more details. Ritu, why has India not been included, and what does Bloomberg say on the road ahead?
That's right. Bloomberg Index Services seems to have deferred India's inclusion in the global aggregate index, but it did say that the review remains open and ongoing. Now, remember, India is currently being evaluated for a potential weighting of around 1% on the index, which is an allocation that can translate into $25 billion of inflows as per various estimates that will be spread over roughly 10 months if admitted. So no decision on this yet. But Bloomberg Index Services did say it will provide an update on the matter by the middle of this calendar year, that is 2026. It also noted that market participants broadly backed India's bond market trajectory and its eventual inclusion in global investment grade indices, acknowledging some of the progress that has been made in recent years, including better market access and the fully accessible route. But it also said respondents have flagged some operational and market infrastructure gaps that still need work, and that includes limited automated trading, post-trade tax-related settlement delays, and lengthy fund registration processes. Now, as a result, the review still remains open and ongoing, and a further update is expected by mid-2026. The ISL also says any decision on the inclusion is going to be announced well in advance, and it will be implemented in a phased manner with at least 1 year between the announcement and the commencement, so that there is orderly market adjustment as well. Now, this is an important event for the market because the inclusion can attract foreign inflows, and this higher demand can lower borrowing costs as well and also boost the long-term market liquidity and infrastructure. The bond market obviously reacted negatively to this update today because most of the participants in the market had anticipated the inclusion to be announced this week itself, and that doesn't seem to be the case now.
Ritu, many thanks for joining us. The other big story we're tracking, Labour Minister Mansukh Mandavia has nudged quick commerce companies to stop marketing and branding the 10-minute delivery promise. This comes after recent protests by gig workers demanding higher pay and safer working conditions. Blinkit has made the first move and it's dropped 10 minutes from its tagline. However, and this is important to note, there is no bar on 10-minute delivery. It has not been stopped and there is no government order suggesting the same. Timsy joins us now with the details. Timsy, we understand that there have been meetings that have taken place between quick commerce companies as well as the Labour Ministry and the Labour Minister. What has been agreed upon?
Well, yes, as you rightly mentioned, what sources are indicating at this point of time is that Labour Minister Mansukh Mandavia held series of meetings with quick commerce companies to stop marketing and branding of 10-minute delivery. Labour Minister held series of meetings with quick commerce companies in the last 1 month, and Labour Minister in these meetings nudged the companies to discontinue the branding of 10-minute delivery to protect the rights of gig workers. Union Minister Mansukh Mandavia, sources claimed, has persuaded during these meetings the major delivery aggregators to remove the 10-minute delivery branding and marketing. Also, these meetings were held with leading platforms, is what sources indicated, which included Blinkit, Zepto, Zomato, Swiggy, to address concerns related to delivery timelines. Other aggregators, according to these sources, is that they are expected to follow suit in the coming days, and sources in the nutshell actually said that this move is aimed at ensuring greater safety, security and improved working conditions for gig workers. Meanwhile, CNBC-TV18 has reached out to these quick commerce companies and is awaiting their responses. But yes, as of now, sources indicating that Labour Ministry has managed to nudge these companies to stop the 10-minute branding and marketing. They might be able to deliver in 10 minutes, that can still be the case. But when it comes to marketing and branding, that needs to be addressed with this nudge, is what Labour Ministry sources are saying.
All right, Timsy, many thanks for joining us. We will take a break, but when we return, the rise of Gen Next at the Tata Group. Sources say 32-year-old Neville Tata is likely to be inducted into the board of Sir Ratan Tata Trust this week. That and more when we return. Let's turn our focus to the auto sector. Passenger vehicle sales increased nearly 27% on an annualized basis in December. According to SIAM data, sales of motorcycles and three-wheelers grew in double digits. The growth momentum also extended to the export market. Total vehicle exports up 21% year-on-year. So that's the latest as far as the December auto sales data from SIAM. Shares of IT giant TCS and HCL Tech in focus today after reporting Q3 earnings. TCS met estimates on revenue and margins. HCL Tech ahead on estimates on most parameters. Speaking to CNBC-TV18, TCS CEO K. Krithivasan said the company aims to become the world's largest AI-led services company. He also added that TCS aims to become more acquisitive going ahead. HCL Tech CEO C. Vijayakumar said that bookings in Q2 and Q3 are almost 30% higher on an annual basis.
Our ambition is to be the world's largest AI-led services company. And we laid out 5 pillars through which we are going to achieve. And one of the pillars about that is how do we play in the larger ecosystem. And we said we are going to be more acquisitive going forward.
We have done very well in the last 2 quarters. And given the strong bookings in the Q2 and Q3, the Q2-Q3 booking is almost 30% higher than in the same period last year. So we are looking at some good uptick in revenue in Q4 in the services, and then of course Q1 as well. So I think given our booking, given our pipeline, and all the momentum that we have, we are looking at a good outcome in the next year. However, anything specific, we will really have to wait for the April meetings.
Well, from tech now to Gridco, it's approached the Supreme Court against the Appellate Tribunal for Electricity's order directing the payment of fixed capacity charges to GMR Kamlanga Energy. GMR Kamlanga has claimed outstanding dues of 280 crore rupees for FY16 and 17. However, Gridco has argued it cannot be held liable for payments that were neither scheduled nor supplied. Neville Tata, the 32-year-old son of Noel Tata, is likely to be inducted into the board of Sir Ratan Tata Trust this week. Pariksha joins us now with more details. Pariksha, this is a significant development. This is the second board that Neville Tata will now be inducted into.
The reason why this is significant is that Sir Dorabji Tata Trust and Sir Ratan Tata Trust together control 51% stake in Tata Sons. Neville Tata, the 32-year-old son of Noel Tata, was inducted into Dorabji Tata Trust in November last year, along with Bhaskar Bhatt. Bhaskar Bhatt is also a long-time Tata Group veteran, so to say. Moving on, we're told that the board meeting that takes place this Saturday, the 17th of January, that will have on the agenda Neville Tata's induction into Ratan Tata Trust. Many observers say that it was definitely on the cards after his induction into the Dorabji Tata Trust, and this is now almost a formality. But his induction has to be unanimously approved by all the trustees. Having said that, what does this mean for Tata Trust and Neville Tata? Now, Neville Tata was someone who entered the Trent business in 2016. He heads the hypermarket business of Trent. This can be seen as a move by Noel Tata to somehow solidify his leadership within the Tata Trust, in the Tata ecosystem, help him grow as well, and also make sure that the kind of feuds and the tension that the Tata Trust had seen between trustees in 2025, that comes to an end. Many observers are telling us, and these are people who've worked with Tata Trust for many years, they tell us that this could be a way to balance things out between the Tata Group family and outside bureaucrats and industry veterans who are a part of the trust. Also to make sure that there are more and more people within the trust who are aligned with Noel Tata's vision going forward. And this is perhaps not the only change. We're told that Pramit Zaveri's tenure also comes to an end in February. He will be due for reappointment. So will be Darius Khambata and some other trustees as well. So what this could mean is we will have to see whether all of these people that I mentioned, will they be reappointed unanimously, or will there be new people who will be inducted into Tata Trust? So possibly we could see some fresh faces, but clearly a lot of changes underway within Tata Trust, which will have a long-term implication over the next 5 to 10 years.
Oh, it most certainly will be Significant development there. Neville Tata likely to be inducted into the board of Sir Ratan Tata Trust as well. And as Parikshit was pointing out, we might see some old-timers like Pramod Javeri who are up for reappointment. Will they stay on or not is the question. Time for us to head into a break. But up next, loudspeakers go silent as campaigning for Maharashtra civic elections ends. Voting will take place on Thursday. That and more when we return. Well, the CNBC TV18 Market Forum is set to begin. Nigel joins us from location. Nigel, you know, it has been a difficult start to 2026 and perhaps the worst start that we've seen in almost a decade for our markets. You've got the best of market veterans with you today to present an outlook on what the year ahead holds, the stories, the themes that we should be looking at. Sum up the mood at this point in time, Nigel, and the top questions that the market really has that it's hoping for answers to.
Well, you said it, Shri. No, we thought that 2025 was a difficult year. Well, 2026 is as tricky as ever. So it's a very, very good platform to have this market forum. I'll tell you what, I've had some chats offline with Mr. Ramdev Agarwal, Mr. Manish Chokhani as well. I'm looking forward to hear what they have to say because today there's going to be a lot of focus. We're going to be giving you a wholesome experience from the market view to where does alpha get generated, and then we'll wind it down with how the economics of the country are looking at as well. Will Budget 2026 be a big event, and what are the triggers in line as well that we have? So it's going to be quite interesting. I think the markets are going to be asking the key factors out here, right? Is 2026 going to be better than 2025? Not just in terms of a headline number, but will the broader markets perform? Because last year everyone was talking about 9 to 10% return. Guess what? Portfolios were down by 20 to 25%. So everyone's interested to see where does alpha get generated this year? Also, what are the top themes and what are the contra bets? Because that's going to be rather interesting. A couple of sectors like real estate and IT, they have done absolutely nothing. In fact, stocks are down between 10, 20, even 30% out there. So can some of those ideas come up as contra bets is going to be important. And also marketmen's view. Gold versus equities. Well, we have been talking about various ratios. Gold continues to move up. It's got safety buying as well that we see, safe haven buying. But will equities finally have a better year than gold? That's going to be top of mind because as of now, a lot of investors going by the start that we have seen to 2026, they're getting a little bit jittery. We start markets at around 9 a.m. By around 11 a.m., we've seen numerous times that the markets have been under some pressure. And we have been seeing recoveries from there. But otherwise, 25,500 important on the Nifty. I'm waiting by to hear what our market men have to say, Shireen.
Yes, and you can see our market experts on your screens there, Ramdev Agarwal and Manish Chokhani. They're going to be kicking off the market forum. But, speaking of themes and sectors, question for Ramdev from my side, Nigel, will really be on how this e-commerce, quick commerce story is likely to pan out. That's a big bet that Motilal Oswal has made. They've put in a significant amount of money into Zepto. There seems to now be a lot of regulatory pushback. Of course, as we reported today, a short while ago, that the ministry has nudged quick commerce companies to drop the 10-minute promise from their marketing and branding. So what does Ramdev make of all of this and the likely implications for that big IPO that's awaited Zepto, which is, of course, likely to be one of the big IPOs of 2026? That would certainly be one of the themes that I would like addressed, Nigel.
Well, indeed, Shri, we're going to be keeping an eye out on that quick commerce space. And as you said, Zepto IPO, but there are a couple of other big ones as well we're looking at for this year. Probably we could see an NSE IPO, probably a Geo IPO as well. So that's going to be top of mind because we know 2025, we had a flush, in terms of IPOs hitting the markets. And the problem was there was draining a lot of money out of the system as well because we keep talking about these SIP flows that are rock solid. The problem is the supply of paper is equally as strong. So in a few minutes from now, we'll hear from the man himself, Mr. Ramdev Agarwal, as well as Mr. Manish Chokhani. I'll toss it back to you, Shireen, and we're going to see you very, very soon.
All right, Nigel, we are going to come back to you and the market forum. Prashant is going to kick things off with Ramdev Agarwal and Manish Chokhani. Stay on with us. Don't go anywhere. That's CNBC TV18 exclusive coming right up.
It's January 2026 and markets are doing what markets do, recalibrating. Indian equities logged their sharpest correction in over 3 months, with benchmark indices adjusting to shifts in foreign flows and global trade dynamics. Foreign investors repositioned significantly through 2025, and the rupee has tested new levels against the dollar. That's the market we're in, one where policy, geopolitics, and flows move as decisively as earnings, where beta is uncertain, but alpha is available for those who know where to look. Which leads to the only question that matters right now: where is alpha in 2026? This is why we have created this platform for the conversations that shape how India allocates capital, the conversations that happen before they become consensus. Over the next few hours, you will hear from some of the sharpest minds in Indian finance and markets, the veterans from the industry who have turned early convection into extraordinary wealth, CIOs managing billions who are navigating this exact moment with real capital at stake, and economists and strategists who advise the institutions that move markets. Before we begin, special thanks to our partners, Mirae Asset Mutual Fund, ICICI Prudential Mutual Fund, and associate partner Reliance Industries Limited for believing in this idea from day zero. Let's begin with what matters right now: markets ahead. Valuations have adjusted, flows have reversed, the macro environment has shifted. The old playbook doesn't work anymore, which means 2026 belongs to investors making conviction calls while others wait for clarity. So where are the risks? Where are the opportunities? To explore that, please welcome Prashant Nair, Executive Editor at CNBC-TV18. And joining him for this conversation, we have Ramdev Agarwal, Chairman and Co-founder, Motilal Oswal Financial Services, and Manish Chokhani, Director at Enam Holdings. Please welcome them with a huge round of applause. Prashant, over to you.
Thanks very much, Shruti, for that. Please. I think we'll get to alpha in just a bit, but I think 2026 has started on a phenomenal note, right? I mean, it's hard to believe it's only, 10, 12 days into this year. 2025, I dare say, seemed like 3 years compressed into one. And these 12 days seemed like, the whole year in that sense. It's the sheer amount of news flow, the news cycle, and every day is new. What we're going to try and do is understand if, it matters for investing, right? At the end of the day, how do you use everything which is being thrown at us in a way which helps us rather than hurts us, right? I want to first up put up something which Manish tweeted, and I think it'll come up right here on the screens, which I think perfectly, as they say, a picture is worth 1,000 words. There you go. So there's Tintin, there's Captain, there's Snowy. What a year. Captain, it's only the end of the first week. So, I think, Manish, let's start there. I think that tells the story, doesn't it?
Well, it's thanks to President Trump, right? You wake up every morning and he's made for television. And he's reset all rooms of the game. And we're back to, like in 1980s, we used to watch Hindi movies. It was Aaj Ka Gunda Raj. That seems to be going on.
But has the world changed, Manish? And will it stay changed?
Yeah, the world has fundamentally changed. There's no two ways about it. That what happened after falling of Berlin Wall gave us 25 years of American supremacy, rise of globalization, capital markets, and all of that. And President Trump is clearly reversing that there's no more globalization. We don't want just in time. We want resilient supply chains. We want nearshoring, friendshoring, onshoring. So this move of capital across the world, goods all over the world, is not going to continue forever. And it is now an inflationary world that we're living in. Because you've created these bottlenecks everywhere, and that gives rise to different kinds of asset classes. You've seen, therefore, the rise of gold and silver and stuff like that, because it's really an anti-dollar. What is the next currency that I could be in? It's not connected to equities. But if I have to store it, the older people buy gold and silver, and the youngsters all go and buy Bitcoin or whatever. So there is a change in the playing field. Having said all of that, as equity guys, we learn, we buy businesses, we buy them cheap. And as long as they compound and they make money for you, we'll still be okay. And before we came in, I'll just use a 2-minute example for that today Motilal Oswal's profit and Sanjay's profit at AU is 2,500 odd crores. And if I go back to 2001, Lata will corroborate this, the profit for SBI, which has 25% of India's banking sector, was of this magnitude, 2,500 crores. And today they are going to be north of 80,000 crores. So in a sense, that's the alpha you need to look for. It's not about what happens this year, this quarter. The scale of opportunity is just crazy. I remember buying Bajaj Finance in 2008. Sanjay, the profit was 20 crores, and there'll be at 20,000 crores this year. So it's a country of opportunity. So let's not get diverted by President Trump. He will play his games. The playing field has indeed changed. As long as we recognize the change to inflation assets, I think we should be okay.
As they say, we kind of tend to overestimate the impact of things closer and underestimate things which are far out in the future. But that does not apply here. In a way, you're saying, well, the way things have fundamentally changed, it'll stay changed. Yes. It may not matter that much for how you invest. That's the point you're making, Manish?
But, I mean, think of it like Warren Buffett went through how many cycles, and Ramdevji will speak more about it. But his first wealth was really made in the inflationary era when he bought brands and stuff. And he morphed over time. Towards the end of his career, he was still buying value. He bought Apple very famously at a 15 PBT multiple. He was not betting on a high multiple in a technology stock. But he played the game well enough to come to that as the playing field changed. And he changed his style, but he never gave up his value orientation. Same way, like we always say, I say, if you can buy something that you look out 5 years from now and it looks like a 5 multiple, that means I know the business for 5 years. And at the end of 5 years, if I've bought a 5 multiple stock today, the end of 5 years, I'm expecting the multiple to be somewhere between 15 and 25, which means I'll make 3x to 5x, which is a 24 to 40% kind of CAGR for me, which is good enough. And that basics of investments will never change.
Ramdevji, do come in. Do everything which is happening, Trump and everything which President Trump is throwing at us, does it change at all? Does it? Do you worry about it in any which way in terms of how you're investing and how you forecast things?
No, I don't think. As far as my investing is concerned, Trump doesn't impact me. Okay. But of course, world will be impacted because the multilateral globalization which was on, I think world is very interdependent. Now, how exactly it will navigate, it will remain interdependent, and actually it will become even more interdependent. But how do you trade between two countries? I think Singapore Prime Minister said very well. He said, whatever Trump does, trade will find its own way. It's like a water. I found that to be the most important kind of thing. So these things keep happening. Of course, I don't think in the very long run, I mean, one side Trump is happening, the other side AI is happening. So I don't know how to figure out which is going to impact how much. So I would feel very happy that I'm in India. I do things which I understand, and we'll find few things in investing. You don't need to have a view. You don't have to view on everything. You need to have a view on 4 or 5 things. That's it. I think I'll be able to find enough ideas out there.
With all this uncertainty, just one to close that loop, Ramdevji, all the uncertainty, all the macros, everything, etc., which is happening, and if Manish's point is that it's not a short-term thing. I mean, something has fundamentally changed. Does it lead to low? I mean, there will be headwinds to growth, etc. For a risk asset like equities, does it lead to lower multiples? Generally speaking, or no? It should not.
No. See, equity is very exotic, mystical asset class. Okay, equity. I mean, even I'm still discovering what is equity. See, equity has a huge power to take a lot of uncertainty in, and yet, entrepreneur, he's the magician. He can navigate all kinds of risk in his own way. So we have to find those entrepreneurs who are able to navigate those things. Whatever his challenge comes, he's able to navigate and deliver me earnings. So if AU is built or any other entities are built, it's not that they didn't have challenges. So new set of challenges will come. But the entrepreneur has that power or magical, competence and determination to sail through all those difficulties and give us the earnings.
Okay, let me ask you something which I don't think either of you want to answer, which is the India-US trade deal. Manish, let me start with you. will get done in 3 months. It'll take 6. It'll take more than 6. What's your sense?
He said you don't have to have a view on everything, so we don't have a view.
But take a shot at it.
No one knows. I mean, even the man who has to sign it, he might decide to change tomorrow morning.
Yeah.
So no one can answer that question.
But does that? I mean, how do you think about it? Eventually, it'll get repaired. Maybe it takes a little longer, a little less.
I mean, worst case is the term is 3 years more. So that's the outside limit, right?
3 years.
India and US will be...
3 years was not there in the options. There was only 3 months, 6 months.
No, I mean, two countries like this can't be at loggerheads for long.
Yeah.
But the fact is we don't have too many things we can, hold someone to ransom for, unlike China. And therefore, it's getting dragged on until, like I said in the beginning, you're kind of now in a world of a G2 where there are two big bullies and you have to decide, you have to go in one camp. We don't want to go into either camp. And both of them are trying to, push us and prod us to fall into a camp. The better that we just stay out of these games that they're playing. And if it takes long, it's painful for the next 3 months, 6 months, 1 year, and for the companies and the individuals involved. But on a 10, 20-year cycle, I think what we're doing is the right thing, to stand with our position and what we need to do. So I'm not so concerned about how long it takes.
Manish, you have a global investing view as well because you invest in other markets. And this is also, I mean, it's not so much about the tariff rate, whether this is this or that. I mean, exposure to the US as a percentage of GDP is small. But it's also a time of absolutely radical innovation, right? Across sectors. And that is where does that worry you a little bit where there are these two countries, US and China, who are kind of pulling away and everyone else, for the lack of a better way to put it, is kind of sort of falling into the gulf. I hope India is not, and India kind of sort of,
No, it's fair. I've said this for a long time that you asked him earlier about do terminal values get affected? Of course they do. It's like, would you now be buying Indian IT services companies at high multiples? You won't, because there is a terminal value to that business. For example, what happened to broadcasting TV versus OTT? You know that there's a multiple which is going to collapse. Any disruption, you know the losers very well. For example, if EVs take over, you know what will happen to ICE engines and so on. So that disruption is certainly damaging for a number of businesses. We don't know the winners as yet. And by losing out in this AI business, forget the valuations, which may be bubble like today, but the business is real, like the internet was real. Now, my hope is that India is a beneficiary of the AI trade because we use our data sets to find solutions which are unique to us. The way when the internet came, our types of businesses, financial services, for example, really benefited from it. We became a lot more global. We started having clients globally. Our research costs went down. So in the same vein, anyone with organized data sets, which is the next 2-3 year window of opportunity for our Indian companies to organize that. But what lies beyond that is how well we use this to get both efficiency as well as differentiation. So in that context, India is really falling behind in the technology space. But the way China took it as a wake-up call 10 years ago, when the first Trump presidency went hammer and tongs after them, and they realized that we need to stand up and create our own tech and our own markets and our own systems for doing things. I think that's a wake-up call we are going through today. The way it happened when we got hit with the first Pokhran explosions. And the next 2-3 years, actually, India woke up. I mean, the rise of what we did with ISRO and the defense industry really owes its origins to that period. I think this period will create a lot of important companies being born in India out of this need and this realization that we need to play our own game as well.
You think that is happening, that waking up is happening as we speak?
Yes, it is happening.
It is happening. Ramdeji, on this AI question, do you have any thoughts at all in terms of how it impacts? I mean, we heard it became almost a meme towards the end of last year. India is like the anti-AI. Huh? I don't know if that still holds, but any thoughts at all? AI and how that impacts markets, what businesses will change. Manish spoke about IT having a terminal value now. What's your sense?
Yeah, so as far as IT is concerned, what he said is right, that terminal value seems to be, today opinion is that terminal value of Indian IT is gone down what it was considered 5 years back. So clearly that's the impact of AI directly on the sector. But I think like yoga is a technology, you can say. Okay, yoga we discovered, it's a completely Indian stuff. But the worldwide, I think US guys, they use it much more and they benefit more. So like that, AI is discovered in US or China, wherever it is being developed. But we are the fastest and the biggest adopter of AI. And our services company will deliver the highest number of AI agents and things like that. So I think how it's a big development after internet. So how exactly will evolve and how it will be used in a corporate situation. You see the way GCCs are coming up. It's a bigger phenomenon than even IT revolution. So all the AI agents of the world could be sitting out of India. So it's too early. Let's not call one way or other. Probably we could be benefiting a lot more than what we might be missing out as not as a technology originator.
Fair enough. Let's drill it down to some local stuff, markets per se. Manish, you think 26 will be a tough year? I mean, no year is an easy year, but you think it'll be tougher than usual, or what's your sense?
We spoke in Diwali, we spoke in December, so it's not changing because the calendar has changed.
Correct.
It is a tough year until earnings cross substantially double digits and come closer to mid-teens. People aren't going to come chase this market. Money has been going already to emerging markets from Korea all the way to Peru and Chile. The anti-US trade in a way has been on already. Metals have been doing well. Hard assets have been doing well. That trade continues. And I said even then that I would expect financials, hard assets, metals, and public sector, especially with the finance minister and the budget day now, a last big resource raising exercise is left is really from the PSUs. So these three would dominate this year in my sense. And if you make a double digit on the index, I'd be very, very happy. I would take it.
Double digit in the index would be a great outcome. And you're saying hard assets, which you've kind of been bullish on, financials and PSUs are three areas. Ramdiji, same sawal aapse. Easy year, tougher than usual year. And where would you generate alpha?
Yeah.
Which is why we're here.
Yeah. So I think it will be better year because earnings cycle is turning for sure. Because I just saw the estimate from, we cover one of the largest number of companies here, 350 companies. So MO Universe, this quarter is expected to deliver 20% earnings growth. This is after 6 or 7 quarters. We are getting real upturn.
This third quarter,
earnings. Yeah.
20%.
Index itself could be about 8 to 10%, but all 350 companies put together will be about 20% aggregate. So let's see what comes out. And my sense is Q4 will be even better. So I'm very kind of optimistic on the earnings cycle turning up after brief, lull for last 4-5 quarters. And government is also after it. Now government is trying to put in place slow down in the credit cycle, slow down in the, your credit cost. You are given fiscal benefit, you are given monetary benefit, you are given GST benefit. So government is firing all cylinders to get their normal GDP growth going at 10-11% so they can collect taxes. They're not able to collect taxes. You see the tax collection, 2-3%, 4%. So they need to get to 12-14%. So now there is a vested interest of the government to reflect the economy to about 10-12% nominal. Hopefully with 4% inflation, it could be 7-8% kind of real GDP growth rate. That GDP growth is better than 7-8% now with nominal GDP growth of 8%, deflator being 0.5%. I think that doesn't fly in India. So I think we are again back to the old style, 7%, 7 plus 4 or something like that. So I'm optimistic that this will happen in next 12 months and which will push up the earnings cycle big time. As far as the sectors, I think large caps are better chance to beat the market than the mid and small. Second, I think PSUs still have a lot of steam. They are much more reasonably valued than private sector and earnings growth is almost 2x of private sector. So that looks to be a very interesting category. And I think financials, I think auto will be the star of the year.
So just a couple of things, autos, two-wheelers, four-wheelers.
I don't know. I think you should buy auto ETF.
An auto ETF, everything in it. And PSUs, you said, PSU financials, PSU banks. Oh, you were referring to PSUs generally? Yeah,
I'm not suggesting any sectoral.
Okay.
But PSU as an aggregate vis-a-vis private sector, PSU should do better.
Okay. And within that, any segment?
I think you are led by, PSU is dominated by banks. Banks clearly. So banks in any case is coming back. So sure. PSU banks led by SBI and all, I think they should do well.
Okay. And capital markets, of course, has been a
that is evergreen for next 25 years, one way.
You leave something for the fund managers.
No, we'll get to that. And I think Sandeep is here and others are here. Ramdiji, you said government also has a vested interest now to push up growth to collect more taxes.
Yes.
या तो आप GDP बढ़ा सकते हैं या फिर आप टैक्स रेट बढ़ा सकते हैं.
वो टैक्स रेट तो काम नहीं करता है. See,
budget is around the corner, so I wanted to just ask you. Just a framework in terms of how you're thinking about the budget, because there is a revenue shortfall, and I think we'll discuss this with on the macro panel. But just your thoughts.
No, there is no question of raising the taxes, because otherwise they would have not brought down the GST from 28 to 18. It's a budget in itself. So I don't think the direction of the government has opened the hands. So I don't think they are going back on to raising the taxes. That's not the way to, because what will you tax? If the economy is not growing, any kind of tax rate is no meaning. So first you've got to get the tailwind happening in the economy. And I think it's very simple. I think they had beaten down the credit flow for whatever reason. That must be their inflation control, whatever. Now they got to get it back to 14-15% credit growth. And that will give you 11-12% nominal, and then it's all evergreen.
But do you think we're on that road and we will start to see these?
It looks like. That's what I hear, what the governor is saying, what the SEBI chief is saying, what the broader things which are coming from Delhi. Look at we should not bother too much about what they say, because they can keep saying, but what they do. So what they do is what they've done in last
which is stimulate.
125 basis point cut in the interest rate. Credit flow gone up from 8-9% to 10.5%, 11-12%. Then you have the GST cut from 28 to 18. Your tax-free rate has gone from 6 lakhs to 12 lakhs. What more they can do? They can further cut the interest rate by another percentage or so. I think things will happen.
तो कुछ खराब नहीं होगा बजट में, कुछ अच्छा हो सकता है, रामदेव जी.
I think so. We are in the. I don't think government is going to go back till they get their taxation right. Their interest is to get the taxes from the market. Yeah.
Manish, budget?
No, he's rightly said it. They've already cut your direct taxes. They've already cut your indirect taxes. So there's nothing to look forward to on that side. And the resource raising exercise has to come now from public sector. And if some of those assets go cheap to private hands, like it started in 2002-03 in Vajpayee era, it reignites animal spirits, because private sector is clearly not opening the purse strings because they are a bit uncertain about what's happening in the world as well. So anything to revive animal spirits, whether through privatization or disinvestment or maybe some other PLI type scheme, would be very welcome, because even the labor codes which have come have actually, in a sense, increased the accounting cost for companies. So you need to give a profit fillip to the private sector. Let's see, something comes. The good news is they've demystified the budget. You don't wait with bated breath ki kis pe talwar padegi. Now you look for
your sector, which is commodities and hard assets, right? I mean, they've had a phenomenal year. On that front, I mean, on the taxation front, I mean...
Listen, tax I don't honestly think about, because let's first think about making money. Then if we make money,
that's what we think. But I think...
Look, the beauty of our profession, which we've chosen, is you wake up optimistic every day, looking at the bright side of things. So I don't wake up worrying and chewing my nails. By and large, everyone in this country, I've said it very often, that if our God had put the GPS off by 5 degrees and we had landed either side of India, we wouldn't be discussing wealth creation. We would be discussing how do we stay alive. So be thankful for where we are. And by and large, the country is going in the right direction. We are in the right age, right space, right time. Things will be better.
That is a nice philosophical sort of close to the discussion, but I think points well made. I think we can maybe open the floor for a question or two if we have a question from the audience. Anyone, please, if you do, so please stand up, introduce yourself, and do ask the question. If you can get a mic to him, please. So behind you.
Thank you so much. So my name is Suresh Gandhi. I am from the healthcare industry, but after leaving healthcare industry, I have moved 15 steps into wealth management industry. And I am also a franchisee holder of Motilal Oswal. So Ramdev ji, it's a pleasure meeting you, and likewise Manish ji. And I have been always a fan of CNBC-TV18, and I was sharing a lot of anecdotes about it, but I will share that later privately. While I like the optimistic approach that Manish ji has so very well highlighted, and a few of the things that one must keep in mind is that in the morning, when we wake up, we need to keep half a dozen different optimistic ideas afloat. Otherwise, we could go off very badly. But nevertheless, does it bother any of us, or you especially, the wealth creators in this country, that certain factors which come to my mind, and I have just jotted them down in 5 minutes that came to my mind, We talk of disruptions and what Trump is...
if I could just request you, if you could keep it brief, because we want to take a few more questions, please.
While Trump is doing what he would do, causing disruptions all over the world, and perhaps that is good for USA. But as a country, what are we doing? What disruptions are we doing? And does it not bother us that without some kind of disruptions, we would end up being nowhere in 5 years, 10 years? We might generate alpha, but for the next generation, we will have a very poor story to tell. There is hardly any research. There is hardly any innovation or beating in AI or being a leader in AI. There is hardly any cost advantage. The social unrest is humongous.
Sir, can I ask them to respond? I think we got the gist of your question. Manish, you want to take it, please?
There are 10 other points.
Please.
Suresh, I just know from 35 years, I could always make a macro bear case for India. And I know for 35 years, we just focused on buying the right entrepreneurs at the right price and generating wealth for ourselves. And by and large, has your living improved or not improved? Has all your standards of whatever you did, whether your house, your car, your road, well, I can't say the roads in Bombay, but generally
road anywhere you can't
coastal road to aa gayi na, but
coastal road.
So, but you can always see glass full or glass half empty. It depends. And you said you're from the wellness industry. If you choose to be looking at life with gratitude and happiness, you will stay well also. And if you look at things with a pessimistic outlook, you'll be pessimistic. I can share, my son is 32. He spends half his time now meeting technocrats and scientific talent. And we ourselves were fortunate to create a business based on that. The creative instinct of the youngsters in India is not dead. You and I may feel old. You go to IIT Madras, go to IIT Bombay, see what is happening there. We have an investment in Agnikul, like one of the top space rocket launching companies of India. He's created a rocket which goes and comes back the way Elon Musk has done, but at a fraction of the price, maybe for the SME sector. So to just dismiss that there's nothing happening in our country is to do with our lack of seeing or knowing what is there. There is stuff happening. Even if you looked at China 10 years ago, we used to famously say, we know software, we know IT, they don't know anything. From where did Tencent and Alibaba come out? From where did BYD come out? It came out from that same country, which we said is full of robotic people. So yahan bhi hoga, just have faith, have patience.
But there are no any green shoots that one can see.
It will come to you at 50p when the P comes and sells it to you in the IPO.
Thank you very much, sir. Okay, any more, please? Surubi, go on.
Fantastic conversation, gentlemen. So in the spirit of optimism, if I could ask, and Prashant was talking about taxation and Manish mentioned that the bulk of it is done, indirect and direct tax. But since we're being optimistic, let's talk about capital gains. And Manish also made that point, right? That jab gain hoga, uske baad tax ke baare mein dekhenge. But say if the government were to consider rolling back to 10% LTCG, will it really help the market? Will it really change anything? Or will it be a bullet wasted in an environment where there's anywhere too much flux?
I don't want to hog the... You want to go?
No, see, as you said, the 15 or 10 depends on how much money you made. If you don't make money, then how does it matter? And actually, I don't think people really complain about 15%. Also, we also need...
Oh, so abhi 12 and a half hai.
No, see, it will definitely be a cent.
15 pe haan mat kehna.
I think it's 15.
No? 12 ideas then.
So she was saying from 12 and a half, if it goes down to 10%.
I don't see, it is sentiment booster for sure, but I don't think it's a game changer. No way.
At a time when you spoke about government revenues obviously being under pressure, Manish, just if you want to add.
No, look, this capital gains is a red herring. And it creates a friction for everybody, including for the foreigners, because the way they have to do their fund accounting with accounting for NAV calculation with taxes implied when people come in and out is just wasting time. If they would just increase the STT on this, they would solve Jane Street and they would solve for FIIs, and you don't have taxation problems at all. But someday something will happen. But to answer a short point, the capital gains is a net deduction from your DCF, right? So your terminal value will go up to that extent marginally. But like he rightly said, I'd rather make 25% gain and pay a 12.5% tax than make a 12% gain and pay a 10% tax. So if we can get the animal spirits up for the entrepreneurs, let's focus on that. We guys are all derivatives. We ride behind people like Sanjay who actually build business, who build wealth. We are just buying 2%, 5% of their companies and riding with them. let's get their animal spirits up. I think if we get that from the budget, I think we would be very happy with that.
And that's so beautifully put, Manish. Thank you very much, both of you, gentlemen, for a really enriching conversation in our attempt at finding alpha in 2026. Really appreciate it. Thank you very much. Ramdevji, please stay on. No.
Thank you, gentlemen, for those insights.
AU Bank back in 2008, March of 2008. They put in 20 crores at a valuation of about 50 odd crores at that point.
30 crores. Sir, इतना महंगा देते नहीं थे यार.
अच्छा, तो ठीक है. So and then they stayed invested. They put in more money. I think in 2010.
10.
There was, and then of course, I mean, in a phased way, they sold their stake.
Yeah.
The final exit value, market cap, when they sold was about 5,000 crores. So
Yeah.
it's been 100 bagger AU Bank for Motilal Oswal private equity.
Yeah.
I know Ramdevji is coming.
Yeah.
Now Ramdevji is the second thing, right? So Motilal Oswal as a firm still owns about 77 odd lakh shares.
70 lakhs. Shares.
Yeah, 77, 78 lakh shares. And there, he's not made 100x. He's only made 33x in the last 11 years, and he's complaining.
No, I'm not complaining. I just wanted to keep the record straight. I have not made 100x.
Well, I think he will. And congratulations, you've got the universal license. So I think the 100x is coming, Ramdevji.
Yeah, sure.
What we aim to...
No, I think, because you are covering the story, but, just 2 minutes on it.
Please.
So when I came in Mumbai in 2007, and I was looking for a private equity or a private capital, and, I was being supported by ICICI Bank. But then I met Ramdevji, I think 2007 September onwards, right? And Vishal and of course Ramdevji. Ramdevji se baad mein mila tha, Vishal se pehle mila. And from there today, it's good now 20 years, more or less 19, 20 years, right? And still when Ramdevji speak to me about the company, the future, the growth, the India story, you must be hearing so much. I think it always inspires me, For me, it's not the way Ramdevji would have earned money or would have created wealth. I think his company, his Sangat, which has inspired me so much that if people ask me that who inspires you to build company or to build, institution, I think one man, which is Ramdevji, So thank you so much, Ramdevji, for doing me all these things for over the years.
He inspires us all. I mean, I have to say.
He is pure, he is so natural that sometimes, you are in such a difficult, positioning mindset. But once you meet Ramdevji, it looks like, why you are so much depressed, Just go and play the inning.
Yeah. What we aim to do here is try and ask Ramdevji how he built his conviction. And I mean, the motto of Motilal Oswal is buy right, sit tight. And I think you've done both with AU Bank. So what can we learn from the journey, and how to, as investors, how do you kind of find these kind of tremendous wealth creating ideas? And of course, we'll ask Sanjay how he did it. So I'm actually just here to facilitate the conversation. It's a conversation aimed, we thought of it as a conversation between Ramdevji and Sanjay. Let me just kick this off. Sanjay, let me ask you this. when did the idea come? I mean, what was the genesis? Because you're your family was not in the business, right? I mean, you're a first-time entrepreneur in that sense.
Yeah. So Prashant, I'm a product of 90s, I done my chartered accountancy in 95, and that time era was very different, and the only silver lining was that India was opening up, there were some sectors which were given the private license, and at that time only the HDFC Bank of the world came in picture, right? And being a chartered accountant, I figured out that I don't want to do any normal practice and all those things. But Jaipur, was never inspiring you or pushing you to do something great, Somehow, I would have done around 10 odd businesses, in those days, right from export to even a truck company and whatever, right? But finally, I figured out that my own knowledge or my own comfort is more around the building the businesses around what is your, finance or maybe investment banking and all those things. So I started with my own HNI help and subsequently, got with HDFC Bank, the famous partnership, which I always say that, I'm a product of HDFC Bank partnership. And they inspired me a lot, when I started meeting their leadership and, figuring out that their knowledge and my knowledge is same. So, the ability to think big.
That was in 2003.
2008, right?
Yeah.
And I met everybody except Aditya Puri Saab till 2008, and with Paresh and everybody. And those people really inspired me that whatever they have as a character, as a personality, as a risk manager, product manager, distribution franchise, I also have, but I'm not getting a platform, right? And where I met Ramdev ji, and the team, of course, the first is Vishal Tulsian, and from there onwards, and when they started believing in me, because it's not about putting 10 crore in your company, it's about believing and supporting you, and I was coming from nowhere, At that time, 2008, it was one product, one state, one lender. That was the company, right? That was not an NBFC. I think when Ramdevji put the money, then we became NBFC. And then, now you know the story. So I think one thing led to another, kept the patients always in mind to really, be around that. So all those things. So
and Ramdevji, I think always used to say the next HDFC Bank. HDFC Bank was a big winner for him back in the day, and he always used to say the next HDFC Bank, and I think he found that in you. Ramdevji, tell us a little bit about your first impressions and what really got you excited about AU and Sanjay.
Yeah, so we had set up this first private equity firm, private equity company, and we had about 400-500 crores to invest to 10-12 companies. So one of the thought process for me was value migration from public sector to private sector. So I said, and that time HDFC Bank had already become somewhat. So we said, I told Vishal, why don't we look at some budding private sector lending companies? So get me few small ones, because we were giving 30-40 crores, so we couldn't have got big one. So we're looking for this thing, but profitable. Okay, so in 1 week's time, they bring in front of me Sanjay. Okay, now Sanjay, I said, I think they're making about 2 or 3 crores profit.
Yeah.
2 crores, yeah. So I said, so how much, what exactly you do? So they said they're onward lender of HDFC. So we had great respect for HDFC. So he said they have got 200 crore line from them.
Yeah.
I said, we'll check with them whether you actually got 200 crores or not. Yes. If Aditya Puri has given 200 crores, we'll definitely give you 20 crores. That was the total due diligence.
I think it was not me, he got the comfort. The comfort was Aditya Puri.
No, if somebody has, how do you check whether this guy is good or not?
Yeah.
So he's a chartered accountant, good looking, very energetic, very nice, everything. But whether he has the business sense or not, if Aditya Puri is given 200 crores, 20 crores, hum pakka denge. And the deal got done.
That was line of credit. I mean,
it was a partnership model, right? And where the first loss basis.
Right.
Outstanding was around 400 crores.
Right.
Yeah. So
no, but Ramdevji, there would have been other companies where HDFC Bank would have had kind of these kind of arrangements.
But we had only this proposal in front of us. Don't forget, he's a chartered accountant.
Yes.
He's a good, robust chartered accountant from Jaipur. So, I mean, we liked him. We liked the whole idea that he has been already successful and he's profitable. See, for me, it was very important that he was profitable. And then I think the one led to other, we
But
negotiated.
Ramdevji, let me also, in 2012-13, I still remember, and you were in different mood that time, and he called me up and said, Sanjay, यार banking license मिल जाए ना, तो मैं तेरे को लेके दूंगा. So he actually quoted me that you should run a bank. And at that time, there was no license, even a guidelines or whatever, And when I got the license in 2015, I called up sir, कि sir आपकी इच्छा पूरी हो रही है. So I don't know how he has some linkage with me. I don't know what, Prashant, honestly, that he has some view on us and he can actually read our future. If you go back and see his video on us in 2009 when we celebrated this investment, what he has said at that time in Jaipur, many people now when they see the video, they say, how come Ramdevji knows you so well that, I think he quoted that, in 2009 that one of the asset class, one of the asset which will grow in Jaipur, in next 15 years would be AU. So I think, I don't know how, from where, you always have some comment on us, whether it's कोई हनुमान जी का कुछ है आप पे या शिव जी का है.
No. It is the tailwind of the private sector banking because value migration was done and they are competent guys. They were actually conducting so well. So I was very clear that there will be many more HDFCs will be born. And a lot of guys that tried to be next HDFC. And nobody kind of made it. In fact, the most successful possible bank right from ground up is going to be AU. And I had been, so see, one of the things he said, I will never give unsecured loan in India. That was one of the promise of yours.
Yes.
So they're never proud. See, a lot of companies, banks, they suffered because of this unsecured loan, the MFI part of their own book. So fortunately, they were not heavily into this right from beginning. So they had a very good risk management. And when I visited their office in 2008, I found their office to be run tighter than my office. And I was always proud of my office. So I said, ये बंदे तो बहुत सही हैं.
Tighter means?
Tighter means you could see, at 11 o'clock, people were silently sitting. You just feel, whether
it's a well-run operation.
Well-run operations or not. Or it's a loose, ऐसा कुछ नहीं. It was a small operation. And yet it was very professional, very disciplined. I mean, those are things you judge because I'm visiting companies from 1985. So I have seen hundreds of companies, badly run, very well run, world class. I've seen all of them. I mean, like I've seen Infosys from 95 onwards. I mean, how, so those things help you understand whether there is something better than special, because you're just talking about 50, 60 crore worth of company. Total market cap to be about 70 crores.
Right.
So these other things, when you look at a company, what is the option value you are paying for all this? You're getting a terrific entrepreneur, terrific future. The runway is very large because this country is going to have 14 to 15% credit growth compounded for next 100 years. In that, you are starting with literally nothing, I mean, some 100, 200 crores. So runway is massive. Size of opportunity is very large. Business is reasonably good. It's not like Nestle or Lever, but 18, 20%, 16, 18%. So it's a damn good. But you can deploy a lot of capital. You can deploy 5 lakh crores, 10 lakh crores. But there needs to be a discipline. So most important thing is, how do you handle capital? How do you, when lend, how do you get it back? It is not an easy trade. I cannot do it what he can do. Because when we invest in equities, we know it can go to zero. And we allow it to go to zero, and many times it goes to zero. But these guys, they cannot afford to do that. When they lend, they want everything back. थोड़ा सा पठानी कार्यक्रम भी हो. So
इतना खराब भी नहीं है सर.
नहीं इतना खराब भी नहीं, but being good lender needs to be very tough. Even if you see Aditya Puri, he's not a very soft guy. He's a you got to be strong. Even physically you got to be strong, and he was. So we said, let's take a bet on.
Collections are not a problem. Sanjay, but has Ramdevji been a capital provider, or he has been a he's provided guidance, mentorship? It's more of a partnership. I mean, how do you?
No. I don't think that Ramdevji, provided me the capital, honestly. It was more of Vishal's fund and all those things. I think Ramdevji always, inspired me a lot, in terms of his approach towards life, his approach towards building the institution, his approach to think, bigger, larger, beyond today. All that came because I never educated from the business school, right? I'm a chartered accountant only from Jaipur. So how come you can relate that in 50 years, you can be a largest bank or maybe a top 3 banks of the country?
So he
right?
gave you, Ramdev ji ne aapko sapne dikhaye aur aapke kuch targets the?
No, Prashant ji, it was not about dreaming. It's about...
No, in terms of what is possible.
No. Yeah. I think he's very natural, honestly, right? Like what he was saying in the earlier discussion that, be optimistic, there will be many noises, but you don't want to be noises, be on your job, be on... I think his maybe would have given me 5 ideas, but those ideas actually built it, Sure. Now it's my duty to not to have 50 ideas from him, right? He will give you 5 ideas and build yourself another 45. So I think for me, he's the first guru to me in terms of not building as a bank, right? Building as an institution, building as a personality, character, governance. I still remember that because I'm Jaipur ke chartered accountant the, in 90s chartered accountant would do a lot of things which is not correct in my opinion. But in 2010 he told me that, Sanjay, don't waste your time on taxations. Don't waste your time on the tax people. It's a waste of your time. Just pay your tax. Pay 1 rupee more so that they are not coming to your office, right? And we are now 17, 18 years, Actually, I don't even waste a minute on my tax status, So I think these were the things where he was pushing me to be focused on business, good governance, building the team, think big, think beyond you, And that is why, Prashant, and with the full blessing of Ramdev ji that, in my last 9 years, our balance sheet has now gone 10 times, in spite of so many challenges, right from, the COVID or the bank crisis, NBFC crisis, the interest rate high, how the last 9 years would have been, right? But we just kept on our resilience, focus, execution, right? And we are now, the largest SFB, the only one we got, the universal. And now from here in next 15 years, me and Ramdev ji were chatting the other day that even if you grow by 20% year on year, we would be touching what today the ICICI is, So what we have done in last, 20 years in the partnership, we have created the belief that we can do it.
I mean, I remember the IPO when it came at 10,000 odd crore valuation, and it was an expensive issue.
Five price to book.
Yeah. 5 and...
Got listed as 6.5, 7 book.
Yeah.
70 or 10,000, and now of course market cap is 75,000 crores. And now you've given us it can be an ICICI Bank. I mean,
it has to be bigger than them, honestly.
Yeah.
Because, let's be honest here, right? SJC Bank never had an advantage of AI. I think they never had an advantage of their own, they didn't have any role model, right? I have this SJC Bank in my front, right?
Right.
I have more technology. I have more ambitious people with me. I have bigger economy, right? So my aim cannot be only SJC Bank, to be honest. In the next 25 years, it can be bigger than that also. I think the challenge is not opportunity. The challenge is how mentally you are solid enough to take that scale. Or to remain in that corridor that you will get, right? So I think my belief is that in next 15-20 years, I know that I'll not be there, but this institution will become big, and you will all people be really proud of what we have created in the last 20-30 years. So
that's a round of applause for Sanjay. I think that's a phenomenally well put story, and of course ambition.
And you were talking about AI, sir, because some subjects maybe not be going deep, but at bank level, Prashant, I am seeing that because for the scale, SJC would have done much hard work. Now hard work can be replaced by AI. You will need people, right? But you can't put energy. You can't put them that they have to do everyday hard work to build a next SJC Bank, right? In my opinion, we will create on a 50% effort bigger bank than SJC Bank in next 25 years because of the tech support.
Which is now available, which is not there back then.
You can't even imagine what kind of AI is doing in that sense of making the life easy. The language has become no matter what, as of now, if I want to build a South franchise, I need to understand 4 languages. Now I don't have to understand any language because AI is talking to the customer, right? So where that capability was 25 years back.
Yeah.
So when I'm deep in Tamil Nadu, I have a support of AI-led communication, right? So I think these small things are really helping me as a CEO to think bigger, scalable, and that too in control.
Yeah.
It is not that, when we are building up, there are many gaps will come in, right? So I think, in my opinion, the technology will actually fast forward the entire scale building mindset.
I think Manish makes that point often that maybe in terms of adopters, the biggest will be financials and banks.
Yeah.
Because, I mean, you have the data, you have the...
Yeah, I have one question, Sanjay.
Yeah.
What the regulator is doing is that whatever is the founder bankers, like Ms. Kotak, and so they are being, at certain period of time, they are being superannuated and they want the team to be in place to take it forward, the journey.
Correct.
Okay. So is AU, since it is a first generation entrepreneur and founder, do you have, well before you are being asked to step down, do you have a team, better team than you, ready to take over?
So, sir, I think if you ask me, banks are public platform, and I completely in sync with the regulator's view that beyond a point, a promoter or a CEO should not continue because it can create a risk. It's not about Sanjay Agarwal or maybe any other name. It's about the system in place. So, and then this my duty, or any CEO duty to create a second line succession because in the end, it's not about 15 years. Maybe after 30 years also, when I get retired, somebody has to take care of that, right? So I think that is completely in focus. And regulator also pushes us to create 2 EDs or deputy CEOs, deputy managing director, in order to really build this, the sustainability around leadership, And Ramdevji, for me, being a first generation entrepreneur, I strongly believe that, it's not about you, it's not about me to build a business. It's about how better I can visualize that, how it will run beyond me, And banks are meant not only for 30, 40, 100 years, I have seen a bank for 400 years, So why can't we create an institution which can last, even, when I come back in this earth, maybe, I just joined AU Bank as an employee, right? So I think that's the whole idea, to build a institution which can last for not for only centuries, for many decades, not for decades, many centuries, So
Ramji, for viewers,
it's there, sir. So in short, it's there, and we work on an everyday basis.
Yeah, Ramji, for an investor who's watching, right? I mean, what is the takeaway? How do you spot an AU? I mean, not everyone has the access that you have, or the team that you have. What are the 2 or 3, especially in financials? Because, I mean, it's a space littered with accidents. And you yourself said, I mean, the most important thing is return of capital. I mean, that is, that you can't go wrong there. So what would you tell viewers who are watching?
So now, actually, opportunity is not only among the lenders, but now the much bigger opportunity is opened up in the non-lenders. That is the capital market. Whether it is AMC, whether it is wealth management, they're just about to start it. So, fortunately, they are not lending type. Here you have, you need a platform where there is no capital adequacy so far. And with 10,000, with 1,000 crore capital, you can manage maybe 10 lakh crores or 20 lakh crores. So what is required is to create a competent team and competent distribution to manage assets, because the wealth generation in the country, I mean, just to give you some numbers, in last 20 years, the total savings is about $12-13 trillion in India. If you add up all 20 years. Next 20 years will be, hold your breath, it will be more like $50 trillion. Just the savings. Mark to market on top will be another. So we're talking about $100 trillion flowing in here. We don't need anybody's money now. I mean, there's enough money from the domestic savings coming into the capital market. Now that capital needs to be managed by wealth managers, asset managers, intermediaries, all sorts of things. Now, can we find one emerging platform, whether it is a wealth management, whether it is asset management, and hundreds of them will come. But can you find a Sanjay Agarwal in that vehicle and maybe seed, So
you don't have to look for a Sanjay Agarwal in a bank. You can look for
no bank. To I'm already invested.
Bank to hai.
Yeah.
So,
now he will set up insurance, AMC, wealth management. Everything he is going to do it.
Yeah.
And that will come free of cost to us. Yeah.
But Prashant, my own understanding, sir, is this that last 5-7 years, and the credit goes to all you people that you put so much money into the new, energy. But nowadays, people are really want to build a business which can actually create a value. So they are not looking, they're creating a value from balance sheet than a P&L, right? So you will find many entrepreneurs, but somehow you have to train them. Somehow you have to, make them understand that it is not a 1 year, 2 year, 5 year story. You want to really create a wealth, it has to be at least 20 years, have patience, have better governance, better transparency, honesty. And you have to dealing yourself with the company, What generally people make mistake that, they want to own everything, and then they just mess up, right? So, but I think there's a lot more opportunity, more people than what at our time, in my opinion. So, but you have to train them, right?
One thing I want to say,
yeah,
we have to find people who have done first round of success. The whole entrepreneurship or success story of any entrepreneur any in the world, it is success builds on success. It's a series of success. It's not one. Now, AU Bank has come this far and they have just got the actual universal license. So that is one of the reward for success. Now, how they use that universal license to go to the next stage. So it is a continuous build-up. So that's what I have seen in my 30 years of entrepreneurship, that success builds success. It's not that right from day one, you know what is going to be your future. Nobody knows.
Yeah. Ramdev sir, in Jaipur, when you invested in 2008, Prashant, we were the only NBFC.
Yeah.
Now, the North NBFC Adda is Jaipur. You'll have 200 NBFC. And the ripple effect is that every NBFC is paying tax.
Yeah.
I think the success is only not limited to you. This entire society, even government benefits from the whole success of any entrepreneur because it inspires so many people, right?
Yeah.
So I think the only point I want to ask Ramdev ji, and then I'm struggling with that, if India want to get a scale, which we are talking about, how we are educating people in terms of building businesses, and building the resilience, building the mindset, I found that Indian education system don't give us a business school, like where we really want to understand the entrepreneurship, building the business, understanding the business.
Programs like this.
Yeah. Program like this? Yeah.
No.
But do you think like American system of
No. Best. See, entrepreneurs are kind of the guys who want to work for themselves. That is what is the real trade. Like you and we both decided to work for ourselves.
Correct.
Whether we are going to become big or not, that is a different thing.
Correct.
So fundamentally, do you want to work for somebody or do you want to work for yourself?
Correct.
Once that determination is there, then that school is your own kind of a country, your own place where you want to do it. I think
I was thinking to propose you, let's start a business school.
I don't think
that's an idea.
Business school. In fact, business school, you go to business school, they are looking for, they will not attend your lecture if it is not going to give them credit. They want only placements, nothing else.
Okay.
So entrepreneurs are not born in business school. In fact, it is born more in Chartered Accounting Institute.
I think this is such a lovely conversation and we could go on, but I think this is, Ramdevji has a further appointment, so he's got a hard stop as well. Thanks both of you for being here. Sanjay, what a
pleasure to be with Ramdevji.
What a wonderful entrepreneurship journey. And I think you've given us targets bigger than HDFC Bank in the next 20-25 years. And why not, right? Absolutely.
I'm giving target to my team.
Yeah. And Ramdevji, thank you so much for being a guiding light to AU and of course, all of us in and thank you for being here. Really appreciate it. Thank you.
Thank you.
nice 30 minutes or so. If I were to ask you a question by March 31st, what do you think? The market's going to be higher from here? Yeah? India will win the T20 World Cup as well? What do you think? Lata is keen on that. So Lata is feeling optimistic today. India wins the World Cup and the Nifty is up 5 to 6% from here. What do you think, Lata? And the second one? Well, I think on that note, we could, Nimesh, get to our panelists.
So, first of all, thank you very much, Sandeep, Tahir, Nilesh. Thank you for joining us. It's been a tough year, so to speak, calendar year 25, I mean. And again, the start has not been that great for calendar year 26 as well. To start with, a broad, looking back at 25 and what to expect in 26. Sandeep, if you want to start.
So obviously, looking back, difficult 2025.
Yeah. Okay.
And I see fragile 2026, not only for India, for global. The challenge which I see in 2026 is not about India. The risk which we are referring is not related to India. Worry is about US market because extraordinary complacency is there. And I see that's one of the big risks of 2026, where developed market will correct and they can correct sharply. And I'm taking a big call. This year belongs to P contraction. Global P will contract. And this is the thesis which is based on some of the analytics which we do. And the biggest risk which I see coming is the rise of dollar index, because it's a consensus trade among all the strategists and the economists globally. The de-dollarization thesis is which did, obviously dollar has depreciated last year. I think long-term perspective, I also believe that we are in structural downtrend for dollar. But from a near-term and medium-term perspective, that's the risk which I see, which means a lot of things can correct sharply. And the trade which we are seeing, everybody has seen a very big move in the metals globally. I think that cycle is also peaking out. Now, when I say from a longer-term perspective, we are extremely bullish on commodity. We have been very early to talk about that money will move towards real economy from leverage economy. That's a thesis for few decades. That's a thesis which I have been saying right from 2018-19. This is from 2020, this period will start. But from a near-term perspective, we have seen extraordinary spike happening. And I think it's a euphoric move. I will not call it a bubble. I will not call it a maniac phase. It's a euphoric phase, which means the correction is around the corner. It's not happened yet, but this is a worry which we have.
Sandeep, you gave us a headline that 26 will be a year of PE contraction.
Yeah.
Tahir, if you want to give a headline to us, what is your broad outlook for 26? Mean reversion is something that you're looking at?
I think so. I mean, Nimesh, the 2025 has been a unique year in many ways. We've seen 125 basis points of interest rate decline. We've seen a lot of money come into the market, especially from domestic sources. Yet the markets have not performed actually. And quite a number of things have actually, worked in a very linear manner over the last 2-3 years, especially after COVID. And therefore, it's quite likely that in many ways we are set up for a mean reversion in many things. Yeah. I mean, everything from the point of view of, the dollar, as you mentioned, to let's say even our own earnings trajectory. I mean, it has been poor. Can we probably improve in the next year or so? Can we probably see our underperformance relative to many of the emerging markets? We've seen significant amount of underperformance in the last 1 year. Can that mean revert? Can we see mean reversion in the global markets, as he indicated, that the whole AI trade, which is dominated and led to almost a bubble kind of scenario developing. So in many ways, I think this is what we have to probably prepare ourselves for, and I think we'll have to be a lot more astute. Quite a number of the themes that we always swore by, we still swear by, and we've, as long-term investors, we've looked at those themes as things which can probably compound over a period of time. Did very well in the last 2-3 years, but have been at the receiving end of things in the last 6, 8, 9 months. And
I'll ask you about themes and how are you?
Yeah, so I think in many ways, mean reversion is therefore the order of the day.
Okay, all right, Nilesh, let me get you in then. That's interesting couple of calls that we've got. Peeking out of the mother market probably, and the dollar index that we were getting used to slipping. maybe it's bottoming out and mean reversion, as Tahir said as well. But Nilesh, how do you view it? 2025 was a very, very tricky year.
Yeah.
Going by the headlines, you should have had a rocking year. That wasn't to be. How's 2026? And what's the big theme or the big call that you're taking for 2026?
Yeah, I mean, looking an equities looking from 1 year lens may not be the most appropriate, but you're right. I mean, all of us know 2025 was tough. But if you look at the scorecard, Nifty had 10 consecutive years of positive returns, green. Even in COVID year, in the calendar year basis, it was positive, which has never happened in the history of any developed or emerging markets. So to see in the 25 returns in context of what happened in very strong market in 2023 and 24. And I think there were three headwinds which caused correction over the last 15, 18 months, and all three are receding, in fact, turning favorable. One is related to macro environment, both globally and domestic. Then related earnings momentum, which also slowed down. And of course, the valuation premium also. Valuations were high about 15, 18 months back. So on macros, all of us know there has been massive sort of turnaround or stimulus, both from the fiscal side and monetary engine has been firing. We have income tax cuts, more money in the hands of people. We have interest rates reduction by 125 basis point. Will full impact, we'll see it. And of course, from the monetary side, again, massive, apart from the reduction in interest rates, injection of liquidity, etc. So it will take a bit of time, but we'll see earnings moving. Again, retracing back. Last 2 years, earning growth has been in single digit, low single digit, in fact. We see it moving over the next couple of years to more like low teens, etc.
Oh.
So in that context, I think the view is positive, constructive. Of course, from a macro construct, the only thing which is sort of missing is what's happening on the trade part. But apart from that, we have very strong flows. We have reversion in the earnings momentum. So I think 1 year again is difficult to predict in equities, but next few years should be pretty solid. Only thing I would like to say is if you're looking for steady long-term returns, then this is a good sort of market. But however, if you're looking for quick and easy money, I think that era may not be sort of what we saw in 23 and 24 may rightfully pause here.
Okay, all right. Tahir, I want to come across to you on that. The problem is nominal GDP. That's still not in double digits, which is an issue with regard to earnings. Do you think by the end of this year, actually, we're getting to a bit of a deflationary scenario and, inflation's virtually zilch? Do you think by the end of this year, we gradually get towards that double-digit normal GDP growth, maybe early teens as well, and maybe inflation suddenly starts perking up a little bit? 12 months down the line, do you think inflation will at least be 3-4% or thereabouts?
I would love to have that actually, Nigel. In fact, again, that is reinforcing the whole mean reversion. We've seen very low inflation. Probably very low inflation also is not something which is very comfortable for India because, top line growths are determined by nominal GDP and that doesn't help beyond a particular point. I think the setup is for, if not in the early part of the year, but probably towards the end of next year or maybe same time, 2027, we might be talking about the negative base effects of inflation actually. And, keeping in mind things like oil prices and the setups which are happening globally on geopolitics, etc., commodity prices starting to inch up, it's quite a possibility that we get some inflation. And it will not necessarily be bad. I think that will be helpful, as you rightly said, that this will assist some part of it will solve the problem of top line growth. We've got, I think, some 20 quarters of single digit or low double digit top line growths. Even post-COVID, actually, if you go to see, we got some very robust earnings growth, but quite a lot of it was supported by margin expansion. Top line growth has actually struggled because aggregate demand has been somewhat weaker. We've had that K-shaped recovery and all that. And so therefore, it is not that everything has been kind of, contributing. So I think, can we get a little more top line? Can we get margins becoming a little more subdued, yet delivering some reasonably decent early double-digit earnings growth? I think that's a possibility, helped by some extra inflation, should really be something which we should look forward to.
Sandeep, to take your point forward on PE contraction, you believe that it's a top for NVIDIA. But looking at India as well, we've already seen the EMS companies, a lot of the consumer names which are trading at 6, 70, 80, 100 PE, they've started correcting now. First, your thoughts on those sectors in India? Would it be a complete avoid for you? And maybe then I can ask the same to the other panelists as well.
So Nimish, let's understand first, when we say P contraction, when we say why we are saying P contraction, okay? Because we are seeing the global risk appetite has peaked out, it started shrinking,
sure.
Okay? And with a lag effect, you will realize this is what happened in July 2024, and people didn't realize. You after 6-8 months, you realize the pain which you saw. I see something similar unfolding in the developed market and particularly in the US market. Okay. And I'm not talking about the broader US market because Russell 2000 has not done much. It's all about that magnificent 7. And obviously the very large portion of money was shifted there. And because of that, a new age bubble or boom, I will still not call it bubble. Okay. I still call it, this is a euphoric phase which we are seeing. Bubble characteristic is still not there. So it may take some more years before you reach that territory. With that background is a PE contraction. Now, obviously, if that is the case, then what is the byproduct of that? Which means growth will underperform and value will outperform. That's a one simple conclusion if you can draw.
Is the way you're approaching 26 now? You're shifting towards value stocks?
We are in that direction. And some of the new age company or the space which you highlighted, we don't have when we never participated in these names. And we think this is the beginning of PE contraction. This is not the start of the or it's a bottoming. A lot of people are trying to do bottom fishing. My call is not India. My call is global. If global PE will shrink for all new age company, then you will see a much bigger damage happening in India also because bubble is here because of low float and extraordinary valuation and limited supply. People have participated.
Sandeep, let me just drive that point home a little bit more. If you're given an option to buy, say, an EMS company at 50-60 PE, or maybe a consumer staples company, which has corrected from the top, but is trading at, say, 50-55 PE, which one would you go in for? Or you'll go for the PSU, which are trading at sub 10 PE?
So if I have to compare a like-to-like on PE basis, I will go for staple company because some of these companies are trading in neglected zone. They have corrected a lot, and given the GST benefit and the consumption focus on the government, I think this is the area where I will, if I have to buy expensive, then I'll buy staple over buying some of these names which 4-5% margins does not make any business sense.
Right. Ignored as well. Nilesh, your thoughts on the broader markets. Why I'm saying is because there are a lot of investors who, through your mutual funds, have invested into small and mid caps. The headline number last year doesn't show up the real picture. The mid cap index, small cap index have been flat to single digit gains. But the pain has been really very hard in the individual names, right? Stocks are down 30, 40, 50%. From a viewer perspective, is the correction done in the broader market names? And would you be encouraging a lot of investors to now look at, again, small and mid-cap funds?
Yeah, see, fundamentally, I would say that one is just a backdrop, the small and mid-cap, the character composition, the scale of opportunity, and the choice of business has changed dramatically over the last 5 years. And the reasons for that is threefold. You had more than 300 plus very large IPOs, $1 billion plus. Then you also have formalization of the economy, typically benefits the smaller businesses. And also flows of money. Flow of money was almost 50% towards this category. But the scale has changed so dramatically that there are many businesses which are large businesses. They are sector leaders. They don't get space in classification of large caps. Some of them don't get any mid caps. If just to put a number in context, the largest mid cap companies today north of 1 lakh crore. It was 1/4 5 years back, and it was 1/7 a decade back. And same goes with the cohorts of these. So what I would like to say is the opportunity size and the quality and the nature and the characteristics of the business has increased so much that there is enough and more to identify, even if 50-60% of that space is expensive. That's in a very generic basis, because the conceptually that valuation risk is only for small and mid caps. I would not buy that. Even if you look at large caps in this correction, almost 40% of large caps have corrected by more than 20% from the all-time highs. We have a retail company which has fallen by 50, almost half of it, and many power utilities 30-40%. Now coming to so in that context, I would say that it's important to have enough and more dose of small and mid caps, provided they are good quality businesses, they are sector leader, they have scale. And there is enough and more opportunities on that space. That said, this correction, of course, you are right, because it has taken some of the froth in that space, because 23 and 24, many businesses moved too fast, too soon on valuation. One has to avoid that. If I just put the context of the overall valuation, almost half of the market was at more than one standard deviation about 15 months back. Today it is 1/3. So we have much more choice. Let's say we cover about 700 odd companies. Even if 60-70% is expensive, there's enough and more to pick and choose. So I will be very positive on that space, but on a selective basis. And generally what we see is when you have macros turning in favor, we have lower interest rates, we have earnings recovery, then some of these businesses generally have a bit of tailwind. So post this correction, I'm long answer, but post this correction, I would say that we're not paint with the same brush that small and mid caps are very expensive. Selectively, it makes a lot of sense because you get right representation. As a fund manager, you want representation across businesses. So you pick and choose. And just to sort of conclude, like for example, mass consumption, discretionary space have been struggling for last 4 or 5 years. We have seen some pickup in autos, etc. And many of those sector leaders, be it footwear, be it building materials, they are either in mid caps or probably only in small caps. And you look at entire cohorts of capital market businesses, hospitals, they are in only in mid caps. So I would say that maybe 50-50 would be a right proportion.
Okay, all right. Tahir, one of the points that Nilesh mentioned were IPOs. Now, over the last few years, there are two factors with IPOs. Either they'll make you a lot of money once you get them in the IPO allotment, or they teach you a lesson that you'll never forget. The last year, actually, more number of the IPOs that came about, they didn't make you money. In fact, there were some of the biggest losers. What about that IPO frenzy? This is another year where we have big IPOs lined up, but there are a couple of interesting ones. NSCA, probably you have a Zepto, probably you have a Geo as well. What is your view on that with regard to the IPO market and the pipeline?
So, look, I think there'll have to be a certain amount of moderation, both from the issuer side as well as from the subscriber side, as far as IPOs are concerned. And by and large, IPOs also are going through that same cycle. Again, I'll talk about mean reversion even in IPOs and valuation in IPOs. That's quite possible. Beyond a particular point, I mean, if I were to talk from my own experience, our own experience at Invesco about how we have conducted or gone about doing IPOs, we've not participated in an all-in sundry. I think at last count, the calculation that I did was, the statistics that I have is that over the last 2 years, we participated in something like 35 IPOs out of 120 odd, which basically are at a cutoff of more than 500 crores of issue size. Okay, and out of which about 70% of them have made money for us. 26 odd out of that 35 have actually made money for us. And more importantly, I think that from an investing culture point of view, I think there are only 4 IPOs from which we have completely exited today.
Okay.
So 31 are the ones which we have actually still retained in some form or the other. So that is a view that we take on IPOs. I mean, IPOs are not about, for us at least from our standpoint, it's not about flipping. We essentially met the same treatment to IPOs the way we do to any other secondary market listed entity. And the same level of due diligence, research, etc. goes into it. So I think we have to be choosy, we have to be picky, we have to stick to business models which we understand, which we can probably buy from a 2-3 year perspective, if not more. And I think, but yes, I mean, from the point of view of the market, we will all have to be a little more reasonable in terms of what we want to, and everybody will look for more margin of safety for ourselves.
So, just for the benefit of the viewers and the audience who's sitting here, given by your philosophy, Sandeep, with your philosophy, Tahir, with your philosophy of mean reversion, 2 sectors, I'll ask all 3 of you all, 2 sectors which you guys are bullish on for 26, and 2 sectors which is a complete avoid for you, just for the benefit. I mean, if I know you can't talk stocks, but from a sector perspective, if you can show some, give some idea.
So from a quant mutual fund perspective, I will say power is a theme, it's a global theme. Okay. Last year it underperformed. So if I have to look at
the power index, by the way, was down 6% last year, and it's part of the mean reversion, which normally turns positive.
So that's the one theme which we think should play out very well. Second thing is about generic company, pharma company, which are not at all affected by the Trump tariff, whether it's 20, whether it's 500, doesn't matter. They are exempt space. That's the area where India has edge.
Okay.
And what IT did 20 years back, we think next 20 years, pharma can do that. So
what's a complete avoid
space.
for you? The These 2 sectors which are complete avoid.
See, if I have to say completely avoid, obviously I will take a clue from our call. If we are saying that NVIDIA is the best shot for 2026, though it has not peaked out, it may take some more time, but that is the best shot, then I will avoid new age companies because if I'm talking about P contraction, then all expensive, most admired territory and most valuable stocks should be completely avoidable.
Okay. All right. Just one more point, Sandeep. The call on metals is we are nearing the peaking out phase even there.
So if I have to say it's a structure bull run, yes. But if I have to say a medium-term perspective, I think top is around the corner, whether it's 15 days or months' time. Somewhere you will see, like First, gold can peak out. Copper is also in a similar situation, but they still have not happened. So
Okay.
we are in the climatic phase. So this phase, whether I should participate, answer is no. I will look for a selling opportunity or booking profit, not shorting.
Okay, the reason I asked you that because you're working with a stronger dollar. So, obviously then you have that correlation. Tahir, coming across to you, mean reversion is something that you've said from the start of this conversation itself. Couple of underperforming sectors last year were real estate as well as tech.
Yeah.
Do they find, a place in your portfolio for this year? Will you be reasonably more optimistic about them? And give us your top 2 sectors as well.
So again, continuing with the theme, my theme of the evening, mean reversion, I think the 2 or 3 things which stand out, basically tech, as you mentioned, is something that we're increasingly trying to build confidence around. And we know that it is not going to be really front-ended returns, but I think this is a good time where at least from a FCF yield perspective, we can probably feel reasonably comfortable that valuations are somewhere in our control at about 4.5-5%. It's not a bad point to enter. So tech is one, IT services that is. I think private banks is another one which is actually not done as much. BFSI as a headline index has done very well, 23-24% over the last 1 year. But when you probably drill it down a little further, and you'll find that private banks, actually the top 5 private banks have all done less than 20 or thereabouts. I mean, they've underperformed the BFSI index. Public sector banks, non-lending, Ramdevji mentioned that a little while earlier, they have really done exceedingly well on an aggregate basis. But I think it is probably now the turn of private sector banks. So probably that is, and especially if I were to probably keep in mind the fact that, we are by and large done with the interest rate cut cycle, more or less. I mean, we might have another 25 basis points or so to go, but much of it is actually done. And if we are probably looking at that changing over the next 12 months or so, then private banks probably have a better chance of improving margins and re-rating. Thirdly, I would say that there are some domestic cyclicals also probably make sense. Certain parts of auto, cement, etc. They're it's more about, see, it's, where I would probably differ a little bit is that with Sandeep is that it's, market is not gravitating from growth to deep value. It is becoming a lot more expecting of reasonable growth and reasonable price. So we are talking about market moving from growth at any price to GARP. I think in that is where, and especially if there is, once again, in the theme of mean reversion, I mean, if there are companies which have underperformed for the last 3-4 years or segments of the market which have underperformed, could be paints, could be chemicals, could be some parts of metals, even certain consumer durables. I mean, it cuts across a swath of different kinds of sectors. If they've underperformed, then they probably, what we are also additionally glued on to is where is the possibility of earnings upgrades.
Right.
That is what the market is actually queued on to all the while. So are the likes of the Dixons and the Trents of the world going to give you earnings upgrades this time around, or is it going to come from the likes of maybe, I'm just throwing names, it could be a Voltas, or could be a Reliance, or could be some of the other durable companies, or many such which have probably underperformed, and even the paint companies and so on and so forth. So I think that is what the market will get a lot more queued on to. Instead of playing very, very durable themes, try and play something which is probably a little more cyclical, mean reverting, but probably provides you margin of safety.
Got it. All right. So IT services as well as private banks. Nilesh?
Yeah, so at an aggregate level, I would say that post the correction, recent correction last 15-18 months, I think the dispersion in valuation is limited. So as a house, we are getting opportunities across most of the sectors. But as a house, we have been positive on the largest sector, which is the BFSI part, and also I mentioned on the consumer side, because you have confluence of factors where product prices have come down, courtesy GST, let's say autos, AC prices have come down. You have income level increasing, both on the rural side as well as on the urban side with the tax concession, and also the EMIs have come down because of the rate cuts. So I think mass consumer discretionary side from a longer term perspective, that sort of looks good. As I said, across that, we are getting enough opportunities, even in healthcare and many other sectors. The only sector I would call out, which is despite the correction, we are underweight or less representative, is this entire capital goods, or maybe some of those EMS name and all, because post the correction also, we don't find enough margin of safety.
Okay. Okay. Nilesh, I want to ask specifically to you. I mean, we can ask all the three, but first to you. Just an example, I'm taking as a real estate as an example, and I want your thoughts. For real estate sector, everything which could go right went right last year. Interest rate cuts were happening. Every company on the street was able to raise funds and raise money. And despite that, the index is down 16%. The stocks are down 30, 40, 50%. what went wrong for the sector, and how do you identify these kind of red flags? If you want to identify something similar red flag in any of the sectors for 26.
No, you're right. See, what happens is sometimes a good trend or everything is going well may not be a good stock. Sometimes most of the commonality, if you dissect only 1 year return, it's not only earnings, momentum is an earnings surprise, but it's also what is the starting point of valuation. 15, 18 months, but starting point of valuation of some of these sectors were not so cheap. So that's why they would have corrected on a 1 year basis.
After the correction, Tahir, you think there is some bit of value? Sorry, I can ask you as well. You think there is value now in real estate sector stocks?
Yeah, we would be positive because they would, as you rightly said, most of the sales numbers have been pretty decent, and they are beneficiary of low interest rate regime, right? So to that extent, they would benefit, but it's not a very homogeneous sector.
Sure.
So one has to be very stock specific, unlike many other businesses.
Tahir, you want to comment?
In continuation of that question about real estate, so again, that is one which can probably revert, and from the point of view that stocks have actually not done well, but it is not exactly reflective of the underlying trend in real estate. It's not as bad as what the stocks are making out to be. So it essentially presents an opportunity. And why I say this is that we started off by saying that valuations starting point maybe at the start of 2025 on the higher side. But I think developers at one level have pulled back by themselves. I mean, they've gone through their own experiences of the past, and I think they're behaving in a more rational way. So whenever they've seen a little bit of contraction of demand, they pull back in terms of new launches, etc. And I think that perhaps to some extent is also a function of market sentiments and so on. Cyclically, I think it can revert, and especially the longer term cycle, I think for real estate, we still remain reasonably positive about. So again, this is one sector which can, as 26 comes about, I think stocks will start aligning more with the underlying reality, which is reasonably fine, particularly as far as luxury, mid-end, premium, affordable housing, of course, has got its own set of challenges. But I think most places where larger developers are actually focused is still in the play.
Okay, and Sandeep, you want to weigh in on the real estate theme?
So I'll give you an interesting perspective from the behavior side.
Okay.
What I say is correct. They are in neglected space. They have corrected a lot. And frankly speaking, numbers are not bad, at least for the larger listed companies. We are not seeing any big deterioration. Okay. I always see on the real estate side, when your wealth contraction phase come, real estate P multiple deteriorates.
Okay.
So we have seen last 1 year, because large portion of houses, premium houses, expensive, people make from markets.
Absolutely.
In some form or other.
True.
Okay. So it's when you have a wealth contraction phase, your confidence level is low. You will not go and participate, The wealth effect is there, then everybody wants to buy a house, second house and third house, So it's more from a psychological perspective that impact is there.
Okay. Among all the volatility, the one big headline to me in the last 1 year was the FDI money in financial space. 5-6 large deals. RBL Bank now with an MNC. Shriram got a $4.4 billion of inflow. What have you reading this? A lot of FDI money coming to the financial space in India. And is there a sector to bet?
So I think this is a good opportunity, given since we are one of the largest shareholder of RBL, so we can say that and we track it closely. Given the USD INR situation and government and first time RBI allowing somebody to take over the controlling stake, here the challenge was 26%, we are offering 75% or 51%. So it means the mindset of the current regime has changed completely, which means there could be a great opportunity. And we have seen a couple of deals happening from the Japanese money coming to India, and there's a big queue. Okay. So this is the area, I think there's a great opportunity if you get something which is completely neglected and beaten down, and appropriate time, confidence capital can be infused. And for whatever reason, if they want to hand over the control also, I think is good news for this country.
Nilesh, you want to come in? I know you're bullish on BFSI, but the fact that so much of FDI money is coming in, how do you read that space, and what it could mean for the sector?
No, I would concur. I think these are specific cases and happen to come together, three cases in particular. And probably it's also has a blessing of the regulator, and probably one of the lens of is also to be more pro-growth. So to that extent, I think there's enough and more opportunity in that space for many of those franchises to grow.
Okay, all right, gentlemen, we thank you all for that. But there are a couple of questions from the audience. Just like to throw the floor open. If anyone has a question, please, if you could raise your hand and we'll come across to you. Okay, I think Lata has a question.
Okay, there is somebody. Hello.
Yes, sir. Please.
Yeah,
Panel
please.
Speakers, hello.
Welcome to you, ma'am.
I had this question. In the real estate sector, like the luxury real estate is a very niche segment, but it is growing the most. Like if you see, like in 2025 only there was this news that around 20 flats worth 27,000 crore launched by DLF got sold within a very short span of time. So do you think that this will continue in like the premium luxury, or it has moderated in the coming years? Luxury real estate.
Yeah, I can take that. So like as I said, yes, I mean, premium luxury is also growing very fast, and it is maybe somewhat of a niche, but generally mid to premium to semi-premium or whatever you call it, and then to luxury, I think it's becoming a larger and larger part of the overall thing, especially in terms of value. So the statistic is that in the last year or so, or 2 years maybe, the share of all premium, mid-premium housing, affordable housing rather on the other side has actually come down quite meaningfully, probably to about 25% of the total housing real estate market, from what was more like 50-odd%. So it is a fairly strong climb down. Is that going to go back to 50? It doesn't really look like. Today we are in a stage where we are, as a country, there is an upgrade cycle which is happening in real estate, and it is gradually progressing up the ladder. We have a significant proportion of our lower middle income households which are going to migrate to upper middle income households over the course of the next 5, 7, 10 odd years. And that essentially should probably sustain this upgrade cycle even further. It's happened in every country around the world, and we are probably one of the last large markets which are going to see that transition over the coming 5 or 10 odd years. So I think this is something which will probably sustain. It may have its swings, but this is where the trend is, and I think even the suppliers are actually trying to essentially drive the buyers in that direction. So that's how I would think about it.
There's another query that we have on the first row. Someone could just...
Yeah, can I ask?
Please.
1 minute. Let us ask the question first.
Sir, will money flow from equities to gold, silver?
Oh, this is something which everybody is asking now.
Well, I'll answer that.
Yes, please.
Okay. See, we don't have to look at it in a very short-term perspective. If you have to take a strategic call, like I always say, we have been saying for a while, last many quarters, precious metal is your tactical call in the global uncertainty phase. And this phase is not going to end so easily. Our view is till 2032, 33, this phase will last. So you should have 10 to 20% precious metal in your portfolio, despite I'm saying that from a very near-term perspective, both gold and silver can peak out. And you can see a very steep correction or sharp correction, 10, 15% correction. And we have to live with this. Maybe 2026, you will see more volatility in gold and silver prices than what we have seen. Last year was the easy phase. We are in bull run, but difficult phase of bull run. So it will be challenging. So I don't think one should look at money will shift on. Money is shifting globally to this asset classes. As I said, it's all about from leverage economy to real economy. This cycle will last for many decades. And that's the reason, if you go back and see how China has built the commodities thing last many years. So commodities in the real world are going to stay on a higher side. If you ask me, copper, let's say, is X level. Can it go by another 30% by year end, despite after a correction? Answer is yes. So we are in structured bull run. So you have to keep your planning in such a manner that it should not get disturbed. You should not participate now. Rather wait for maybe a quarter or so when it corrects. So buy on dip should be a strategy for you.
Okay, there's one more query. Yes, sir.
Yeah. So, as you answered the real estate as well as the current question of gold equity. So, so much data, so much information, rather information noise. So question to all of you actually, do you see AI is what now making, life easy for you, or is it the competitive advantage driver? So how you use AI internally? curious to see whether that's a competition to you actually going forward.
I'll answer it very simple. Any technology benefit, it increases our efficiency, improves productivity. Okay. So I don't think a lot of people look at other way, it will lose job and all those things. I think in some segment it will happen, but when I look as an individual or from an analytic perspective, our life has become easy. Okay, what we can process in 15 minutes, you should take sometime few days also. So obviously we are beneficiary, as in the previous session we are also talking about. We should understand how to optimize these opportunity which is there, and everybody should use it.
Okay, all right. I think we can take one final question from the gentleman back there. If we could get a mic out there. Yes, one final question.
Thank you for such an enlightening discussion. A quick question. We've seen that quality stocks like TCS, Asian Paints, Hindustan Unilever, over the last 3 to 4 years have been more or less sideways. So what are your thoughts that will quality finally be taking a turn in this new year and going forward, or do you still feel that these quality names at higher valuations will continue to face headwinds in the future?
Nilesh, you could take that.
Yeah, we cannot give a very generic answer. At a broader level, obviously, quality is always the last line of defense. In investing, you have to buy quality businesses as defined by growth, ROI, ROCE, and good management, and at a reasonable valuation. Some of the names you mentioned, I think for different reasons, each have underperformed. Most businesses we see are either impacted by disruption and or competition. In some cases, it's both that. So one of the paint names which you mentioned, there has been serious competition on that, apart from a bit of headwinds on the sectors. Staple business generally are again disrupted because of the supply chain, as well as they are low growth businesses. IT has its own sort of headwind. It was never a high growth sector. But those names, just because they have underperformed or outperformed, should not, as a construct, obviously, quality is very basic. It's very fundamental to investing. So obviously, no one would say that you would not buy. And how do you define quality? In our opinion, it is on the longevity of the growth and the quality of the growth, or the character of the growth as defined by ROCE. So I think in the longer term, wealth creation obviously happen if the business is able to intrinsically compound the value, and the starting point of valuation is reasonable. We're not overpaying for that. But sometimes quality, the perception and the names which you mentioned is also probably as the stock has not done well because the starting point of valuation may be very high. Some companies, some of the names were at 60, 80 multiple 3 years back. Then obviously it ought to underperform. I mean, I remember a case, one of the staple companies in 1999, there was a 10-year of underperformance because the starting point of valuation at that point in time was a 60 multiple. So I think it's much more nuanced rather than a very generic answer or framing anything under quality, value sort of thing. But that said, quality is very fundamental foundation of investing and creating wealth in equities, through equities.
Okay, all right. Thanks a lot, Nilesh, Tahir, as well as Sandeep, for joining us, giving us those insights. On a personal note, I'll hope that, it's a batsman that's come to the crease, batted out the initial few overs when the ball is moving around, and hopefully we're setting ourselves up for a bigger innings. That's the note I'd like to end on. Thanks a lot. And thanks, Nimesh, for co-hosting this.
Thank you, everyone. Thank you.
and welcome to Startup Street. I'm Ritu Singh, and here are the top headlines from the startup world. Biz Date Up, an India-focused strategic investment firm, has acquired 54.5% strategic stake in Kamma. The deal aims to unlock access to government-backed incubators, R&D labs, and innovation facilities, particularly across Tier 2 and 3 cities. Specialty chemical startup Atom Grade has raised $7 million in its pre-Series A funding round led by A99 VC. It plans to deploy the fresh capital to expand its export capabilities, set up on-ground teams and offices across key international markets. Cross-border supply chain enablement company Hexalog has raised $4 million in a seed funding round that was led by Enrichsen India Capital. The fresh funds will be deployed towards strengthening its technology capabilities with a focus on building scalable, reliable, and data-driven orchestration layer for cross-border logistics. Google, parent company Alphabet's market capitalization has crossed the $4 trillion mark. The company has now surpassed Apple and Microsoft to become the second most valuable company in the world. Alphabet is the fourth company to hit this milestone after Nvidia, Microsoft, and Apple. Apple chooses Google to power its artificial intelligence tool, signs a multi-year deal to integrate Google's Gemini across Siri and other features. Elon Musk criticizes the deal, calls it unreasonable concentration of power for Google. Well, those are the headlines we're tracking, but on to the big news that we've been covering for you today. The Labour Minister, Mansukh Mandavia, has nudged quick commerce companies to stop marketing and branding the 10-minute delivery promise. Now, this comes after recent protests by gig workers demanding higher pay and safer working conditions. Blinkit makes the first move and drops the 10-minute from its tagline. However, 10-minute delivery has not been stopped, and there is no government order suggesting the same. Timsy Japuria reports on all of the details.
Well, yes, as you rightly mentioned, what sources are indicating at this point of time is that Labour Minister Mansukh Mandavia held a series of meetings with quick commerce companies to stop marketing and branding of 10-minute delivery. Labour Minister held a series of meetings with quick commerce companies in the last 1 month, and Labour Minister in these meetings nudged the companies to discontinue the branding of 10-minute delivery to protect the rights of gig workers. Union Minister Mansukh Mandavia, sources claimed, has persuaded during these meetings the major delivery aggregators to remove the 10-minute delivery branding and marketing. Also, these meetings were held with leading platforms, is what sources indicated, which included Blinkit, Zepto, Zomato, Swiggy, to address concerns related to delivery timelines. Other aggregators, according to these sources, is that they are expected to follow suit in the coming days, and sources in the nutshell actually said that this move is aimed at ensuring greater safety, security, and improved working conditions for gig workers. Meanwhile, CNBC-TV18 has reached out to these quick commerce companies and is awaiting their responses. But yes, as of now, sources indicating that Labour Ministry has managed to nudge these companies to stop the 10-minute branding and marketing. They might be able to deliver in 10 minutes, that can still be the case. But when it comes to marketing and branding, that needs to be addressed with this nudge, is what Labour Ministry sources are saying.
All right, Timsy, we'll leave it at that. Thanks very much for joining in with that update. Now on to what's brewing today. D2C skincare brand Skin Inspired has raised 24 crore rupees in its Series A funding round that was led by Spring Marketing Capital. It plans to use this money to power its R&D function, boost marketing exports, as well as hiring. Now, prior to this round, it had raised about $1.5 million in its seed round from Unilever Ventures and others. Founded in 2022, Skin Inspired offers dermatologist-recommended products for various skin concerns like aging, acne, and pigmentation. For more on what this funding will mean for the company's growth trajectory ahead, joining me now is Piyush Jain, the founder and CEO of Skin Inspired. Piyush, welcome to Startup Street, and thanks for your time here. Briefly tell us about the Series A round for 24 crores. What is the capital for, and how much of a runway does it give you now? Piyush, I think your audio is on mute.
Well,
Well, if you can hear me now, Piyush, the question we were trying to ask you is the deployment of that 24 crores and, how much of a runway that gives you.
Right. So the fund would primarily be used in research and development. We are setting up our own laboratory as well as later plan to bring in our own plant. Bulk of that fund would also go into building team and resources and capabilities for the future. In terms of runway, it would easily help us have at least a couple of years of runway.
Got that. So a couple of years of runway thanks to this 24 crores. The funding is actually, it doubles on your previous seed round by Unilever Ventures, which was mid-2024. To give us a sense is how has your revenue and customer base scaled since that seed round? Can you share some current growth metrics on that as well?
Sure. So the revenue growth has been really promising. We have more than tripled our business since the previous round last year. And in terms of repeat rates, we are again clocking very strong numbers. Along with Unilever, we have industry stalwarts like Spring Marketing Capital and Lotus also joining in this round. So very excited to have all of them on the cap table.
Well, that's the cap table you're talking about, but also tell us about competition. I mean, brands like you compete with legacy incumbents and fast-growing D2C peers. I mean, there's competition on both sides. How do your clinical efficacy claims and, this dermatologist partnerships that you talk about actually translate into measurable market share?
Fair. So honestly, not really worried about competition. Only focus is on bringing value to the consumers. The way we look at it is whether our products are efficacious enough for the consumer love. I am pleased to share that almost most of our products have 4.5 to 4.7 rating on key marketplaces, which actually tell us about the consumer love that we've been getting. And the focus will continue to bring on efficacy-based solutions, which are safe for the consumer as well as deliver on their expectations.
So then give us metrics. I mean, what are your repeat purchase rates like? What is long-term customer loyalty compared to, say, conventional beauty brands? Any stats you could throw light on?
Sure. So if I talk about numbers, our repeat rates are upwards of 45%, which are actually very strong in terms of industry benchmarks. Even on Amazon Pi dashboard, our customer lifetime value shows a value which is closer to 2.5x versus the category average. So that is the kind of numbers that we have. We also have a lot of dermatologists prescribing us in key cities like Delhi, Mumbai, which tells a lot about the kind of efficacy and the kind of conviction that industry experts have about this brand.
It's not really converting into your bottom line growth, because if you talk about your financials for FY24, you had sales of 1.5 crores, but you also had a net loss of 1.9 crores. And that was also a substantial increase from the 26.2 lakh loss you recorded in FY23. What did you end FY25 with? And, what does the path to profitability look like now?
So the things are much better right now. And of course, it takes some time to, initially overcome the kind of capital needed to build a brand. But I think we are right there because in terms of our current financials, we have already turned CM2 performance positive, and we are very much on track for break-even in next 6 to 12 months. So things are looking up pretty much for this year.
Okay, break even in the next 6 to 12 months, and thereafter you're expecting a more sustainable profit growth.
Yes, that's right. And even right now, the burn has been limited a lot. And the growth also started increase significantly on key pockets of, core business. Our key focus areas were retinol-based night cream and sunscreen spray, which are our hero SKUs, and they are doing really well. If we look at SKU level profitability, they are amongst cash cows now for the brand, and now we are investing into new launch, and hence the burn is only on those products which are now coming new to the market.
And what are these new launches you're working on?
Sure. So we have launched Acnil, which is basically a spot corrector for acne. And in the coming month, we would be launching a serum for nail. We are also launching an under eye serum, which is India's first dual chamber under eye serum, which is meant both for anti-aging benefits as well as pigmentary benefits. And very excited to looking forward to that launch.
All right. Finally, you have this backing. You were talking about your cap table earlier. Unilever Ventures and, Lotus Herbals, their venture innovation fund. Do you see some sort of strategic partnerships beyond the investment that they've made in the company as well?
Well, too early to say. And honestly, currently, the way we look at it is purely as financial investors. But of course, one cannot deny the fact that these have been proven very strategic for other brands also. But it would be very early on for me to comment anything about their position.
All right, Piyush, we'll watch out for that one. Thanks very much for your time here today, and we wish you the best with your journey ahead.
Thank you for having me. Thank you so much.
Moving on-demand renting platform Flent, they've raised 21 crore rupees in a pre-Series A round, which includes about 17 crore in equity and 4 crores in debt. Now, this raise was led by Incubate Fund Asia with participation from WH Ventures, Twin and Bull Family Office, Stride Ventures, and others. Now, Flent, it provides fully furnished turnkey homes with zero brokerage, minimal deposit, and flexible terms. And this full-stack approach offers renters a move-in-ready home and provides homeowners with a guaranteed premium, entirely hands-off property management as well. The company now is going to use this capital to scale its team, expand its footprint beyond Bengaluru as well. So on that note, let me invite the co-founder and CEO of the company, Shail Daswani, who's joining in now. Shail, thanks very much for your time here. Briefly give us an overview of the business and how rapidly you've managed to scale since your launch, I believe, only in October 23.
Thank you so much for having me on the show. So at Flent, what we're trying to do is we're trying to kind of build the future of modern renting. And what that means is kind of just riding on top of the kind of expectations that modern India has when it comes to renting. Because if you look at how people are moving into newer and newer cities, they don't want to buy houses right away. So renting has become a very important part of their lifestyle. And we at Flent see this becoming a category that can be as big as a food delivery or ride hailing, because audience today expects instant gratification, and they're getting instant gratification in almost everything except this renting problem. So what we've done from day one, and I think it's been like about 18 months since we've started, is to completely revamp the way you would go about renting a house, right? So instead of just going to a broker, looking at 10 places, finalizing one of them, and then kind of getting all that furniture, setting up Wi-Fi, we've eliminated all of that and made renting as simple as buying things from Amazon. So you just go into our website, select a room or a house that you like, and you move in right the next day. And we've seen a lot of interesting feedback and a lot of positive feedback on how on-demand renting can actually be the future of how young India and modern Indian people would rent. Over the last 18 odd months, we've scaled to about 150 odd apartments here in Bangalore, all grade A developers, all grade A buildings. And we've managed to get about 300 to 350 odd people who've already rented with Flent. So yeah, I think the supply side of the market is equally compelling in the sense that if you look at modern landlords, right? So people who are buying modern residential inventory are, sitting maybe somewhere abroad, they're NRIs. So landlords today also want a lot of convenience when it comes to renting out their place. And what we've done for them is we kind of become this property management company that comes in, we take up your house, we give you a guaranteed rental, we verify tenants on your behalf, we furnish the apartment on your behalf, and then everything for you is on autopilot as a landlord.
Sure.
So we get a lot of interest from there as well.
Shail, we understand your business model. We got that. But what's interesting from your data I see is that the average tenancy that you get is only about 14 months. I mean, why is that? I mean, I've rented for the better part of my life. That seems like a very short period to keep shifting houses. I mean, any particular trends there, and your target customer would only be the young working population?
So of course, we've started with the young working population that's moving into the top 5 cities of India. But the reason why that stay duration is 14 months today is because, young people, they keep traveling, right? So I'll probably be in Mumbai for 12 months and then I'll want to move to a new rental home in a Gurgaon. And I think the only thing that's limiting our average stay growth, average stay duration right now is the fact that we're only present in Bangalore, which also becomes, which is why the money that we've raised is also going to go into, new city expansion like Gurgaon and Hyderabad and Mumbai, because we see this as a network product. As to once you start flenting, you never go back to renting. So we see the average stay duration to be upwards of 3, 4, 5 years when the product expands into newer and newer cities. And as we scale as a company, I think we'll also start tapping into married people and like the different segments of the audience to then kind of see where that average stay duration goes from.
Okay, interesting. So married people are not on your radar at the moment, but very briefly, we're running out of time. This is quite interesting, Shell. Now that you've raised this money, the plan is to expand beyond Bengaluru into Mumbai and Gurgaon. Where else will you be deploying it?
So we are creating a new product in the new category, which is why we have to put in a lot of effort when it comes to building the supply chain for a product like this. Because we furnish and design homes ourselves, a lot of this capital would also go into figuring out newer and newer supply chain ways to ensure that we're able to set up 500 homes in the next 1 odd year. So I think the second usage of capital is predominantly going to be on the supply chain side of it.
Got that. And, given that you set up the entire house and you manage the property end to end, what is the per unit cost that you incur and what is the profit you're making on top of that?
So for a typical apartment that we set up, we invest anywhere between 3 to 4 lakh rupees setting up an apartment. This could be a 2 or a 3 BHK. And we easily end up making about 4 lakh rupees a year in profits from that particular apartment. From a capex perspective, all the money that we deploy into the apartment comes back in about 10 to 11 months, and post that, whatever we make is pure cash flow for the business.
Interesting. So, finally, what does that translate into in terms of ARR, your current rate, and how you project both your top line and bottom line to grow with the kind of expansion you have planned? I mean, 350 rooms, across 140 homes at the moment. How will that expand and how will that translate into the growth in financials for you?
Sure. So as I said, we're currently at about 150 homes in Bangalore, and we do a monthly rent collection of about 1 crore a month right now. Over the next 12 months, we see this number going from 1 crore a month to about 5 crores as we expand beyond Bangalore. And of course, we'll go deeper into Bangalore as this company also scales. From a bottom line perspective, when we get to about 5 crores a month, we'll end up with a bottom line of about 50 to 70 lakh rupees a year, which puts us in a great position to then go out there and raise a larger round after this pre-series A.
Shell, quickly, if I may add a question, you pegged the size of the entire market at 40,000 crores, but what is the share you think you can capture and who are your competitors in this space at the moment?
So the 40,000 crore number is the revenue potential of the company and not the market size, because if you do a simple math of let's say just the urban renting market, that in itself is about $10 billion today. And we feel we can capture about 20-30% of the market at its scale. When it comes to competition, see, honestly, no one's building for the more affluent categories of the audience. So currently, I think we're the only player that's operating in this space, but we definitely see competition popping up in Gurgaon, in Hyderabad, as our model becomes more and more popular.
All right, Shell, very interesting thoughts there. We hope to have you back with more updates as you hit your next milestone. Thank you very much for your time here on Startup Street today.
Thank you. Thank you so much.
All right, we have to slip into a short break, but up next, global tech giant Lenovo outlines its vision for the next phase of artificial intelligence at CES 2026. That conversation in just a bit. Welcome back. You're watching Startup Street. Now at CES 2026, Lenovo outlined its vision for the next phase of artificial intelligence, hybrid AI. From AI PCs and smartphones to enterprise infrastructure, the company is showing how AI can operate seamlessly across devices, data centers, and the cloud. Their message is clear. AI is moving from demos to real-world deployment at scale. Aishwarya Anand brings us this special report from Las Vegas.
We are at CES 2026 in Las Vegas, where global tech giants are setting the tone for what AI looks like next. At Lenovo's Tech World event at the Sphere, the focus is on hybrid AI, AI that works across devices, the cloud, and enterprise systems, rather than in isolation. From personal AI agents to next-gen AI PCs and enterprise servers, Lenovo is signaling a shift from AI demos to AI designed for real-world scale. One of Lenovo's biggest announcements here is Kira, a personal AI super agent developed jointly with Motorola. Kira is designed to work across PCs, smartphones, tablets, and wearables, creating what Lenovo describes as one AI across multiple devices.
We will be bringing the Kira personal AI solution to India. So as soon as we get the necessary local approvals, it will be available for all our customers. So that should happen in a few months. And that cuts across Moto phones and PCs as well. So it's going to be pretty exciting.
That hybrid AI vision is showing up across Lenovo's hardware lineup. The company unveiled an expanded range of AI PCs, including new Aura Edition laptops and desktops developed with Intel. Lenovo also showcased a range of concept devices, from rollable laptops and gaming displays to AI glasses and personal AI hubs. How strategic is India now in Lenovo's manufacturing and supply chain, especially as companies are rethinking resilience?
So India is a very critical part of the global supply chain network. Of course, we use the India capacity to meet the local demand, and we are making sure that it's part of the overall global supply chain network. Now, growth is in excess of 20%, which is very significant, one of the fastest growing markets in the world.
As Lenovo's mobile arm, Motorola is positioning itself as a testing ground for how AI can become more ambient, more personal, and more integrated into everyday life. Motorola has unveiled its AI-powered Perceptive Companion concept device, which is designed to be a neck piece rather than smart glasses, but it is comparable to Meta's AI glasses in terms of features. Now, this comes on board with onboard camera, it has microphone, and it has a touch interface. A lot of Motorola's AI variables at CES that has been showcased are still proof of concept right now. So what will determine whether these moves will actually be showcased to the real world? It will move to the real world.
Our plan is to bring some of these to market. I can't say exactly which ones and when, but we're still trying to figure out which are the ones that are best for our consumers and which are the ones that are going to work best with our other devices.
Lenovo and Motorola are taking AI to the world's biggest sporting stage with FIFA World Cup 26 inspired smartphones that blend premium power, AI features, and fan-focused design. Is this just a branding play, or will there be AI features in these phones that are designed specifically around live sports consumption?
Yeah, so we're working very closely with FIFA right now to make sure that we're not only delivering a very interesting material and finish of the device, but an experience on the device as well. So we will have some very specific AI capabilities. Again, we're working through them now, and so we can't unveil them yet. But we want to make sure it's a very exclusive, it's a very immersive experience for whomever is actually using that device.
Beyond consumer devices, Lenovo is also making a strong enterprise play. The company announced a new lineup of AI interfacing servers designed to bring AI closer to where data is generated, whether in data centers, factories, retail environments, or at the edge. Lenovo says this is key to scaling AI responsibly across industries.
What was one of the biggest shifts that enterprises in 2026 will feel because of hybrid AI that wasn't even thought of a year ago?
Well, we all know that for organizations, data is the fuel for AI. So in order to really unlock AI potential and those business outcomes that organizations want, the ROI that they need from AI, they need to have data in the right place. And so that is the promise of hybrid AI, to bring together the best of public AI, enterprise AI, and personal AI so that that intelligence can occur in whatever form factor is needed. And Lenovo has the broadest portfolio in the industry to be able to do that. Whether it is AI gigafactories for the cloud, whether it is enterprise AI factories on the edge or in your customer data center, or even on the device, AI PCs, other form factors like the AI brain for the robotics. Those are the types of solutions that we can bring for customers so that they can access their data and their intelligence wherever it resides.
What Lenovo is pitching here isn't just smarter devices, but AI that operates seamlessly across personal and enterprise ecosystems. From consumer hardware to large-scale AI infrastructure, CES 2026 is showing how quickly AI is moving from concept to deployment. We'll keep tracking how these ideas play out beyond the show floor. For now, this is Aishwarya Anand in Las Vegas for CNBC-TV18.
Okay, and on that note, we wrap up this edition of Startup Straight. Thanks for tuning in, but stay with us. More news and updates will continue on the other side of this break.
No.
Typically, a 60-year-old going into retirement was thinking about how do I give back to my children or leave more for my children. It was never about how do I take care of myself.
Having done this for 15 years, I'm now starting to see this demography wanting to spend. The pie has increased. I think the wealth that India has seen and the wealth that the current 60-year-olds hold, they're not having to make that trade-off.
As we look at this longevity debate, Taran, I want to understand how you're viewing it.
I think it's almost too short-sighted to think that you can, twist and play with the fundamentals of how life is going to work. We want to make the years that you are alive physically as joyful, as healthy, and as happy as possible. Forget even for a minute the 350 million people over 60. You take 1% of that. Who is going to care for them? My nickname growing up was Granny. So I think I always...
Why were you called Granny?
I was always older than my actual age. I think I behaved older. I thought like an older person. And then I got into the senior care business. So I clearly proved everybody right that I am inherently a lot, I think, older.
Old soul.
An old soul.
India is aging faster than it is prepared for. According to reports, 11% of India's population today is 60 plus, and by 2050, this number is projected to be double to almost 21%, which means that 1 in 5 Indians will be a senior citizen. Longer life expectancy, smaller families, dual income households mean more seniors are living alone. Hello and welcome to Young Turks Reloaded. I'm Shireen Bhan. Joining me on the program today is somebody who has been on Young Turks and is trying to address the problem of what we do for senior care. We put the spotlight today on Antara Senior Care Company that's reimagining senior care, not as a charity or custodial living, but as a structured, scalable business opportunity built around dignity, wellness, and continuity of care. Tara, it's wonderful to have you back on Young Turks, and thanks very much for joining us here on Reloaded.
Thank you. So happy to be back.
So 15 years now, Tara, of doing this, but I want to understand from you, as you look back, this was a space that had a whole bunch of societal sort of stigma attached to it. Nobody wanted to even talk about the possibility of setting up senior care homes, because the idea of sending your loved ones to a senior care home, courtesy Bollywood and all of that, was just traumatic. But has that changed, and how much has that changed in the last 15 years?
It's absolutely changed. I remember walking into a room for the first 2 or 3 years of starting Antara and always having to push the conversation and having exactly that reaction, saying, oh, you're making an old age home. I don't want to live in an old age home, or I don't want to send my parents there. And I feel when we started Antara, we were very clear that this is going to be more than just senior living or retirement living. We wanted to be a brand that people thought of as they got older or had loved ones who were getting older. And so when COVID hit, and at that time we had the one Antara Dehradun residential community, and we had launched our second vertical care homes. I think that changed the game and the narrative for us. People started believing in wellness a lot more. They understood that as they get older, they need an ecosystem to support them. And so when I walk into a room now, especially actually the last, I would say 2 years, investors, organizations, corporates, and even people looking at starting new businesses have been talking about this space as a whole. So it's very exciting.
So it took the pandemic for people to understand the use case for a business like yours?
I think it did. And also by then, I suspect that because we had done things the way we had done things, and people had something to engage with as a concept or a product or a service, it changed their mindset as to what the concept could actually be. And it took that much time for us to prove ourselves. And then for other players also to start seeing, hey, this could possibly be a benchmark for the narrative to change.
But let's talk about the business case of this now. And, Max Holding is the listed entity. Antara is a part of that. As you look at your expansion plans, as you look at building this out pan-India, if that is in fact the aspiration, what do you think it's going to take for you to be able to do that?
So Antara is 3 different business verticals, and I want to create that distinction because each one will have different opportunities and challenges. So the first with what we started was what we call senior living, retirement communities. Dehradun was the first. We then launched a project in Noida, which is fully sold out. And then we did a partnership with Max Estates for Gurgaon. And so in that ecosystem, now I feel what it's going to take is just us being aggressive and finding opportunities to grow. And the pathway to that is 1.5 million square feet a year of commitment, which will over the next 8 to 10 years give us 8 to 10 communities. I think there's a huge opportunity there. And so really it's just about us being aggressive and saying who can we partner with, because we as Antara will not go buy land and do all of that. We want to partner with people who have the land, who have the expertise of construction, but we will bring the expertise of design, sales, and of course, eventual operations. The second vertical is what we call care homes. That's sort of the sort of colloquial way to explain it is assisted living, short-term and long-term. There, I think there are going to be 3 things that are going to push us. We have 500 beds as of the next 2 weeks, live in Bangalore, Chennai, NCR. A is going to be finding infrastructure that allows us to retrofit and move quickly. And that has been a challenge, and I think will continue to be, because we know compliant infrastructure in India is a challenge. 2 is insurance, which has also started to get unlocked. For insurance players to potentially think of assisted living as a focus product, or even combine it with a healthcare product, is going to be the big unlock there. And 3 is actually going to be just awareness, which again, we're starting to see shift because it is category building as well. AGZ, which is our newest baby on the block, D2C platform for products to really help people with conditions that are chronic and age-related. I think that's been the most quick to market and the most exciting. And I think the challenge there is just to keep our metrics of ROAS, of margins, and hold those very, very tight so that we can play the long game there.
So let's unpack each one of these. And let's start with the first, which are these residential communities, courtesy Antara Living, that you're creating. Now, typically, who are the people who can afford to be at an Antara living facility? I mean, how much does it cost? And when you talk about building out an ecosystem of partners, because you don't want to buy the land, you don't want to get into actual construction, you essentially are managing the property for somebody, who would typically be interested in partnering with you? What have you seen so far?
Yeah. So I think who is buying is, we actually have two variations of the product. When we launched Antara Dehradun, it was almost product first. We had a dream. I had a dream, a vision, and that was what it cost. And we tried to find the market that would buy it. After that, I said, look, I think to make this a scalable business, I have to think customer first. I have to think, what are they willing to pay and what are they willing to pay for? And that's how Noida came about. So two very different price points. The thing that stays sacred amongst all of our communities will be our deep mission to impact quality of life. So our services don't change, but I would say the per square foot cost between Dehradun and Noida and then
is very different.
It's different. So example, today, Antara Dehradun is reselling at 26,000 rupees a square foot. We launched also back then at 100% more expensive than the next real estate comparison. Our monthly charges are 3 times of that. And so that was the big push back there, and it took us therefore longer to sell. But today, I mean, when I think about the resale value, I'm shocked myself. Noida launched in 2021 at about 9,500 rupees. It's now reselling at 15 to 16,000 rupees. So there's still a 10,000 rupee per square foot price difference there. And we just launched Gurgaon Estate 360 and 361 at 21,000 rupees. So who is buying are therefore people who can afford a ticket size of 2 to 7-8 crores, depending on the size of the apartment they want, and who are willing to pay a monthly charge more than a regular condo, because we pack in a lot more services. And that can vary from about 30 to 80,000 rupees a month, again, depending on the size of the apartment. So that's who is buying. And in terms of the partnerships that we want to create, when we finished Dehradun and looked for partners, it was a big struggle, because why would anybody partner with a concept that was so nascent? They could command velocity as well as per square foot rates of traditional real estate. But as the market has changed and people believe in what we do, they realize that we can command a premium. So we actually sell 15% more per square foot in terms of a sales price than anything that's next to us. So now those are the partners who say, we want to diversify our portfolio. We believe in the senior care spaces being high demand. And we want to work with an organization like Max and Antara that has high governance and high standards. So far that partnership has been with Max Estates. Yeah. Haven't had to go too far, and they will continue to be our partners in NCR. And we are therefore looking for partners in the top 5 markets that we believe, which are, Chandigarh, Bangalore, Chennai, Hyderabad, and perhaps even Goa.
2 to 7 crores is the elite market. I mean, it's what you could call premium or what you could call luxury. Is there space then to do anything for the mass market to make this product more affordable?
100%. I actually believe if we are 350 million people over 60 by 2050, there is a market at every price point. The reason we haven't entered that market yet is because we know this market better and we want to play to the strength right now. So in our scale up the next 3 to 5 years, we want to continue to play in this price point. So what have been some of the big learnings, of the last 15 years in terms of customer behavior, in terms of customer expectation, also in terms of customer fulfillment? Because, so far the Indian marketing community or the Indian sort of
entrepreneurial community has been servicing the demographic dividend, because that is what we have been accustomed to believe, that India is a young market, India is the youngest democracy, and so on and so forth. For the silvers to open up as a market has been a fairly recent phenomena. What have been some of the learnings on account of it?
So having done this for 15 years, I'm now starting to see this demography wanting to spend. In the early years, it was still it was a previous generation of 60-year-olds. And so when we were selling, there was always a hesitation to spend on yourself. And spend on yourself with wellness. That was something that just didn't exist. So what was our fundamental offering in Antara Dehradun, as an example, was, a beautiful place to live. What we believe was also beautiful infrastructure, and a promise that as you get older, the services would kick in to keep adapting to those needs. And so 10 years hence, the population is 10 years older. So those who moved in at 62, 63 are now in their early 70s. And we have a fair amount of people over there living that are over 80. So I think the expectation now is that we want the wellness and what we call life care elements to kick in. And that was always the vision and the promise. We were never going to be an offering that said beautiful place to live, great food, learn a language, socialize with each other, do yoga, go for a walk. That's hygiene now. Now it's all about the wellness in terms of care, not just wellness in the way we know it today, but care. And so I think what sets us apart is that we will always be the player that looks at the longevity and long-term care of our communities. So whether it's the quality of the food that we serve, or the nursing, or the doctor care, or the way we do preventive care, or the physical aspects of it, for us, the expectation has now become care, and we're ready to fulfill that completely. And people are willing to spend on it as well.
It's interesting that you said that typically a 60-year-old going into retirement was thinking about, how do I give back to my children or leave more for my children? It was never about how do I take care of myself and my needs, or invest in myself and my needs. It was almost as if, as you get to 60 and as you get to retirement, your life is over. And now you're seeing that change. What has been the big surprise element there for you?
Two things. One has been, I think the pie has increased. I think the wealth that India has seen and the wealth that the current 60-year-olds hold, they're not having to make that trade-off. So they are being able to say, we are going to fulfill our obligations to our children. We're well healed enough to be able to take care of them as well as take care of us. And early on we would see actually next of kin come in the way of taking this decision, because they were worried about what would be left for them.
You're taking away from my share.
But that has also changed, because I think when the next generation is also done well and created financial autonomy and independence for themselves in the India ecosystem, which is, furthered everybody's economic prosperity, that level of insecurity doesn't seem to exist that much anymore.
Or is it less so? I mean, less insecure, I would say.
Less insecure. Also, Shireen, the truth is we are also in a position where we're talking to a certain type of consumer and customer.
That's what I said. I mean, you're talking to a very discerning, very elite, audience. They don't have to worry about writing out the next check.
Exactly.
That's not what they're concerned.
Exactly. So therefore, we get to see the benefit of that shift. I would assume that in other sort of economic, demography, it would be a different type of conversation. And like I said, maybe I'll unlock that later. But we are seeing just a more, I think there's a generosity to oneself that is starting to happen, and it's wonderful. And why not?
No, absolutely. I couldn't agree with you. Why not? Yeah, absolutely. But as we look at this longevity debate, Taran, I want to understand how you're viewing it. I mean, you've got all of these Silicon Valley entrepreneurs, and now entrepreneurs sitting in Gurgaon and Bangalore also trying to hack longevity. The notion is almost trying to beat getting older, right? It's almost age-defying hacks that people are trying to invent. But you're approaching it differently, and you're approaching it from, okay, we are going to get old, and so what can we do to be able to cope with that life stage better? How do you see the change that we're seeing happening, and the way that entrepreneurs are looking at the issue of longevity?
Yeah, I haven't jumped on that bandwagon. I know enough about it. I read about it. I stay aware, but it's not my DNA. It's not my way of thinking, because I think we trying to beat the spiritual element of life and the reality and of impermanence. I think it's almost too short-sighted to think that you can, twist and play with the fundamentals of how life is going to work. So for us, we want to make the years that you are alive physically as joyful, as healthy, and as happy as possible in the way we can contribute to it. We are not trying to prolong or extend life at this point in time. That's where all the longevity people come into it. And I think all of those who engage with Antara also have that similar belief that they want to live well. They're not necessarily trying to fight to live long.
Business is not new to you. You come from a family that has been in business for generations. But the decision to go down this road specifically, again, I mean, you were 15 years ago, you were 23. 23.
Yeah.
Why were you concerned about addressing this problem?
I think it was a few things, and just the confluence of it got me to where I am. I moved back to India. I was figuring out what to do. I think I've always been someone who's liked accountability and responsibility. And I was a fly on the wall in the Max Group at that time. We were sort of doing multiple things. That journey made me sort of re-realize that I can't be a fly on the wall. So that was number one. I said, I have to create something. Two was, when the first conversation happened around senior care with this incredibly enterprising lady in Hong Kong, I said, wait a minute, if China and parts of Asia are thinking about this, why is India not thinking about it? And so when these two things happened, and I said, wait, we have the experience and the background as a group in healthcare. We have a passion for hospitality. We like creating spaces. Why can't all of those skills not come together to serve a population that has not been served? And third was the confidence in the economic opportunity at that time. Of course, this has taken much longer
than you expected.
I don't know if I had any expectations, because I just didn't know what it was going to be. Now I have expectations. I think now the drive to prove oneself to be a strong financial and economic organization has started to kick in. So now the impatience is starting to come in to say, can the next 5 years also be about just the metrics around, good financial health? But the confidence has always been there. So when these three things came together, and the more I spent time exploring it, the more passionate I felt about the idea, saying hundreds more people need to think about this.
Yeah, and why isn't anybody thinking about it?
And that was because of the reasons you mentioned. There was social stigma. People couldn't figure out how to actually make money around senior care. And that's still a dilemma and challenge in some of the value pools we play in, but less so than before. And I think that confidence is starting to really kick in now.
You said that you're getting impatient now, but are you seeing the kind of acceleration that you were hoping for? Okay, the use case has now been clearly established, but are you seeing an acceleration of adoption?
So I'm seeing acceleration of adoption in the senior living space, which is our residential communities. Like I said, I've been very surprised by the acceleration in the age easy space, the D2C products business. There's still time for the care homes model. So I'm trying to be patient there, but I can see it. I can see that if you just take into account the number of seniors who live alone that need care and wouldn't have potentially made a purchase decision in their 60s or late 50s to buy into a senior living community, where are they going to get the care? Forget even for a minute the 350 million people over 60. You take 1% of that. Who is going to care for them? Which is why the care homes model, I feel, is so pertinent. Again, we're ahead of time in that. So I see that will take maybe a couple more years to fully mature and accelerate.
So on the care home side, the biggest problem is infrastructure, obviously. So what's been the hurdle there?
So we wanted to create an asset light business after having, originally bought the land, built the building, and then like I mentioned, partner now for land, but still responsible for building the building and running it. We said, how can we still continue to be relevant in the aging population without all of the asset density? And so we said we will go and we will find, 10,000 to 12,000 square foot existing infrastructure that we can retrofit, get completely compliant, and operate care homes. The problem is there are no standards for this category. We've had to work with policymakers to create the standards, to say, what should the spaces look like? What are the fire norms? What are the exit entry norms? Just every part of the governance around it. So buildings like that don't exist. So the cost of retrofitting, the time that it takes to retrofitting is the biggest challenge. So the next ask, I have of the universe is find us an investor who's willing to build the infrastructure for us, build to suit. Because for them, it's long-term, rental models that they can have. And then we get to have assets that really work. So that's really been the hurdle, to find good quality infrastructure that's compliant in an ecosystem where a policy exists.
Over the last 15 years, I'm sure there have been many moments of people whose lives you have touched through Antara. Are there any specific moments that you recollect? People who may have met you, written to you about how their lives changed?
So many, and I'm so grateful. I think that's a fuel that you can't be grateful enough for. But I remembered our first residence in Antara, Dehradun, and that first check is still framed in my office.
How much was the check for?
5 lakhs was our booking amount. And the couple that actually bought the first apartment, Mr. Verma, still actually lives in Antara, Dehradun. But his wife actually was suffering from cancer. And she said, Tara, I am going to go through my journey of illness, probably knowing that the outcome is not going to be in my favor, but knowing that I can go through this, that, my husband will be with you sort of in that journey. And sure enough, they moved in, and a year later she passed. So, examples like that where you really feel you could step in and be family for somebody and give them that sense of peace, to be able to go on their journey knowing their loved one was going to take care of, I think was a very big shift for me. We opened our first care home in the thick of COVID. It wasn't timed that way. It just so happened. We were able to set up 2 facilities which were COVID care spaces for seniors. And every story there was remarkable that we were able to take care of them. And in AgeEasy, we have testimonials from customers who've said, I've not been able to go on my morning walk for the last 3 months, and your knee brace has done that for me, or the physiotherapy has really helped, or the pain relief has helped. I think those moments of truth are just priceless for me.
So AgeEasy, what's the pipeline of products? What's the kind of innovation funnel that you're working on?
So we're about 80 products now. We go condition-wise. So we launched with joint care. Then we talked about lung health. Then we did an entire fall prevention portfolio. And we actually just launched our gut care range, which is designed specifically for seniors. And so our desire is that within each of these conditions, we should have majority of our products that do have R&D that's specific for seniors. And that is therefore the focus, that we will have generic products that could even be used by a 40, 50-year-old, but we want to continue to create those USPs. So for example, diapers doesn't sound very sexy, but a huge, huge market. And we have actually done a patent on a certain type of absorption on a diaper, and that product range will launch very soon. Our wheelchairs have antifungal and anti-skid wheels. They're not typical wheelchairs. The gut range has been curated very specifically to look at comorbidities of seniors. Because today you can take a certain gut nutraceutical and it can have confluence with other things that you're taking. So always keeping the senior and aging at the heart of every decision we take is, very much a USP of whatever we do.
And the R&D is happening at your,
a mix. We partnered with IIT. We have experts even from international ecosystems. We have a product and scientific committee that looks at every single one of our products, and then we get experts in that domain. So Dr. Guleria is part of the products committee when we did lung health, for example. We have Dr. Maria from Max, which is one of the best authors for the joint pain piece. We have Dr. Ishi Khosla doing the entire gut care piece. So the product scientific committee really come and rally behind each of the products that we launch.
Well, Tara, it's been an absolute pleasure speaking with you again, catching up on all things life and business, and we wish you the very best of luck. I hope you do get into top gear now, which is what you're hoping for. But thanks very much, and we wish you all the best.
Thank you so much for having me.
Well, with that, it is time for us to wrap up this edition of Young Turks Reloaded. If you enjoyed that conversation, then do send us your feedback. We always like to hear from you. But for now, from all of us here on the team, for this week, goodbye, and many thanks for watching.
Hello and welcome to CNBC-TV18. Today we're going to be putting the spotlight on the capital goods space because the capex and the manufacturing cycle in the country is the big story. That's where India will lead the growth going forward. And to talk to us about that, today actually we're at a very special place. We're at the Sri Sati plant of Thermax. Thermax is going to be completing 60 years this time. And to talk to us about the capex story, business with purpose is the motto of Thermax, and that is what we will be talking about with the MD and CEO of the company. We have Ashish Bhandari of Thermax at the plant. Ashish, firstly, thank you so much for, letting us come here, visit the plant and, know more about the capex story as well, Ashish.
Vinny, thank you so much to you and to the CNBC team for making your way out here. It's a pleasure to host you.
Pleasure to be here, Ashish. Let's start by talking about first Thermax. 60 years, that's what you'll be completing at the end of 2026. And what a journey it's been, right? From a boiler maker, today y'all are across diversified, industries that we could talk about, even a new energy kind of industries that y'all are focusing on. How has the story been in the last 6 decades so far? And now what is the growth driver that you see that could come in?
Look, I'm relatively new to Thermax. Yeah, I've been with Thermax for 6 years. There's so many people that I know who have worked their entire lives with the company. And it's a fascinating story. It's a company that in every phase of its development did what was important for India, but in a way that was, in the eyes of the company, the right way to go about it. Mr. Rohintha Naga, who took the company public, his seminal words were, profit is not just a set of figures, but a set of values. And that is a theme that has continued for Thermax throughout its journey. It started with boilers because that was, at that particular point, India needed packaged boilers because hospitals and many other industries had imported equipment, and entire hospitals would go through problems when steam could not get generated. So he said, I'll start to make them in India. And this was the time of the license Raj. As India grew, Thermax grew. It grew into many adjacent spaces around it, got into water technologies, air pollution control equipment, chemicals, and the like. Where we stand today, I look at the next phase of our evolution as perhaps one of our most exciting times forward. And that is because, A, the world is changing. Yeah, energy transition is a big, big topic. We are all looking at what we are doing to the climate. And any company that has the capability to make a difference, and Thermax does, this is an exciting time. Second, equally important, India too is at a very specific juncture of its own. Yeah, to get to Viksit Bharat, Indian companies have to think in a very different way, much bolder than what we have done ever before. And with that view and that look is how Thermax is looking at the future. There's a lot that we have achieved, but our journey in many ways is just beginning.
You know, what about the overall capex cycle? When I spoke to a few people, they highlighted that maybe private capex is there, that we're seeing a comeback. I want to know about both, the capex cycle overall. Are we seeing an increase in private capex, public capex? What's the story right now?
Thermax has never been directly driven as much by government capex. We are more of a private capex driven company. I would say post-elections, there was a bit of a slowdown. And especially for Thermax, there was the whole ethanol industry, which after India hit E20 came through a bit of a slowdown. So that affected. But I would say the last few months have been good. And as I look at the next coming period, in India, we have got many new industries, electronics manufacturing, semiconductors, solar modules and cells progressing, and then of course data centers. So you see a new wave of companies coming in which were not part of our ecosystem even until 2 years ago. So there's a shift of where capex is coming from in India, and given the overall demand strength as we are seeing, I expect the coming period to be of a much stronger, larger revival in private capex all across India.
Okay, so you are expecting a revival there. You know, you touched upon all these data centers or the systems that were not there in place for India so far. Is that something that you all are working on?
Very much so. In the last quarter itself, we had 2 of our biggest wins in data centers. I'm very proud and happy to share that we had a big breakthrough in the US to export for one of the largest data centers, which will ultimately be providing storage and cloud storage for one of the largest companies in the world. We'll be providing 23 absorption chillers, which will be coming out of this plant, and which is just the first phase and the first entry for us. But given it is going for a marquee client in the US, we expect this to be first of very many.
That's going
Then in India, we have with our latest products, which are called the hybrid closed loop cooling towers, hybrid CLCTs. We just closed a major order for a major data center in India as well. So 2 very different products, both cooling related, one in the US, one in India. So for Thermax as well, the entry into data centers is now very real and now.
Okay. Ashish, you know, in the recent times, or 2025, we could say, there was those FGD issues, and just for our viewers, FGD is fuel gas desulfuration. Now, obviously, there were some norms that came in, then there was a change in that. What is the current status, just to get an update?
So for the last 3 years, we have been saying that we don't expect any future FGD orders, and that's our current stance. We are executing the old set of orders. Our order book also went through what seemed like a dip, because all of these kinds of orders we said we don't expect in the future. And as I look at the future as well, I don't expect too many central government's actions towards pushing FGDs.
So, and when will all these orders be completed for the
So the orders between this year and next year, all of our FGD backlog would be done.
So by FY27, you all will be done with
We'll
that,
be done
and not
with
much of an
FY20.
expectation of anything more.
Anything beyond that.
You all have also interestingly, you know, focused on lowering those low margin businesses, right? So are all those executed, or that will also be done by FY27?
So between this year and next year, and FGD projects are one such set of projects. There's one other very specific project which also will be done. Finally, the other segment which continues to remain is like this bio-CNG space, where we have done these 14 plants, but doing that has been technically challenging, not just for us, for the entire industry. But this space I'm still hopeful for, because it makes a lot of sense for the country to grow this space. Done well, bio-CNG should be India's next ethanol sector.
Okay, and where do you see any specific pockets now that are showing great green shoot for growth? Maybe for Thermax, maybe for industry. Bio-CNG you mentioned, but apart from that, petrochem, ethanol side, biomass side. What is it, or where is it that there are these pockets that are showing?
So one we already talked about, the entire this new group of industries, data centers, electronic manufacturing, semiconductors, solar cells, all of these are suddenly creating a big book of business, which is newer for Thermax and newer for the space at large. That is one. Two, overall, clean water and the water space is very interesting because India right now, driven also by many of these industries and by higher compliance driven by government initiatives, is making sure that water gets recycled lot more than what was done in the past, which means zero liquid discharge solutions, desalination solutions. All of these are creating a new book of products and solutions for Thermax. Third, I would say international. Yeah, international, Thermax has been investing in growing our presence globally. That is now starting to show up. From India, exporting out to the world, I think you will see Thermax becoming a lot more of an exporter than we were
So from
previously.
that 14%, where is it going to go in terms of export then?
At least double that would be the expectation.
By when?
By, look, over the next 3 years even.
Wow,
So we
that's
would
gonna
like
be
to
fun.
do that. Though if India continues to grow very fast, we won't be the ones complaining.
No complaining on that
No
front.
complaining.
But on that note, I want to go and start seeing
Let's
the
do that.
factory
Yeah,
as well.
that's the joy.
that-
Instead of standing outside, let's walk
Might as well
inside.
see if the work going on there. So we'll go
Absolutely.
back in the factory now. Ashish, we were talking about exports. We ended at exports growing, but where will it grow? Which countries? Where are we seeing the development now?
So I'll start with the Thermax picture, and for us, there are multiple geographies of the world that we are interested in. Thermax has 3 manufacturing plants outside of India, and from our existing plants in India also, we do quite a bit of export. In fact, this particular plant that you see, more than 50% of what we do from this plant is actually exports going all across the world. Right now, the geographies that are growing the fastest for Thermax is the Middle East, Sub-Saharan Africa, Southeast Asia, US, which was surprisingly, you would think would be an area where, especially with some of what is happening geopolitically, would be slow. In the last few months, after some period of slowdown, has picked up substantially, driven by some of these newer segments like data centers that we were speaking about.
Other than that, what are the segments that you're seeing a growth coming in like in the export market?
The larger projects in exports are coming from oil and gas and petrochemical and refining. In Q1 of this year, we had a big win for Dangote. Sorry, in Q2 of this year, we had a big win for a major oil and gas company from the Middle East, which was a big breakthrough for Thermax. Because the first orders are typically marquee orders, which once you qualify for, gives you a chance of lot of repeat business. So with this, with 3 major oil and gas companies in the Middle East, Thermax is now qualified to provide products.
At least some positive sign and big green.
Because all of these are repeat business, continue to be. Then in Q2, we had a major win with Dangote, which we had publicly announced, where Dangote is one of our largest customers internationally. But as we look at Q3, Q4, and some of the other periods, we see a continued pipeline of international projects, not only from Middle East and Africa, but also from the US.
Ashish, I want to understand. We spoke about a lot of segments that are going to do well. We spoke about the new energy transition side, data centers. Where will those large orders come in from? Are these the sectors maybe which will give y'all the large order books, or will this be the newer ones and this will be smaller order books?
So in the last 5 years, the portion of Thermax which has grown the most is what we call as the industrial products. Yeah, industrial products doesn't have large orders. It provides products that go into multiple industries, sells through distributors, channel networks across India, and the same model we are driving internationally as well. This is the business which is the most profitable for Thermax and has grown the fastest as well. The kinds of products that you will see here as well. Yeah, they don't make the headlines, but they provide continuous business and repeat business across multiple customers. So that is one area. But if you're asking specifically which are the areas that will provide the large orders numbers for Thermax, refinery, petrochemicals we talked about, steel and cement we talked about. The one segment which is coming back strongly, which was how quickly it has emerged as a surprise, is the whole thermal power sector, which for India was a sector where for a while there were no new coal plants coming up. But now high efficient coal plants, supercritical or subcritical, but highly efficient plants are now back in discussion. And there again, the order sizes are large. And of course, Thermax has the capability to do those projects.
While we're talking so much about the infra side, I want to also understand the industrial infra side, right? Because that was some bit of where the company had faced a bit of a pain point or an underperformance versus other segments. How is that performing now, or where is the trajectory of that business moving on, given that it's a major part of the businesses?
Look, I would say of the last few years, the current period that we are in, the last 6 months, and as I look at the outlook for the next couple of years, this is the most optimistic I am and have been for this particular part of the business for two reasons. First, the kinds of wins that I talked about, the international wins, the growth of India's power sector, some of the newer, bigger projects that are coming in internationally and domestically are all of the kind that is very much in the sweet spot of what the industrial infra business excels at. Okay, around our core competency, and we have been under-emphasizing projects where there is significant civil construction, long-term risk. Even businesses like FGD, we said for the last 3 years itself, we will execute our current set of projects, but we won't do any more. So our backlog in industrial infra is starting to go up. The quality of that backlog is continuing to go up. And the opportunity set internationally and domestically is improving. So I'm very, very bullish on industrial infra, and with fair amount of visibility, at least for the next couple of years, into the kinds of projects we are undertaking in that business.
Ashish, what about your subsidiaries that are there for Thermax as well, right? FEPL, TO, TOSIL. All these, how are they doing, and how big can, actually I want to understand chemicals, green solution side, how big can that be?
As we continue to look to the future, many of our businesses we are incubating. Yeah, hydrogen is a great example where over the last year and over the next 3 years, we will be investing more than 100 crores in just establishing a hydrogen business. And we know for the next couple of years, substantial revenues won't show up. Yeah, but we know they are the right investments to make as we look at energy transition and as we look at Thermax of the future. Bio-CNG is also one such example of where we have made significant investments. TOSIL is the place where we provide green energy, which is steam or power, to our customers on a build-own-operate basis. It's a fantastic story where we have now done more than 50 plants in India for our customers. And one of the best examples that I can share with you is one of the biggest names in F&B for their noodle plant in Gujarat, which was coming up. They shifted from using coal or fossil fuels to using biomass-based steam, because to make noodles, you need a lot of steam. And Thermax built that plant for them on a build-own-operate basis, using local agro waste which comes from that local geography. groundnut shells, whatever else was available, converting that into steam to the customer on a guaranteed basis. So the customer is guaranteed a plant uptime, availability of steam, and all things considered. The customer has liked the model so much that on multiple plants across India, they are moving completely to this plant. So that is what TOSL can do. Yeah, last FEPL, which is our foray into renewable energy and renewable power, that business we have invested in and we continue to grow. Our plan is that we will grow it to 1 gigawatts for our customers, and at that point we will bring a suitable partner in to scale that business up as we look forward.
Okay, suitable. Once you'll reach that scale, when the new partner will come?
Which should be within the next couple of years.
17% CAGR growth approximately that one has seen. Is that something that can continue for the company? Or do you think overall the industry could grow faster than that if the push comes in faster?
I am an optimist by nature, yeah, and I believe the next 20-25 years are India's years. Yeah, and this is the period where if India has to build 3 Indias, what we have done in the last 75 years, multiple sectors will have to think very, very differently. Yeah, and a company like Thermax has a big role to play in supporting that growth and also making that growth happen. So I believe, I don't think we should be limited to a particular growth number. Our ambition should be to build products that are revolutionary, to be able to do them in a manner which can stand up. And if we do that, a 15 to 20% growth number should be achievable.
The vision board for Thermax is going to be what over the next decade?
Our vision for the next decade is to be a partner to our customers in their journey through energy transition in a way that Thermax itself is a lighthouse company with capabilities and a solution set which is leading not just for India, but for the world at large. To be able to do that, we will have to enter newer areas like hydrogen, like carbon capture, like advanced biofuels through partnerships, but also through our own R&D. We will have to invest heavily in our existing set of products, like this cooling set of products that you are seeing, electric boilers, chillers, investing in international services, variety of those things. Beyond that, digital is a big part of our growth story, taking some of our smaller businesses like water, chemicals, building them out because they have a story beyond energy transition. And then finally, in this next phase that we are coming through, looking at partnerships, looking at people very, very differently as well.
Absolutely. Ashish, one more point I want to ask is investments, because you said that there will be investments required to enter newer. Any short-term plan right now as well as long-term you spoke about that is going to be?
Look, we will be in an investment cycle. We have been recently. This plant itself is relatively new, but in the last couple of years itself, we invested in a new plant for water. We have invested in a new plant for expansion for chemicals. 2 of our plants where we do boilers will go through capacity upgrades. This plant here will go through a capacity expansion. As I said, we are investing over this period, we'll invest more than 100 crores in hydrogen. We will invest at least 100 crores in many of the new R&D related areas that I was talking about. FEPL will get some amount of investment. So the next period that we are going through, we expect to grow. We expect to grow profitably, and we expect to be in an area in a period that we will invest domestically and internationally as well.
Okay. Ashish, thank you so much firstly for bringing us here, showing us all of this as well. It is exciting for me. I'm sure it's exciting for our viewers as well. Thank you so much for having us here.
Typically, a 60-year-old going into retirement was thinking about how do I give back to my children or leave more for my children. It was never about how do I take care of myself.
Having done this for 15 years, I'm now starting to see this demography wanting to spend. The pie has increased. I think the wealth that India has seen and the wealth that the current 60-year-olds hold, they're not having to make that trade-off.
As we look at this longevity debate, Taran, I want to understand how you're viewing it.
I think it's almost too short-sighted to think that you can, twist and play with the fundamentals of how life is going to work. We want to make the years that you are alive physically as joyful, as healthy, and as happy as possible. Forget even for a minute the 350 million people over 60. You take 1% of that. Who is going to care for them? My nickname growing up was Granny. So I think I always...
Why were you called Granny?
I was always older than my actual age. I think I behaved older. I thought like an older person. And then I got into the senior care business. So it's clearly proved everybody right that I am inherently a lot, I think, older.
Old soul.
An old soul.
India is aging faster than it is prepared for. According to reports, 11% of India's population today is 60 plus, and by 2050, this number is projected to be double to almost 21%, which means that 1 in 5 Indians will be a senior citizen. Longer life expectancy, smaller families, dual income households mean more seniors are living alone. Hello and welcome to Young Turks Reloaded. I'm Shireen Bhan. Joining me on the program today is somebody who has been on Young Turks and is trying to address the problem of what we do for senior care. We put the spotlight today on Antara Senior Care Company that's reimagining senior care, not as a charity or custodial living, but as a structured, scalable business opportunity built around dignity, wellness, and continuity of care. Tara, it's wonderful to have you back on Young Turks, and thanks very much for joining us here on Reloaded.
Thank you. So happy to be back.
So 15 years now, Tara, of doing this, but I want to understand from you, as you look back, this was a space that had a whole bunch of societal sort of stigma attached to it. Nobody wanted to even talk about the possibility of setting up senior care homes because the idea of sending your loved ones to a senior care home, courtesy Bollywood and all of that, was just traumatic. But has that changed, and how much has that changed in the last 15 years?
It's absolutely changed. I remember walking into a room for the first 2 or 3 years of starting Antara and always having to push the conversation and having exactly that reaction, saying, oh, you're making an old age home. I don't want to live in an old age home, or I don't want to send my parents there. And I feel when we started Antara, we were very clear that this is going to be more than just senior living or retirement living. We wanted to be a brand that people thought of as they got older or had loved ones who were getting older. And so when COVID hit, and at that time, we had the one Antara Dehradun residential community, and we had launched our second vertical care homes. I think that changed the game and the narrative for us. People started believing in wellness a lot more. They understood that as they get older, they need an ecosystem to support them. And so when I walk into a room now, especially actually the last, I would say 2 years, investors, organizations, corporates, and even people looking at starting new businesses have been talking about the space as a whole. So it's very exciting.
So it took the pandemic for people to understand the use case for a business like yours?
I think it did. And also by then, I suspect that because we had done things the way we had done things and people had something to engage with as a concept or a product or a service, it changed their mindset as to what the concept could actually be. And it took that much time for us to prove ourselves. And then for other players also to start seeing, hey, this could possibly be a benchmark for the narrative to change.
But let's talk about the business case of this now. And, Max Holding is the listed entity. Antara is a part of that. As you look at your expansion plans, as you look at building this out pan-India, if that is in fact the aspiration, what do you think it's going to take for you to be able to do that?
So Antara is 3 different business verticals. And I want to create that distinction because each one will have have different opportunities and challenges. So the first with which we started was what we call senior living, retirement communities. Dehradun was the first. We then launched a project in Noida, which is fully sold out. And then we did a partnership with Max Estates for Gurgaon. And so in that ecosystem, now I feel what it's going to take is just us being aggressive and finding opportunities to grow. And the pathway to that is 1.5 million square feet a year of commitment, which will over the next 8 to 10 years give us 8 to 10 communities. I think there's a huge opportunity there. And so really it's just about us being aggressive and saying who can we partner with, because we as Antara will not go buy land and do all of that. We want to partner with people who have the land, who have the expertise of construction, but we will bring the expertise of design, sales, and of course, eventual operations. The second vertical is what we call care homes. That's sort of the sort of colloquial way to explain it is assisted living, short-term and long-term. There, I think there are going to be 3 things that are going to push us. We have 500 beds as of the next 2 weeks between Bangalore, Chennai, NCR. A is going to be finding infrastructure that allows us to retrofit and move quickly. And that has been a challenge, and I think will continue to be, because we know compliant infrastructure in India is a challenge. 2 is insurance, which has also started to get unlocked. For insurance players to potentially think of assisted living as a focus product, or even combine it with a healthcare product, is going to be the big unlock there. And 3 is actually going to be just awareness, which again, we're starting to see shift because it is category building as well. AGZ, which is our newest baby on the block, D2C platform for products to really help people with conditions that are chronic and age-related. I think that's been the most quick to market and the most exciting. And I think the challenge there is just to keep our metrics of ROAS, of margins, and hold those very, very tight so that we can play the long game there.
So let's unpack each one of these, and let's start with the first, which are these residential communities, courtesy Antara Living, that you're creating. Now, typically, who are the people who can afford to be at an Antara Living facility? I mean, how much does it cost? And when you talk about building out an ecosystem of partners, because you don't want to buy the land, you don't want to get into actual construction, you essentially are managing the property for somebody, who would typically be interested in partnering with you? What have you seen so far?
Yeah. So I think who is buying is, we actually have 2 variations of the product. When we launched Antara Dehradun, it was almost product first. We had a dream. I had a dream, a vision, and that was what it cost. And we tried to find the market that would buy it. After that, I said, look, I think to make this a scalable business, I have to think customer first. I have to think, what are they willing to pay and what are they willing to pay for? And that's how Noida came about. So 2 very different price points. The thing that stays sacred amongst all of our communities will be our deep mission to impact quality of life. So our services don't change, but I would say the per square foot cost between Dehradun and Noida and then
is very different.
Is different. So example, today Antara Dehradun is reselling at 26,000 rupees a square foot. We launched also back then at 100% more expensive than the next real estate comparison. Our monthly charges are 3 times of that. And so that was the big pushback there, and it took us therefore longer to sell. But today, I mean, when I think about the resale value, I'm shocked myself. Noida launched in 2021 at about 9,500 rupees. It's now reselling at 15 to 16,000 rupees. So there's still a 10,000 rupee per square foot price difference there. And we just launched Gurgaon Estate 360 and 361 at 21,000 rupees. So who is buying are therefore people who can afford a ticket size of 2 to 7-8 crores, depending on the size of the apartment they want, and who are willing to pay a monthly charge more than a regular condo, because we pack in a lot more services. And that can vary from about 30 to 80,000 rupees a month, again, depending on the size of the apartment. So that's who is buying. And in terms of the partnerships that we want to create, when we finished Dehradun and looked for partners, it was a big struggle, because why would anybody partner with a concept that was so nascent? They could command velocity as well as per square foot rates of traditional real estate. But as the market has changed and people believe in what we do, they realize that we can command a premium. So we actually sell 15% more per square foot in terms of a sales price than anything that's next to us. So now those are the partners who say, we want to diversify our portfolio. We believe in the senior care spaces being high demand, and we want to work with an organization like Max and Antara that has high governance and high standards. So far that partnership has been with Max Estates.
Yeah.
Haven't had to go too far, and they will continue to be our partners in NCR. And we are therefore looking for partners in the top 5 markets that we believe, which are, Chandigarh, Bangalore, Chennai, Hyderabad, and perhaps even Goa.
2 to 7 crores is the elite market.
Yeah.
I mean, it's what you could call premium or what you could call luxury. Is there space then to do anything for the mass market to make this product more affordable?
100%. I actually believe if we are 350 million people over 60.
In branding, the 10-minute delivery promise, Blinkit makes the first move, drops 10 minutes from its tagline. However, 10-minute delivery has not been stopped and there is no government order suggesting the same. India's government bonds decline after Bloomberg defers inclusion to a global index, cites operational and market infrastructure gaps, also acknowledges significant progress and keeps the review open for more feedback. Global central bankers rally behind the Fed Chair Jerome Powell after Trump launches a criminal investigation. Central bank chiefs from Europe, England, Canada, Australia, Brazil, South Korea and others issue an extraordinary joint statement expressing full solidarity. The rise of Gen X at the Tata Group. Sources say 32-year-old Neville Tata is likely to be inducted into the board of Sir Ratan Tata Trust this week. He's already on the board of Sir Dorabji Tata Trust. Both these trusts own more than 51% stake in the group's holding company, Tata Sons. NSE gears up for its long-awaited IPO after SEBI chief hints at a green signal this month. The stock exchange eyes a market cap of nearly 5 lakh crore rupees, which will make it the 11th biggest listed company in India. Apple chooses Google to power its artificial intelligence tool, signs a multi-year deal to integrate Google's Gemini across Siri and other features. Elon Musk criticizes the deal, calling it unreasonable concentration of power for Google. Loudspeakers go silent as campaigning for Maharashtra civic elections draws to a close. Voting will take place on Thursday for 29 municipal corporations, including the BMC in Mumbai, which is Asia's richest civic body. As always, let's start with the day's market action. Another volatile session, the Sensex and the Nifty closing largely in the red, but again coming off sharply off their intraday lows in the last hour. The Nifty managing to hold on to levels above the 25,700 mark, finally closing flat. The Sensex down 250 points, 100 point lower on the Nifty mid-cap. The Nifty Bank closing in positive territory, but just about, so that recovery really coming in towards the close of trade. Now, nearly 30 Nifty stocks closed in the red despite that late recovery that we saw. In fact, staying with the markets, the big call from veteran investor Ramdeo Agarwal for 2026. He expects the auto sector, in his words, to be the star sector of the year. That's just one of the key takeaways from the CNBC-TV18 Market Forum. He also expects earnings to improve in Q3 and Q4. Meanwhile, Manish Chokhani of Enam Holdings says private sector spending remains subdued and any move by the government to revive animal spirits in the budget will be welcome.
My sense is Q4 will be even better. So I'm very kind of optimistic on the earnings cycle turning up after brief, lull for last 4-5 quarters. I think PSUs still have a lot of steam. They are much more reasonably valued than private sector, and earnings growth is almost 2x of private sector. So that looks to be a very interesting category. And I think financials, I think auto will be the star of the year.
The resource raising exercise has to come now from public sector. And if some of those assets go cheap to private hands, like it started in 2002-03 in Vajpayee era, it reignites animal spirits because private sector is clearly not opening the purse strings because they are a bit uncertain about what's happening in the world as well. So anything to revive animal spirits, whether through privatization or disinvestment or maybe some other PLI type scheme, would be very welcome.
Well, we'll get you more from the CNBC-TV18 Market Forum on the outlook for the markets for 2026 in a bit. But the big global story, President Trump has announced a 25% tariff on Iran's trading partners. The Islamic nation has been roiled by massive anti-government protests.
biggest in decades. Tehran has blamed the US for fueling the unrest. Now, in a post on social media, Trump said, and I quote, effective immediately, any country doing business with the Islamic Republic of Iran will have to pay a tariff of 25% on any and all business being done with the United States of America. This order is final and conclusive, end of quote. Now, the announcement comes days after Trump warned the Iranian regime of military action if security officials continue to kill protesters. Iran's foreign minister has said that they are ready if Washington wants to test its military might. Meanwhile, tens of thousands of demonstrators took to the streets across the nation in a show of support to the regime. State media is showing visuals of a massive crowd of people streaming through the streets of Tehran. Iran's officials say 2,000 people have died in the protests so far. Iran's president also participated in a pro-government rally, promising that he was ready to listen to the concerns of people. However, the Islamic nation continues to be cut off from the internet for the 5th straight day, though we are given to understand that there could perhaps now be a return to some sort of mobile connectivity. A US-based human rights group has reported over 10,000 arrests. So who does Trump's latest tariff salvo impact the most? China is Iran's largest trading partner, followed by Iraq and the United Arab Emirates. Iranian exports to China amounted to $22 billion in 2022, according to the World Bank. Iran's exports to Turkey hit $5.8 billion in the same period. China said it will take all necessary measures to safeguard its interests. In a social media post, the Chinese embassy has said China's position against the indiscriminate imposition of tariffs is consistent and clear. Now, Indian government sources tell us that the new tariffs will have minimal impact. India exported goods worth over $1 billion last year. That is less than 1% of India's overall goods trade. However, rice exporters remain concerned, and Manisha joins us now to explain why. Manisha, what could potentially be the big risk for rice exporters who are exporting to Iran?
Iran is also the second largest basmati export destination for the Indian exporters there. If you look at the overall numbers, Ministry of Commerce and Industry data shows that in 2024-25, nearly $753 million of worth of basmati rice was exported to Iran. Now, overall agriculture exports that India does, 20% of that is rice, and much of that goes to Iran. So clearly not very favorable right now. The same goes in for tea as well. The tea as an industry also is quite moved right now, and there are various reasons for that. To begin with, tariffs is just about one part of it, but it also is issues within Iran as well. And while Iran has for many years seen a lot of internal political unrest, etc., but the markets believe that this time it's going to be quite difficult, and whether or not Iran can bounce back quickly from that is going to be something to be seen there. You also are looking at a sharp depreciation when it comes to Iran's currency. That's one part of it. And then there is a lot of cargo in transit. Indian rice and tea exporters do not know on what is going to really happen to that. The second point also is about the shipping costs, which seem to be surging on a day-to-day basis there. And the payment delays is yet another thing that is bothering. Much of the payment, which should come in within 180 days as per the clause of transactions, has not come. So whether or not these payment remittances will happen, when will they happen, how will they happen, are a lot of questions that the trade seems to be asking ministry and various regulators like ABIDA, etc. We do understand from these traders and companies that Indian regulators and ministries have told them that very soon that they will be coming out with a guideline or a framework on how to trade with Iran. That is something that the street is awaiting at this point.
Yes, Manisha, many thanks. In fact, the U.S. Embassy in Iran has issued an advisory urging American citizens to leave the country immediately amidst escalating nationwide demonstrations. The U.S. advisory has warned of road closures, transportation disruptions, internet shutdowns, and limited communication access. Several airlines have already cancelled or suspended flights to and from Iran. The statement advises Americans to consider leaving Iran by land to Armenia and Turkey. Now, moving from Iran to Ukraine, it says that Russian forces have killed 4 in drone strikes that targeted Ukraine's 2 largest cities. Kyiv has said the attack was the most concentrated barrage of the year so far, and this comes hours after the U.S. accused Russia of dangerous escalation during an emergency meeting of the United Nations Security Council. Washington has expressed particular alarm about Russia's use of a nuclear-capable ballistic missile last week, so things continue to be tense in Ukraine. Days after Trump doubling down on Greenland, Republican Congressman Randy Fine has formally introduced the Greenland Annexation and Statehood Act. Now, the legislation is aimed at providing the Trump administration a legal authority to pursue annexation and eventual statehood for Greenland. Denmark and Greenland's foreign ministers will meet US Vice President J.D. Vance and Secretary of State Marco Rubio tomorrow. Ines de la Cuetara is in the Greenland capital. She reports on how Trump's imperial ambitions have kept citizens on the edge. Take a look.
I think people are really worried. They are frustrated. They're growing increasingly angry with the president's rhetoric. And most people we've spoken to, I think, just want President Trump to leave them alone. I think there's been a shift in the mood when you compare, this time around to what happened a year ago when President Trump was making those comments a year ago. People, I think, kind of laughed off the president's plans to take Greenland. This time around, after Venezuela, people are taking it much more seriously. So the U.S. already has a presence in Greenland. They already have a space base here, and they could, reopen bases they used to have. They could expand their presence under a 1951 treaty that they have with Denmark. They could expand their military presence without having to invade. So, lots of frustration here. I think people looking ahead to those diplomatic meetings that'll take place this week. So we know on Wednesday, Secretary of State Marco Rubio will be meeting with Danish and Greenlandic officials in Washington. And then we also know that Danish officials and Greenlandic officials will be meeting with the group of U.S. senators that are traveling to Denmark. That is a bipartisan delegation that is heading to Denmark. We understand it's being led by Senator Coons, but Senators Murkowski, Shaheen, and Tillis will also be participating. And the point of those meetings will be, hopefully to find a diplomatic solution to this and hopefully de-escalate the situation.
Well, that is the latest there from Greenland. Now, IT Minister Ashwini Vaishnav attending the G7 Critical Minerals Ministerial meeting hosted by U.S. Treasury Secretary Scott Bessent in Washington. The ministers discussed focusing on supply chain resilience amidst China's dominance in mineral refining. Vaishnav has said strengthening critical mineral supply is vital to enhancing the resilience of India's manufacturing.
It's very important for all the countries, including India, to have a resilient supply chain of critical minerals. There were discussions around funding new projects. There were discussions around technology sharing between different countries. There were very important discussions about recycling, because that's a good way of harnessing the minerals out of the waste products.
Well, that is the IT minister in Washington. Now, international central bankers have reacted to the criminal proceedings against Jerome Powell, the Fed chief. In a social media post, central banks have said they stand in full solidarity with the Federal Reserve System and its chair, Jerome Powell. The post added that Powell has served with integrity, focused on his mandate and an unwavering commitment to public interest. Now, this comes a day after former Fed chairs Janet Yellen and Greenspan and Ben Bernanke extended their support to the current chair, who is currently being investigated by the U.S. Justice Department. A joint statement by Powell's last three predecessors condemning the criminal inquiry is an unprecedented attempt to use prosecutorial attacks to undermine the Fed's independence. The joint statement also added, and I quote, "This is how monetary policy is made in emerging markets with weak institutions," end of quote. The big story back home, Labour Minister Mansukh Mandavia has nudged quick commerce companies to stop marketing and branding the 10-minute delivery promise. This comes after recent protests by gig workers demanding higher pay and safer working conditions. Now, Blinkit has become the first mover and has dropped 10 minutes from its tagline. However, and this is important, 10-minute delivery has not been stopped and there is no government order mandating the same. Timsy joins us now with the details. Timsy, so what has transpired in these meetings that have taken place between quick commerce companies and the government? Has the government asked them to drop the 10-minute delivery promise, or has 10-minute delivery, the service in itself, been put an end to?
Well, yes, as you rightly mentioned, what sources are indicating at this point of time is that Labour Minister Mansukh Mandavia held series of meetings with quick commerce companies to stop marketing and branding of 10-minute delivery. Labour Minister held series of meetings with quick commerce companies in the last 1 month, and Labour Minister in these meetings nudged the companies to discontinue the branding of 10-minute delivery to protect the rights of gig workers. Union Minister Mansukh Mandavia, sources claimed, has persuaded during these meetings the major delivery aggregators aggregators to remove the 10-minute delivery branding and marketing. Also, these meetings were held with leading platforms, is what sources indicated, which included Blinkit, Zepto, Zomato, Swiggy, to address concerns related to delivery timelines. Other aggregators, according to these sources, is that they are expected to follow suit in the coming days. And sources in the nutshell actually said that this move is aimed at ensuring greater safety, security, and improved working conditions for gig workers. Meanwhile, CNBC-TV18 has reached out to these quick commerce companies and is awaiting their responses. But yes, as of now, sources indicating that Labour Ministry has managed to nudge these companies to stop the 10-minute branding and marketing. They might be able to deliver in 10 minutes, that can still be the case. But when it comes to marketing and branding, that needs to be addressed with this nudge, is what Labour Ministry sources are saying.
All right, Timsy, many thanks for joining us. In fact, Elara Capital has said that removal of the 10-minute delivery branding is largely optics-driven rather than business-altering. EVP at Elara Capital, Karan Tarani, has said that this change will not have any material impact on volumes or the growth trajectory. He noted that typical quick commerce deliveries continue to be completed within 20 to 30 minutes, which is materially faster than horizontal e-commerce. So we will have to see how this finally plays itself out. India's government bonds declined after the Bloomberg Index Service deferred the inclusion of Indian bonds into the global aggregate index. The service provider cited operational and market infrastructure gaps. However, Bloomberg said it will keep the review open and continue engaging with authorities to explore improvements in infrastructure. With less than a month to go for the union budget, telecom companies have said that license fee is a huge financial burden. They've sought relaxation. In a letter to the Finance Ministry, companies have darted for rationalizing fee from 3% of AGR to 1%. The companies have also sought a waiver of GST on regulatory payments and the recalibration of spectrum pricing. So the wish list there from telcos to the Finance Minister. Neville Tata, the 32-year-old son of Noel Tata, is likely to be inducted into the board of Sir Ratan Tata Trust this week. Parikshit Luthra joins us now with more details. Parikshit, this move is significant. This is the second board that Neville Tata will be inducted onto. Explain the rationale and the impact.
The reason why this is significant is that Sir Dorabji Tata Trust and Sir Ratan Tata Trust together control 51% stake in Tata Sons. Neville Tata, the 32-year-old son of Noel Tata, was inducted into Dorabji Tata Trust in November last year, along with Bhaskar Bhatt. Bhaskar Bhatt is also a long-time Tata Group veteran, so to say. Moving on. We're told that the board meeting that takes place this Saturday, the 17th of January, that will have on the agenda Neville Tata's induction into Ratan Tata Trust. Many observers say that it was definitely on the cards after his induction into the Dorabji Tata Trust, and this is now almost a formality. But his induction has to be unanimously approved by all the trustees. Having said that, what does this mean for Tata Trust and Neville Tata? Now, Neville Tata was someone who entered the Trent business in 2016. He heads the hypermarket business of Trent. This can be seen as a move by Noel Tata to somehow solidify his leadership within the Tata Trust, in the Tata ecosystem, help him grow as well, and also make sure that the kind of feuds and the tension that the Tata Trust had seen between trustees in 2025, that comes to an end. Many observers are telling us, and these are people who've worked with Tata Trust for many years, they tell us that this could be a way to balance things out between the Tata Group family and outside bureaucrats and industry veterans who are a part of the trust. Also to make sure that there are more and more people within the trust who are aligned with Noel Tata's vision going forward. And this is perhaps not the only change. We're told that Pramit Zaveri's tenure also comes to an end in February. He will be due for reappointment. So will be Darius Khambata and some other trustees as well. So what this could mean is we will have to see whether all of these people that I mentioned, will they be reappointed unanimously, or will there be new people who will be inducted into Tata Trust? So possibly we could see some fresh faces, but clearly a lot of changes underway within Tata Trust, which will have a long-term implication over the next 5 to 10 years.
All right, Parikshit, many thanks for joining us. And staying with the House of Tata, Tata Motors has given a facelift to its compact SUV Punch. The starting price of the upgraded vehicle is 6 lakh rupees. The company's MD, Shailesh Chandra, is optimistic about the new year with more new launches in the pipeline.
We are entering the year with new launches. Sierra will add to our volumes. Punch, which is one of the highest selling cars from us after Nexon, gets a significant, uplift. And therefore, multiple launches which are going to come throughout this year, whether you talk about EVs or ICE. So all the cylinders would be firing, I would say, and all the motors would be, giving that whining noise. So it's a good year for us.
Well, staying with auto, passenger vehicle sales increased nearly 27% on an annualized basis in December. That's according to SIAM data. Sales of motorcycles and three-wheelers grew in double digits. The growth momentum also extended to the export market. Total vehicle exports climbed around 21% on a year-on-year basis. Well, up next, NSE gears up for its long-awaited IPO after SEBI chief hints at a green signal this month. A special analysis coming up. And you can catch all of CNBC-TV18's news and updates on YouTube, Facebook, Instagram, X and Geo Hotstar. Subscribe to CNBC-TV18 Access for our exclusive stories.
And 50, there is a market at every price point. The reason we haven't entered that market yet is because we know this market better and we want to play to the strength right now. So in our scale up the next 3 to 5 years, we want to continue to play in this price point.
So what have been some of the big learnings, of the last 15 years in terms of customer behavior, in terms of customer expectation, also in terms of customer fulfillment? Because, so far the Indian marketing community or the Indian sort of entrepreneurial community has been servicing the demographic dividend, because that is what we have been accustomed to believe, that India is a young market, India is the youngest democracy, and so on and so forth. For the silvers to open up as a market has been a fairly recent phenomena. What have been some of the learnings on account of it?
So having done this for 15 years, I'm now starting to see this demography wanting to spend. In the early years, it was still it was a previous generation of 60-year-olds. And so when we were selling, there was always a...
WhatsApp and its parent company Meta have moved India's Supreme Court, challenging the competition regulator's order that charged them with abuse of dominant market position. The petition has also challenged the NCLAT's judgment upholding the competition watchdog's penalty of 213 crore rupees. CCI had charged Meta WhatsApp with abuse of dominant market position, citing the 2021 WhatsApp privacy policy. WhatsApp 2021 privacy policy allowed for user information to be shared with Meta and did not allow users to opt out, gave no opt-out option to consumers. And speaking of Meta, the company is planning to cut more than 1,000 jobs from the Reality Labs division. As per Bloomberg, this move is part of a plan to redirect resources from virtual reality and metaverse products towards AI. The cuts are expected to hit roughly 10% of employees within the impacted divisions. Tech giants Apple and Google have committed to a multi-year AI partnership. Google's Gemini technology will now be incorporated into Apple's AI-powered Siri, a major update that is expected later this year. In a statement, Apple has said that Google's technology provides the most capable foundation for Apple's models. And speaking of Google, parent company Alphabet's market cap has crossed the $4 trillion mark as of yesterday's closing. The company has now surpassed Apple and Microsoft to become the second most valuable company in the world. Alphabet is the fourth company to hit this milestone after Nvidia, Microsoft and Apple, Nvidia right at the top, Alphabet coming in at number 2. Back home, NSE is gearing up for its long-awaited IPO after the SEBI chief hinted at a green signal this month. The stock exchange eyes a market cap of nearly 5 lakh crore rupees, which will make it the 11th biggest listed company in India. Nimesh is here with a deep dive into the NSE IPO. Nimesh.
I'm putting the spotlight on NSE and in terms of numbers and what are the key metrics to watch out for. Now, the total outstanding shares of NSE after the adjustment of bonus shares is 247.5 crore shares. I'm taking an unlisted current price is around 2,000 rupees, which means that NSE will command a market cap of 4.95 lakh crores as in if it listed around 2,000 rupees per share, which is nearly 5 lakh crores of market cap for NSE. Now, we all know that the self-listing is not allowed. So obviously, NSE has to be listed on some other exchanges. Just for an example, I've looked at the BSE top 30 companies. Only 10 companies are actually commanding a market cap of more than 10 lakh crores. So assuming it lists on BSE, it will be among the top 10 companies for sure, as and when NSE lists. So that's just a number to watch out for. Now, in terms of earnings and what are the valuations for NSE? The first half of FY26, NSE reported an EPS of 25 rupees. For the full year estimated, Street is anticipating 50 rupees of EPS. And for FY27, I just took the BNK estimate, and they were estimating 51 rupees of EPS. Now, given that if it earns 51 rupees with a market cap of nearly 5 lakh crore, NSE would be quoting at a multiple of close to 39 times. Now, let's compare this with the Indian peers. BSE, MCX and IEX, the other 3 listed entities. BSE on FY27 earnings is quoting at close to 43 times, MCX is at 48.5 times, and IEX is close to 25 times. So that's the valuation metrics for NSE versus the Indian peers. Now, I've also looked at NSE's comparison to the global peers, the likes of Hong Kong Stock Exchange, London Stock Exchange, the NYSE and others as well. Versus NSE at 39, all others are between 20 to 25 times. But it's not a like-to-like comparison, so to speak, because the growth metrics, the earnings metrics are way, way different for NSE. For example, Hong Kong Stock Exchange last year grew at just 4%, and NSE is growing at almost 40-50%. So that's the kind of growth NSE has been reporting. Now look at the shareholding pattern. This is going to be quite important because all will be selling shareholders in NSE. It won't be an IPO, it will be a FPO. LIC owns the highest stake in NSE at this point in time, close to 10.7%. And remember, LIC is listed as well. Stockholding Corporation owns 4.4%. SBI Capital owns 4.3%. SBI, the bank, owns 3.2% stake in NSE. The likes of GIC owns 1.6%, Oriental Bank 1.4%, and New India Assurance own 1.4%. Some of them are listed entities as well, so they will be selling shareholders. So watch out for value unlocking for all these companies. If you just look at the overall shareholding pattern, the PSUs, within the PSU basket, the PSUs in total own close to 31.3% stake in NSE. Within that, the insurance company is 17.5%. Of course, LIC is the highest in that, 10%. Financial firms own 8.9%, and banks own close to 4.5%.
All right, Nimesh, many thanks. That's the data there on NSE's ownership as we look forward to that big proposed IPO. Back to the CNBC-TV18 Market Forum. Chief investment officers at top mutual fund houses have given us their outlook for the new year. Some expect earnings growth to pick up pace. Some remain confident about the IPO market. But there is a word of caution for investors as well. Take a look.
From a near-term perspective, we have seen extraordinary spike happening, and I think it's a euphoric move. I will not call it a bubble. I will not call it a maniac phase. It's a euphoric phase, which means the correction is around the corner. It's not happened yet, but this is a worry which we have.
And I think there were 3 headwinds which caused correction over the last 15-18 months, and all three are receding, in fact, turning favorable. One is related to macro environment, both globally and domestic. Then related earnings momentum, which also slowed down. And of course, the valuation premium also. Valuations were high about 15-18 months back. So on macros, all of us know there has been massive sort of turnaround or stimulus, both from the fiscal side. A monetary engine has been firing. We have income tax cuts, more money in the hands of people.
That over the last 2 years, we participated in something like 35 IPOs out of 120 odd, which basically are at a cutoff of more than 500 crores of issue size. Okay, and out of which about 70% of them have made money for us. 26 odd out of that 35 have actually made money for us. And more importantly, I think that from an investing culture point of view, I think there are only 4 IPOs from which we have completely exited today.
Okay.
So 31 are the ones which we have actually still retained in some form or the other. So that is a view that we take on IPOs. I mean, IPOs are not about, for us at least from our standpoint, it's not about flipping. We essentially met the same treatment to IPOs the way we do to any other secondary market listed entity.
Well, top CIOs with their outlook for 2026, and you can catch that conversation right here on CNBC TV18. Visit CNBC-TV18.com. We have all the market calls there for you. Read at your own leisure, and of course, visit our social media pages. We've got plenty there for you. With that, it is time for us to wrap up this edition of India Business Hour. Thanks very much for watching. The news will continue right here on CNBC TV18. We're going to track the global developments and bring you the big stories from India as well. For now, goodbye.
Spend on yourself. And spend on yourself with wellness. That was something that just didn't exist. So what was our fundamental offering in Antara Dehradun as an example was, a beautiful place to live. What we believe was also beautiful infrastructure and a promise that as you get older, the services would kick in to keep adapting to those needs. And so 10 years hence, the population is 10 years older. So those who moved in at 62, 63 are now in their early 70s. And we have a fair amount of people over there living that are over 80. So I think the expectation now is that we want the wellness and what we call life care elements to kick in. And that was always the vision and the promise. We were never going to be an offering that said beautiful place to live, great food, learn a language, socialize with each other, do yoga, go for a walk. That's hygiene now. Now it's all about the wellness in terms of care, not just wellness in the way we know it today, but care. And so I think what sets us apart is that we will always be the player that looks at the longevity and long-term care of our communities. So whether it's the quality of the food that we serve, or the nursing, or the doctor care, or the way we do preventive care, or the physical aspects of it, for us, the expectation has now become care, and we're ready to fulfill that completely. And people are...
The market closes on a mixed note. A sharp recovery in the final hour ahead of weekly expiry helps limit losses. The Nifty holds above 25,700 mark, while the Bank Nifty holds on to its gains.
US President Trump announces a 25% tariff on countries doing business with Iran, says the new tariff is effective immediately. Indian rice industry could face an impact with basmati exports forming a significant share of shipments to Iran.
The rise of the Gen Next at Tata Group. Sources say 32-year-old Neville Tata, the son of Noel Tata, is likely to be inducted into the board of Sir Ratan Tata Trust this week. He is already on the board of Sir Dorabji Tata Trusts. Both these trusts own more than 51% stake in the group's holding company, Tata Sons.
Hello and welcome to Markets Forward, your go-to show where we aim to get you all of the key data points to gear up for the next trading day.